having an impact of the sell-off that you're seeing across the global indices. 318 points lower is what the implied open is suggesting. At one point, that figure was almost 360 points. So we are still around about 320 points down on the implied open, which means if these losses hold, we most probably open right at the mark of 23,000, and that is going to be an important level on the downside that the bulls would look to defend to prevent a further fall towards levels of 22,700 or 22,800. So it's right across the screen. There is absolutely no place to hide as of now. The bulls would hope that the situation perhaps improves as we go into the second half of the day. But let's get you the latest on the US-Iran war. Israeli air forces have struck military targets in western and central Iran in response to Iran's missile attack against Israel. An Israeli army spokesperson said they are prepared for any attack and are strongly prepared on the defense and on the offense as well. Earlier, Iran fired ballistic missiles against Israel. Iranian Parliament Speaker MB Ghalibaf said that the naval blockade and the violations of agreements regarding Lebanon amount to violations of the ceasefire. The Iran's Revolutionary Guards called the attack against Israel a warning. Now, Israel intercepted most of the missiles fired by Iran, and the Israeli military said that Iran made a grave mistake by attacking them. Meanwhile, US President Donald Trump in a telephonic call had urged the Israeli Prime Minister Benjamin Netanyahu to not respond to the latest Iranian attack. In an interview with the Financial Times, Trump said that Netanyahu will not have any choice but to accept a deal that the US negotiates with Iran. Meanwhile, in an interview to NBC, Donald Trump also said that they are very close to signing a deal with Iran. Listen to what he had to say.
We're very close. We have a couple of points. They don't even seem like big points. They've conceded the fact that they will not have nuclear weapons. We had a clause in there that we will not develop nuclear weapons, and everybody was very happy with it except me. And I said, well, what happens if they not develop, but they go out and purchase, they acquire? I want to put the word, if they buy or purchase or acquire, you've got to have that in there too, because that's not developing.
So that would come after.
Comes after, yeah. If
they
behave,
turned
if they
over
do a
their
good job, we
nuclear
start
enrichment.
talking, yeah.
And based on all of these developments, the most immediate impact has been on oil prices. Both Brent and WTI are trading with strong gains earlier this morning after almost falling to levels of $90 a barrel late last week. Manisha Gupta is now joining in with all the updates from the commodity space. Manisha, good morning. Oil is on the rebound yet again.
Oh, it is. Last week was all about mounting hopes of a de-escalation in the U.S.-Iran conflict, but all of that seems to have changed over the weekend, and Asian markets today have opened nearly 3% on the higher side, where we're looking at $96 a barrel, back in case of the crude oil prices. U.S. also has criticized Israel's strikes, as you were mentioning, urging Israel to avoid retaliatory reaction against Iran. And markets also are looking at OPEC Plus now approving July oil production quotas by 188,000 barrels per day. So while OPEC has been increasing production on paper, on ground, not much has been seen. That is something that the markets will take cognizance of. And this latest round of conversation and attacks now will continue to add a premium to prices. Most of the banks and brokerages already have been saying that they see crude oil prices between 95 to 105 if the status quo continues. But if something of a conflict yet again arises, then you're looking at 110, 115 of a level as well. Remember, Strait of Hormuz continues to be shut even as we have entered June, and that premium will be in case of crisis. But that's about crude oil prices. You must look at the kind of decline that we've seen in precious metals. Gold fell 5% in the previous week. We are trading at 4,300 right now. Silver fell 10% in the previous week, and we have broken below $70 an ounce. Sharp decline in copper on Friday, down by 4%. Platinum fell 6%. So very sharp declines coming in for the metal prices, precious and industrial.
Manisha, thank you for that update there. Oil prices are back on the rebound yet again. Both Brent and WTI trading with gains of around 4%. Take a short break. On the other side, we set you up for today's trade and tell you how our own markets are likely to start off today. Stay tuned. Welcome back, and it's time to set you up for today's trading session. Our research team is here to tell you the important market cues that you need to watch out for today, the stocks that should be on your radar, and of course cues from the F&O side of things as well. First up, Sonal is here to tell you all the market cues that you need to watch out for. Sonal, good morning. It looks like it's not going to be a very good morning after all.
It isn't going to be. So many things that happened over the weekend, right? Not a very positive handover is what we got from the Wall Street. A sharp fall in US markets on Friday. NASDAQ down 4%, biggest single day drop since April 2025. It is a stronger than expected jobs report data for May. US Treasury yields surging, all of them coming together, which led to that sharp fall that we saw in the markets as well. S&P was down 3%, Dow down 1.3%. Iran reportedly fired missiles at Israel, and this is something that you've been discussing. And it was the 100th day of the West Asia war this weekend, this Sunday that is. The complications continue for global markets and economy as well. As far as Asian markets are concerned, no relief there as well. Kospi, which has been the darling of investors, saw a sharp fall. It is down around 8%. Nikkei is down around 3.5%. So the backdrop is not looking very strong as far as our own markets are concerned. For India, on Friday, we did see DIs net buying again around 9,100 crore rupees. FII sold around 8,700 crore rupees. Basically, they coordinated yet again to give us a net figure again. Rupee posted strong single-day gains since April 2, appreciated 85 paise on Friday on back of a host of policies announced by the RBI and the government as well. For now, the Nifty support comes in at 23,200. There is a strong resistance at 23,550. So it crosses that. We could see levels of 23,800, 23,900 as well. It would be a very stock-specific market this week. Not a lot of triggers domestically otherwise as well. But crude oil prices, they are higher in trade. Of course, because of the escalations yet again, and OPEC Plus has approved fourth oil output quota hike since Hormuz closure, which is at 188,000 barrels per day from July. So keep an eye out on all of that. GIFT Nifty, that rate will come up on the screen, indicating the start for our own market. Yes, the focus continues to be on the West Asia war for our own markets. It could be very stock specific.
Gap down indeed. 312 points is what the implied open is currently suggesting. Sonal, thank you for setting that up for us. Over to Ananya now, who will tell you the stocks that should be on your radar today. Ananya, good morning.
Good morning. So here are the stocks likely to be in focus as the trading resumes today, starting with Adani Enterprises, where GQG Partners sold a 1.3% stake worth 4,760 crore through a block deal with SBI Mutual Fund acquiring the entire stake. Now, Z Entertainment will also be on investors' radar after the company said its board will meet on June 10th to consider raising funds through an equity issuance. The stock has already gained nearly 19% over the last three sessions. Now, Tata Steel is in focus after clarifying that a fire broke out at its subsidiary Tata Steel UK facility in Wales, with the company currently assessing the operational and financial impact. Now, TVS Motor announced that its HLX motorcycle franchise has crossed the milestone of 5 million cumulative sales globally across more than 57 countries. Among other stocks, Alembic Pharma will acquire a 45% stake in a Canadian venture, while JK Cement executed a mining lease for the Mahan Gold Mine in Madhya Pradesh. AJ Infra received the completion certificate for its 4,971 crore Ganga Express Highway project. Railtel secured a 41 crore order from the Uttar Pradesh Police Recruitment Board. Ether Industries received the final insurance claim settlement related to its 2023 fire incident, and EMS emerged as the L1 bidder for a 103 crore project from UP Jal Nikam. So these will be the stocks in focus in today's trading session.
Ananya, thank you for that list of stocks that you should be watching out for. And finally, over to Sudarshan, who is here with cues from the F&O space on what promises to be yet another gap down start. Sudarshan, good morning.
Good morning, Harmas. So if I just had to track Friday's data, I would have easily told you that it can be one of the good days for the market, and we would have seen a completely close, not only in the green for market, not only for Nifty, even for the broader markets. But how the things have turned out over the last 48 hours, we are seeing a big fall in the global markets. Look at the Kospi, down more than 6%. Similar fall is seen with Nikkei, and it's all on the back of the sharp fall we are seeing in the chip stocks. But talking about FI data, The short positions FIs have in the Indian market are at the highest levels that we have seen since April 6. It's not that bad. So it tells you that if there can be any positive news, there can be a short recovery or short covering at the same pace. So in the index futures, while they were sellers, but in the stock futures, they were buyers of more than 620 crore. If you take a look at the long position, they have reduced by 2,200 crore. But on the short side, addition is just 925 contracts. That's the lowest additions that we have seen in the last few weeks. In the options data on the put side, 23,050 and 23,000 were the most active put options with an increase in the open interest. And on the call side, 23,700 and 23,500 have seen maximum increase in the open interest. So narrow range for Nifty would be 23,000 to 23,500. GIFT Nifty is indicating you that we might open below 23,000, but I still feel that Nifty would protect the levels above 23,000. So support I have taken. First support 23,150. Next support comes around, if we fail to hold 23,000, next support comes around 22,540. Resistance would be 23,500 and 23,700. Two stocks remain in the band, Amba Enterprise and Keynes. Of the stocks that have been saying unwinding, long unwinding or fresh shorts, MCX long unwinding, and Natco fresh shorts, and Adani Energy has been saying fresh longs.
Indeed, metal stocks will be the ones to watch out for as well today, considering the strength in the US dollar. The dollar index is now at 100. Darshan, thank you for that update there. And over to Wall Street then. It was a painful session on Friday. The Dow falling over 700 points. The Nasdaq was down over 4%. Selling was concentrated among most technology names. And of course, all of them hot. Nvidia, AMD, Micron, all of them down anywhere between 11 to 13% on Friday. And more importantly, a hotter than expected May jobs report also fueled fears of a hawkish policy pivot from the US Federal Reserve. CNBC's Peepa Stevens gets us a wrap of all the action on Wall Street.
U.S. markets were down sharply across the major indexes in Friday trading after a chip stock sell-off broke the S&P's 9-week winning streak. The Dow fell 695 points, the S&P was down by 201 points, and the tech-heavy Nasdaq falling more than 4%, and seeing its worst day of the year, dropping 1,122 points. Job growth surged in May, according to the Labor Department on Friday. Employers added 172,000 jobs compared to the consensus estimate of 80,000. The unemployment rate held steady at 4.3%. Leisure and hospitality led the surge, adding 70,000 jobs, while local government and healthcare also posted solid gains. The strong jobs report also sent stocks lower, as it pushed expectations higher that the Federal Reserve could raise rates by the end of the year. And CNBC confirmed Friday that OpenAI CEO Sam Altman and the White House are having ongoing talks about a possible government stake in the AI company. A source tells CNBC Altman first shared the idea last year, and the talks continued this week as Altman met with lawmakers on Capitol Hill. News site Notice was first to report the talks. One of the potential ideas being considered is a public wealth fund in which Americans could participate in AI growth by getting returns directly from the fund. President Trump said he is meeting with AI companies probably next week about the proposal. That's what's happening here in the U.S. Back to you in Mumbai.
Peepa Stevens, thank you for that update there. Take a short break. All the updates from the world of AI. No better day to get that. On the other side, stay tuned. Welcome back. On to all the updates from the world of AI in our special segment, the AI Pulse. Rachna is here with all the latest. Rachna.
Well, first up is Google, that's paying SpaceX nearly $1 billion a month for AI compute. But it is quite ironic because Google has its own TPU infrastructure custom built for AI workloads. But now reportedly, demand for its Gemini enterprise agent platform has certainly outpaced even its own build rate. So the company is renting roughly 110,000 NVIDIA GPUs from SpaceX at $920 million a month from October this year through June 2029. A contract worth approximately $32 billion. It mirrors a separate deal Anthropic struck with SpaceX in May, paying $1.25 billion a month for the full output of the Colossus One data center in Memphis. But the timing is interesting because both the deals have been disclosed ahead of SpaceX's planned IPO, the roadshow for which begins today. Also underway today is Apple's WWDC 2026 keynote. It is Tim Cook's most consequential as CEO and his last. Cook steps down September 1, handing over to John Turnus. The headline is expected to be a full Siri rebuild powered by a custom 1.2 trillion parameter Gemini model, with Apple paying Google roughly $1 billion a year for access. The existing OpenAI partnership also continues and expands. Under iOS 27, users can now will be able to route Siri requests to ChatGPT, Claude or Gemini via a new extensions setting. Apple has been promising a smarter Siri since WWDC 2024, so we'll just have to see what happens this year. On the boardroom front then, LinkedIn co-founder Reid Hoffman is stepping down from Microsoft's board after nearly a decade. He joined in 2017 following Microsoft's $26.2 billion LinkedIn acquisition and was there for the company's first $1 billion investment into OpenAI. He's now returning to what he calls founder mode. In a related talent story, then, Clive Chan, the second hire on OpenAI's custom chip program, has moved to Anthropic as a member of technical staff. OpenAI's accelerator, built in partnership with Broadcom, remains on track for deployment in the second half of this year. This was the project that Chan was heading. South Korea has now nominated Hon Seong-suk as Prime Minister, which would make her the country's first female Prime Minister in 20 years. A former CEO of internet giant Naver, Hon is currently Minister for Small Businesses and Startups. This is also a transformational year for South Korea when it comes to AI, so having a tech CEO would make sense as the Prime Minister. And finally, then, Amazon is putting conversational AI on its warehouse floors. The company unveiled a next-gen Proteus robot as a part of a €10 billion investment, which is a part of the broader European announcement. The announcement comes as Amazon has cut roughly 30,000 corporate roles since October. That's all from the world of artificial intelligence for now, but we'll get you more updates through the day.
Indeed, and more so considering the fact that we are gearing up for the biggest IPO in history, and that of SpaceX. Rachna, thank you for that update there. Take your leave on this edition of Power Breakfast. From me and the team, thank you for watching. Bazaar Morning Call on the other side sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Well, I'm not in the studios, as you can see behind me. Of course, is the backdrop of ICICI Securities' India Investor Conference 2026 happening right here in Mumbai. It's going to be an exciting next 2 days of conversations, and CNBC TV 18, of course, exclusive partners for the conference, and you'll get lots of conversations through today and tomorrow, Monday and Tuesday, from here at this conference. But, well, it's been a pretty consequential Friday for U.S. markets, and I think this morning there is a fair bit happening as well, which we need to cover. With me, my colleagues Nigel and Mangalam. Guys, hi, morning.
Hi, morning, Prashant, and good to see you at the conference. I'll catch up with you later. But Mangalam, welcome back from the United States of America. Hope you put in a word for us, but good to have you back, mate, as always.
As always, and I have to say that out there in the United States on the road, there is no such inkling of any sort of things that they've, done to the world, and they're not feeling any of that. It's consumer sentiment fairly high, stock market fairly high. I had the rare opportunity of seeing the Dow Jones actually open from Wall Street and open at a record high as well. I did pray to the bull. I did go to White House. I did go to Capitol. I saw all of that, made my prayers. The only thing that I hope, along with me, some FIIs come back because, all of last week and the weeks before that also, there was a lot of selling.
Good to have you back, Mangalam. We've got a markets to contend with. And Prashant, it seems Mangalam has done some various, he's touched the right spots, looks like. Hopefully it turns out to be something positive from an India perspective. But let's get straight to the action.
Well, it was a sign of things to come. Mangalam took the plane out of the US and the US was down 4%. So he's here now, and will hopefully, some of those percentage points show up as gains here. But anyway, let's take it from the top then, right, as we always do, because there is a fair bit to track. And Friday, after a long time, we saw a pretty sharp cut. The Nasdaq was down 4%. It wiped out 2 weeks worth of gains, the prior 2 weeks worth of gains, and was the worst one-day fall since April of 2025. The question is this, and I think this is something which we will keep asking our guests. Was this a healthy reset, or was this a warning shot? A healthy reset or a warning shot, right? And I'll tell you straight up, I think it was a healthy reset, to a lesser degree as compared to calling it a warning shot. I'll explain why in just a bit. Now, remember, the backdrop is this. U.S. markets, tech particularly, had seen this frenzied rise before. The SOX index, which is the semiconductor index in the U.S., was so overextended that it was trading, as of just last Wednesday, 75% above its 200-day moving average. That is how far away from the long-term moving average that the index was trading at. And of course, that took a large hit as well. SOX was down 10% on Friday. Now, this is the interesting bit. The S&P ended down 2.6%. Nasdaq was down 4%, but the S&P was down 2.6%. But if you take a group of stocks, S&P 500 stocks, and take out the AI element from it, it was absolutely flat. It was actually unchanged. Friday over Thursday. So it is AI, it is Mag 7, it is that entire semiconductor bunch of names, which has done phenomenally well. And, we've seen this in the past. When you have these phenomenal rises, the corrections also feel, pretty shocking. And this morning, for example, Kospi is a case in point. Kospi is down 6% as we speak. Now, the other bit, of course, was the U.S. jobs data, which came through, and that came in very strong. The 2-year was up about 11 basis points. The 10-year jumped 6 basis points. And the natural response for the market is, by the way, after these data points, markets are now pricing in, a full rate hike in 2026. At least what we will see, I think they will hesitate to hike because of pressures from President Trump, etc. But a longer pause is very much on the cards as far as the US Fed is concerned. The other headlines have all been kind of building up below the surface. You had Broadcom, the giant chip maker, which is down 20% over the last 2 days, which is over Thursday and Friday. There were these headlines from Anthropic, recursive learning kind of, and Anthropic itself in that research paper highlighting that there's a big problem. They're saying research labs around the world should now take a pause because it's getting serious. Well, we'll talk more about this, but all of this, I think, was a bit of a reality check, whatever you want to call it, right? But all of this contributed at the margin. There is, of course, continued focus on equity supply in the US. Google, for example, raised $50 billion. But that is only the first of many to come through the course of this year, all the way into the end of 2026. The other bit, of course, is US-Iran. It's been 100 days as of yesterday of US-Iran conflict starting, and there's no end to sight. It's like a game without an innings, and it's kind of sort of goes on in 100 days now. And this fresh development, and this seems pretty serious. Now, Israel struck Beirut, and Iran retaliated against Israel by firing a wave of missiles at Israel. Now, President Trump is jumping in, and he seems to be trying to calm the situation. There are comments which the Financial Times is reporting saying, and this is verbatim, we perhaps will play some sound bites as well, I call all the shots, Netanyahu doesn't call the shots. So he's basically saying, you fired your missiles, now get back to the table and try to strike a deal. We'll see how it goes. But by the way, oil this morning is up. I think Brent is up to about $96 a barrel. Once again, it's up about 2.5%, 3%. Now I just come to the local bit, right? Because that is also equally important. Rupee strengthened sharply, about 0.9% on Friday. And all the measures which the Reserve Bank of India announced, and we'll talk more about this as we go on, the FCNR, the ECB, the relaxations which have been provided. Market participants say these measures could basically generate or attract inflows of between $65 and $70 billion in over the next 3 or 4 months or so. And this is the context, right? Estimates of India's current account deficit is about $75 billion in 2026. So let's see how much they're able to raise, but it's pretty large. And for a moment, that equation suddenly looks balanced. So something to sort of keep an eye out on. I think just to tie in the levels here, they don't change very much. The Nifty support zone is now in the area between 23,150 and 23,270. This is nothing but that gap zone which the market kind of got to but did not break. So 23,150, 23,270, we are just above that level. And of course, the first resistance, if the market's got to do anything good, is got to take out 23,800 on the upside. I think GIFT Nifty gives you a quick sense of how we're likely to start. And then we will pick it up from there. I think we're down about 1% or so to begin the session. 300 points lower is the implied open on the GIFT Nifty. Nigel has walked across to the wall with the F&O stats and the positioning. Nigel, take it away.
Well, going by what the GIFT Nifty is suggesting, a sharp downtick is what we are bracing ourselves for. The bulls will be hoping actually that we end off those lows. But what's weighing on global equities? One is the geopolitical tensions. Who calls the shots? Whether it's Netanyahu or whether it's Mr. Trump. And also the sound bites that are coming overnight are making you a little bit jittery. So that's point number one. Second factor is the AI trade is unwinding a little bit, and maybe some are making space for the SpaceX IPO. But both those two, seem to have derailed the equity markets to some extent. From an India perspective, what do we track? We track Brent crude prices. That has spiked up overnight, but that's still holding above, above the $95 per barrel mark. Let's pull up crude oil prices. Well, that's holding above that mark, but it's still below the $100 per barrel mark. And the Indian rupee is going to be extremely important because economists are talking about roughly around $50 billion of inflow, which is essential because the Indian rupee showed some strength in Friday's trading session, and you want more stability, more of the same, because that's been a sentiment point, and also that's been another factor that's been weighing on equities as well. How do you expect FIs to come in if you have the rupee sliding one way? But the FIs in Friday's trading session, they sold yet again, closer under $1 billion. That's offset by the DIA buying. However, since the rupee is strengthened a little bit, you'll be a little bit more optimistic that the FI selling actually cools off, and maybe you're throwing in the carrot out there to turn buyers at some point of time after the big underweight stance that they've taken on India. Moving to index futures, what do they do out there? They unwound some long positions this time around, and they added some minor shorts. The short position, remember, is holding at around 92%. That's the highest we've seen all the way since January. And if you look at the FIs as well as the clients, they're at both extreme ends. The client positioning, that's the highest we've ever seen at around 2 lakh contracts on the long side. Well, the FI shorts are moving to the highest that we've ever seen at around 2.7 lakh contracts or thereabouts. So both of them at opposite ends. You need a trigger to force these FIs to go ahead and cover some shorts. Remember, they went ahead and they wrote some calls as well. So that's telling you their positioning is fairly defensive. So one you'll be tracking is the FI positioning reaching those extreme ends. The other factor is the PCR. That's come down to around 0.8. We have seen in the past when the PCR comes down to around 0.65 to 0.7, like we saw last week, we saw a bit of a bounce. So extremely important to track this PCR. Well, in terms of options, you have two strikes that are active, 23,500 call, aggressive writing being seen out there. But there were some signs of buying at around the 23,050 put, which the premium moved up to around 25 or thereabouts. Some kind of protection buying in case things go wrong. Which brings us straight to the levels. Last week's low becomes important, which is 23,150. We could start off below that mark, but by the end of today, you want to defend that particular mark. And going by the options data as well, this 23,000 mark is an important mark on the downside. Resistance very aggressive at 23,600, 2050 DMA, both in that vicinity. But the Nifty Bank, that will have to play an extremely crucial role if we have to fight back today, because it took out a couple of technical levels. You know, it trades mildly above the 20 DMA, and it's around the 50 DMA as well. So today it starts off in the red, but you'll fancy your chances that this one, in fact, if there's going to be a fight back, then the Nifty Bank could lead from there. And we'll also keep an eye out on the other pillar, which is the tech index. Rank underperformer, you know, the Nasdaq has outperformed in a big way. But if this AI trade is going to lose some momentum, some would believe that maybe, in fact, you know, the Nifty IT index at around this 28,000, 20,500 odd could see some kind of buyings. Stark underperformance till now. Can it reverse that? Well, time will tell, but we'll keep an eye out on this particular index as well, Mangalam.
Most definitely, Nigel. We will monitor how the gap between the Nasdaq as well as the Nifty IT pans out. And as we speak, you know, the important part is the latest on the US-Iran war. In an NBC interview, US President Donald Trump says that they're very close to signing a deal. Let's hear out what he said and then get to our market expert.
We're very close. We have a couple of points. They don't even seem like big points. They've conceded the fact that they will not have nuclear weapons. We had a clause in there that we will not develop nuclear weapons, and everybody was very happy with it except me. And I said, well, what happens if they not develop, but they go out and purchase, they acquire? I want to put the word, if they buy or purchase or acquire, you know, you've got to have that in there too, because that's not developing.
So that would come after.
Comes after, yeah. If they behave,
turned
if they
over
do a
their
good job, we
nuclear
start
enrichment.
talking, yeah.
Right, that eventful interview with Donald Trump from NBC. But let's get in Arvind Sanger, who's the managing partner at Geosphere Capital. Arvind, good morning. You know, so much has happened. 100 days since the war, no end in sight. Still, no one believes that it will last beyond 6 months because the world can't afford it right now. But if you look at the prices, you know, the US indices have moved way past that, and the trade has moved towards AI. That too is now unwinding a little bit, perhaps making space for the large IPOs that are around the corner. Amidst all of this, what's your sense on how global markets are likely to pan out? What does the very near term look like? And India, what happens to that?
Well, there's a lot of questions, so let's try to unpack it one at a time. Firstly, I would say that when you look at the oil markets, one of the things that your discussion didn't touch on is that despite President Trump saying that Israel and Benjamin Netanyahu will not do anything because Trump is in charge, or something to that effect. Well, Israel just in the last half an hour has struck a number of targets in Iran, including in Tehran. So clearly, Israel is showing that it's not going to be sitting there, and taking blows from Iran. And so there's a risk of this ceasefire unraveling and things getting worse. So I think the oil markets, first of all, in the very short term, are now, just reflecting that concern. Secondly, I don't think there's anybody who believes Trump, although the oil markets probably have believed him, that a deal is around the corner. So, President Trump has been promising Godot now for weeks, if not months. And the Iranians are very clear that they need some immediate relief in terms of cash. 12 or $24 billion being released, and President Trump has been unwilling. So I don't think a deal is imminent. And I think our biggest concern in the short term is that the oil markets are still behaving as if the Strait of Hormuz opening is imminent. And if the Strait of Hormuz stays closed through the end of the month, which in our opinion is the central case today, it's a central case, then oil is headed much higher. And then we come to markets. And, the AI trade in the US has worked and it has shrugged off other concerns. Friday was a bit of a profit taking, but AI trade is pretty much being driven by all the, good news coming out of Anthropic. And now we've got SpaceX IPO. So, and all the news that have been coming out about chips and everything else. So the AI story continues to be very strong. But I think if oil is going to go much higher and goes towards 125, 150, which is quite likely if the strait stays open for any extended period, then I think you could see some profit taking in general in some of these high-flying areas. And when we come to emerging markets, including India, which is probably one of the most sensitive from a current account deficit, I think buying the Indian market in advance of having any clarity on what's going on in the in the Strait of Hormuz and how long this might stay closed is, in my opinion, a very risky enterprise. So we're staying a little bit circumspect because we are concerned about the near-term trajectory of oil markets.
Okay, so Arvind, hi, morning. So you're saying that markets kind of underpricing this entire event. And you're absolutely right. I mean, they want to believe that this is just so close to getting done, and the strait is going to open. But it's been 100 days of this, right? I guess markets are optimistic creatures. But oil, either it's there or it's not there, right? So at some point, the inventories will run very, very low, and markets will have to price higher. Let's hope it doesn't come to it, but otherwise they've been pretty well behaved at about, from obviously over the last 2.5 odd months or so, even though there's been no resolution. Arvind, the Friday's US action, right? The NASDAQ down 4, the SOX index down 10. How do you read it? Was it like a healthy reset, or this is a warning shot of something bigger coming?
Well, this is a bull market that has had very, very few pullbacks. And it is pretty unhealthy, in my opinion, for markets to have so much euphoria without a few scares along the way. Markets climb a wall of worry. Markets don't climb a wall of complacency, because that becomes, dangerous. And so we were climbing kind of a bubble of complacency. And I think the fear that we got on Friday, I don't know if it's going to mean further pullback for the next couple of days. It's possible. But I don't think the AI story has yet sprung a leak. But I think the real issue is Meta announced, or there was news story that Meta is also thinking of a large equity offering. So I think you do have a problem here when companies which were heretofore extremely cash flow generating are now forced, because of their excessive or aggressive capex needs for AI, they're forced to go into equity markets after a long, long time where they've not needed to address equity markets. So I think that, to me, is the bigger concern, that these bellwethers are now all issuing equity, in addition to obviously SpaceX coming, and then Anthropic and OpenAI coming beyond that. So I think that the AI story may be strong, but the capex and the lack of free cash flow is raising some concern about the Mag 7 and some of these other stocks, and how high they can fly while there's all this equity issuance coming.
Well, Arvind, the US markets have been rank outperformers, and they've been backed by good earnings as well. But if you look at various data on the credit front as well, the delinquencies are moving up out there. Those markets are not very, very cheap. And now you have these fresh offerings that are coming in there. Do you see there's a risk that these US markets actually top out? Because for the time being, you throw anything at those markets, whether it's a war, whether it's the fear of a rate hike, or all these data points as well. Everyone chooses to look at the brighter economic factors. But there is some pain that is emerging on the credit side of things. Do you see a risk that the US market actually could be peaking out?
I definitely, but I've been seeing this risk for the last few weeks. So I've been wrong, because this market is running on euphoria. But the reality is, with these equity offerings coming, and with the established companies raising equity, and the bond market, potentially, if oil goes up, I think the credit risk in some of the private credit is a negative, but I don't think by itself it's strong enough. But if the bond market continues to sell off, and these equity offering overhangs coming, and oil goes up, I think the combination of all three do present a risk that this bull market, having a 10-15% correction in bull markets is normal through the history of bull markets. This market has not seen a double-digit correction, even after the Iran war started. The last one we saw was last year in April, after Liberation Day, so-called Liberation Day. So I think we're overdue a correction. So I definitely think that we are gearing up, the storm clouds are gathering, and we could see a correction which could take it deeper than what we've seen so far.
All right, Arvind, we'll take note of that and let you go on that note as well. While we are tracking the developments that constantly keep happening, it's a dynamic world right now. Let's see where we go from here. Good luck. We have another conversation shortly as well. But as we leave you, let's also tell you what are the other interactions that we lined up on the show today. At 8:35 in conversation with ICICI Securities, Prasanna Balachandra and Manoj Menon from the sidelines of their event. We also have at 9 a.m. Abneesh Roy from Nuvama to put the spotlight on Z Entertainment and their fundraise plans. At 9:20, we do have Sanjay Mukim of JP Morgan, our market master of the day. And 9:30, we will be in conversation with Helios Capital's Samir Arora. Following that, the management of PNB will be chatting with us today at 9:40 a.m. And at 9:50, we have Goldman Sachs' Arnab Mitra and put the focus on the consumption space. Towards the end of the show, Lata speaks to former SEBI whole-time member Anant Narayan and ICICI Pru MF's S. Narain on the markets after the RBI's rupee push. Stay tuned.
Time for a quick break. A lot of stock-specific action is waiting for you on the other side in our special Top 10 segment. We're looking at Divi, Z, Amber. You have EMS, Adani Energy, Sterlite Tech, Updata Services, and Lenskart. All of them will be reacting to positive news flow. Gold sensitives could open up in the red, while you have a mixed view coming in on crude oil prices. Take that break. Come back. We get into further detail on all of these names.
Welcome back. You're watching us here on Bazaar Morning Call. We come to you on this Monday morning with a Gift Nifty indicating a 300-point downtick. As we speak, a lot of important individual stocks on our radar. And as always, our research team standing by with CNBC TV18's list of top stocks for the day. The first one, Divi's Lab. Ekta joins in on what the news is. Ekta.
Morning. Well, I'm watching Divi's Labs this morning because Eli Lilly's drug retatrutide has delivered strong phase 3 trial data in terms of obesity as well as type 2 diabetes. So the drug is likely to be filed soon with the US FDA, possibly in 2027. Now, why exactly is Divi's Labs in focus on account of this? It is expected to be positive for Divi's Labs because they are expected to start contract manufacturing for peptide fragments, which is basically the fragments going into these kind of peptide drugs and likely drug substances in the future for an undisclosed client. So the innovator client, according to a lot of analysts, is speculating that it is likely to be Eli Lilly, and retatrutide could then be a long-term growth driver for Eli Lilly as well as Divi's Labs CMO business.
Got it. Okay, all right. Ekta, thanks a lot for that. Well, let's go across to Vinny. She's here to tell us about some stocks that are on the news. Hey, morning, Vinny.
Hi, good morning. So first up, we have Zee Entertainment that's going to be in focus. Why? Because the board is going to be meeting on 10th of June to consider some fundraising plan. Do not forget the last time they met was in July 2025. A special resolution for this was there, but that had failed to secure the required amount of votes. So because of that, they failed to raise funds. Now again, they're going to be trying for fundraising. We'll see what happens there. Green expected at least today on the screen here. Amber Enterprises, we have its subsidiary, that is InterGlobe Electronics as well as a Singularity, have formed a JV mainly for medical, defense as well as aerospace electronics. In this JV, InterGlobe, that's the subsidiary of Amber Enterprises, will hold 60% stake, while Singularity will hold 40% stake. Green could be seen on the screen here as well. And lastly, we have EMS Limited. Positive news here as well. They've been declared as the lowest bidder by UP Jal Nigam Varanasi for a turnkey sewer network project. And the value of this is 103 crores. It's a contract period over 24 months. So we'll watch out for this as well.
Got it. All right, Vinny. Thanks a lot for that. Well, going across to Sudarshan, he's a busy man as always. Monday morning, a lot of trades he's tracking. Tell us about the block deal data, Sudarshan.
Good morning, Nigel. So we'll start with Adani Energy, which had seen block deals, and that GQG has sold more than 63 lakh shares, and that is 0.5% of its total holding of nearly 3% stake in the company. And the entire thing was bought by SBI Mutual Fund for an amount of rupees 958 crore. Next one is Sterlite Tech, or say STL. This stock is up 500% in 2026, and at this level, Motilal Oswal Fund has gone ahead and bought 36 lakh shares at a price of rupees 619 per share. Next one is Updater Services. In that, SIS has bought more than 4% stake. SIS is a peer company and operates in a similar field as Updater does, and it has done 4% stake block deal for rupees 51 crore. Last one, Lenskart Solutions, in which Copthall Mauritius Investment has sold near 19 lakh shares at a price of 508.55 rupees per share, and this Copthall had bought the same amount of shares on June 3, but now on 6 they have sold, and the entire thing was bought by Viridian Asia Master Fund in Friday's block day. So I'm going with green on all the block days data.
All right, Sudarshan, thanks a lot for that. With that, let's go across to Manisha Gupta. No day goes behind without us looking at crude and gold-related sensitives. Manisha, this morning no different.
Oh, well, absolutely. Last week was a negative week as the markets thought that there was de-escalation between US and Iran, but that seems to have turned around over the weekend. And Asian markets today are trading nearly 3% on the higher side. We are inching closer to that $100 a barrel mark yet again. This is after Iran launched multiple rounds of missiles towards Israel. Iran has warned Israel of any further military action. U.S. in the meanwhile has criticized Israel's attack on Beirut, urging Israel to avoid retaliatory action against Iran. So the markets are reading into that. Further statements from all three countries is something that the crude investors would be looking at right now. The markets do believe that we're looking at higher highs when it comes to crude. 95 to 105 is an anonymous, a level that most people believe that we could be looking at in case of crude prices. Remember, the Strait of Hormuz continues to be shut in the month of June as well, with markets believing that if it is June end and we enter into July with a similar situation, we are looking at perhaps much higher crude prices.
All right, Manisha, thanks a lot for that. So those were a bunch of stocks that we are tracking in today's trading session. The GDP number of the fourth quarter, numbers that came in on Friday post-market, and the slew of policies which are announced by the RBI are very market positive. Ex-EPT, they are coming at the time of falling global risk sentiment. Lata joins in this morning to give us the key takeaways from one, the GDP numbers and the policy that may impact the markets today. We saw signs of that in the rupee strengthening on Friday, but does that continue into this week or not? Lata joins in. Lata, good morning.
Well, good morning. First, the GDP numbers. Actually, there is a huge amount of positivity in the GDP numbers. The number coming in at 7.8 versus our poll of 7.3. The full year numbers coming at 7.7, with even, the MOSPI, RBI, everyone below, 7.6, 7.5. Nobody guessed that this number could be as good as this. And some of the services numbers that really stand out. Trade, hotels, transport, communication, that employs a large number of the Udupi hotels, ST buses. That's grown like 12.5%. So it's a dispersed growth. Likewise, finance, real estate, professional services, ownership of dwelling. Again, a very large service-oriented sector, 10.5%. If you think that is not good enough, capital formation in the fourth quarter is 10.8%, which means that lays the foundation for future growth as well. So, when you look at the overall 7.7% growth of last year, which RBI didn't know when it was forecasting 6.6 for this year, I think there will be an upward bias. The slowdown doesn't look like it is, 1.5% from last year. Therefore, chances are of an upside risk to growth, and you put it in conjunction with the red-hot non-farm payroll numbers of the US. Japan today announcing 1.8% growth against an expectation of 1.4. Everywhere growth is surprising to the upside, so we should be prepared for upside surprises. On the RBI's rupee steps, well, the whisper in the market or the calculation in the market is at least $50 billion. But let me just leave you all with a tinge of worry. Why has RBI not put out the circular yet? Usually when they announce in the policy, by evening the circular is out. So there's a bit of a worry as to, will the conditions be a little stringent or will they be easy? A little bit of unease, but overall the market's expectation is if the rule is as it was in 2013, we are going to get hand over fist numbers. The rupee could go to 93 at least, if not 92.
So look good. Lata is hawking all the time, right?
Lata, thank you very much for that. And, more strength, hopefully more strength, and that's how it's going to pan out. Let's hope for it. Lots of expectations about how many dollars all of the RBI measures can get into the country. We're going to ask some experts right out of the ICICI India Investor Conference 2026 as well. So I'm right here on location, on ground. It's going to be, as I said right at the beginning, at the top of the show, it's going to be an interesting 2 days of conversations, meetings, and we'll get you all of the stuff which comes out of here over Monday, that is today, and Tuesday, tomorrow as well. For now, let me welcome in our two top people from ICICI Securities, the people who've put this conference together. Prasanna Balchandar is head of investment banking and institutional equities, and Manoj Menon is head of research at ICICI Securities. Gentlemen, great to have both of you here. Thank you very much for joining us. So just a quick word, Prasanna, on the conference itself. What are the aim? What do you expect to come out of it? Lots of corporates, lots of investor interest. Although, generally speaking, investor interest in India has been a little low, but they're showing up here.
So, Prashant, first of all, thanks very much for coming over to our location and having us on the show. So, when we started the planning for the conference, Prashant, world was much safer. Yeah. The war was not on, and traveling was easier. Yeah. And we started this theme. And then, all the troubles which have, started for the last 2-3 months, and we've started kind of getting a little nervous on the attendance. But happy to say that the response has been phenomenal. It's a kind of, I think, a testament to the fact that India as a long-term, medium-term growth location and economy is very much there. And we have got a phenomenal amount of interest from corporates and investors seeking one-on-one meetings, more than group meetings, which actually means that they are actively pursuing some kind of investment opportunities rather than just monitoring their investment. So that's one part. The other part is the fact that more than 125, 130 companies are in this conference, and that is a kind of a full house for us. That's how much we invited, and we got full confirmation. More than 800 investors are attending from 300 funds, and a very strong strong DII community, of course, but very good representation from foreign investors as well. And interestingly, foreign investors have come in from multiple geographies, almost all the geographies. So that is also another thing. And most of the guys who are actually present here, on paper, do not have a positive view on the country, but are still here to, explore new ideas, new themes, talk to companies, find out which companies are the ones which have moat and which will be,
And I'm going to ask you guys about which are those areas where there is, maximum meeting requests, right? I think that'll give us a sense. But Prasanna, let's start with the macro-ish question, right? Which is the big one, RBI and what they've done. And hopefully that turns the mood around in a more durable way. Because, markets have not done terribly or anything. It's just that the sentiment has been pretty poor because of, I guess, the rupee and there's a fair bit of self-loathing, if I can put it like that. But so simple question. What are the quantum of dollars which all these measures put together, the FCNR, ECB, and all the other stuff, will help us get in the next 3 to 4 months?
So first of all, we're not an expert in this topic, but I think since we have continuous discussions with various people, whether it's bank treasuries or investors, we have a very informed view of what we think is going to happen. So I think what RBI did on Friday is a bazooka of sorts. Whatever we had suggested, whatever the market wanted, I think they have literally given everything. And if you look at the 3 or 4 measures that they have done, I think getting into removing taxation on government bonds is one, but probably the least effective at this point of time. It will turn out to be a very good one much later when things get better. But the other 2, which is FCNRB and ECB, I think are, with the subsidy being taken over substantially by RBI, is very, very powerful. Just to give you kind of a number, if a bank is looking like borrowing at 5.5%, it's in dollars, but its domestic borrowing rate is close to 7.75 or 7.5. With RBI giving full, subsidy on the hedging cost, your dollar borrowing cost for the bank also becomes your rupee borrowing cost. So that means that the bank can actually go much higher than 5.5 as well to, announce deposit rates on the FCNR scheme.
In 2013, about $26 billion came in, right?
Yeah, that's right.
What do you think? This, just an estimate.
So I think, I'm an optimist. So I do think that this time around, RBI very well knows the cost of these measures. And they will be, following up with banks and, PSUs to figure out how they are pricing their deposits and borrowing. If the pricing is quite attractive for investors, I would say $50 to $60 billion can come over these 2-3 schemes.
Across the board, 50 to
$60 billion is possible from ECB borrowing as well as from the FCNR.
And that is pretty consequential, right? The current account deficit is projected to be about $75-80 billion, right? Yeah. So this is a chunky.
Yeah, so that's why I said it was a bazooka of sorts, because what is happening in the market is that, like you mentioned, that the market has not been going anywhere. I think the view on the currency was kind of driving the view on the equities. Normally, it is the other way around. Equity move drives the currency market, but over the last 2-3 months, it is the other way around. So I think clearly the BOP hole, the current account deficit, and the fact that we were not getting capital flows enough on a net basis meant that the view on the rupee was never positive over the last 2-3 months, and that was preventing foreigners from actually entering the market, and to that extent prevented the market from rallying.
Hopefully now with the RBI having acted, the actual underlying situation with regards to the war, etc. Also, although this morning there is no sign of it. There are again missiles flying, oil's jumped to about $96, $97 So we'll just have to wait 100 days of this now.
Yeah, absolutely. Today I think is the 100 or 101st day. But I think from a short-term perspective, we will still, bow down to what's happening globally, oil prices and all that. But if you see over the last almost 2-3 weeks, between 23,000 to 24,000, a lot of bad news is getting absorbed. So that clearly means that more and more bad news getting absorbed. When things get resolved, hopefully we'll start. And with the RBI measures, meaning the rupee is not a headwind anymore. Hopefully, we'll see better days ahead.
Manoj, give us a sense of what is top of mind for you. We were just chatting before we hit air that there's a fair bit of difference between how US investors perceive India and investors in other parts of the world. And just what's going to be top of mind for you here?
Yeah. So just 3-4 things, because just last 4 months I happened to market in all geographies, right? Starting with Asia, US, Europe, and also UK. Now, I found a distinct pattern over here, right? So the investors in Asia, in fact, we rolled out and it was sold out in a day, right? So we've never seen that actually, right? All long onlys, etc. I think the investors in Asia was largely conveying a message that, look, quote unquote, I've made money in Taiwan, Korea. I've not really looked at India. I'm an underweight. It's not sort of a stance, but I know that in the next few months, few quarters, I need to relook at India. So help me bring up to speed. absolutely high levels of interest.
Let me be ready with a list.
Oh, absolutely, absolutely right. And within that, I found a very clear pattern. It was a fairly pro-cyclical sort of investment thought process, right? For example, like they say, we talk about consumer staples, etc. There's hardly any interest, right? I mean, so don't even mention the names, right? Kind of that sort of stuff. It is extremely positive on the cyclical side of it, whether it is metals, power, defense, and all cyclical aspects, large banks, etc. Remember, this was before the war broke out, before the view that inflation is inching up, which essentially helped the bank system, etc. Right? So this was before that. As you move away from Asia, I generally found the interest to be, let's say, tad lower, right? And one of the yardsticks which I have when I walk into these meetings is, if someone let's say, spend 10-20 minutes on let's say general India or cricket or kind of, not necessarily you're not using your 1 hour, it essentially tells you that the level of interest is low.
Correct.
Right? I mean, yeah. So the only point which I'll highlight here is that the number of investors sitting in Singapore who are actually the decision makers, along with the other geographies, is a very clear indication about the optimism, the way I would put it.
What is the number one? I mean, the rupee has been stable. So is what's head, what's tail. But rupee apparently has been driving sentiment. But earnings is the other thing, right? What are you projecting, actually, earnings growth? Because earnings growth in these other two markets, Taiwan, Korea, has been... I mean, it's tough to imagine that it didn't last. I mean, Samsung, $30 billion profit will go to $250 billion. And it's just crazy, right? But those are also, I mean, memory, for example, is a cyclical kind of, it's a commodity at the end of the day, but it's real shortage. But it can't last forever. So do we have to wait for those things to cool off for money to come here? What's your sense?
I think that's a reality, right? I mean, so, look, there are two types of investors, right, in any market, particularly when you talk about, relative investors. Very, very few of them tend to be early in any cycle, right? Which means, most of the investors, by definition, end up chasing, right? So that same thing happened in this case as well, right? So which essentially would mean that, for let's say, things to cool off first, then you'll probably see some reallocation. I really don't think it's going to happen before that. But that said, that scenario is also not necessarily great because, a lot of the portfolios may have losses, which means there has to be a stabilization phase, right?
And we get most of our funds through the emerging market route, right?
That's
we don't
right.
get, not very much India dedicated flow. It's largely EM funds.
No. Historically, we used to get a lot of India dedicated. It's just that the last few years, it's kind of, I would say, got evaporated for a variety of global reasons. I just want one perspective on the FI bit, right? Kind of versus consensus. I was looking at one statistic. There is this narrative that FIs are selling India, which has kind of affected the rupee, etc., etc. But if you actually look at a hard statistic, the number of stocks in which FIs own more than 1%, right? That's actually gone up from 900 to about 1300 in the last 6 years, right? Of course, the headline numbers would say that the FI holding in India is down from 20 to 15, but the fact of the matter is it is again broad-based. So it will be inappropriate to say that they're exiting India. Probably they're exiting positions which they own, but at the same time you're adding a lot of, I would say,
actually an investor pointed out this report. I think you guys published a report.
Yeah, published a report on it.
And I had a long chat around it, based off this report, how when we say India weight has gone down, but it's basically from large caps to the mid cap.
So the way to look at it is India is being seen as a bottom-up micro story right now, and anybody who's looking at a macro top-down approach is actually selling because they're looking at the overall macros, current account deficit going up, inflation going up, interest rates likely to go up, and so on and so forth. So we are possibly seeing a little bit of selling from some of these large cap ones and getting replaced with small cap and other stocks.
Prasanna, the other bit, of course, is the retail flows, right? FIs can keep selling, but if the retail bid is super strong, I mean, market just stays where it is. I mean, small drawdowns, do you think that'll continue?
So I think if you look at it over the last maybe 7-8 years, Prashant, 14 lakh crores to 82 lakh crores of AUM, 27 crores of folios, out of which 21 crores more or less are equity or equity based. And I think somewhere we also made it much easier and tax efficient for equities rather than fixed income. Maybe we earned a little bit on the other side, but whatever it is, that's what it is. So I think this is going to continue. And if you see last 2 years, there have been tremendous amount of drawdowns and there have not been returns which have been made by incremental SIP investors, but still SIPs are continuing. And today SIP AUMs are as much as 20% of the overall equity AUM managed. So I think this is not a cyclical kind of a flow. It is a structural flow. And it is the realization that Indians are underinvested in equities. Early 2000s, if you remember, there was a lot of talk and discussion as to how will risk appetite be, farmed off from the FPIs to domestic if domestic is not investing. happening. It's exactly the mirror image of that which is happening right now. So I don't think this is going to, change very quickly. And also, if you look at the measures which are taken, which are likely to be positive, plus the fact that it does look like Trump is not, eager to go for a war this time around in trying to, catch hold of straws. So if things were to get better, I'm reasonably confident that, inflows will still, continue.
Let me put you on the spot, Prasanna. Tomorrow, if the war stops, Strait of Hormuz opens, how much will we go up by?
No, so I think there will be a short-term reaction positively. But I think
but do you feel there's this huge kind of, it's like a dam which is waiting to, not like that, right? I mean, it's not as if you're going to suddenly go to...
No, that's right. So what I mean to say is that I think things will stabilize and marginally go up or maybe go up a little bit. But also be aware that there are a lot of investors on the FPI side who are possibly waiting to sell as well. And IPO pipelines are there. All of us have, issues which are still not hitting the market because the market is still not as good as what it could be. So these two supply will definitely come into, kind of assuage
as soon
the
as
rise.
markets start to look better, supply will hit.
Supply will hit. So I think that should be taken into account.
Yeah. Just one question, Prasanna. On the bond side, fixed income side, a lot has happened. You think something will happen? Now it's time to look and be hopeful on the equity side. This taxation question doesn't go away. It keeps coming up. But why not? It's a fair question to ask.
No, if you're referring to taxation of equities for FPIs, I think it is very... I think India is one of the very few emerging market constituents which actually tax capital gains from the place where it is sold, whereas most of the other countries tax it on residence and they don't get taxed at all. But I don't know. I'm not too sure whether the government will, go to the 0% kind of a thing. But I think what I can say is FPIs today, as long as you give them the commitment and the comfort that you're going to stay at a particular tax rate for a reasonable long period of time, rather than the uncertainty of, bringing it to 10, then going it to 12.5, then adding a surcharge to it, that kind of creates a risk premium which acts as a deterrent. So I think maybe something like that, a stable tax regime will itself be good. On the bond side, Prashant, the interesting thing that we possibly didn't speak about is the fact that because of the taxation has been removed, it becomes easier for India to qualify in the aggregate bond index maybe by next year. So that could provide a further $20-25 billion of inflows for the next financial year.
Passive flows into...
Absolutely. Passive, we've seen that any equity flow or any other active flow is active and can go out as well. But passive index flows are the best kind of flows which actually stay with you as long as the AUMs at the overall level are staying there.
Manoj, in terms of absolute returns, what are you most bullish about here?
So I said earlier, right, it's largely cyclicals, right? Whether it is these parts of power, right, parts of large banks, right, parts of defense, right, in fact, parts of discretionary consumption as well, right? So I think the only two aspects where we are kind of, I would say, neutral or negative is actually on IT. And largely on the low cyclical FMCG, sort of, and one cyclical which kind of is more like neutral stance is cement. We find the capacity
neutral-ish kind of
neutral sort of stance. So it's largely pro-cyclical sort of stance. Has been the thought process. And one other aspect which we sat with the entire analyst team the last couple of weeks, re-looking at and stress testing the assumptions, etc. We still came out with a 13-14% sort of EPS growth, for Nifty for FY27. And remember, this is after stress testing, right? It's not just simply bottom up, right? I mean, so I think the team is fairly confident. The only one aspect, Prashant, is that the broader thought process across sectors seems to be, which you mentioned a little earlier with Prasanna, that let's say life will be normal in terms of inflation, prices, etc. in about 3 months. If that assumption doesn't hold good, obviously,
then you'll sort of
we'll have to revisit it.
Okay. Before I wrap, let me ask both of you, one session, one conversation over the next 2 days you're most excited about, that you want to really, you're looking forward to, Manoj?
Personally, for me, it's all actually, all sessions actually. So, particularly the one on, AI, and then the couple of ones actually on the markets, etc.
Right.
I mean,
so I was looking eagerly at what the SEBI chair has to speak, because it's an opportunity for him to...
That's going to be now,
That's going to be in another 15 minutes or maybe 20 minutes. So that's one. And all the other, I mean, the thematics, the renewable energy, AI, data center, there are a lot of interesting discussions. I think everything has...
You guys have covered the hot spots and the hot button issues over the next 2 days or so. So I wish you all the best of luck, Prasanna and Manoj, for sitting down this morning and doing this. And of course, we'll continue to cover more conversations out of here. Guys, back to you in the studios. Actually, let's take a quick commercial break here. There's, I think, 15 minutes to go for the pre-open session. So keep it here with CNBC TV 18.
Welcome back. Hope you're having a good morning. It's going to be a bit of a rocky start for equity markets since the GIFT Nifty suggesting a pullback of nearly around 300 points. But Dharmesh Kant, Head of Research, Chola Securities, joins us on the show. Hi Dharmesh, good morning. Good to see you win. Headline index suggests a bit of a dip. I think investors should not throw in the towel. The reason I say that is since the time this particular war started, the Nifty, everyone argues, is down 6 to 7%. The mid-cap index is up 3%. And this sort of a market, there have been stocks that have moved up 50, 60, 70, even 80%. So very selective, but still there have been winners out there. Now, I wanted your, your understanding. We have some measures that have been announced by the RBI, which will stabilize the rupee, so that's a sentiment positive. But let's talk about the tech pack, because that's been the big underperforming sector. And you have, AI trade globally that's going into a bit of a tizzy. Anything you like out there?
Yeah, good morning, Nigel. And I hope the evening is far better than what the morning is suggested at the open. So, I mean, the earnings for FY26 panned out in a divergent way. Large caps, it was 3.5% kind of a gains on the entire FY26. If you look at the reported profitability basis, stripping off the one-offs, micro and small cap again was a 1% kind of a gain. Mid cap did pretty well. It was around 30% plus, and the volume growth and the GDP numbers, all we are seeing that resilience was there and the robust growth was being seen into the economy. As far as IT is concerned, I think around mid-single digit kind of a growth is still doable, given the fact that currency depreciation will play out. And IT, we have been liking two stocks. One is Orient Pro Solutions Limited. Though the numbers were a bit muted for Q4, but I think going forward into FY27 on the back of a big order book built up and few more are expected in next couple of months. They are under talks. If those materializes, then 20% profitability growth is doable for Orient Pro Solutions. So valuations are dipped that we are liking. Tata Technologies, we did an IC at 840. It corrected very sharply and it's again back on our roll. So we have been reiterating that. It has done quite a nice pullback from the lows. I think the price action is likely to continue because 15-17% kind of a growth is expected from Tata Technologies based on the overall recovery in the automobile space, be it EV or ICE. And their acquisition of Aztec is now the synergies are playing out quite well. Management is quite confident with even margins, getting improved to 17-18%. So there, I think, a one-year price target is around 1,000 rupees. So Tata Elxsi and Orient Pro is what we are liking for the IT space. Coming back to the overall, IT earnings growth, I think this time what can turn around the earnings trajectory would be the financials. As you spoke about, the measures have already been taken by the RBI, and this year is likely to be a consistent on the interest rate front. I am not expecting any rate hikes, be it October or December policy. The reason being 3 months is a long time in international market. US is cornered. They can't afford a rate hike, and I think Trump will get some negotiation. Rather than being an aggressor, he is now play a neutralizer in the Middle East in light of events which is unfolding out. And that if the reversal happens, the Strait of Hormuz opens, even if the headline numbers, printed numbers can be higher, but the rate hikes won't be there. If that is the scenario, if you look at the earnings growth of entire BFSI segment, in the Nifty 50 pack, it was 3.5% only, single digit kind of earnings growth, primarily driven by the Bajaj twins. So the internals were good. Trade growth was around 15-16%, but the PAT realization was not happening. This time, with a stable interest rate scenario, I think NII growth would be far better. Treasury income should be there, and this will lead to around 15-17% kind of earnings growth on the BFSI. So this is the best case scenario thesis we are working on. Having that in light, I think this is offering you a great buying opportunity to do bottoms-up picking in the market.
Take that point, Dharmesh. Hang in there. We'll take a short break, come back, continue our conversation. And also on the other side of the break, we'll bring back Mitesh Thakkar and Sudarshan Sukhani for a quick technical check on the market. Their trades for today, given the GIFT Nifty indicating a near 300-point downtick. Stay with us. Welcome back. You're watching us here on Bazaar Morning Call. We still have Dharmesh Kant with us. Dharmesh, you did speak about a couple of these tech names. You spoke about BFSI that you like. You believe that that could be the dark horse. I just wanted to ask you a little more on BFSI. You said the earnings growth were led by Bajaj twins, but it could broaden out a little more. If you could give us a sense on your preference out there, whether it's private sector banks, public sector banks, large ones, small ones, and the capital markets play as well. Because while we're talking about, democratization of India's equity markets, we're also looking at lower returns for the last 12 to 18 months. Do you think that theme pauses for now?
As far as capital market plays are concerned, Mangalam, I think it's a long-term play. I mean, a lot of run-up has been seen into the stock prices, particularly like if exchanges like BSE and MCX. So I don't think it's here in for a reset. It's a structural story in the making. And if somebody is a basket buyer, be it exchanges or infra providers at the same end, along with AMCs, you should be staying invested in that. And the story is still unfolding. 2 to 3x kind of growth we are seeing in next, say, 5 to 10 years kind of a time frame. As far as financials are concerned, we are constructive of all segments, be it private sector banks, public sector banks. A lot have been spoken about ECL provisioning, hitting into the profits. We don't think so. It would be so harsh. 10-15 basis point is what we are penciling in for FY28. So, but that is, still valuation takes care of that. And along with NBFC space. So NBFC, we have been liking, housing finance companies. So they all posted a very good set of numbers in the Q4. I think this strong trade growth momentum is likely to continue. I heard SBI management on your channel saying that even May was very good on the credit growth front. So that is what we are also getting a feel for, even the NBFC space. So credit growth has not taken a beating till now. I mean, as we speak, the growth has been very strong as far as the credit offtake is concerned. And in tough times, anyways, credit growth is far stronger. So I think on the private sector space, from valuation metrics, where I think a major upside can come through is IndusInd Bank and Axis Bank. Those are the two banks we have been liking. Public sector banks, Bank of India, we have again reinitiated with an upside target of 170. And housing finance company, Aadhar Housing Finance is what we have been liking for a price target of 600 rupees from a year's perspective. So these stocks can be added on days like this.
Got it. All right, Dharmesh, I recall that call on Bank of India. I think it went very swiftly from 125 to 155, 160 odd. Now you're reinitiating coverage on that one from the PSU banking space as well. Taking note of your picks. Have a good day ahead, Dharmesh, and it's going to be a tricky session. But as you said, hopefully by evening you'll be happier than the morning. Thanks for joining in. Time to slip into a short break. Come back, pre-open rates will be there, and we'll also be joined by Nuvama's Abneesh Roy, who will be putting the spotlight on Zee Entertainment. Stay with us. Welcome back. Well, as promised, let's welcome our technical experts. We have Mitesh Thakkar as well as Sudarshan Sukhani who join us on the show. Good morning, gentlemen. Good to see you all in. Sudarshan, you go first. 300-point gap down, closer to 23,000 odd. What would the trade be on the index?
Good morning, Nigel. You know, from 23,900, we have held our patience and said, we will not trade, we will not trade. Fortunately, today is a different day. You know, we are opening almost right at a very strong support level of 23,050, 23,000. Think of that as a zone rather than a number, but we are going to open somewhere there. And it's not just the support level, it's also the fact that the Indian markets have significantly underperformed. So we are not going to fall, hopefully, 3 to 4% that Nikkei is doing or that the US markets did, because we did not go up in that fashion. So coming to a strong support level with a gap down today after many days is a buying opportunity. Now, this doesn't mean that I can tell you with some guarantee that the markets will stop falling here. Obviously not. It's a very good location to go long. So the suggestion is buy call options for June expiry. Don't take it for a 2-day, 1-day trade. No one knows what will happen in 1 day. The cost of the call is your stop loss, because we can't even put a stop loss. Suppose the market falls 300 points intraday and rallies, then what happens? So this is a good day to go long in the index, in individual stocks, with the full understanding that we are taking some risk.
All right, take that point. Let's go across to Mitesh as well. Mitesh, Sudarshan believes there is a good time to buy calls. What are your thoughts on the index?
Good morning, Manoj. I agree that 20,000 is a support area. To me, the bigger support is the level of around 22,700, which is very important. We've been closing last time when we buying about 22,100. So 22,700 is the level to look for. So given the fact that we might open close to 20,000, I think I would want to wait and see if there is some kind of support or buying coming in. Otherwise, we might decline a bit more before giving the reversals. So I would start today with a slight negative kind of feeling, but in case 23,000 holds and there is a reversal, then we will turn around and look for buying. But for the time being, I think the initial starting news like what the
All right, so you believe that the market can go all the way down to 22,700, and that would provide a better buying opportunity than currently. Individual stocks, we'll come to you, Mitesh, in just a bit. Sudarshan, what's on your radar today? You said good time to go long on the index as well as stocks. What two stocks stand out for you?
Well, Adani Ports is a buy. They see that I won't give the stops because those numbers will become meaningless because of the gap down. So just discussing the stocks, Adani Ports is a buy. REC is a buy. I have two buys, and in the unlikely event or the likely event that the markets continue to go down, Tata Steel is a sell and Swiggy is a sell.
Okay, Swiggy and Tata Steel are sells. Adani Ports and REC are a buy for you. Mitesh, yes. Your stock picks?
Yeah, I have one buy and a couple of sell calls. On the buying side is Federal Bank with a stop at about 295, trying to buy it around 301 and look for a target of 315. On the selling side is IEX with a stop at 125 for targets of 116. BSE finally showing some signs of profit booking in the short term. That's a sell with a stop at 39.26 for targets of 37.80. And Ambuja Cement is a sell with a stop at 425.5 for targets of 400.
Right, gentlemen. Thanks a lot for that. So those are a bunch of picks that our technical experts have laid out for us and the view on the index. But individual stocks, they'll be on our radar. Zee Entertainment is one which is in focus as the board will fundraise on June 10th. And this will be an interesting one on account of two things. One, they've now been, appointed as the official broadcasters for the FIFA World Cup, which plays out in India shortly. And then we also have the same time last year, around July 2025, where the announcement of the promoters, investing in the company via convertible options, that was failed by, or rather, the shareholders did not give the required 75% approval for that to go through as well. So all these factors, along with what the stock is likely to do from here on, we'll discuss this further with Abneesh Roy. Abneesh, your thoughts on this fundraise plan? Whether is there any inkling on what it could entail? Would it be external fundraising via institutions? Would it be promoters looking to back the company once again now that the earlier resolution was not given the minimum vote or go ahead by the shareholders? Your thoughts on the likely course of action when it comes to fundraising? And secondly, the amount that they are likely to pay for the broadcast of FIFA World Cup and the kind of returns that they would get from this.
Sure. Hi, good morning. Thanks for having me. Yes, it's an interesting development. When I tie the different developments for Zee, clearly they are looking at expanding the total addressable market. So sports has been a missing link. If you remember, Zee had in fact exited sports around a decade back, and now they're re-entering. But world has changed in the last 10 years. So clearly monetization, subscription, consolidation in the industry has happened. FIFA 38 properties over the next 8 years. I think it makes a lot of sense from a longer term perspective. The cost is also quite rational because I think it is 1/3 of what FIFA was looking for. Of course, interest was low because most of the matches will be held in the midnight or early morning. So viewership, my sense is, may not be too much of live audience. Maybe catch-up audience can be there, but I think it's a very affordable costing. And now Z has obviously launched a lot of channels in the sports. It makes a lot of sense long term. Does it make a lot of sense short term? No, I don't think so. Because clearly, as I said, timing is not that appropriate. Plus, football is not cricket, right? Cricket means huge dollars, revenue, etc. But this is low revenue potential, low cost also. Now, coming to your specific question on fundraise, yes, we await for more clarity. We also need to see how minority investors react to all this because Z has a lot of cash on the balance sheet, right? So is there a real need to just do fund infusion, or is the promoter looking to hike stake? We need to see. Of course, approvals is very important, right? Last time they could not get the approval because of a small gap. Otherwise, they could have scraped through and the promoters could have increased the stake. How do I see the stock near term? The stock has rallied in the last few days, but Q1, Q2 results will be quite challenging because FMCG companies will cut advertising, because whenever they see any gross margin pressure, the first thing is cut in advertising by FMCG, durable, auto companies. So near term, clearly results will be challenging. FIFA is a long term good trigger, but not a short term trigger.
All right. Hi, Abneesh. Thanks a lot for joining in. Abneesh, but they're sitting on cash, right? I mean, the market cap, I think, is 10,000 crores, and I think around 15-20% is in cash. Update us with that number. And if they have cash, then why are they going ahead? Are they being opportunistic?
You're absolutely right. If you see, the cash levels are quite strong for the company. Company has been doing some kind of a acquisition in the short video format also. So they are doing investments where needed. But yes, they do have a lot of balance sheet strength. So we'll need to get clarity whether it's a acquisition related fundraising, or is it again the promoter, because promoter stake is quite low, right? At that kind of 4% kind of a promoter stake, clearly it's quite low. The pricing has also become quite reasonable. If you remember, the promoters had infused some level of funds into the company around 1.5 years back. The levels are lower than that. So yes, last 5-6 days there is some rally. So yes, we would need to wait for clarity. But yes, you're absolutely right. From a balance sheet position, company is almost having 20-25% of the market cap in cash. So that I don't think is not a low number. So it could be linked to the promoter stake. It could be linked to some big acquisition. But that I think we need clarity because the board meeting is day after tomorrow.
What's your call on the stock in general then? Because on the one hand, there are a lot of triggers, but on the other, there are a lot of risks as well. So give and take everything. What's your call on the stock right now?
So we have a buy rating, but definitely in the near term, this is a high beta stock. This is a business which will have testing times in Q1, Q2. So someone has to take a 1-year call. Of course, what happens to the fundraise, that is extremely important for the stock. That in the past scenario, when the approval did not come by the minority shareholders, the stock did cool off. The margins have been very volatile. If you see Q4 margins was a shocker for the market on the negative side. I think company needs to come back to a more rational and more predictable margin profile. As I said, Q1, Q2, because advertising will be weak for entire media industry, there is a more negative bias to the margins rather than a positive surprise. So net, this is a 1-year call. This is not a 1-quarter call. But because of all these events, the stock has rallied. So if the minority shareholder approval doesn't come, when we get more clarity on that, the stock could cool off also. So one should take a 1-year call here. We'll prefer more the FMCG companies because Q1 results will be strong for Nestlé, Marico, Pidilite, Asian Paints. Those will be preferred over Z in the near term.
All right, so you are positive on FMCG over Z. And in the media space itself, I mean, typically one compares Z to say something like a Sun TV. Do you think the fact that they own an IPL team reduces the downside on Sun TV? Do you have a call there?
Yes, clearly IPL valuation $1.52 billion, which I think most teams are getting. That's positive for Sun TV. The issue is Sun TV, if it monetizes it, then the minority shareholder will get interested. Of course, what we are seeing, Z is more interested in expanding total addressable market. Sun TV, on the other hand, wants to be more conservative, work more on the cash flows, work on the current business rather than expanding TAM. So currently, that's why investor interest in media stocks is quite low. And definitely in the media broader space, we will prefer PVR Saregama over Z, given currently the advertising risk is much higher on broadcasters rather than on Saregama or a PVR. In Saregama, clearly we are seeing that more monetizations drivers are coming into place gradually as we are seeing Amazon, etc., turning more on the pay format rather than just on the freebie. So we'll prefer Saregama and PVR over Z and Sun TV in the near term in the media space.
All right, take that point. Saregama, interesting one to track when it comes to monetization of their content. PVR, though, you know, what they do with any sort of acquisition that is likely is something that we will be tracking as well. There are reports which are abuzz as well. Good time to then, you know, leave you and then perhaps invite you on another day to track both the consumer and the media space. But also, it is 9:10, which means that we bring back Sudarshan as well as Mitesh for their 9:10 calls. Sudarshan.
Well, it'll be Adani Ports. Consider buying Adani Ports.
Mitesh?
Buying Federal Bank with a stop at about 295.
Okay. All right. Got it. Thanks a lot for that, gentlemen. Well, Ekta joins in to tell us about Divi's Laboratory. Some positive news flow coming in there. Ekta?
Well, likely positive news flow. So what has taken place is that Eli Lilly's drug retatrutide has delivered strong phase 3 trials in obesity and type 2 diabetes. And the drug is likely to be filed soon with the US FDA, possibly in 2027. So analysts have indicated that this news is positive for Divi's Labs because they expect to start contract manufacturing for peptide fragments, which go into these drugs, as well as the likely drug substances in the future for an undisclosed client. So the street is assuming that the undisclosed client could possibly be the innovator, Eli Lilly, for their diabetes or their new weight loss drug, which is in the pipeline. And hence it could be a long-term growth driver for Eli Lilly as well as for Divi's Labs CMO business.
Okay, Ekta, thank you very much for that. So, you know, lots of stuff to watch. I think there's, a minute to go for the market open. And we will, of course, look at indices. We will look at the Nifty 50 stocks in terms of where they are starting up. And, of course, then look at the broader market. Broader markets, of course, have done phenomenally well, even off the lows of March. But, of course, you know, in recent weeks as well, the small cap part of the market has done very, very well. Nimesh, of course, highlighted a broad bunch of sectors which have done, broad bunch of stocks in the broader space which have done very well on Friday on Editors Roundtable. We've got first trades come up in a few seconds from now. We will look at those and then, of course, come back to more stuff. What do we have as far as first rates are concerned? 23, about a 1% cut, broadly a 1% cut on the Nifty. You got a 1% cut on the Nifty Bank. The small cap index is, will come up with the first rates. I don't think we have, the first change come up yet. Now that's, they're 1.5% lower on the small cap index. The mid cap index is starting by about 1.5% lower as well. So, uniform 1.5% cuts on the Nifty Bank, mid cap and small cap indices. The Nifty heat maps gives you a quick sense of where we are starting on the 50 stock index right out of the gates. I think it should be broadly lower, and then we will look at single stocks. There's a lone gainer, that is Tech Mahindra. Everything else is down. Wipro, Hindalco, Bajaj Finance, Shriram Finance, Tata Motors Passenger Vehicle, Asian Paints and Eternal, etc., etc. So 49 down, 1 up. That's the picture at 9:15 this morning. 270 lower on the Nifty. Back to the studio for what's happening in the broader space, guys.
Well, that's right. A few winners to point out, Prashant. EMS, that stock is higher. They won 100 crore order, so I think the street likes that. UP Jal Nigam project in Varanasi, so that's why that stock is up and about. AG Infra as well, they've got a provisional completion certificate for around 4,971 crore project in UP. Just a completion certificate, but for the time being, the street is latched on. That's up close to around 6% as we speak. What else is moving around? NRP Bearings, I think there was a large trade that we saw earlier, in pre-open. And I think, the street is excited about that. We'll have to wait to see who exactly are the participants to that. On the flip side, though, a few stocks that are selling off. MTAR Tech, finally that stock, has moved lower. It's down close to 6%. It's had a one-way run. So there's some profit taking, some money being taken off the table. Sterlite Technologies as well as HFCL, both of them are down 5% apiece. Remember, these are stocks that had a big run, so that's coming for some profit taking. Aeroflex Industries, another stock that's down close to around 4.5% in today's trading session. The breadth of the market is firmly in favor of the number of stocks declining, so you should keep that on your radar. Only 350 stocks are advancing as of now. You'll want that number to go up substantially from here on, but that's the important stuff. A statistic that you'll track. And Z Entertainment, after the kind of rally that we've seen, Street is optimistic with regard to this fundraising plan. Let's see what it throws up. For the time being, that stock as well has opened up gap up. And a few more stocks, Mangalam, that are opened up in the green. Syngene is up and about in today's trading session, so good move out there. PNG Reva, I think our ticker team had put out that there was a large share promoter had done some creeping acquisition out there. So that stock as well has moved higher in trade today. And Thomas Cook as well, up 3.5%. What else, Mangalam?
It looks like the pharmaceutical stocks are having a good run today. Look at Sun Pharma from the frontline end doing extremely well, up around 1%. Dr. Reddy's, Ekta had spoken about this possible deal with Eli Lilly. That stock's higher as well. And in the broader markets, while Syngene is the top of the pops, up 4.5%. Look at among the top 5 gainers, 4 of them belong to the pharmaceutical space. Look at Pfizer, up 3.5%. Alembic Pharma, up 1.5%. We're seeing some traction on Strides as well as Granules. Zydus Life not too far behind as well. Given the context that we're in for the market right now, even a 0.5 to 1% sort of gain really is an outperformance, and that's what we're seeing in the pharmaceutical pack. SAIL continues to sell off. We are seeing some decline in NMDC as well as Hindustan Copper as well, both of them down around 2.5 to 3%. Ashok Leyland down around 7%. Cummins coming in for a bit of selling, down about 2.5% for that one as well. HG Infra, you pointed out at the open itself doing well, but now it's expanded its gains up around 8% with a fair amount of volumes piling up on that one as well. Another group of stocks which have started well in today's trading session so far have been the sugar stocks. So look at Dwarikesh Sugar up 4%, Dhampur Sugar up 3.5%, 4%. Typically they move in a pack. Bajaj Hindustan is the other one, which is up 2.5%, 3% as well. Perhaps on the back of higher oil prices, maybe the ethanol trade comes back into play, and that explains why these sugar stocks are higher as well. By and large, it is a down market, but maybe not an out market, because we're curtailing our losses at around the 200, 250 points on the frontline index. And even Korean markets, which opened about 8 to 9% lower, have recovered from the lows. So the Kospi is now down just around 4.5%, which implies a near 4% recovery from lows. So markets, while they are down, maybe finding some buyers at lower levels. The Nifty is swiftly off around 40 to 50 points from the opening low so far.
I think we should put the crisscross lines up for you on the screen. We started at around 320 stocks that were advancing. That number has gradually moved up, and by the end of today, irrespective of what the headline index does, you'll want that number just to move up. Currently, it's around 470, moving towards that 500 odd. You'll want that to gradually improve, because that's the thing that makes actually portfolios feel much better. That said, let's welcome Sanjay Mukhi, Head of India Equity Research at JP Morgan, who joins us on the show. Hi, Sanjay. Good morning. Good to see you. And as always, well, the last time we chatted, we were hopeful that by the time we chat again, the end of this war would be announced. That's not happened, and crude oil prices continue to remain elevated. However, you're seeing some steps coming in from the RBI as well as the Government of India, at least to look at some stability with regard to the Indian rupee. At this juncture, what is your stance with regard to India? We have been rank underperformers. Valuations are far more palatable. And I think Q4 numbers, actually, earnings weren't as bad, or they were pretty good in comparison to what estimates were. Your take?
Morning, great to be on. There's quite a few things to unwrap in what you said. What I'd say is that, look, India growth will actually come under pressure. And of course, inflation will go up. And we've seen those revisions in the RBI's latest announcements as well. And this can cause near-term issues on equity markets. And much of that seems to have happened. Higher oil prices are a challenge for India. India is the second largest importer of oil in the world. And it is a bit of a circularity, because as long as oil remains high, my current account deficit remains elevated. Capital flows are obviously under pressure at the moment. And this creates a BOP problem, it's a problem for the currency and the INR. So the starting point is we need this conflict to end. We need oil prices to settle lower, and that eases the pressure on the Indian macro for a while. And what we've been talking about for a while, and we discussed this last time as well, is that equity market performance tend to mirror relative growth arguments. So because of the elevated oil price environment, we're looking at cuts to Indian GDP, Indian growth in the near term, whereas for other countries, the AI capex is driving upgrades to growth. So in the near term, there is a very nice logical framework that explains the pressure that you're feeling on Indian equities at the moment.
Yeah, Sanjay, but it's largely, good morning, Prashant here. You know, it is large caps, right, where there has been pain. I mean, broader markets, it's not a raging across the board bull market, but there are enough pockets which have done very well. So actually, the thing to do, but obviously, I mean, you know, it's no investment strategy, and we're all wiser in hindsight. It's the non-FII part of the market which continues to do very well, supported by this very, very strong retail bid.
Yes, and that is something, Prashant, that you've seen actually across the world. It's not unique to India as well. You've seen retail participation go up in the US, in North Asian economies as well. And I think this, Prashant, has to do with the lesson all of us have learned over 20 years, is that you must always buy the dip. And that every correction ultimately is fixed, or the cause of the correction is fixed, and markets rebound. So if markets have fallen at the start of the Middle East crisis, people, and especially retail, tends to go back in a hurry. The challenge, I think, this time around is that this is not, or at least the drivers of the correction this time around are very macro. It is driven by weaker growth outcomes. That is something I don't think that we will debate. And typically, when you have growth cuts, smaller and mid-cap businesses tend to bear a disproportionate impact of those cuts, right? So it is not that these sectors or smaller stocks are universally exempt from a downgrade. And the worry that I have now is that these stocks are rallying in India and everywhere in the face of what might be a bit of a downgrade cycle that is still due.
Right. So you do believe that a downgrade cycle is due? Because I remember the last time you joined us, it was early days in the war, and everyone was hoping that there could be a resolution sooner, and this could perhaps be a dip. But now it seems like it's a lot more prolonged and perhaps a cycle now. In light of that, what do you make of the valuations? Because we're still at the lower end at around 16, 17 times. How much of that do you think will now be reset given the sort of earnings cut that may come by? And what are your thoughts here? How much lower could the EPS estimates be curtailed?
Let me talk about something we did recently. This is now an AI world. So we stuck the transcripts for all major companies that have reported the March quarter into an AI. And we asked it to summarize the guidance that every company has for near term and for FY27. Now, in the near term, almost a lot of sectors and companies have acknowledged challenges. But the guidance for FY27 for almost every sector in India, 42 sectors we looked at, is still positive. Almost every company is guiding to double-digit growth for the full year. Now, the longer this conflict continues, the longer the disruption continues, you will have challenge to that outlook. And we did a note this morning again to say that, look, the country is managing its energy availability reasonably well, but the cuts to industrial supply of energy, whether it is oil or natural gas, is still pretty large, right? So it's not that everything all is well. We still are living in a curtailed energy environment. And this combination, one, the expectation that companies still maintain of strong growth in FY27, and the fact that there is at the very least a reduction in energy availability for industry, should lead to some downgrades if this conflict is not resolved pretty soon. How much, we'll see, because what will happen mathematically, certain companies will benefit from the inflation. The upstream E&P companies will do well. On the back of this, some of the refining stocks should do well as well. And that will tend to mitigate or compensate the overall index level earnings impact. But the core consumer-facing economy should remain under pressure from an earnings point of view for a while.
Sanjay, the other thing is, of course, monsoons, right, which are expected to be subpar. And the headlines here in Mumbai over the weekend about reservoir levels and things like that. Just your thoughts on this one, Sanjay. Globally, there are lots of organizations who are not calling it a El Nino, they're calling it a super El Nino. So one of the, a rare event occurring after many, many decades. Just your thoughts, Sanjay.
Well, it is another headwind, you would argue. The only saving grace, I'd say, Prashant, is that the intensity of agriculture in the overall Indian economy has fallen gradually over the years. And, if you go back to the 1970s, agriculture used to be 70% of rural GDP. And by our estimates, is now less than 30%, maybe even 25% of rural GDP. Manufacturing and services are more important. But what matters, I think, is that a shortfall in rains could lead to agri-inflation. It could lead to lower yields. And this couldn't have come at a worse time. We are sort of struggling for fertilizer availability. So there's an input cost pseudo input cost pressure for farmers as well. So it's a combination of let's say, a series of bad events, like you would argue. But I don't think that the impact directly on GDP will be as large as it used to be previously.
Okay, all right, Sanjay, let's get to sectors and themes then that you like. I think defense was something that you'll be looking at, and renewables as well. You know, the reason I'm focusing on these two is because in the post-war era, these are going to be rather important, right? Geopolitical tensions have spiked up globally, so there's going to be additional focus on defense. But our stocks, pricing in the best case scenario, are they giving an opportunity? Point number one. And on the renewable energy space as well, you know, India's dependence on crude imports, that's hurting us right now. And in the next few years, there'll be a big push in that direction. As is, we've seen directionally that's been a push, but now there'll be even more focus. Are these two throwing up opportunities?
I think first, as themes, they seem to be very valid in that the expenditure on both these, one from the government perspective and the other privately funded as well, the momentum should sustain for the next several years. The government will have some challenges in funding defense capex because everything that's happened is negative for the fiscal balance. There will be a lot of, let's say, rebudgeting with costs having gone up, subsidies probably having gone up, and revenues may be under pressure this year. The momentum of spending may actually be a little limited, but within that, you may see further shifts towards indigenized defense equipment versus imported ones. So at least for the companies, the momentum may sustain for a while. The solar momentum seems to be, or the renewables momentum seems to be real. And I think this is because of this rapid advancement of battery technology and the reduction in costs of installation of batteries. And in the last 12 months, the number of tenders that have been given out for BESS systems is very large. The accelerations is very sharp, and the economics kind of fits even without any major subsidy. I think the challenge we face as an economy is that we don't produce any of those batteries locally. Cell manufacturing is still, well, nascent in India. And as demand grows, hopefully that ecosystem also comes up. A little difficult to kind of in this context argue whether stocks are pricing all of it in, but as themes, these should continue.
Right. Since you spoke about, you know, putting a lot of these call transcripts into an LLM and try to figure out what the future looks like, it would be very interesting to see some of those past conference calls during, you know, periods of uncertainty, put that and perhaps calibrate that with what was the actual impact versus what the management was saying at that point as well on the same LLM. But, you know, just a view on the pharmaceutical space, that's been doing well, relative outperformer in this world of uncertainty right now. And a lot of investors like this space. After having underperformed for a while, they believe that maybe FY27 could be the year of the pharmaceutical space. Do you believe that there are pieces in place for something like that? If yes, then what would you back?
Well, we do think that, you know, one of the permanent impacts of the conflict that we've seen in the Middle East is that the rupee will remain at, let's say, somewhere in the mid-90s or maybe higher, right? Even if the war were to end, supply is restored, and, you know, energy flows come back, it is very unlikely that the rupee retraces the depreciation that it's delivered recently. And this means that when I stick numbers into my models for FY28, I need to now build in a higher currency figure. And the pharma space starting up is a beneficiary of that rupee depreciation. There's a whole bunch of other exporting sectors in India where the rupee number hasn't yet been put into FY28 forecasts, I'd argue. Pharma, of course, needs to be more bottom-up. You need to understand the pipelines and the prospects of each company. But the top-down argument that, look, it is a beneficiary of the direction of the rupee is valid.
All right. And have you put any numbers to the semaglutide opportunity?
No, I may have to get back to you on that.
All right. Take that point. Thank you so much, Sanjay. Just one final question before we let you go. Is there anything that you believe could be an outperformer from here on, maybe something of the left field?
Well, I wouldn't actually do that. I'd say that, look, if the fundamental premise of investing in India is that the macro situation is improved, and which it will, it's a question of time, I think, then the biggest beneficiary of a macro improvement is the financials. The sentiment on the market, the improvement of outlook on the currency or rates should flow through onto the multiples of the banks. These are the only cohort in India which have become cheap in this correction, or I'd say fairly valued. And I'd say instead of looking for multi-bagger returns, the compounding argument is always easier to implement. And there, I think the financials will stack up right on top.
Any segments, Sanjay, or large private banks?
I think large private banks are all fine, Prashant. Of course, the smaller banks will tend to have better growth over a period of time, at least in the near term. But again, like I said, if you're not trying to hit it out of the park every day, then just buying and holding the macro trade in India for growth over the medium term, which is large private banks, should be fine.
By the way, Sanjay, have you or your team on the macro side, Sajid, etc., put out a number in terms of the flows the RBI measures could get? Dollars, all the measures combined could get?
Well, we have our own estimates. I'm not entirely sure if we've published them, Prashant. But we do think that these measures can be pretty meaningful over a period of time. And over, let's say, a few months, these could end up, hopefully, pulling in tens of billions of dollars if implemented.
Well, Sanjay, thank you very much for joining us, and good getting that perspective across. Well, we have somebody on now who has a number, and Sanjay, if you're so inclined to watch on, Samir Arora is joining us now. He's, of course, needs no introduction with Helios. Samir, great to have you with us here on the program. Thank you very much for joining us.
Morning.
I don't know if you can pull Samir's tweet up. He said, if I have correctly understood the FCNRB scheme, India will get maybe $40 to $50 billion by September through the scheme. Samir, is that a updated assessment, or
that was my instant reaction within maybe half an hour. It could be higher. Now it depends on if the RBI does not. How did I get this random 50 billion? Is because more or less the features are similar to what AI was hoping for and saying on your channel, but because I had seen that same numbers in 13, sorry. I mean, not numbers, the same features. And therefore, if at that time we could get $30 billion or so, now the market is much bigger, the banks are much bigger, economy is much bigger, NRIs are much bigger. So you can easily get it. And the economics is very easy, that an investor who leverages, an NRI who leverages, can make around 15% per annum, and that is a decent number. The only thing is, the fine print, I don't know whether RBI says to banks, don't give leverage to the NRIs to do it, or it just sort of keeps mum. If you keep mum, yeah, you can get 50 billion, no issues. I think just simply because we have seen live 30 billion like 13 years ago, so why should it be any less now?
Yeah, I think 2013 we got about $26 billion.
26 billion. So I'll change. Even if you see economy size, bank size, you can easily get 40, 50 billion. Now it depends exactly, but it won't be outside. It won't be less than this range. I am thinking, because I spoke to 2-3 private bankers here, and they said you could get 75 billion also. But the only thing is that I believe now, after talking to these two guys, that India may have to stop it after 1 or 2 months, because this time you can do it till September. Maybe they have in mind, RBI has in mind how many billion they want. And they should create that impression so that these banks run around faster.
You're saying that they may need to actually close it.
No, I'm not saying they need to.
Then
I'm not saying they need to.
But they may.
But
they may
assuming
want to.
that there is a budget in mind. Yeah, assuming there's a budget in mind. Because it is very attractive to get 15-16% in dollar. The only bet you're taking is that India does not impose capital controls 3 years later when you have to get your money back. That bet every NRI will take very easily.
Yeah, 100%. Just a couple of more questions. You said that unless they say something about maximum leverage they can take, if they say stay mum, then it is all good. Why did you? Is there a reason you brought that point up?
So what happens is
that something you're looking to? Yeah.
So what happens is normally you're going to get on your deposit around 6%, because right now the FCNR rates are some 3.5%. And that is because the bank which takes that money in dollars has to hedge, and maybe their cost is say 2.5%, 3%. So once that hedging cost is taken by RBI, basically the Indian bank can offer the same rate as what they offer for INR funds, which is say, let's say 6.5% or whatever it is. So you can try and be stingy there and give 6.25%. But you can't get $50 billion if all you are saying to the NRI is that, okay, I will give you 6.25% instead of 4% that you'll get for this term from just your regular offshore bank wherever you are. So the way this works is that the offshore foreign bank or an Indian bank tying up with a foreign partner, foreign bank, will say that I will lend you money around 5%. That is the current rate at which an NRI, high net worth NRI, can borrow money from the bank. So you put a $1 million, and bank will give you $9 million, and you have a 10 million deposit, FCNR deposit. But if they say that you can't lever, then what happens? The NRI has to first put up $10 million, and then maybe 3 days later you can get 9 million back, because then you're not taking a loan to put a deposit. You are taking a loan against your deposit, and that is a different thing. So it constrains the capacity of the NRIs to, take leverage and put in, and they should not bother. It's an offshore leverage. It has been done every time. Just keep mum. You can get as many billions as you want, maybe double of this also if you want.
Yeah. Samir, how much are you putting in?
I will put in if they let me lever, of course. I don't have to take out of India. I have global and all I can take out of. No, this is good. All for motherland, India.
No, got it. Now, on the fixed income side, a lot has happened, right? So this has happened. On the equity side, do you think, and you and I have spoken about this in the past, and you alluded to, you think for now this whatever firefighting had to happen, I'm calling it firefighting, is done,
been saying,
or
but not expecting.
This is a series of steps, and something on equities as well?
No, I don't expect anything on equities. I have been saying that it is wrong and you are losing many billions. But I don't think anybody is doing that. But it's okay for now. This is quite meaningful in itself. And this whole world works on delta. It does not work in absolute that way. So this news is quite positive, and this can keep us going. And then we see, unless there's another issue in life that happens later. But the thing with equity, if you remove equity taxation, the issue is not that this one is literally the next day you will get the money, because there's a time bound and it's an easy thing to quantify. But if you reduce taxes on equity, it does not mean that tomorrow you'll get flows, but it means that over time you will get, according to me, 20-30% more flows than you would get otherwise. But you won't know what is the base, because these things will all work in future. I can't even imagine anybody arguing against it from a numbers point of view, because it is just simple. You are making 10%, now you're making 8. 8 is less than 10. And 8 makes you relatively unattractive on if you put all the other countries. So obviously you have to lose money, but nobody knows how much. But I can give you one example, although I don't expect it now. If you look at the world ETF, MSCI World ETFs, these ETFs are quite big. Their benchmark as India, and they don't put money in India. You can see it for any ETF, any world ETF which should have India in it, does not have, because they don't know how to handle the taxes. Now, if somebody has an ETF which has 20% India, obviously they have to buy it. They can't avoid it if it's some Asian emerging market or some 5-country ETF. What's an India ETF? So you can see that there is leakage, but I'm not expecting, and right now it doesn't matter for me to be bullish. I was bullish even before this, and now I am happy that some very meaningful steps have been taken which can stem the currency weakness. And then, small correction in the rest of the world puts us back in sort of plus minus similar keel.
Samir, it's almost consensus now that this, memory North Asia trade needs to cool off for foreigners to look at India in a meaningful way. Do you believe that? And you invest, you've invested in markets around the world for a long time. Friday, NASDAQ sold off, the SOX index sold off 10%, but frenzied rise into it. This morning, Korea was down sharply. I think it's down only 4-5% now. how do you read it? It's like a normal, regular, healthy reset or a warning shot?
I think the small reset because the demand will not go away. The demand is very big. It's just that what should be the price for that? That you are when you are buying it now, you are believing that the price will keep going up because the volume is what it is, and that actually if the price of these memory chips and other chips fall a little bit, either because it's gone up too fast, or because of some more efficient chips, or because against Nvidia now you have Amazon making Trainium and what is it called, something Inferentia, or TPUs from Google. So all that will reduce the prices a little bit and maybe make the AI investments more useful. Because right now, all these guys who are hyperscalers who are investing, some part of it is getting wasted in the sense that they are just paying a higher price for whatever was otherwise at X price, and they are paying 40% more. But the hyperscalers investments don't seem to be ending. This weekend, I saw a presentation which you can see on Google, on YouTube, on Google, because when they're doing their equity raise, saying that in 2027, the capex by them will be nearly double, I think, if I remember saying, of what it is this year, which is 180 billion. But it'll be more than 180 billion next year. So you will still need all these memory chips and all. By the way, I have sold my semiconductor ETF on Friday, fortunately, before US opened, because all ETFs of offshore guys are London listed, mostly we buy. So after seeing Korea's fall and Broadcom falling 8% on the day before and Korea falling 5%, I said enough of me. And I'm not going to buy it back, although I think they will not fall much more. But I've had enough of this semiconductor going up some 60-70% in 2 months. It's a bit too much.
Right. Hi, Samir. Good morning. Good to see you in. Samir, what about the tech pack? You have been bearish on it. You have stayed away. No interest still?
I would say cheers to that with my tea.
So you're still not interested in tech, even after the stark underperformance?
That has been the trade. All you need is one trade a year. So let's do big picture. Big picture is there is a lot of uncertainty. Nobody knows. Not that the guy who buys knows. The only thing that the guy who buys knows is that it has become cheaper than it used to be. Is that enough of a reason for a fund manager to say, I am overweight? They can say it is very uncertain, but it's a bit cheap, so let me not be underweight. I should be market weight. But you see all the big guys, all the 3-4 big guys who come on your TV saying we are overweight. On what basis? I believe that this will happen. I believe that will happen. Just last week, there was a report from Goldman Sachs saying how much is the saving when you do things on AI versus doing things on with human beings. And the savings in some cases are 90%, particularly in coding type of activities. You see the investments that are being made in AI. How do you think Anthropic will justify its IPO at that time? If it says that everybody will grow, then whose market share are you taking? Whose lunch are you eating? What are you doing? Everybody will initially have to show that I am taking that guy's market. Because by the way, I have another theory that market caps normally go up in line with the market, which means they go up 8-10% per year. And if anybody has a disproportionate increase in market cap, it is accompanied by eating somebody else's market cap. For example, Apple grew its market cap disproportionately because it took market cap of Sony and Fujitsu and HP and whatever, and Netflix took it from the TV channels and Disney and whatever. No, nobody just grows without taking from somebody else beyond the normal growth. These guys have gone from 0 to 2 trillion. Somebody has to lose 2 trillion of market cap.
That's a very interesting one that you're saying, that someone has to lose, because in growth markets, people believe that maybe there is value created and not value shifted from one place to the other.
Value is created. Value is created, but up to that point. That means in India, if somebody is growing 15%, 12%, part of life. If you, for example, how did, let's say in theory, Eternal have a 23 billion market cap? It took the implied market cap of all the Kirana stores in India.
Got it.
Somebody's market cap or theoretical market cap or whatever has to be taken away. You can't just randomly create, I think.
Right. You know, legacy IT companies in your call, great call on that in hindsight aside, just a view on all the new age companies. Since you believe that there could be a lot of efficiencies that would emanate from the AI trade, India, we're not in the upstream AI, but now perhaps we could be, you know, users of AI. A lot of these companies could optimize their operations and perhaps, you know, cut their costs further. Do you think there are further bets to be made on the likes of Zomato, Eternal, Swiggy, you have, you know, all the others?
I know, but that is not related to them using AI to become more efficient. I don't think that is such a big deal. The deal is that they, first of all, the bets in most of these companies, including ones I don't own, like Lenskart and all, is that they are effectively, in some sense, big picture, it is unorganized to organized. You are not having to believe that the end customer is growing a lot, because those are the most difficult decisions or projections, that the end consumer is growing some 10%. All you are saying is that instead of buying from this model, he's buying in this model, and he's become more comfortable with this model. In the case of quick commerce, he's become comfortable with not going out, and he's willing to pay for that. And new entrants coming in are finding it difficult. If you see, yesterday or day before, or maybe 2-3 days ago, they said that the guy was very aggressive, has stopped giving free delivery, now wanting some X149 or I don't know, 299 or 199 rupee order, which is, all these things are just showing that there are already winners and the rest can fight for second and third position. But it's not that AI will bring in new savings and somebody delivering to your home. That is a bit, okay, just storytelling, I would think.
Samir, by the way, that's interesting, right? I always thought that, what is that famous quote of Einstein, right? Energy can neither be created nor destroyed. Value can neither be created nor destroyed. Attributable to Samir.
Broadly, it can't be. It is moving. Yeah. First, for example, how did the banks do it? Private banks. They took it from the state-owned banks.
It was a great
How
point.
did Z do it?
Absolutely.
By taking Doordarshan's cap. That's what I mean.
Samir, so just before we wrap, right? Where are you taking the bets now? And ITs don't like, we discussed that, but what's top of mind for you in India?
So top of mind till say a month ago now, it's gone up a bit much after the results for these power equipment related stuff. We also have defense. We're talking about new marginal things. We are not really adding to the private banks. I was a bit frustrated seeing, have you heard of this company, Revolut? I mean, it is basically an online doing 1/3 the things of a bank, valued at $125 billion. I don't know why. In India, we could not have done. So we are buying broadly the same kind of things, which are the cash app, the quick commerce, defense. We are not buying new power equipment because it's gone up a lot. All we are doing is not buying old. And I think that is another thing, that you can't keep thinking that your life will totally change just because P of a company has gone down. The competition, people's expectations, in terms of service, in terms of things. So the new is good actually, but we don't have so much of the new. We have maybe 15-18% of new, but excitement is only in new things. Rest is okay, you are just defending.
All right. Well, great conversation, Samir, as always. Really appreciate your time, and thanks for being such a sport. Thank you for coming on this morning. Thank you. That's Samir Arora of Helios, with perspective, of course, on the RBI's measures, but I mean a whole bunch more as far as markets go. Well, I am sitting here at the ICICI Securities Conference, and the SEBI chairman, Mr. Tuinkanta Pandey, is addressing investors. So let's cut across.
If the investor feels informed, protected, and fairly treated, confidence will follow, participation will deepen, and markets will continue to grow on a strong and sustainable foundation. And that's the direction we should all strive to build towards. Thank you. Jai Hind.
Thank you so much, sir. Truly an honor to have you.
Welcome back. This is Corporate Radar. Let's invite our next management. We have the management of PNB, Mr. Ashok Chandra, the MD and CEO of the bank, joins us on the show. Hi, Mr. Chandra. Good morning. Always a pleasure talking to you, sir. You know, I wanted to address the way business is progressing as well. But first, let's address what the RBI did. They announced that they will absorb part of the hedging cost on ECBs. So could you give us some details from your bank's perspective? What is the current ECB borrowings for you? And what is in the pipeline, more importantly, because now you have a funding option. Do you think you can mobilize a fair amount of money via this route?
Yeah, good morning. Thank you very much for inviting me to this show now. In fact, it is a very, very commendable announcement RBI has made in the last MPC. And not only the ECB, in fact, the other most important part from the banker's point of view is the FCNR deposits and the hedging cost, which has been announced that it will be borne by the RBI. I think we are expecting good traction going to happen in the FCNR book. And we all know that US Treasury yield is something around, it is 4%. I think going forward, the interest rate on FCNR will likely to increase, and we are going to mop up good volume under that. We are expecting that country as a whole, I think it should be in the range of around 35 to 40 billion USD. And for our bank, we are calculated, and somewhere we are expecting that around 2.5 to 3 billion USD we are going to mobilize during this period.
Oh.
Now, coming to the ECB, I think many of the public sector undertakings, they are already doing it. But with this hedging cost, which has been liberalized, and the RBI is going to bear that cost, I think we are going to see good traction happening under that also. Last year, it was in the range of around $6.12 billion. I think we are expecting that good traction should happen around country as a whole. 20 to 25 billion USD should happen through that ECB route.
Okay. All right. Interesting points you're making, Mr. Chandra. If I got that correct, via the FCNRB deposits, you're talking for your bank, it could be around $2.5 billion?
Yeah, 2.5 to 3 billion USD we are likely to mobilize.
Interesting. Give us some more details. What is the current interest differential, within what you currently do right now, and how much can you offer post this measure that's coming from the RBI? Just to give us some more color.
See, right now, the difference between the domestic deposit rate and the FCNR rate, it is somewhere around 3% difference is there now. Because right now we are offering the FCNR deposit between 3 to 5 years band is somewhere around 3 to 3.5%, whereas the deposit domestic rate is around 6.5 to 6.6%. So we need to wait for the RBI guidelines to come, RBI circular to come. And then we will decide that what is the interest rate we are going to offer. And then the ALCO committee will sit and decide what is the final rate we are going to offer. But definitely, I can assure you, and I can assure through your channel to all my NRI investors also, that interest rate on FCNRB is likely to increase.
Yeah. Mr. Chandra, hi, good morning. Prashant here, sir. Do we know that whether the deposits mobilized through the FCNR scheme will they be exempt from SLR and SLR requirements? I mean, I think they were, right, when this was done earlier?
Yes. I think in the latest announcement also, I think it will be exempted from the CRR and SLR requirement. So that much cushion will be there for the banks to improve the NIM and thereby improve the lending rate also there.
So this makes it even more, then it makes it very attractive, right? I mean, actually for...
Going to be very attractive. See, there was liquidity in the system, but only challenge that was there, that cost of deposit was a little bit higher side. I think with this one important measure which the RBI has announced, definitely there will be liquidity will be there, which is already there in the system, but the deposit rate will come down, cost of deposit will come down. And to that extent, the banking sector will, their NII and the NIM in the long run going to improve. And another important aspect will be because all these FCNR deposit is going to mobilize between 3 to 5 years band. And generally, we know that the retail term deposit or the bulk deposit which the banks mobilize, that is for the duration of 1 to 2 years, maximum it is during that period. So with this channel, banking sector will have the long-term deposit in the system.
Right.
So there will be a stability.
Just one further clarity on this, Mr. Chandra. You did say that the differential right now is between 2.5 to 3 percentage points between the return that is given on FCNRB versus what is on regular term deposits. And you did believe that this can increase. With the RBI now taking care of the hedging costs and with, there being no SLR or other statutory requirements on funds coming in through this, obviously back of the envelope calculations do suggest that you can increase the rates on this by about 2 percentage points at least. Do you think that is realistic, or would it be a little less than that?
I will not suggest that what rate finally it is going to happen. I have already indicated that is the difference between the domestic rate and the FCNR deposit rate, which we are offering it. We need to wait for the RBI circular and guidelines to come. What are the measures they are announcing and what are the provisions they are suggesting. And based on that, our ALCO committee will sit and they will decide. But definitely, the interest rate which is being offered now and going to be, there will be good improvement will be there in the rate.
All right. Just a final question before we let you go. And this is aside from what we've discussed so far. This is on the current borrowing environment and more importantly, the credit environment. Given the sort of prolonged nature of the war that has taken place, the increased uncertainty around inflation, etc., have you faced any sort of stress in your book in the quarter that we're currently in? Are there any early signs? And what about credit offtake? How do you foresee that after your fourth quarter, now that we're in a new financial year and, the war has prolonged as well?
To be very frank with you, in fact, as of now, we are not seeing any stress happening in our book. And neither the growth is shrinking in any of the sectors of the book now, like retail, agri, and MSME. Like MSME, last year, full year, we have grown at 20%. This year, April and May also, the data which we have, we are growing more than 20%. Retail also, we had grown more than 18-19% last year, and we are maintaining the same trend YOY. Agri also, there was 15 to 16% growth was there. So all these sectors, which in the 25-26, the growth was there, we are almost on the same trend. Rather, in some sector, we are seeing the good tractions happening. But yes, we are all aware that the challenges which is going to come, and we are all prepared for that. And for that, the government of India has rightly came out with the ECLGS for 2.55 lakh crore now. And we have sizable likely to offtake happening in that particular segment.
Yes.
So we are all prepared and we are all aware that going forward, there will be some challenges in the system. Yeah.
Mr. Chandra, very quickly, loan growth of 12 to around 13%, NIMs at around 2.6%, and ROA headed to around 1%. All those on track, right?
Absolutely. Absolutely. We are on track on that.
Thank you.
All right. Thanks a lot, Mr. Chandra. Always a pleasure speaking with you. You gave us a lot of important data on, the announcements that came by on Friday. But at the same time, the commentary around growth and no stress have been fairly satisfying as well, given the sort of uncertainty that we are in right now. And does that relate into growth in consumption or not? Let's bring on the next guest on our channel. We have Arnab Mitra from Goldman Sachs who joins in. He does believe that maybe FY27 could be the year where consumer staples stage a comeback. Arnab, always a pleasure speaking with you. I was looking at your note. You do believe that this year could be one where everyone who's waiting for Godot may finally see them in the staples space. Just one question. You said that maybe this time around there could be earnings that would be better than the street expectations in the staple space, and there could be perhaps some sort of re-rating that would take place as well. Before going into the fourth quarter numbers, what were your and consensus estimates on FY27 earnings? Post these numbers, post the price hikes and all the commentary that has come by, how much have those estimates been increased by? And how much further of an upside do you see in the space, given the sort of commentary, price growth, and valuation upside that there is?
Yeah, thanks, Mangalam. Thanks for having me on. Great to catch up with you again. So I think on the FMCG industry in general, the fourth quarter was very, very strong. In fact, the entire second half was quite strong. But if you recall, when the third quarter was good, there were a lot of concerns that maybe it is channel restocking post the GST destock. And what we saw in the fourth quarter was this was in the last 12 quarters, the highest volume growth, the highest revenue growth, and the highest EBITDA growth, if I take the aggregate of all the stocks that we cover here in under staples. You asked a question about earnings upgrades. That's a bit interesting because before the fourth quarter results came, the Middle East conflict had started. And I think most analysts, including us, had lowered our estimates based on the increased crude prices. From those estimates, I think estimates went up as the fourth quarter results reported. I think the key question that we are getting from our investors is, was the fourth quarter, third quarter backward looking? Now in the context of what's happened in the Middle East and the El Nino and the concerns on the monsoon. And that's where what we believe is both these factors are genuinely factors, but the growth in the fourth quarter is likely to continue in the FY27. In fact, if anything, there could be some acceleration in growth because of pricing-led growth coming in, while there could be a slight downtick on volumes, which historically happens when price hikes are very strong. But for the FMCG sector, generally FY27 could be the best year since FY23, which was the last strong year of growth that we had seen.
Right, we take that point. One would have the proclivity towards staples during inflationary periods because for the last many years, price growth has been, not coming by, even though volume growth was there. And now additional price growth could support growth for the overall growth for these companies. At the same time, inflation could take out some competition. I get the thesis out here, but what's your trade on staples versus discretionary? Because on the one hand, while staples could benefit, discretionary may face the trifecta of higher volume growth, rather higher competition, higher inflation eating into potential volume growth, and maybe from a valuation standpoint, staples looking a lot more attractive as the discretionary part is saturated. Would you be in that camp and bet on staples over discretionary? Or do you believe discretionary continues to do well and staples catches up this year?
No, we are definitely in the camp that there could be some challenges in small ticket discretionary. I would want to distinguish between high ticket, premium, very luxury discretionary and small ticket discretionary. If it's ultimately the consumer wallet is going to be under pressure, consumer will spend more on essentials, whether it is FMCG or it is fuel. And therefore, there will be some pressure on the wallet, which will have to come out from somewhere. We do believe small ticket discretionary, for example, something like fashion, could have some challenges in terms of underlying demand. Staples should do better because historically price elasticity of demand has been low. That's number one. Number two, large companies tend to gain a little bit of share from small companies in this period. And the third is that the price-led growth always typically gives some operating leverage, which can offset the gross margin pressure. So staples, I think, is in a good place. Small ticket discretionary could face input cost inflation and a slight hit on demand. We have to just watch out for that. Large ticket affluent consumption, I think, is still, that's been a structural theme for the last many years. We don't see that getting derailed.
All right, take that point. Short but effective conversation. Arnab, we'll continue to revisit this thesis periodically as we speak to you. But for now, we'll have to let you go because there's an interesting conversation which is currently underway. Lata is in conversation with the former CHEBI whole-time member Anant Narayan and ICICI Pru's S. Naren, who will decode what the RBI said and the impact of that on the market. Let's hear that out.
Fear that they bring in and the next day the value goes down because of the currency. The currency was becoming self-fulfilling. If that is out of the way, which it looks like in the next few hours, perhaps by end of day we will know. Do you think that the FPI attitude to India, both in debt and equity, is going to be much different?
I think FPI and debt certainly immediately and one thing what we have to keep in mind is and this is learning over the last 20-30 years, you have to break vicious cycles. So when UTI was in trouble in 90s, they created SUTI and UTI, and no one would have believed SUTI would have created so much money. In 2008, for example, when Ben Bernanke bought warrants in all the banks and said, I'm backstopping all the banks, they made huge money on those warrants. In 2019-20, when, the government supported Yes Bank and made the other banks invest, a lot of people criticized how can the banks make money? Every bank is sitting on huge profit out of that investment. So what we have learned is when you have vicious cycles, and because today we don't have current account deficit, we have a huge gold reserve, both with the people and the Reserve Bank of India, and still people question dollar rupee. You have to break vicious cycle. There's a cost for the vicious cycle which is very small, which Reserve Bank can afford to break. So that's where it is. So once the vicious cycle is broken, will FPI money definitely look more positively in debt? Yes. Equity is today, there's so many questions, AI, no AI. I mean, what's happening in the world? It'll come, but it's not something where one RBI policy changes equity money. And that is what is very evident at this point of time. But is this a positive development? It breaks the vicious cycle of rupee? Certainly. From that point of view, it certainly does.
Yeah, I mean, we are going to discuss both FPI attitude and our growth and earnings cycle in just a minute. Let's just finish the policy to practice dialogue on the most newsy bits, and I'll come to the larger growth issue. Anant, on the FPI, tax removal on FPI debt, both withholding and capital gains. In your learning and in your understanding, how good is this from an FPI point of view? You must have met many of them during your both trader journey and your SEBI journey. Will this be a huge relief? Will this be a minor relief? What can be the response?
So Lata, I think of the announcements made on Friday, this is probably the most consequential one in terms of medium-term policy. And I have to commend the government for biting the bullet and saying that at least for government bond investments, there will be no tax liability on foreign investors. Now, I know this is a tricky topic and lots of people have strong views on this, but the reality boils down to this. Globally, every country or most countries follow the OECD norm of saying that foreign investors will be taxed in their country of residence. So it's a residence-based taxation as opposed to paying tax where you're operating, as opposed to a source-based taxation. A few years back, we effectively moved to a source-based taxation where we said foreigners have to pay capital gains tax here. Of course, we also said that we will put in place double tax avoidance treaties, etc., so that the liability on foreigners does not go up across what they have to pay in their home country and what they have to pay here. However, in practice, that double tax avoidance did not work always.
Oh, really?
Yeah. In the sense, if you are a sovereign wealth fund, or if you're a person based in Singapore, or if you're an endowment for a university in the US, which is exempt from paying capital gains taxes, if you have withholding taxes in India, what do you set it off against? There is no set off. Secondly, if you're an investor coming via a fund and investing in India, then what you get when you exit is a provision for withholding tax which your fund deducts. That provision for withholding tax cannot be set off against the liability you have in your home country. Finally, and all of you are market participants, you'll understand this. In India, we calculate capital gains on a rupee basis. Now, a foreign investor might actually have a loss in a dollar basis or a euro basis, particularly at a time when rupee has been depreciating. But yet, you have to pay a withholding tax, which is computed in rupee terms. What do you set that off against? And finally, think of the process, implications for people coming into the country. For every sale of security, you required a tax certificate telling you exactly what the tax liability is. You had to make sure the tax liability is made good. Only then you could remit the funds out. Can you imagine the nightmare? Now, I have to commend the government for doing the analysis and at least for government bonds removing this particular requirement. By the way, at least my back of the envelope implications. Foreigners typically hold about 3 lakh crores of government bonds. Assume a 7% interest. So every year, they're earning about 21,000 crore rupees. If you take 15% withholding tax, including surcharges, etc., that's about 3,150 crores of annual withholding tax held by the government. In the overall scheme of things, in the fiscal balance that we have, it's a rounding off error.
It's a decimal point.
It's a decimal point. So what are we trying to achieve by having these taxes? And I have to commend the government once again for removing this massive irritant for investors, at least for government bonds. Now, two things. We were not included into the Bloomberg Global Aggregate Index in the beginning of this year. There was a review done by that particular group, and they quoted a few issues. One of them was tax. This ordinance, which has been passed by the government, paves the way for Bloomberg Group Aggregate Index to include India into its index. I'm not saying it's a done deal. There are other issues that have to be worked out, but I have to again commend the RBI as well. Many of the other issues in terms of accessing government bonds, including on our systems, have actually been addressed by the RBI.
All the subcategories have been removed.
Subcategories have been removed. See, it's also a question of market access. Foreigners who are dealing in multiple countries don't want to log in only into a specific India system to be able to trade India bonds. They would rather do it through their Bloomberg, front end or some other front end. What RBI has done, I have to commend them for understanding the market. They've actually created market access, and I believe even the Bloomberg access and other access will be available very soon. So actually many of the irritants which were there for foreigners has now gone away, which means it's a matter of time, hopefully, before we get inclusion into the Bloomberg Aggregate Index. That alone should bring in passive flows of $25–30 billion to start with, besides getting in, Japanese insurance company, European insurance company flows on a regular basis. I'm also hoping that this paves the way for a similar discussion to happen on equity markets as well. Again, there's a lot of disinformation doing the rounds. Nobody is exempting FPIs from anything. We are simply saying you please pay whatever taxes are liable in your home country rather than having to pay a tax here. By the way, if you and I are Indian residents, Indian passport holders, when we invest in the US and in UK or in Singapore or in Japan, we do not pay capital gains tax in those countries. We only pay capital gains tax in our home country in India, barring some very few exceptions like real estate investments and stuff like that. So we are simply going, India was a massive outlier in terms of the way we treated tax. Commend the government and the RBI for removing this aberration status, at least for government bonds. I think removing this for equities as well should be the next step.
That's extremely well explained. This unfortunately got into a narrative, you're taxing domestics and not FPIs. An extremely wrong comparison. It is a destination-based tax and you're taxed in the country of origin. That narrative needs to be re-established, and hopefully, like in 1991, some of the misgivings of policy will happen, and this dialogue between policy and practice will continue at the highest levels. But to continue that point, Naren, you began by saying that you think FPIs in debt will be impressed by the fact that they may not lose on the currency front. What are you picking up from your, FPI visits? Do you think this Bloomberg inclusion looks ever more likely now?
I think so. I think, see, in debt, there are two factors. One is currency, second is taxation. Both have gone very positive. And so that's why I think the chances in debt are very, very high that Bloomberg can consider much more positively. And that's why I think on the debt side, clearly, I would say that the mood is very, very optimistic. Yields had gone off completely away from the repo in almost all the 3-year corporate bonds and all these things. It gave us an investment opportunity to invest, but it had diverged so much from the repo rate. So many of them are coming down now at the rates. So that's why I think on the debt side, clearly there is good scope, actually.
Yeah, actually, AAA companies are borrowing at 300 basis points above repo. Maybe that's not the comparison we should make, but so is the government of India. Borrowing, some 200 basis points above the repo. So this was a great opportunity. But more to the point, in terms of the current, currency flows or debt flows, last time before the JPM inclusion, people front ran. So do you really wait for the index inclusion, or even if, the wind is blowing in the right direction, things may work positively?
Actually, today you should look at how Japanese government bond yields are, how US government bond yields are. The gap is also very low. So for people to decide, okay, instead of buying Japanese government bond, let's buy India, that gap is so low at this point of time that how can people do this investing ahead? Because you're getting very, very juicy yields across the world today. I don't think Japanese government bond yields have ever been high like this in the last 30 years, maybe. So that's why and today US 30 years gives you 5%. So there are a lot of, there are challenges that India has managed their macro much, much better in the last 12 years, that the gap between Indian yields and the US yields is very different from 2013. So this is one of the things that we have to keep in mind when that in 2013 you had zero interest rates in the rest of the world. So if you offered 5.5%, you got 5.5% was a phenomenal rate. Today, 5.5% is a rate you can get in a 30-year government bond. So that is the difference at this point of time. So we are in a very, very different global environment in fixed income. I think totally different from 2013.
Since you picked up the mic, I assume you wanted to say something?
No, I think Naren makes an extremely important point. The steps which have been announced on 5th, first on taxation, this is a medium-term correction which had to happen. Do not say that this is a tijori which is being opened and suddenly flows will start to come in. We are simply creating the conditions for money to come in more on a realistic basis. Similarly, what has been announced on FCNRB is a way to shore up our immediate reserves so that it gives a lot more of buffers and confidence to the ecosystem to precisely do what Naren was saying, which is break this vicious cycle of negativity around the rupee. Having said that, that doesn't mean that we immediately start to see large amount of flows coming into the country. And here I want to add to the point that Naren is making. Look, we are trying to achieve multiple objectives together as a country. I'm kind of imputing motives out here between the government and the RBI. So we want a somewhat stable rupee, or at least a rupee that doesn't underperform the way it has been underperforming over the last 2 years.
Well, indeed, you don't want the rupee to underperform. If I look at a like-to-like comparison, I think only the Turkish lira has slipped as much as the rupee this year. And obviously, fundamentally, the rupee is much better placed. And as, Anant as well as, Naren made that point, that this is a very big and bold decision that's come in from the RBI as well as the government with regard to bonds. Hopefully, flows come back. For the time being, we slip into a short break. On the other side, we have Manisha Gupta, who will be joining to turn the attention to the commodity space. Stay with us.
Welcome back. The Nifty down about 185 points, a recovery from the lows. The number of stocks which are advancing from the opening have advanced to about 900, so that's a positive. But what's taking place in the commodities space with the up move that we've seen on crude? Let's hand it over to Manisha. Manisha.
Well, thank you so much for that. We started the Asian markets today with 3% of gains. We're trading 4.5% on the higher side right now. Much of the news that the markets are factoring in comes in from the weekend, where we did see Iran launching multiple rounds of missiles towards Israel. And there have been statements from US President suggesting that Israel should be avoiding retaliatory action against Iran. But that's exactly what Israel has done. We do understand, as per the latest reports coming in since morning, that Israel indeed has taken some retaliatory action against Iran, and that has taken the prices much on the higher side there. Strait of Hormuz, remember, now remains shut for a fourth straight month as we enter into June, and that this is something that would continue to support prices going forward. There was an OPEC Plus meeting over the weekend as well, where they have decided to increase production by 188,000 barrels per day going forward. But the markets do believe that this is majorly going to be on paper, because in sense of production, exporting it is something that most of these OPEC members at this point in time lag. The China's demand decline is something that seems to be balancing the markets right now, but the street does understand that as soon as that Chinese demand comes back, which fell by 3.5 million barrels per day in the month of May, you could be looking at a very strong spike coming in for the crude oil prices therein. This is the fourth quarter 2026 forecast that has come in from various banks and brokerages, and clearly all of them believe that the prices are going to stay at elevated levels above $90 a barrel. You have Barclays suggesting $100 of an average for the fourth quarter, 97 from JP Morgan. HSBC is given a number at $95. Goldman Sachs believes that 90 is an average that we could be looking at, and you have US EIA talking about almost 90 as well. But this is if the situation continues to be status quo. When you look at the worst case scenarios that many of these banks are factoring in, that could be because of exhaustion of global buffers. This could happen by the month of July or August as well. Remember, much of the strategic reserves are now coming into the market. So if this continues to decline, the global inventories anywhere are near multi-year highs, multi-year lows there. July closure, if that happens, we are into the month of July and the Strait of Hormuz is still shut, then the structural deficit of 6.6 million barrels per day is what the street is working with. Apart from that, it also is about the long-term rubber band effect that the street is talking about. But this is important. The Gulf states will continue to fast-track the overland pipelines bypassing the strait. So this would mean that, yes, there could be a price shock in the third quarter of this year, but by the fourth quarter or by 2027, you could be looking at a lot of crude oil not coming in via Strait of Hormuz, but coming in via the lands and pipelines there. Now, this can take the prices much on the higher side in this year, but lower in the next year as well. So worst case scenarios, when we listen, when we hear, and when we read those reports from various of these banks, Rabobank, for one, believes that if it is August and we are still in where we are, we could be looking at $140 a barrel then. Xanalyst is talking about 120 by the time it's July end. World Bank also says 115 of an average is a possibility by the end of this year, and Fitch Ratings puts it to $120 a barrel as well. But the most bullish of it all comes in from Wood Mackenzie, and they're saying that 11 million barrels per day of crude is as of now trapped behind the blockade there. And the physical and the buying shortages, the panic, all of that could take the prices to almost $200 a barrel. That is if we are into the third quarter end and nothing changes. That's the kind of price levels that we perhaps could be looking at. So clearly a lot of concern coming into the markets as we're looking at more further geopolitics arising out there.
Take that point, Manisha. Everyone will hope for peace and not those high levels that you're talking about right now. But with that, we'll wrap up on this edition of Bazaar. You don't go anywhere, because the team of Chartbusters comes back for all the market updates and corporate conversations. The Indian market opens up with a gap down as the ceasefire in West Asia threatens to unravel with Israel and Iran trading strikes, sending oil prices higher. Stock markets make a slight recovery, come off lows, but still remain under pressure.
Divi's Laboratory, one of the few gainers, as Eli Lilly's drug delivers strong results in diabetes as well as obesity drug trials. Analysts expect this to be a significant contract manufacturing opportunity for Divi's. Going ahead, the stock is outperforming with a gain of around 0.5%.
Shares of EMS surged nearly 14% as the company emerges as the lowest bidder for a 103 crore rupee Jal Nigam project in Uttar Pradesh.
AG Infra receives a provisional completion certificate for near 5,000 crore rupee project in Uttar Pradesh. The stock is up close to 4%. Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. We're still with you, having an extended session today, post-bazaar into Chartbusters as well. And you look at the top of the screen, you'll see you're a little bit disappointed. We're at around 23,200. It's not disappointing. Look at the remainder of Asia. India is outperforming today, and it's been a while since we could talk about that, Mangalam. Not too bad. Number of stocks advancing as well have moved up from around 300, I think, to around 650 odd. And the markets have bounced off the lows. So pretty encouraging, I would say.
Pretty encouraging. The Nifty is back at 23,200 as we speak. The lows today were closer to 23,050, so about 100, 150 points higher. And if you look at the other indices as well, we have the Nifty IT index that comes up for you. At one point, it was lower by over 2% and currently has recovered. We have the Nifty Bank as well, which is marginally lower right now, but off lows. So the Nifty IT index as well as the Nifty Bank, both of them come up for you. Both of them off lows and still in the red, but where we go from here would be extremely crucial. Let's welcome Ajit Mishra of Religare Broking for a quick technical check on the market. Ajit, all of last week we saw a bit of a decline, but lows were maintained. The same happened today as well. The question is whether this is for real and whether we see any uptick from here on or not.
Yeah, good morning, Mangalam. Good morning, Nigel. So what we are seeing, Mangalam, largely if you see that it's almost 1.5 months now that the declining trend is intact. Means we are gradually drifting lower. And today we have almost retested the lower band of this declining channel in which currently Nifty is trading in. At the same time, we are seeing put writers being active at 23,000, 23,100 mark. And that's the reason why we are seeing a rebound happening in the index. Banking is showing relatively higher strength. Last week also we were seeing a similar trend. And let's say once we cross this hurdle of 54,700, 800 levels, probably banking may provide the needed push for further recovery in the index in further session. So overall, I'm expecting consolidation to continue with 23,000 being the immediate base and 23,500, 600 being the immediate resistance area.
Got it. All right, Ajit, what about individual stocks? What's on your radar?
Yeah, so Nigel, considering the overall buoyancy in the banking, first name is from the banking pack, the outperformer Federal Bank trading at the record highs, consolidation range, breakout, very strong volumes. So everything is aligned for this prevailing momentum to continue. So 325 is what we are eyeing in Federal Bank. So one can accumulate even at current levels with 296 as a stop. Then we have pharma and healthcare basket where we are seeing noticeable strength. Means after this marginal pullback, we are seeing Fortis, Astra DM, Apollo Hospital. All these names are buzzing in the trade. So Fortis is something that one can look to accumulate fresh with 1,060 as a target area and 968 as a stop.
All right, take that point, Ajit. Thank you so much for joining in and giving us your picks on the stock side and the indices. We'll take a short break. On the other side, we get chatting with the management of Stovecraft on their FY27 outlook. Rajendra Gandhi joins in. Welcome back. You're watching us here on Chartbusters. While the indices are lower, look at a couple of individual stocks. Z has seen a big up move from the lows. The board meets on June 10th, which is day after tomorrow, to consider a fundraising. The stock's done well already. This month it's up around, 25%. And add to that, a near 5% move from the lows, currently sitting with a gain of about 4%. And a bunch of other stocks as well, which are moving around. The stock on our radar right now, however, is Stovecraft. Rajendra Gandhi, who's the managing director, joins in to decode the growth plans for FY27. Thanks a lot, Rajendra, for joining in. You just about managed to do about 11% growth in FY26, slightly below your guided range of 12 to 15%. But the fourth quarter, you were saved by a big up move that we saw in induction cooktops. And that really is the first question. What's the kind of growth that you foresee in induction cooktops in FY27? Have you increased your capacity? It accounts for about 15% of your sales. How much is it likely to grow in FY27? And as a result of which, the overall guidance that you have for this year?
Yeah, good morning and thank you. The induction cooktop is really doing very well. There is huge acceptance and push for this product in the market. We are growing substantially higher than the last year. While last year was around 15% contribution, we are very likely to cross twice that contribution from induction cooktop in this year.
Okay, all right. Yeah.
Go ahead.
That will lead us to a better growth than the normal growth rate that we were planning to do year on year. So definitely our growth this year, if the same momentum continues, will be much better than what is anticipated at the beginning of the year.
All right. Hi, Mr. Gandhi. So I can see induction cooktop is around 15%. But there's also air fryers, and the other segment, which are ancillary, so to call it. If you put that together, as a percentage of your total mix, how much is it? 15% is induction cooktop, which will move up. You add to it air fryers and other ancillary products. What will it be in total?
So cooking appliances along with induction cooktop is about 30% of our business. Okay. Only the cooking. And we believe this can easily double this year.
Got it. And this is margin accretive, this part of your business, or is it margin dilutive?
It is agnostic. No, it is for us agnostic.
Got it. All right. Another quick question. In COVID time, 2021 or 2020, 2021, you all had a brilliant run. Not just you all, actually. It was for the best for the entire industry. So it wasn't a company-specific thing. It was an industry-specific thing. Mangalam and me were not cooking, I can assure you that. But there was a lot of demand out there. Are you seeing some replacement demand coming back now? Because we're 5 years down the line. I think it was expected after 4 years. But is that playing out and aiding demand on ground?
Yeah, early users have adopted to many of these cooking appliances, which hitherto did not find a place in the kitchen. Most of these people who acquired these appliances during COVID is now time for replacement. Definitely, there's a huge opportunity around the replacement. But overall, as the cooking appliances segment is seeing a lot of growth in the consumption. People are using more and more of electrical cooking appliances. With the challenges on LPG, this is also giving a momentum to these cooking appliances. Both replacement and adaptation of these electrical cooking appliances is what we are witnessing at the moment.
Right. Could you give us a sense on how your capacities are right now, how capacity utilization is? Because if you're targeting doubling of growth in your induction business and small appliances, I'm sure you would have some capacity headroom. If not, then maybe some capex plans. Because some of the other larger players, we spoke with TTK Prestige, they are looking to double their capacity in induction.
Yeah, we are adding more and more assembly lines. We are every month on month, we are increasing our capacity. We are fairly now well capitalized on the capacity. We have on the base of last year, we have a capability to produce 3 times of the induction cooktops. We are very near that capacity now. I think we don't require any large capex for this. We have enough facility in the company. It is more to add with the supply chain management and the assembly lines. Okay. On capex, there is no requirement for capex for additional for increasing the capacity on our induction cooktop.
Got it. Okay. Now let's get a couple of factors clear. And Mr. Gandhi, in the past, the street has been disappointed with the over-promising and under-delivering. So let's be very, very cautious on that aspect. Going by the guidance that you've given, you should end the year at around 1,850 crores. That's basically a 15% growth. At current reckoning, do you think you can do better than that? Point number one. And IKEA as well will be contributing this year, right? I think that starts off in the first or the second quarter. How much will it contribute to this entire revenue mix?
Yeah, IKEA is at the beginning of the business. While the last 1 year we've been developing the products, it is a fag end of approval, and we'll start business very soon. But the bigger opportunity this year for the current year is the cooking appliances. With the current trend, we will be able to definitely deliver better than the 15%. Far better than the 15%.
The other problem is on margins. What about margins? Last quarter, that is
the
quarter.
Operational leverage will set in. The challenges that remain are Forex. There is a huge volatility on Forex cost, and also the input cost. We were able to pass on the input cost increase in the first quarter. We will have to further pass on further price increases and various other input costs, freight going berserk, and then with the Forex also going up. Majority of our inputs on many of these the components are all imported, and both on RMB and dollar, we are seeing huge pressure on cost.
You're not giving us the number, sir. You're not giving us the number. What kind of margin should you look at? You mentioned there were some Forex losses. I think that impacted you in quarter 4 as well. You're saying input costs have gone up, but you've also taken price increases. And the operating leverage as well you're talking about. Put everything together, give us the margin band.
We are able to achieve better margins than in the past. Definitely will be better than 11%.
Definitely will be better than 11%. You're guiding for revenue growth of over 15% and margins definitely better than 11%. A lot of this is also predicated on, how the working capital pans out. Your cash conversion days had come down in 2026. At what level do you expect it to be maintained in FY27?
I'm sure we'll be at the same level or better than this. Maybe for 1 or 2 quarters, we are building up inventory to cater to this huge surge in demand. But for the year as a whole, we'll definitely be at the same level or better than the number 27 days.
If I look at your shareholding in June 2023, your own shareholding was a little over 55.3%. That has come down by a smidge. It's below 55.2% over the last few years or so. I wonder whether there is open market sale from you or maybe there's shareholder dilution. But the stock is well off highs. Do you believe that this is a good time for promoters to perhaps, given the sort of upcycle that you're seeing in demand, maybe show some confidence and lap up some shares from the market? Or you would avoid that?
Now, we are committed to our shareholders. On the dilution, there is a ESOP program that we run in the company. And as and when this gets allotted to the employees of this company, there is a dilution of the shareholders. Otherwise, there is no dilution of my personal shareholding. Definitely, we are looking, wanting to get to below debt levels and have enough cash before we can explore any buyback. At the moment, there is no plan. But then definitely as the company moves forward and we have enough cash, that will be one of those things that we'll look at.
Okay. Just a couple of things. IKEA will contribute how much to this 1,850 crores odd revenue that you'll do this year? I think at peak it could do around 250 crores.
Yeah, that is 2 years from now.
This year?
Between 30 to 50 crores is what.
30 to 50 crores. Okay, you're accounting for that. Also, if I look at your OCF, as a percentage of your market cap, OCF, you're doing more than 200, 250 crores. So if you're saying that the promoter entity will not be increasing stake, why don't you do a buyback? I think you have adequate capacity, right? So update us on the peak capacity, revenue potential from your current existing investments. And also tell us why not do a buyback?
Yeah, we are not ruling it out. At the moment, we still have some small debt on the books, and there are some small maintenance capex that is going on. And with that, it's not that we have too much of free cash. We can do a buyback that will be very small and then not worthwhile. Definitely, we'll explore this. I think at the end of the year, end of this current fiscal year, we'll have enough cash and then we can explore this.
Got that. Take that point. Just a final question from my end before we let you go. Exports, which were about 9% of your revenue in the fourth quarter. What's your target for exports in FY27? And that would be more accretive, right? Given the rupee weakness that we've seen.
There are some input cost challenge that has been addressed now. Our customers have given us the price increase that is required. Going forward, the margin is again agnostic going forward. On the contribution, we believe it will be closer to between 12 and 13% of our business.
Okay. And very quickly, sir, EBITDA margins we've got, your PAT margin is only 2.5%. You're doing 1,600 crores of revenue, doing profitability of 45 crores approximately. Do you think this PAT margin number as well moves up? I know the interest cost has been high, depreciation cost has been high if you look at your line items. What is the targeted PAT margin we should look at?
Between the next 2 years, we should be between 7 and 8%.
7 and 8%. Oh, okay.
That'll be quite a jump. Thanks a lot for joining in. Again, in the past, you've been promising a lot to shareholders. Delivery and execution on those things will be extremely important. As of now, the street will hold you on to the numbers that you've given. 15% plus revenue growth for this year, 11% plus EBITDA margins over the next 2 years, net profit margins of 7 to 8%. At the same time, they may mull a buyback towards the end of this year, with exports accounting for about 12 to 13% of sales, doubling revenue coming in from their appliances, which include induction tops. That's about Stovecraft. The stock has moved a smidge higher, but again, as the management has promised, delivery on those numbers will be extremely crucial to track. With that, let's get you some ideas for profit. Our colleagues at Money Control Pro joining in. Varsha Bang joins in this morning with the stock that she's been tracking. Varsha.
We continue to like V2 Retail as a compelling play on India's growing organized value fashion segment. Quarterly performance remained impressive, with revenue increasing 60% year-on-year, and EBITDA margin expanded to 13.7% from 11.6% a year ago, supported by better merchandising mix, higher full price sale, and operating leverage. A key positive is that performance remains largely volume-driven rather than pricing-led. Same-store sales growth stood at 8.6% in FY26, despite the addition of 139 stores during the year, indicating sustained customer traction across both existing and newly opened stores. Store expansion remains the primary driver of investment thesis. V2 Retail ended FY26 with 325 stores and plans to add another 170 to 200 stores in FY27, providing strong visibility on future scale-up. Importantly, new stores are achieving nearly 70% of mature store productivity from inception, supporting faster break-even and improved capital efficiency. At around 24 times FY28 earnings, valuation appear reasonable considering the company's store rollout pipeline, improving store economics, and potential to gain market share in the organized value fashion segment.
Thanks a lot for that, Varsha. Well, for the time being, we'll slip into a short break. We'll get you more on the markets as well as on stock-specific action on the other side. Stay tuned. Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. Well, there was some incremental negative news flow that was flashing at the bottom of your screen that things appear to be escalating, but it seems the street is factoring in that this will actually not blow out. That's at least the belief as of now, because crude oil prices, they continue to remain at around $97 per barrel mark, but the Nifty is not reacting currently to that headline that did come in. So we'll have to keep an eye out on that front. And for today, at least, the Indian markets actually outperforming what our Asian peers are doing. Crude oil prices are up. That's a negative for India because we import most of our crude requirement. However, Asian markets are getting slammed. We are down just around 0.5% to around 0.7%, which is heartening to see. Not just that, you pull up the advanced decline ratio. The number of stocks advancing from the start of trade has moved up from around 350 all the way to 950. So that's good news. And a few stocks, Mangalam, that are bucking the trend. You pull up Physics Wala. You know, that one's really spiked up in the last few minutes. That's moved to the high point of the day. I recall having a chat with the management, and they said in the next 2 years, they're very, very confident that they can deliver much improved profit numbers, you know, as the centers that they have start maturing. So that stock is up 7%. Tilak Nagar Industries, the stock has corrected, I think, 25% from the top. That one from the day's low actually has popped up, and volumes are fairly okay. So that's another stock that we are looking at as of now. And Thomas Cook, you know, that's another big underperformer. Stock went down to sub 100 rupees, but from there, Thomas Cook, the bulls will say they're cooking.
The bulls would say they're cooking. Bulls would also say that maybe some of their forex business starts to do well right now, given the weakness in the rupee that we're seeing. But meanwhile, you know, temperatures are rising, right? So you have a lot of these summer plays which are doing extremely well as well. So pull up something like a Blue Star, which has moved to the high point of trade. Voltas isn't doing too badly either. That's moved higher as well. Summer typically does well for a lot of these consumer demand companies. So you have Varun Beverages as well. A large part of their revenue comes in from India Pepsi business, and that stock too has moved to the high point of trade. But good time to get in Vinny for a quick check on a bunch of stocks which are abuzz, EMS and HG Infra. Vinny.
Hi, morning. So firstly, HG Infra, why is the stock buzzing in trade today? The company has actually said that they've received that completion certificate. This is the provisional completion certificate for around a 4,970 crore project that they were working on, which is the Ganga Express project in Uttar Pradesh. This project was an EPC project for them. So civil associated work, EPC work is what they had done on, and this is what they'd received from the Adani companies. And that is why the completion project was positive for them, and that stock is buzzing. Apart from that, obviously, EMS Limited, they've been declared as an L1 bidder for the UP Jal Nigam Varanasi project. It's a turnkey sewer network project for house connection projects as well. And the value for this is 103 crores. It will be executed over a time period of 2 years. And that is why this one is in focus today.
Okay, all right. Thanks, Vinny, for that. Sharp uptake on that particular name as well. Well, earlier today, we spoke to Samir Arora, founder and fund manager, Helios Capital, and asked him about the Reserve Bank's latest measures and what could it mean for the Indian economy. Let's listen in to what he had to say.
When you see economy size, bank size, you know, you can easily get 40, 50 billion. Now, it depends exactly. But it won't be outside, it won't be less than this range. I am thinking, because I spoke to 2-3 private bankers here, and they said you could get 75 billion also. But the only thing is that I believe now, after talking to these two guys, that India may have to stop it after 1 or 2 months, because this time you can do it till September. Maybe they have in mind, RBI has in mind how many billion they want. And they should create that impression so that these banks run around faster. The only bet you are taking is that India does not impose capital controls 3 years later when you have to get your money back. That bet every NRI will take very easily. No, I don't expect anything on equities. I have been saying that it is wrong and you are losing many billions. But I don't think anybody is doing that. But it's okay for now. This is quite meaningful in itself. And this whole world works on delta. It does not work in absolute that way. So this news is quite positive, and this can keep us going. And then we see, unless there's another issue in life that happens later.
All right, flirting with the 23,200 mark on the Nifty right now after having corrected about over 170 points. We're off the lows, but off the morning highs as well. With that, we'll take your leave on this edition of Chartbusters. You stay tuned to CNBC TV 18. The team of Trading Out takes market action forward. From Nigel Me, thank you for watching.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Patakia. Joining me as always is Ritu Singh. Well, the not so good part to start today's trading session is the fact that the Nifty slipped below last week's low. The good part is that it has reversed from those levels after making a new intraday low today, which is 23,070. And now there is a 130 odd point recovery from the lows of the day. So from a 300 point gap down, we are now around about 150 points lower. So the index trying to hold on to some important levels, but of course we still have another half day yet to go, and the emerging news updates from West Asia are not on the positive side. Ritu, good morning.
Good morning, Hormaz. Let's hope this up move continues in the second half as well. We made a bit of a recovery, still in the red though. The IT pack, for instance, it was down about 2% when we started. It's now down about 1% or so. The Bank Nifty also is still seeing cuts of about 0.5 percentage point. The mid cap and the small cap index as well are down and out. India Wix, that shows you the kind of anxiety in the market. It's up almost 8% as we speak, and the advanced decline ratio shows you that almost 2 stocks are declining for every 1 stock that is advancing on the National Stock Exchange. Even in this market, some of the pharma names, media names, they're doing well. Bharti Airtel is one such name that's helping the frontline index. Power Grid, Maxell, these are some of the names that are doing well in trade. Apollo as well. But on the downside, HDFC Bank, the big boy Reliance, ICICI Bank, all of these are exerting downward pressure. So let's do one thing. We'll go across back to you, Hormaz, on the wall for the top movers and shakers to keep our eye out on.
You know, at the start of the week, the important bit that we wanted to highlight is the fact that last week's low of 23,151, that's going to be an important one for the bulls to defend on the downside. But then the developments over the weekend pushed the index right below that, right at the start of today's trading session. And that's the other thing that we were talking about, that today's opening low should be the intraday low and not go below that. So 23,070 is that index to watch, is that level to watch. Still, we are holding on to 23,200 as of now, and the bulls would hope that this continues to sustain as we go into the second half of the day as well. But the one factor that was working in favor of the bulls all through last week is not doing so today, and that is the rise in oil prices. Brent is now above 97 a barrel, 4.25% higher. NYMEX 2 is trading with gains of around 4%. More attacks that are coming in, reports of more attacks from both Israel and Iran, and it'll be interesting to see how the oil markets react to those developments. But besides this volatility, there are still some names that are looking to outperform in this market, and the healthcare stocks are the ones that come to the fore first up. You look at Syngene, look at Fortis, Aster DM, all of them trading with gains of 3 to 3.5%. Fortis Healthcare almost at 1,000 rupees now. Syngene, after a brief period of underperformance, is seeing some buying at lower levels as well. The selling in metal names continues in today's session. SAIL, Nalco, Vedanta, all of them seeing selling pressure. The metals index itself is down for the 4th day running, and 3 names in this list, SAIL, Nalco and Hindustan Zinc, all 3 of them are down well over 10% during this 4-day losing streak. You take a look at the newsmakers today. Adani Ports, of course, opened lower. Then it announced that contract win in South America and now has recovered from the lows of the day, almost in the positive territory now. Wipro, well, all through last week, we kept highlighting the fact that there is severe dichotomy in the rates of Wipro in the cash market and in the FNO side. There is some catch-up that is currently underway. So another 5.5% knocked off on Wipro. The buyback dates are yet to be announced, so there's adjustments there as well. And Z Entertainment, of course, has gained in 8 out of the last 10 trading sessions now. Since the 22nd of May, the stock is up almost 40%. You look at the high-flying names where profit booking continues in today's session as well. Another 5% lower circuit for both Sterlite Tech and for HFCL. HFCL at one point had even crossed 200 rupees last week. Sterlite Tech had gone up to 650, and now we've seen these 2 lower circuits on back-to-back days. And the capital good names as well. GE Vernova, Hitachi Energy, both had received positive brokerage recommendations last week. They too are seeing some profit booking. And some other names that are bucking the trend today, look at PhysicsWallah. Ever since they made the decision to reverse the NBFC lending decision, the move, the stock has been on an upward trajectory, 6% higher today as well, still below its IPO price of 111. EMS after the order win is up 13.5, and NRB Bearings, the block deal that took place earlier in the day, that stock too is up over 12.5%, Ritu.
All right, Hormaz, thanks very much for bringing us that list. Let's shift focus to one company in particular, Seagull India. That's in focus after signing a definitive agreement to divest its Seamash Road asset in Punjab to Neo Infra Fund for around 177 crore rupees. This comes even as the company has reported a strong earning growth, a record order book, and it continues to diversify into new areas. Ramneek Sehgal, CMD Seagull India, is with us now. Mr. Sehgal, thanks very much for your time here today. Let's start with that road asset in Punjab. You've signed an agreement to sell for 177 crore rupees. First, start with, what is the timeline by which you'll conclude the transaction? How will you use this proceed from the sale? Will some of it go into debt reduction as well? And also, will we see more such asset monetization from the company in this year as well?
First of all, thank you so much for having me over, Ritu. So, yes, we have already signed a definitive agreement for Malotapur Sadhuwali, where they have to pay us 177 crores. And we've got a multiple of close to 1.8x. And besides this, we have signed another two SPA, the binding documents for, non-binding document for Bathinda Dawali and Jalbida Shabad. So we are targeting to sign the Bathinda Dawali by next month. And the third one would be next 6 months. So with all these three, debt closer to 750 crores will go, and equity more than 400 crore will come to the company. And we are in the process of doing this, and we have made almost 35% of the project IRR in Malotapur Sadhuwali. And as I said before, we always target a minimum 25% of IRR in all these HAM projects. And we are within that range. And in fact, in Malotapur Sadhuwali, we've gained better than that. And order book has always been a great, we have got almost 11,332 crore against what we guided our investors, which was 5,000 crore.
Mr. Sehgal, thank you for taking time out today. So that you mentioned that there is some of your debt will see reduction after this. So what will be the overall debt figure, if you can tell us that? And is there a plan to become net debt free or just debt free in the near future?
So, at company level, our debt is one of the best in the industry, is 0.2x debt equity ratio. And whereas on the console level, it's 0.6. So after the 760 goes down, we'll be at 0.49. So it's one of the best in the industry. And, the debt on the HAM is a very safe debt, I would say, because, after the projects are completed, it becomes AAA rated. Malotapur Sadhuwali was already a AAA rated asset. And we were making 29% equity IRR on that project. So, if you see on the whole, our debt ratios are one of the best at the console level. And after the 760, it'll come to 0.49. And, company will always make sure after completing the projects, as we have sold this, we have already finalized 3 projects. Going forward, once the projects are completed, we will be rotating these projects so that the equity IRR gets included in the bottom line, and the debt goes off.
Okay, 0.49x debt to equity is what you had already indicated, Mr. Sehgal already. Let me just get a sense of where you will end FY27 in terms of debt and also the growth outlook for the full year. I think your FY26 revenue growth was ahead of guidance. What kind of growth are you targeting in FY27? And, do EBITDA margins remain in that 16% range, or can you do better?
So, good question. We always have been guiding that our revenue growth would be between 10 to 15%. I'm happy to share that this year will be minimum 15%. So this has been a conservative approach. The revenue is not a challenge this year because, going forward next 3-4 years, we have great order book and we have quoted projects more than 16,000 crore. And, again, this year also our target is about 6,000 crore getting a new order book, and which is easily achievable. And, revenue, you can see in last quarter, we had a growth of about 30% year-on-year growth. And revenue is not going to be a challenge. So we would get at least 15% revenue growth in this year.
So if 15% is the lower end, what is the higher end, Mr. Sehgal? What is the aspiration to go beyond that? If you're saying 15% is conservative, I'm sure you would have a bigger number in mind. And if that's the case, then what's the outlook for your margins? Do you get back to that 16%, 17% level by the end of the year? Is that a realistic projection?
So, margins at the EPC level will be same, but overall the margins will increase because, after selling this, all three assets, the profit will increase and it will come in quarter and quarter, every quarter. See, we have already sold one. So this quarter will highlight this Malotapur Sadhuwali. Next quarter, Bathinda Dabali. Third quarter would be Jalbida Shabad. So quarter and quarter, the PAT will increase. Overall, the bottom line will increase, but margins from EPC will be almost the same.
Quickly, Mr. Sehgal, what kind of order inflows are you penciling in for the full fiscal year 1? And also, a quick word on your international expansion. You've set up subsidiaries in Singapore and the UAE. What sort of opportunities are you seeing there? And when do these start making a meaningful contribution?
So this year, we have guided our investors that we should get 6,000 crore of the order book, and that is achievable. And if you talk about the international market, we've already opened an office in Dubai, and Singapore also we've opened an office. So we are very conservative going international, but we want to get new work there. But again, we need to get our better margins there. So right now we are hands full within the country, but we are looking. We've already quoted few contracts outside, and since there is a war, the markets are a little slow in finalizing the contracts. But we are very, very positive and looking forward to getting new good contracts across GCC.
So fair to assume that the focus this year will be on the domestic front, especially considering the war. And once the war dies down and then the situation normalizes, you would go more into overseas?
Exactly.
All right, Mr. Sehgal, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. There's the management of Seagull India. Well, that's the management there. The market, though, continues to remain where it was as we started off the show, still holding on to levels of 23,200. We take a short break. On the other side, we focus on the bond markets with Manisha Gupta. Welcome back. As promised, let's shift focus now to the bond markets, and that's the more happening space over the last couple of days. Manisha is here with all of those updates there. Manisha.
Well, thank you so much for that. Yes, RBI's capital inflows measures that we saw in the previous week as during the MPC is something that has impacted the rupee and the bonds as well. And we've seen some support continue into the markets today as well, even as the crude oil prices have jumped up by 4.5% and the global markets clearly reeling under on the fresh geopolitical tensions that we are seeing coming in from the Middle East. Having said that, there's so much data that is coming in this week that the markets will be keeping an eye on. For Indian markets, it really is going to be about the CPI data that comes in on Friday. And then apart from that, RBI also has said that 10 states will raise nearly 1.48 billion through sale of bonds. This is going to happen tomorrow in the markets, that is Tuesday. In the meanwhile, there have been various events and we've been covering them. SEBI in one of those events today has said that the working group is discussing framework to increase liquidity in the corporate bond markets. Well, remember, this is an area that needs work on as well, even as we did see those tax waivers, but that is majorly on the corporate, on the government G-Secs, not on corporate bonds. So there is some push that we are seeing in case of corporate bonds as well. Apart from that, the SEBI also said that they are working with RBI to introduce derivatives on corporate bond indices. Now, this has been said. We also have seen a framework come into that effect. And this is exactly what the markets really seem to be hoping or waiting for at this point in time. That is because this would enable the over-the-counter derivatives that would come in for the bond markets there. The aim to do this is to deepen the secondary markets, allow investors to manage the market, also manage the credit and price risk without owning the underlying bonds, that is. And then apart from that, this is also done targeting the securities which are AAA, AA plus and above. And then you also have a full basket of corporate debt rather than relying on a single issuer in sense of risk management as well. The underlying corporate debt market right now stands at 53.6 trillion. And that is the reason that you have the regulators moving ahead in sense of more instruments and widening the market to the retail participants as such as well. Now, to begin with, the resident companies with the minimum turnover of 1,000 crores, institutional investors, FIs, are the eligible partners or participants as SEBI and RBI have put it out.
All right, Manisha, thanks very much for bringing us that update from the bond markets. We'll slip into a short break on that note, but when we return, we're going to discuss market technicals with Saumil Mehta of Mirae Asset Sharekhan and also discuss his top trading bets. Welcome back. The markets have slipped below the 23,200 mark, 23,191 on the frontline index. That's a cut of 175 points. And, the IT pack has recovered a tad more now. It's down about 0.5% versus being down about 1% when we started the show. The Bank Nifty also now trading with cuts of about 400 odd points. Let's bring in Somil Mehta from Mirae Asset Share Khan for more on what the technical charts are suggesting for the markets from here on. Somil, good morning. Thanks for your time here. 23, 180, 190 is where we're currently at. What are the key levels you'll watch out for in the near term? And in this market, what are your top picks in terms of individual stocks?
Good morning to everyone. We've been making low tops, low bottom on the daily, weekly charts. Previous week's low has also broken down today with a gap. Now, I'll be expecting this downtrend to continue as we are making low top, low bottom formations on the high degree time frame as well. The momentum indicators are still in the sell side. So my view is negative in the short term, in the medium term, both. And I'll be expecting a target of around 22,700, 22,750 levels, which is a previous swing low as well of one of the candles here. Now, on the upside, the crucial resistance in the very short term would be 23,400. That will be one level to watch out for, and 20 daily moving average, which will be very crucial, which is 23,600 now. So sell on rise should be the strategy. The weaker sectors like financials and IT would be the ones to go short on. Now, I have two stocks. One is Chola Finance. Chola Finance has broken down of a small consolidation, trading below 20 and 40 daily moving average, trading below 200 daily moving average. A great setup for a short trade. Stop loss would be 1510, and my target would be 1400 for Chola Finance. The second stock which I've chosen is KFinTech to go short on. It has formed a flag pattern, taking resistance at the 40 daily moving average. I'll be expecting this flag pattern to break on the downside. Stop loss would be 867 and target would be 800.
Somil, I was very curious. The metal names are also seeing some significant profit booking today, and has been the case over the last 4 sessions as well, be it Nalco, SAIL, and even Vedanta for that matter. Anything on the metal space that appears weak to you on the charts?
National Aluminium, I was looking at it definitely, but the risk-reward ratio does not match. But I'm not expecting the stock to go above 410, 412, which is 20 and 40 daily moving average. My targets for Nalco would be around 345, 350 levels. So yes, definitely looking weak in the short term, but overall, the medium term to long term structure is still intact.
All right, Somil, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. The one stock that is also not doing well today is Indigo, and that's also on the back of the company's targets that it has laid out for 2030. In fact, the airline wants to position itself as a key global aviation player by that period, by 2030 that is. Devyani is now joining in with more highlights from the analyst day that Indigo held. Devyani, over to you.
Well, Indigo is positioning itself as a key global aviation player by 2030, and in its India 2030 vision, it has targeted 300 billion ASK capacity and 200 million passengers. Now, that said, the FY27 capacity is expected to grow in the single digits itself, with it accelerating to mid-teens by FY28 till FY30. Now, it aims for 3,000 daily departures with a fleet of over 550 aircrafts by 2030, with mid to long-haul international flights set to rise to 10 to 15% of the total capacity from the current 4%, while domestic share is set to decline to 85 to 90% of the capacity from the current 96%. Now, that said, the premium push is also what Indigo is aiming for. Now, the business class seats are set to expand to over 4,300 by FY27 end from the current 2,800 plus, with the stretch product rollout to reach 105 aircrafts from the current 53 only.
Devyani, thanks very much for bringing us that update. Let's now go across to Mangalam for the latest from the F&O space. Mangalam, welcome back. What are the cues here telling you?
Well, a couple of things. We're down, but perhaps not out. Why do I say that? Because if you look at the frontline indices today, the Nifty Bank, and the mid-cap index, they were likely to open in the red. They've continued to be in the red, but there has been a recovery from the lows. The India VIX, which is up 7%, could have been higher, a lot higher, but that too is seeing just a moderate spike. And importantly, the Nifty low today, 23,170. From there, we've seen an over 100-point up move. So closing in on that 23,200 mark for the frontline index. The advanced decline as well. When we started the trading session, we had just about 300 stocks which were advancing. Yes, there is a notable gap between the number of stocks which are advancing versus the number of stocks which are declining. But the number of stocks which are advancing have actually tripled over the last 2 hours of trade or so. While the markets moved higher off lows, we've also seen put writing emanate at around 23,100 and 23,200, telling you that today's low is important and 23,000 is an important mark as well. Remember last week's low on the Nifty of 23,150. So all of that you put together looks like between 2350 to 23,150 is an important support zone for the frontline index. However, the question is, after this recovery, still, there is some sort of headwind that we're likely to face at higher levels, which is why we're continuously seeing some writing at the 23,200 call and the 23,500 call as well. The Nifty Bank, the one that was above the 20-day moving average up until Friday, it's now fallen below that. So the 20-day moving average, it's hovering very close to that. That's an important level to track. And thereafter, the 50-day moving average, if it crosses that, there could be better news for the frontline index out there as well. But amidst all of this, a lot of the consumer stocks, a lot of the healthcare stocks are doing extremely well, which is why we're seeing a lot of long positions being added on names like Fortis Health, Max Health, as well as Apollo Hospitals. So more stocks declining than the number of stocks which are advancing. But we are seeing the markets claw back a bit. So we're down, but perhaps not out.
Optimism, or whispered some words of optimism in the bull on Wall Street. Mangalam, thank you for setting us up on the F&O side of things as of now, even as the markets are looking to recover from the lows of the day. But that recovery too appears to be getting sold into. Take a short break, get you more on the markets on the other side. Stay tuned.
Reserve Bank of India and the government have both rolled out a multi-pronged bazooka to attract foreign inflows into India, from incentivizing NRI dollar deposits and making Indian government bonds more attractive for global investors, to even offering tax breaks on government securities. And the street now believes that these could trigger a meaningful increase in foreign inflows. Let's start with SBI research, which believes the FCNRB deposits alone can attract more than the $34 billion that had come in during the 2013 scheme. It also points out that foreign investors have barely used the FAR, which is the fully accessible route so far, with utilization at just 6.8%, while more than 4 lakh crores of investment capacity is still available. Now, RBI has also expanded the pool of bonds that will be available to foreign investors under this fully accessible route, and also removed restrictions on short-term bond investments. So Deutsche Bank says these could eventually help India gain inclusion in more global bond indices like the Bloomberg Index. It also estimates that without the 5th of June measures, India could have faced a $43 billion balance of payment deficit. But with these moves from the RBI and the government combined, India can attract an additional $40 to $50 billion of foreign capital, and that would be enough to potentially bridge the country's expected BOP gap in FY27. Macquarie arrives at a similar estimate of $40 to $50 billion in potential inflows. It says RBI's decision to absorb the hedging cost will allow banks to offer FCNRB deposit rates closer to domestic deposit rates, and that will make them far more attractive to the overseas Indians. Jeffries compares this move to the successful 2013 scheme, which brought in $34 billion to FCNRB at the time, though it notes that lower India-US yield differentials could limit the inflows this time around. The bottom line, analysts believe the combined RBI government package could attract tens of billion dollars, which is up to $50 billion of inflows into India. It will support the rupee and it will lower the borrowing cost, as well as strengthen our case for inclusion in more global bond markets. So that's as far as the RBI and government measures are concerned. Hear out what the Punjab National Bank CEO and MD Ashok Chandra had to say. Also listen in to what former SEBI member Anand Narayanan and B. Prasanna of ICICI Securities made of these measures and what they could do for the country.
I think going forward, the interest rate on FCNR will likely to increase, and we are going to mop up good volume under that. We are expecting that country as a whole, I think it should be in the range of around 35 to 40 billion USD. And for our bank, we are calculated, and somewhere we are expecting that around 2.5 to 3 billion USD we are going to mobilize during this period. Rate. It is somewhere around 3% difference is there now. Because right now we are offering the FCNR deposit between 3 to 5 years band is somewhere around 3 to 3.5%, whereas the deposit domestic rate is around 6.5 to 6.6%. So we need to wait for the RBI guidelines to come, RBI circular to come.
This ordinance, which has been passed by the government, paves the way for Bloomberg Group Aggregate Index to include India into its index. I'm not saying it's a done deal. There are other issues that have to be worked out, but I have to again commend the RBI as well. Many of the other issues in terms of accessing government bonds, including on our systems, have actually been addressed by the RBI.
All the subcategories have been removed.
Subcategories have been removed. See, it's also a question of market access. Foreigners who are dealing in multiple countries don't want to log in only into a specific India system to be able to trade India bonds. They would rather do it through their Bloomberg, front end or some other front end. What RBI has done, I have to commend them for understanding the market. They've actually created market access, and I believe even the Bloomberg access and other access will be available very soon. So actually many of the irritants which were there for foreigners has now gone away, which means it's a matter of time, hopefully, before we get inclusion into the Bloomberg Aggregate Index. That alone should bring in passive flows of $25-30 billion to start with, besides getting in, Japanese insurance company, European insurance company flows on a regular basis. I'm also hoping that this paves the way for a similar discussion to happen on equity markets as well.
I think what RBI did on Friday is a bazooka of sorts. Whatever we had suggested, whatever the market wanted, I think they have literally given everything. And if you look at the 3 or 4 measures that they have done, I think getting into removing taxation on government bonds is one, but probably the least effective at this point of time. It will turn out to be a very good one much later when things get better. But the other two, which is FCNRB and ECB, I think are with the subsidy being taken over substantially by RBI is very, very powerful. With RBI giving full subsidy on the hedging cost, your dollar borrowing cost for the bank also becomes your rupee borrowing cost. So that means that the bank can actually go much higher than 5.5 as well to announce deposit rates. I'm an optimist, so I do think that this time around RBI very well knows the cost of these measures, and they will be, following up with banks and PSUs to figure out how they are pricing their deposits and borrowing. If the pricing is quite attractive for investors, I would say $50 to $60 billion can come over these 2-3 schemes.
Across the board, 50 to
$60 billion is possible from ECB borrowing as well as from the FCNRB.
And that is pretty consequential, right? The current account deficit is projected to be about $75-80 billion, right? Yeah. So this is a chunky.
Yeah, so that's why I said it was a bazooka of sorts, because what is happening in the market is that, like you mentioned, that the market has not been going anywhere. I think the view on the currency was kind of driving the view on the equities. Normally, it is the other way around.
Some big voices on the measures announced by the government and the Reserve Bank of India last week. Well, some profit booking also seen in MTAR Technologies. The stock was up almost 200% already this year. So seeing some selling from higher levels, 5.5% lower on MTAR Tech. Coffee Day is locked in a 5% lower circuit. For First Source Solutions is also down around 5%. And Vishnu Prakash Punglia, that stock once upon a time had a record high of well over 340 rupees. Now it is trading at 30 rupees as we speak. So another 5% circuit. For that, NRB Bearings, by the way, has extended its gains, now up 14%. Now, what has also moved to the highest point of the day is Thomas Cook. That is up over 12% as we speak. And ENIL, Entertainment Network of India, that has moved to the highs of the day, 12.5% higher on that stock as well. Some correction there on that as well. Take a short break, continue our conversation on the markets with Nilesh Shetty from Quantum Advisors. Stay tuned. Welcome back. Continuing our conversation on the markets with Nilesh Shetty from Quantum Advisors, who is joining in. Nilesh, good morning. Thank you for taking out time. Well, there has been a lot of conversation about the unwinding of the AI trade across the globe. You saw that on Wall Street on Friday. You saw that across Asia on both Thursday and on Friday as well. With this kind of news flow that is happening around this AI trade and the kind of fundraising that all of these companies are planning to do, with this kind of uncertainty now plaguing in the minds of the investors, do you believe that this is an opportunity for the Indian markets to play catch up, especially considering the fact that we do not necessarily have a pure play AI story just yet?
Yeah, that's right. I mean, the lack of AI story has sort of hurt India. And of course, the environment around India per se is not being that great given the taxation structure. So hopefully, again, the fact that other markets are correcting and India does not correct that much in that environment allows it to catch up. But again, it doesn't give reason for foreign investors to invest into India, which remains a primary drag on Indian equities. Again, India seems to be off the radar for most foreign investors. And there is a general sense of not wanting to invest in India because of how the currency has behaved as well, which is not necessarily just linked to AI trade. There are other issues, including war in the Middle East, which is driving that. So it may allow some catch up for India, but it doesn't give an incentive for foreign investors to come and invest in India, which again, at the moment, it looks very difficult in terms of what can trigger a large inflow into India.
Nilesh, you don't think that bazooka measures from RBI and government, from taxation to including the universe of bonds that they can invest in, all kinds of relaxations, you don't think that helps shift the mood for foreign investors enough?
Yeah, a little bit, but I think they're still not confident about how the currency is going to behave. I think whatever returns they think they might make, and this has been the experience in previous investments into debt as well, has been eroded quite a lot by currency depreciation. Until they have a bit more confidence in the currency, I don't think trying to save a bit on capital gains tax is going to invite a lot of foreign capital.
Nilesh, the other sector that continues to hog the limelight is, of course, pharma. And even in a market like this, pharma continues to do well in and a lot of these healthcare names as well. So if you are invested within this pharma space, where is it that your preference lies? Whether it is the US exposed names, the generic players, the contract manufacturers, or the hospitals / diagnostics operators?
So our exposure primarily remains in large cap pharma. Again, it's been very selective where some of these names have corrected because of stock specific reasons. And we've been able to allocate them or buy them, add them to the portfolio at specific points in time. Most of them we think will do well because of the currency tailwinds. There are sort of company specific issues where we expect some drug development or breakthroughs to come through, which will aid sort of revenue growth for them. But we've always had a penchant for large cap pharma, not necessarily in mid cap and small cap pharma. What happens in the smaller spaces, if there is one FDA notice or one drug which comes off in terms of because of competition, the impact on these companies tends to be very large. We'd rather have a company with a bit more diversified pool of drugs which are driving the revenue. So hence our penchant has always been towards large cap pharma.
What about the metal space, Nilesh, from here on? I mean, that seems to have been under some pressure, even with RBI not cutting rates and the kind of commentary we got. Today, again, it continues to be under pressure with what's happening in West Asia. A near-term outlook on that space, and if you see any particular stock or any opportunity there?
We've actually been trimming whatever we have. I mean, they've done really well over the last 3 years. Metals or commodities, you want to buy them in periods of stress. You want to sell them in periods where they've done really well. So last 3 years have actually been fantastic for commodity companies. They've actually led a lot of the rally globally. So even in India, if you see a lot of the commodity companies last 3 years they've had a very good run. So at least at these valuations, they will not make sense to us. We'll have to wait and watch. If they were to correct, given interest rates, at least the view on interest rates in the US, if that changes and interest rates move higher and you have a big correction, we may then start looking at them. But at the moment, we have negligible allocation there.
With interest rates moving higher, does financials warrant more preferred allocation, or do you believe that the second order effects from the headwinds of the Iran war are keeping a lid on what could possibly be a potentially good phase for the financial names?
I mean, we have a very large allocation to financials, specifically private sector banks and insurance companies. Private sector banks, again, whatever the negativity that may come out, the valuations are sort of far more compelling. In one of the lowest we've seen in the last sort of 2 decades for them. So if there is any kind of revival domestically on the corporate capex cycle, you will see them doing really well. You're already seeing credit growth hitting closer to 15%. So that space looks quite attractive for us. And the valuation does provide comfort in terms of whatever negative headwinds might come through. We also have an allocation to the insurance space where there are regulatory headwinds in terms of what the regulator wants to do on the distribution side. But adjusting for that, valuations are very, very attractive, given that it's a structured long-term story for India.
Nilesh, very quickly then, where will you allocate, more money? What are the sectors that are looking attractive if none of these that we spoke about clearly?
Yeah, I mean, surprisingly, we've allocated a bit more to IT services, where we think at 4-5% dividend yield. And if this AI trade were to reverse, you might see some re-rating there. Again, it is for a patient investor like us. We are value investors by nature. So next 6 months might be tough, but as sort of things normalize and people perhaps realize that the AI growth story is not as it is made out to be, and there are risks there, you might see them coming back in terms of valuations. Again, we've had selective allocation to the logistics space. Some of them were hit because of earlier sort of the tariffs imposed by the US, and then later on war in the Middle East. So valuations came off, because of which we allocated to that space. But apart from that, generally getting names outside of these buckets is not been that easy.
All right, Nilesh, thanks very much for joining in with that. We appreciate your time here. We'll slip into a short break then. Up next, we're going to be joined by IRCTC's CMD, Sanjay Kumar Jain, on their FY27 guidance and more. Stay tuned. Welcome back. Let's focus on some corporate conversation. In the railway space, we have IRCTC, which had beat its guidance of 10% revenue growth and 33 to 35% EBITDA margin in FY26. So let's bring in the management. Sanjay Kumar Jain, Chairman and Managing Director of the company, for more on the company's performance and the way ahead. Welcome to the show. Thanks very much for your time here, Mr. Sanjay Kumar Jain. You've beaten the revenue guidance, but margins have weakened across ticketing, catering, and tourism simultaneously. Would you say this is the start of a structurally lower margin regime for IRCTC, or does it improve from here?
This year, we have recorded highest ever revenue and EBITDA. And our business mix, trade mix, we are into largely 4 kind of business. Internet ticketing and catering, tourism and railway. So to improve the revenue further, we are increasing the trade mix of a different segment. And of course, whereas we are maintaining a margin of around 10 to 12% in catering and tourism business, and similarly in railway business. So what we are expecting that this year will be maintaining EBITDA of 30%, EBITDA margin of 30%.
Right. Mr. Jain, the biggest crisis right now that's going on is in West Asia. Has that had any impact on your business?
You see, here and there a little challenges had come, but I'm happy to inform you that we could sustain it, and we are likely to sustain it further. If I tell about our catering business, you know that during this crisis also we are able to maintain around 18 lakh meals being served to the passengers. We made a Ministry of Railway allowed us to do cooking in pantry car with induction cooking. Like all our LHB pantry cars are having this facility. So we have shifted our production of meals from this kitchen to the electric induction cooking on the pantry car. Then at our kitchens also, that's how we could substantially lower our requirement of gas, and with the coordination of IOCL, BPCL and HPCL, we are able to maintain the services. As far as tourism is concerned, I'm happy to inform you that despite the crisis, we inbound tourism in India onto our Maharajas Express is the highest number we have achieved. And domestic tourism has increased manifold. That's how we could maintain, we could achieve a very quantum jump in our tourism business also.
All right. So since you say you're going to sustain growth despite what's happening in West Asia, if you could give us a breakup segment-wise growth, what kind of growth do you see in FY27?
You see, tourism, I'm expecting to grow by 20%, catering around 15%, and IT 9 to 10%, because the non-convenience fee side, we are planning to go for better advertisement earning and loyalty program and all. That work is already in the process, and our this unified portal, and then this really around 5%.
Right. So in that light, what is the kind of business mix that you are expecting going forward, Mr. Jain?
We have already made our vision plan for the next 5 years. To from here, how do we grow from here to in the next 5 years? So per se revenue mix for 1 year is I can give you a forecast for the next 5 years. So there I'm finding that this mix will change, like our catering at the moment is around 45%. So that will in the mix it will come down slightly, but our OTA business and tourism business will grow, and IT non-convenience fee will grow.
All right. Could you also give us a sense of the pipeline of new trains and new services that customers and, of course, your investors can also expect as far as this new financial year is concerned?
You see, in everywhere, Ministry of Railways is indicating that they are very aggressive on bringing new Vande Bharat sleeper trains and Amrit Bharat trains. So in the next 3 years to 5 years, they are expecting to bring around more than 200 such trains. So future is good.
Since we are on this subject of Amrit Bharat trains, do you also have to absorb the input tax credit of 5% that you do on the Vande Bharat trains?
You see, there are two kinds of train. The one is prepaid train and the postpaid train. Vande Bharat trains are prepaid trains where we have to incur 5% additional GST. But in Amrit Bharat train, this is not there. This is the postpaid train only. So what kind of mix is coming?
All right, Mr. Jain, thanks very much. Thanks very much, Mr. Jain, for those comments. We appreciate you joining us here on Trading Hour. And on that note, Hormaz and I will take your leave and wrap up this edition of Trading Hour. Thanks for tuning in, but stay with us. Halftime Report will take all the action forward.
Stocks slide on global market weakness following the sharp AI sell-off and resumption of hostilities in the Gulf. Healthcare and utilities managed some gains, even as metals, autos, industrials are the big drags.
Experts see RBI's measures drawing in between $35 to $50 billion in foreign funds, helping the nation address its balance of payments problem. The tax exemption for foreign investors in government bonds is also seen as a positive step that can aid India's inclusion in global bond indices.
Brent crude jumps to nearly $97 per barrel after Israel retaliates to Iran strikes despite US President Donald Trump urging restraint. Fears of the Strait of Hormuz staying blocked sparks fears of a supply shock.
Silver and gold see a sharp drop after Iran and Israel resume strikes. Strong US employment data and the rising likelihood of Fed rate hike also weighs on investor sentiment.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batran, with me Sonal Bhutra as well as Vinny Motiwala. Well, we've started the week definitely on a weak note, you'd have to say. So we have the Nifty, which is at around 23,200. So we've slipped below that 23,200 level. The mid-cap index, in fact, is down over 300 odd points. And we have the Bank Nifty, which is down over 350 odd points. It's obviously geopolitical concerns, which is weighing in terms of the market sentiment. I just want to point out that other indices besides the equity are also quite weak in today's trading session. So, for example, the rupee is currently at around 95.67 versus the Friday close of around 94.95. Remember that we did see a significant amount of appreciation post the RBI steps which were announced, but that hasn't really managed to sustain at this point in time. We do have the yield as well, which is hardened to levels of around 6.97. To put it into perspective, it had softened post the RBI policy to levels of around 6.95. And obviously, one of the key culprits is Brent crude, which is hardened all the way back to over $97 per barrel versus that level of around 93, what it was in terms of Friday's close.
Hey girls, good afternoon. 100 days of the war, that's what happened yesterday. That continues to be the biggest concern that the markets are factoring in currently. Most of the sectoral indices are in the red, barring something like a CPSE index, pharma and FMCG. So the defensive pack is doing well in trade today. Crude continues to be a big worry. Now remember, 23,100 is a very important support for the Nifty. If we go below that level, there could be further pressure, and 23,550 is the resistance. So if we go above that, we could see levels of 23,800 or 900 as well. A wee bit of recovery from the lows, but that's not something that could sustain. Of course, time will tell what happens there. There have been measures over the weekend, Friday that is, as far as investments in bond market is concerned. But overall, geopolitics has taken a step ahead again. Correct.
Absolutely. Good afternoon, girls. And obviously, you're talking about the 23,100 level as well, Sonal. It's important to watch out for that. Today, actually, we opened below and around the 23,100 mark. So it'll be key to see in the second half of the trading session where we're going to be headed. Pharma, media, FMCG, that's some bit of a bright spot, right? But we have a very exciting lineup for you all on the show today. We'll have Maulik Patel of Aquarius, who will join us to discuss the latest trends in the oil and gas sector and the overall health of India Inc. and the balance sheet there. We'll also be focusing on the buzzing stocks as well as big movers in today's trading session. Stay tuned in for that. So first up, time for our movers and shakers segment, where we track a whole host of stocks that are buzzing in trade. First up, we have Devyani to take us through Indigo's 2030 vision. There is an investor meet that's been going on as well, but there's a presentation, some key highlights here. Devyani.
Well, Indigo is positioning itself as a key global aviation player by 2030, and in its India 2030 vision, it has targeted 300 billion ASK capacity and 200 million passengers. Now, that said, the FY27 capacity is expected to grow in the single digits itself, with it accelerating to mid-teens by FY28 till FY30. Now, it aims for 3,000 daily departures with a fleet of over 550 aircrafts by 2030, with mid to long-haul international flights set to rise to 10 to 15% of the total capacity from the current 4%, while domestic share is set to decline to 85 to 90% of the capacity from the current 96%. Now, that said, the premium push is also what Indigo is aiming for. Now, the business class seats are set to expand to over 4,300 by FY27 end from the current 2,800 plus, with the stretch product rollout to reach 105 aircrafts from the current 53 only.
Okay, all right, Devyani, thanks very much for that. So that's on InterGlobe Aviation, but this is our movers and shakers segment. So we have a lot of stocks that we're tracking, and EMS and HT Infra are the ones which are buzzing today. Vinny, tell us more about it.
Hi, both these stocks are buzzing. First, let's talk about HG Infra. Has come off from the day's highest point, but nonetheless, what came in was that the company announced that they've received those provisional completion certificate for that 4,970 crore project, which was there for the Ganga Express project in Uttar Pradesh. This is the completion that they've received, a provisional, and this was mainly an EPC project for them. So there was associated work, engineering, procurement, and construction, which they did for this expressway as well. And that's the reason we saw a good run up in the stock, as of now holding on to gains of 3.8%. Let's move on, talk about EMS Limited. They've actually received and been declared as an L1 bidder for UP's Jal Nigam Varanasi project for a turnkey sewer network as well as home connections and house connection projects for the Varanasi ward and some wards which are having problems. Now, currently, the contract value of this is at around 103 crore rupees and will be executed over a period of 24 months. So, EMS Limited also is seeing a very, very sharp uptick, holding on to 14% gains there.
Okay, that's about EMS Limited, 14% higher, but Divi's Labs, that's on our radar as well. Flat right now, but important news?
Well, yes, it possibly is a long-term driver for Divi's Labs, where Eli Lilly's drug retatrutide has delivered strong phase 3 trials in obesity and type 2 diabetes. And the drug is likely to be filed with the US FDA soon in 2027 as per analysts. Now, they say that the news is positive for Divi's Labs. They expect to start, analysts are saying that Divi's has said that they expect to start contract manufacturing for peptide fragments and likely drug substances in the future for an undisclosed client. So the innovator client is highly likely to be Eli Lilly, according to some analysts. And hence, this particular drug, retatrutide, could be a long-term growth driver for Eli Lilly as well as for Divi's Labs in terms of their CMO business. So as of now, Divi's Labs just about lower by around 0.3%, but this is something that we would be watching out for. But we do have Hormuz to take us through all of the stocks that are moving around in trade. Hormuz, over to you.
I'm more red than green actually in today's session, but I'll start off with green today. We'll look at the stocks that are bucking the trend, and it is something that you track very closely, Ekta. The pharma healthcare names that are doing very well today, and all of them, look at Dr. Lal, Aster DM, Fortis, Syngene, all of them seeing gains of anywhere between 2.5% to 3.5%. So pharma is one index that has done well in today's session despite an otherwise wobbly market. What has not done well though is metals, and it's not just today. It's been 4 sessions now that the metals index is down for the 4th day running, and there are 3 names that during this 4-day period have declined more than 10%, and those include Nalco, Hindustan Zinc and SAIL. Nalco and SAIL down for yet another day. Hindustan Zinc though, after Friday's losses, seeing some bit of stability at lower levels. You look at the sugar names as well. They are the ones that are also seeing the benefits of the rise in crude oil prices today. Balrampur Chini, Mawana, Dhampur, all of them seeing gains of 2.5% to 3.5% in today's session. The high-flying names of the last month, HFCL and Sterlite Tech, were locked in a 5% lower circuit on Friday. They are locked in a 5% lower circuit today as well. So circuit down for both these names for the 2nd day running. HFCL at one point had gone past levels of 200. Sterlite Tech had even reached levels of 650. So some profit booking setting in for these names as well. Wipro, we were highlighting this last week as well, that there has been a big price difference in the cash market levels and futures levels for Wipro. And there has been some catch up on that front in today's session. 6.5% lower today as well. So among the top losers on the Nifty 500. And lastly, MTAR Tech, 2nd day of losses today. But on the 22nd of May, when the stock had hit a record high of well over 8,500 rupees, the stock is down almost 15% from those levels.
Okay, all right. Thank you so much, Hormuz, for joining us. So those are some buzzing names on our radar. With that, we'll slip into a short break. When we come back, we'll connect with Maulik Patel of Equirus to discuss latest trends in the oil and gas sector. Also understand the overall health of India in balance sheets as well. Welcome back. You're still tuned into Halftime Report. One of the big stories for today has been how oil has flared up. So let's focus on the oil and gas sector. Equinor in a recent report says new project ramp-ups are providing meaningful non-Hormuz supply relief but cannot bridge the Qatar gap. They also add India ramps up oil imports from US, Oman and Nigeria. We have seen that happening as per the Kepler data as well. To discuss this and more on Q4 FY26 earnings fine print, we have with us Maulik Patel, the head of research and oil and gas expert at Equinor, is joining us now. Maulik, good afternoon. Thank you so much for joining in. Markets are in their own zone. So let me first ask you about oil and gas because there's so much action happening here. Oil prices are back above the $95 per barrel mark again. There are tensions, there are supply concerns. What do you make of the entire oil and gas space, considering that even spot LNG prices have surged around $18 to $19 per MMBTU? What do you like and what do you not like in the entire space now?
Yeah, good afternoon, everyone. The first thing is that energy price will remain higher for the longer. We are in fourth month of the war. The Strait of Hormuz has still a disturbed one. We have seen that the oil global inventories are down by close to around 20% from what they were. And currently the oil and commercial inventories are one of the lowest one. Plus at the same time, you have the driving season in US is starting. One of the reasons why the oil price is not crossing 120 or 110, the simple fact is China. China, which used to import around 11 to 12 MBPD before the war, they are now importing only 6 to 7 MBPD. So there's a massive drop in Chinese because Chinese are using much more of the strategic oil reserves, what they have built it in a year and a half back. What we like, what we don't like in a high energy price scenario, we obviously are underweight on the OMCs given that the kind of price hike which is not adequate enough and there is still the peace deal is far away. We like more on the gas sector, we like GAIL, we like Gujarat Energy. One of the reasons is that for the Gujarat Energy, the Morbi market, which is one of the India's largest market. Earlier there was a competition with propane. Now the propane is not available. So Morbi ceramic sector is using natural gas. The volume of Gujarat Energy, which used to be around 8-9 MMS CMD pre-war, now is almost around 14-15 MMS CMD. So that's one of the sector stock which we like within the sector.
Mm-hmm. Hi Maulik, good afternoon. While you've said the names that you like as well, there's one thing that I want to still understand is more on the supply side, right? Supply issue, what is the current scenario right now? And obviously we've seen the geopolitical tensions, the West Asia tensions have caused infrastructures to be impacted, right? So does that become a major concern, though China, you said, is not importing as much, the numbers come down. But what is the supply scenario currently?
So Strait of Hormuz, we had around 20 MBPD, which was there. 7 MBPD has been offset by East-West pipeline of Saudi Arabia. One is from UAE, which they are now doing from on the east coast of near Oman. So we are still on a gap of around 11-12 MBPD. Now, out of that, I mentioned that China, which used to be importing around 12, now doing only 6 or 7. So still we have a gap of around 5-6 MBPD. And that's been partly offset by this massive withdrawal or of strategic oil reserves by the OECD countries, which was 400 million barrels. US is producing maximum and they're exporting on a highest ever volume. We do believe that given we are entering into a very heavy demand season for the US driving and the Northern Hemisphere driving season, even if tomorrow if there's a peace deal is there, price of the oil unlikely to fall below $80-85 per barrel. So that's number one on the inventory side. Second, on the infrastructure side, how much the infrastructure is damaged because of the war. So we know what has happened within Qatar, Ras Laffan, 2 trains are out of the service for the next 3 to 4 years. Then there is some kind of attacks on some of the energy infrastructure in Saudi Arabia. But what is more important, Kuwait and Iraq and Iran are not producing as up to the maximum level. Now they are forced to shut down those wells. Now, when you're forced to shut down this producing well, it impacts your reservoir, it impacts your production. Historically, we have seen that such kind of things take 3 to 4 months at least for the production to normalize from the forcefully shut down wells. So my view is that even if the war get over tomorrow, will take some 3-4 months for the entire productions to get normalized.
Maulik, that point is taken, and obviously, higher Brent crude prices is a threat for the entire equity markets as well in terms of a risk. So from that context, and if you put on the hat of head of research, what is your view in terms of what the equity markets could do for the second half of the year based on your assumptions of Brent crude?
We do believe that in the
Okay, Maulik, we're just going to try and reconnect with you in just a bit because I think there's a little bit of an audio issue there. But that is basically Maulik Patel, Head of Research and Oil and Gas from Equirus, talking to us about his view in terms of what could take place with regards to the oil and gas space. And he assumes that even if the war is expected to end, it's probably going to take a couple of months, 3 to 4 months, for crude prices to stabilize. But Maulik, we have you back with us. So if you could just continue or restart your point with regards to where the markets could be based on where Brent crude, where you're assuming Brent crude will be.
Yeah, sorry. So inflation is likely to be higher in the second half. That's number one. Also, we have likely to be in a below average monsoon as per the prediction, partly because of the El Nino what we have. So inflation is going to be little higher than what we had in the last one and a half year. Interest rate, we say that there is not significant room for any kind of cut. We expect a 1 or 2 hike in this financial year, again starting from the Diwali onwards. So in this current context, what we'll see, the equity market will remain in a range bound. As you know that India is an anti-AI play. We are anti-commodity play. What has worked well in the last 2 years is this AI theme commodity. And that's also, we were very relatively expensive to the EM market, and that's why we have underperformed a lot. If any of these two themes goes for a toss, whether the AI bubble burst or you have a significant lower commodity prices going forward, then India may get some kind of a favor. Partly also we have done some reform last week. Some of the more reforms, long pending, may come up in a couple of months. So India may gain some kind of favor among some large global investors. But we will remain in a range bound. Also, the earning wise, if you look at where the earning growth is maximum is in a small, mid cap and non-Nifty stock. Nifty has delivered some 4-5% earning growth in a last quarter, where the majority of the large and mid cap and small cap stocks beyond Nifty has delivered double-digit growth. So action or the momentum is in a mid cap and small cap and not in a Nifty stock. So we believe that small mid cap, which has underperformed a lot in the last year compared to that at the time of the March, but now they will outperform given that the earning growth is there.
Take that point, Maulik. Anti-AI, anti-commodity trade could be range bound. That's the outlook on the markets, considering the situation that we are in. Thank you so much for joining us today with your thoughts on specific sectors and overall markets as well. Thanks for joining us. Time for a break now. Rajesh Palvi of Axis Securities will join in with some trading strategies on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is at 23,220. Around that mark is what it's trading at. Obviously recovered from that day's low, but since the time we started the show, there's not much of a movement that we're seeing. But on that note, let's also bring on board Rajesh Palvia, VP Technical and Derivative Research at Axis Securities, joining us on the show now. Rajesh, good afternoon. Thank you so much for joining us on the show. While we started around that 23,100 mark, slightly below that as well through the day, we've seen a bit of an up move from there, right? What are the levels you're keeping an eye out on? And if we do close below 23,100, then what are the levels we should watch out for?
Yeah, hi. So looking at the recovery from the lower level, almost we tested around 23,070 mark in the gap down opening in the morning itself, and then some recovery took place. But broader market has recovered in this pullback. Nifty is still struggling to cross the major call concentration area of 23,300, 400 zone, which is very important and crucial for this pullback action. Again, on the call writing front, the call writers are looking confident at 23,400, 500. So I think these levels may act as a stiff resistance for any kind of pullback in the near-term perspective. Though on the lower side, put writers are also building up their position at 23,200, 23,100. So I think we could see some range-bound activity going forward. 23,100 to 23,400, 500 would be the range for next couple of trading session. And either side breakout, breakdown will decide the major direction. But the kind of recovery which we have seen in the mid-cap space and the broader market is, showing some buying action despite a lot of volatility in the global market. I think market is, waiting for some, positive announcement. If anything comes on a positive front, I think market is poised for giving breakout of this range. So buy on dips is a strategy, but with the strict stop loss of 23,100 for Nifty, those who are purely on the trading side But on the higher side, 23,300 and 400 are the range where one should book the profit. Bank Nifty is also showing some bit of recovery from the lower level and still in holding the 54,000 level. So I think here we may see some uptick once Bank Nifty crosses above 54,400 zone. I think some short covering action we may see in the Bank Nifty. Some of the banking stocks are trying to show some recovery. So 54,000 needs to keep as a stop loss. But especially in today's session, pharma is looking attractive, healthcare is looking attractive. So I think here there are a lot of opportunity in the stock specific. So one can focus on, and some recovery took place from the metal space also. So some buying interest we could see in the metal space also going forward. On the trade front, from banking space, Federal Bank is looking attractive, continuity of uptrend. Despite this volatile market, stock is enjoying its all-time high trajectory. Series of higher top, higher bottom formation is taking place. So Federal Bank is looking attractive. One can buy and accumulate. On the higher side, 323.25 could be the target. On the downside, 302 needs to keep as a stop loss. And from healthcare space, Fortis Healthcare is looking attractive. Fresh breakout of almost 5-week consolidation took place. And looking at the structure, we do hold bullish view and projecting target of 1,040. So Fortis is buy with stop loss of 985.
Okay, all right. A bunch of stocks from different sectors today, Rajesh. But we have a couple of queries as well. So let's get going on that. We have Umang Srivastav, who writes to us from New Delhi, holds 100 shares of Oil India at 250 rupees, wants to know if one can book their profits now on this particular stock. Oil India is the one that I'm talking about, Rajesh.
So he's sitting on a huge profit. He has bought at a lower level. Looking at the consolidation in the stock since last couple of weeks, my advice would be follow the trailing stop loss strategy. Keep stop loss at around 460, and I think if it's not breaks on the downside, still stock has potential to extend gain. And once the stock crosses above 525, I think we could see further higher level towards 600 also. So follow a stop loss of 460 to hold position.
Okay, all right. That's about Oil India has been an outperformer considering the Brent crude moves that we've seen. Let's go to the other one. Ishwar Kumar writes to us from Chandigarh, ask if you can invest in Alembic Pharma for the short term. Defensives are doing well. What's your take on this particular stock?
So I think most of the pharma stocks have done well in last couple of days, and I think Alembic Pharma is also showing a good strength in this volatile market. And overall, pharma is a space where we see, furthermore continuity of uptrend would be there. Though there is recovery and some consolidation is taking place in Alembic Pharma at this juncture, immediate support area is placed at around 720. So keep stop loss around 720 on the higher side. Once the stock crosses above 785, I think 840, 860 would be the next target.
Okay, thank you so much, Rajesh, for joining in this afternoon, talking to us about individual names, your strategy, as well as helping our viewers get solved and answered in terms of the queries that they've sent. But, sorry, I beg your pardon. On that note, let's also bring on board Mangalam, who's here to tell you the important cues in the world of F&O that we're keeping an eye out on.
Well, if you look at the markets, we're low today, but we're off lows as well. So we're down, but not out. If you look at the Nifty Bank, the mid-cap index, all of them tell you the same story. Yes, there is a fair amount of red on the screen, but it has seen recovery from the lows. And today's low on the Nifty, 2370, is extremely crucial to track because, all the data suggests that between 23,050 to 23,150, which was last week's low, we are finding a lot of buyers for the market. But not only does the market have to defend today's low, but also, go above the recent highs as well. So to that extent, it is a bit of jostle for space. 23,200 seems to be a bit of a fulcrum, where we are seeing put writing at the 23,200 mark, but at the same time, call writers haven't given up their positions out there as well. So 23,200 put comes up for you on the screen, as does the 23,200 call. Both of them fairly active in today's trading session. Tell you that the range for the Nifty is between 23,000 at the lower level, 23,100 at the lower level, to around 23,400 to 23,450 at the upper level as well, beyond which we have the 20 and the 50-day moving average on the frontline index. While a lot of stocks are declining versus the number of stocks which are advancing, fresh shorts have been added on a couple of these stocks which are underperforming right now. The ones that stand out today, GE Vernova, Muthoot Finance, as well as Nippon Life. All three of them are seeing fresh short build-ups take place in just the last 20-25 odd minutes. So monitor that even as the fulcrum of 23,200 continues for the frontline index.
Okay, all right, Mangalam. Thanks very much for that. Well, for the markets, just watch out for the advanced decline ratio because that continues to be weak. So 1,544 stocks advancing to around 2,700 stocks declining. Couple of stocks which do stand out are from the pharmaceutical and healthcare space. So Fortis Healthcare is showing a good amount of momentum today, up 3.5%. Syngene is up around 3% and back to the healthcare space. We have Thyrocare, which is doing well with a gain of around 3% and giving it company is Dr. Lal's Path Lab as well. So that stock from the diagnostic space doing well as well, up around 1.8%. We'll do one thing, we'll take a break, but on the other side, Manisha Gupta will join in. She has with Amit Kumar, the CEO of Queen Jewelry, to decode the volatility in precious metals. Stay tuned.
Welcome back, and joining us on the show now is Amit Kumar. He is CEO at Queen Jewelry. Amit, hi, thank you so much for joining in. And well, very, very soon it's going to be all about jewelry as we get into the festival season, wedding season, and then of course it all carries on up to Diwali and Christmas and New Year, etc. With the way the markets are though, and I'll come back to the buying part of it, but with the West Asia conflict, inflation hiking, markets anticipating that we are going to be perhaps seeing a 70% probability of a rate hike coming in by the end of this year. Is all of that impacting jewelry buying in any sense?
Hi, Manisha. Good afternoon. Yeah, very relevant question with respect to the current times. Definitely, we have seen there is certain with a current increase in the gold rates and as well as call out from the Prime Minister himself. Definitely, there has been impact at the retail. We are seeing that consumer right now are far more cautious in buying jewelry than they were before. Definitely, we are saying there is a point of definitely thought through discussion with themselves, with their family is happening before they come to the store. So we are seeing an impact at the retail, although India has been very bullish on gold and jewelry, especially jewelry over the time. So I think the time will say how resilient we are, but going by the past data, I think we are quite resilient in terms of market dynamics on the gold price increase. So definitely there is an impact, but the time will say how big the impact is going to be, Manisha.
Amit, a lot of industry representatives that I have been talking to tell me that one thing almost everybody is doing is that the jewelry that they were making earlier, they're making it 20 to 30% lower in weight right now. Is that something you're also looking at?
Manisha, definitely. I think lightweight jewelry is something that was trend from quite some time. And as you would have seen, the gold is on the rise from last 1.5 years in a quite a steep way. So definitely one aspect is decreasing the gold consumption in the product. Lightweight jewelry is definitely one of the trend. However, what we see a second trend, and as a new age jeweler to the brand, there is also a reduction in the caratage of the gold. For example, earlier a studded jewelry was at 18 karat gold was assumed to be a normal. Today, most of the brands and even luxury brands today are shifting towards 14 kt gold, and many of the mass retailer at 9 kt gold, because they want to bring that craftsmanship, they want to bring that story to the consumer at a good price. And that's the positive shift that we are seeing. Consumer is not very fixated on what caratage of gold that they would be liking. Rather, they are quite content with a 14 kt gold as long as they are falling within their taste of design and within their wallet size.
Amit, what are you looking to do in Queen going forward now? What is the kind of jewelry that you're working with? What are the new themes that you're working with for this year now?
So Manisha, for Queen is bringing to the market is fundamentally a different way of experiencing jewelry across three critical aspects of trust, retail, and design. Just to give you an example, over the past 50 years, Indian retail industry has gone through a sea change to meet the growing aspirations of the evolving customer. But today, the jewelry industry has been most laggard sector to offer any such retail experience. Today, no customer walks inside the retail jewelry store until unless they have 95% chances of buying a jewelry. There is no browsing happening at the retail at a jewelry retail store. It's because traditional jewelry stores are often feeling intimidating. When customers get inside the store, they are bombarded with 100 different questions, and that gives a intimidation to the consumer. At Queen, we have created India's first self-discovery experiential retail jewelry brand, where women can browse, they can self-discover design at their own pace without any uncomfortable questions being asked. We believe that jewelry shopping should be intimidation-free, where consumer can connect with the product or with the design that we have created, and then once they like the design, they can ask further questions and further discussions can happen.
Right.
Also, what's equally important is what sits behind the brand. We are backed by two global leaders in the jewelry industry. One is a very 96 years old jewelry jewelry brand from Japan called Kashike. They have invested in Queen, looking at the business plan that we have.
Okay.
And second is more than 60 years old brand called Rosy Blue, who have partnered with us in the supply chain, where with their support, we are able to offer mine-to-market traceability for diamonds, advanced in-house craftsmanship, and technological-led transparency. Finally, when it comes to design, jewelry industry today, unfortunately, has gone through FMCG-fication of design, where not much of the brand that you see across in the market today have a very, very differentiated design. But at a Queen, we have created 100% of our in-house designs, which has been developed by very senior craftsmanship, very, very senior designers, and that we are creating that internally and creating craftsmanship-led jewelry. That's I think, fundamentally 3 different changes that we are looking at Queen and bringing a very new, fresh perspective to the brand altogether.
All right, to begin with, I like the name itself and a lot of changes that you're bringing about to the industry itself. Amit, great talking to you. Queen then.
Absolutely. Thanks very much, Manisha, for joining in and taking us through that conversation, and definitely tempting to see all of those designs that was spoken about. But nonetheless, for the market, still weak. So the Nifty is currently down around 130 odd points. We have the mid-cap index, which is down around 0.4% at this point as well. We'll do one thing. We'll take a short break, but we'll get you a lot more in terms of specific stocks today on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. Now, obviously, as of now, the Nifty is at 23,250 levels. From when we started the show, we've seen a 50-odd point uptick from those levels. So watch out for that, while advance decline ratio still continues to be in the favor of decline versus advances. Few names that have run up are walk hard in the last 40-odd minutes. CCL product continues to see an up move, as well as Kaplan Point. So keep an eye out on those names as well. But on that note, let's get to some market opinions that we had through the day as well. And earlier, we spoke to Sameer Arora, founder and fund manager at Healers Capital, and asked him about the Reserve Bank's latest measures and what that could mean for Indian economy. Listen in to what he had to say.
When you see economy size, bank size, you can easily get 40, 50 billion. Now, it depends exactly. But it won't be outside, it won't be less than this range. I am thinking, because I spoke to 2-3 private bankers here, and they said you could get 75 billion also. But the only thing is that I believe now, after talking to these two guys, that India may have to stop it after 1 or 2 months, because this time you can do it till September. Maybe they have in mind, RBI has in mind how many billion they want. And they should create that impression so that these banks run around faster. The only bet you are taking is that India does not impose capital controls 3 years later when you have to get your money back. That bet every NRI will take very easily. No, I don't expect anything on equities. I have been saying that it is wrong and you are losing many billions. But I don't think anybody is doing that. But it's okay for now. This is quite meaningful in itself. And this whole world works on delta. It does not work in absolute that way. So this news is quite positive, and this can keep us going. And then we see, unless there's another issue in life that happens later.
Okay, all right. That's a market opinion coming in from Sameer Arora. Markets continue to trend at a 23,200 mark. We'll keep tracking markets for you. For now, we have to slip into a short break. When we come back, we'll talk about more stock-specific action on the other side.
Welcome back. Well, today the markets are weak, but if you keep your eye out on a couple of these hospital stocks, they're doing well. We mentioned Fortis earlier, which is up around 3% but stocks such as Aster DM as well as Krishna Institute of Medical Sciences, both those stocks had fresh 52-week highs. So there's definitely a lot of interest which is coming into healthcare/hospital stocks in today's trading session. The other space which is seeing some amount of momentum is these larger mid-cap banks. So G&K Bank, for example, is at a fresh 52-week high. We have Federal Bank, which is part of the Bank Nifty. That one is up around 1% at this point and is also at a fresh 52-week high in today's trading session. So just watch out for a couple of these stocks which are managing to buck the trend in today's trade. But for the Nifty, 23,250. So there's a bit of a recovery which has taken place from the day's low. We also have the mid-cap index, which is now down over 200 odd points as compared to a larger loss when we started the show. And the Bank Nifty also has seen some amount of significant recovery at this point. So around 150-point recovery just in the past 1 hour is what we've seen for the Bank Nifty. Well, on that note, it's a wrap on a halftime report. Business Lunch will take all of the action forward. Stay tuned.
Stocks slide on global market weakness following the sharp AI sell-off and resumption of hostilities in the Gulf. Healthcare and utilities managed some gains, even as metals, autos and industrials are the big drags.
Experts see RBI's measures drawing in between $35 to $50 billion in foreign funds, helping the nation address its balance of payments problem. The tax exemption for foreign investors in government bonds is also seen as a positive step that can aid India's inclusion in global bond indices.
Brent jumps to near $98 a barrel after Israel retaliates to Iran strikes, despite US President Donald Trump urging restraint. Fears of the Strait of Hormuz staying blocked sparks fears of a supply shock.
Silver and gold see sharp drops after Iran and Israel resumed strikes. Strong US employment data and the rising likelihood of a Fed rate hike also weigh on investor sentiment.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. You know, the escalations in the West Asia war, higher crude oil prices, weighing on the markets, right? Although they are off the lows of the day, but still in the red, broader markets doing better than the Nifty and Sensex.
It's more of it could have been worse sort of a scenario for the markets right now. And the index, where it started off at one point, the gap down was almost 350, 360 points is what the implied open was suggesting. In comparison to that, you would take a 130 point fall, and there's a recovery of almost around 100 odd points from the lows of the day. So the bulls will take that one. And the second part being the fact that the Nifty Bank is continuing to lead that recovery, as has been the case over the last 4 sessions as well. The index had almost slipped into positive territory, and again there's some fluctuations or volatility seen at higher levels. That 54,500 mark proving to be a bit of a barrier for the Nifty Bank. But the one single contributor to this Nifty recovery that you have seen has been the Nifty Bank, still 200 points lower, and it is at that very important 20 DEMA level of 54,300. So that is going to be the one level that the bulls would look to defend, at least going into tomorrow's weekly expiry for the NSE contracts. The circumstances though are not boding well. Oil is now near 98. Brent is up almost 5% as we speak. The hostilities in the Gulf, instead of de-escalation, are now heading towards escalation. And more importantly, the Dow futures too are trading with losses of anywhere between 100 to 150 points, although the Nasdaq futures are seeing some stability, Arundhati.
Absolutely. So the global picture is not looking very good for the Lal Street. Now, if you take a look at the sectors, we've got that healthcare and pharma pack, and those stocks are sort of bucking the trend. We've got Nifty Pharma that's up in trade, Nifty Healthcare, both of those sectoral indices are up in trade. We've got Apollo Hospitals, Alchem Labs and Max Healthcare, all of them gaining between 1% and 3%. Fortis Healthcare also up over 3% in trade. It's the metal pack that's continuing to see some weakness. It's the top losing index. It's down over 1%, and it's the 4th straight session of losses for that index, right? Nalco, Hinzing, SAIL, all of them falling between 2% and 4%. Right now, Hinzing seeing some sort of a recovery, so 1% lower in trade. Weakness in the realty pack also continues. DLF, Prestige, Lodha, all of them seeing cuts of over 3% in trade as we speak. On that note, it is time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. The Indian rupee today lost a significant part of the gains it made on Friday when the RBI announced steps to boost dollar flows into India. Dealers say the heating up of the war between Israel and Iran and the consequent global equity sell-off is hurting India for now. Lata Venkatesh is here with all of those details. Lata, you know, the rupee weak again today.
Well, the rupee had gained nearly 1% after the Reserve Bank announced those bunch of steps on Friday. Today, about 0.7% lower. So you can see that a large part of the Friday gains have been sold into. The immediate reasons are entirely global. Like we said, the intensification of the Gulf War, which has pushed crude prices about 5% more and counting. It's still rising, and the dollar index has also risen, now gone over the 100 mark. Both those are negative. Then we must also remember that FPIs had sold some 8,776 crore of stocks on Friday. That usually gets transacted T+1 and the dollar purchase happens a day or two later. Some of those dollar purchases are happening today to be repatriated. But the counter is coming from bankers saying that in the slightly more nearer and medium term, there is a significant amount of dollar flows expected from the Reserve Bank's FCNR deposit scheme, where the Reserve Bank is going to bear the hedging part. So their expectation is $50 to $60 billion in the very least will flow through the scheme. And maybe if you add ECBs, the inflows may be even more. Now, there is a bit of a worry, or there was at least over the weekend, a bit of a worry that the circular is not yet out. The Reserve Bank normally announces something in the monetary policy, and by Friday evening, the circular is out, and there is a bit of a worry that this one was not announced. But what we are picking from sources in the banking space is that the circulars will mostly come by today evening. So then the market will be more confident of the flows that will come.
95.65 on the currency, and as Lata was referring to the RBI's proposed schemes that it will be bearing the hedging costs for the FCNR bonds until September. Well, CNBC TV 18 spoke to top bankers on how much dollars schemes announced on Friday may bring. Now, here's a slice of what the bankers and market experts said as well.
When you see economy size, bank size, you can easily get 40-50 billion. Now it depends exactly, but it won't be outside it won't be less than this range. I am thinking, because I spoke to 2-3 private bankers here, and they said you could get 75 billion also. But the only thing is that I believe now, after talking to these two guys, that India may have to stop it after 1 or 2 months, because this time you can do it till September. Maybe they have in mind, RBI has in mind how many billion they want. And they should create that impression so that these banks run around faster.
See, in debt, there are two factors. One is currency, second is taxation. Both have gone very positive. And so that's why I think the chances in debt are very, very high that Bloomberg can consider much more positively. And that's why I think on the debt side, clearly, I would say that the mood is very, very optimistic.
I think going forward, the interest rate on FCNR will likely to increase, and we are going to mop up good volume under that. We are expecting that country as a whole, I think it should be in the range around 35 to 40 billion USD.
Many of the irritants which were there for foreigners has now gone away, which means it's a matter of time, hopefully, before we get inclusion into the Bloomberg Aggregate Index. That alone should bring in passive flows of $25-30 billion to start with.
And let's get you the latest on the US-Iran war. Israeli Air Force strikes military targets in western and central Iran in response to Iran's missile attack against Israel. An Israeli army spokesperson said they are prepared for any attack and are strongly prepared on the defense and on the offense. Earlier, Iran fired ballistic missiles against Israel. Iranian Parliament Speaker MB Ghalibaf says that the naval blockade and violation of agreements regarding Lebanon amount to violations of the ceasefire. Iran's Revolutionary Guard call the attack against Israel a warning. Dan Murphy joins us now with all of the latest from West Asia. Dan?
First, this new escalation certainly putting that fragile April ceasefire to the ultimate test now. Israel and Iran have struck each other directly for the first time since that truce took hold, leaving the regional peace agreement basically hanging by a thread. Of course, markets reacting to the uncertainty. We're seeing oil prices spiking here at one stage over 5%, with Brent crude surging over 95 USD as investors brace for potential disruption. Of course, the Israeli Air Force has hit military targets deep inside central and western Iran, specifically targeting air defense systems and weapon sites, they say. We're also following reports that say explosions were heard across multiple Iranian cities. And this was direct payback in a way. On Sunday, we saw Iran firing at least 10 ballistic missiles into northern Israel in response to a deadly Israeli airstrike inside Beirut, targeting Hezbollah locations. Israel saying it was able to intercept all of those incoming targets and there were no injuries on the ground. Crucially, though, neither side has officially declared the ceasefire dead, but as I mentioned, the truce has kind of never been more vulnerable at this point. The real battle, though, seems to be unfolding behind closed doors between Washington and Tel Aviv. And Steve alluded to this earlier, but Axios reports that President Trump personally ordered Prime Minister Benjamin Netanyahu to stand down and to give diplomacy more time. One U.S. official says Trump told Netanyahu, "We are close to doing something good in terms of a deal with Tehran." Israel went ahead and struck anyway, and the president's frustration is seemingly spilling into the open as well. President Trump also speaking with the Financial Times in the last 24 hours, saying, "I call all the shots. He doesn't call the shots." President Trump also insisting that Israel's prime minister won't have any choice but to accept whatever final agreement Washington secures. So behind the scenes as well, U.S. officials speaking to Axios are seemingly trying to contain the damage, not just the fallout in what appears to be a growing fracture between the United States and Israel, but also intentionally describing these Israeli strikes as relatively limited in scope, perhaps hoping to prevent a formal declaration that the truce is over and to maybe even buy the president more of a narrow window to try and salvage these negotiations. Iran had previously threatened to target U.S. military bases if Israel retaliated, and its top negotiator also warned that American assets in the Gulf will once again become legitimate targets. It's a threat really underscored by that weekend clash between U.S. and Iranian naval forces near the heavily blockaded Strait of Hormuz. So the Gulf certainly on a higher alert this morning, how Iran could potentially retaliate, whether or not U.S. bases or even civilian and energy infrastructure could once again be in the crosshairs remains to be seen at this point. But just to underscore it, the truce looks incredibly fragile right now, and asset markets are reacting as a result.
Dan Murphy, thank you for that update there. Now, oil prices, as we mentioned, well, a slight bit of profit booking from higher levels. They're nearing the mark of 98 at one point. They're still at 97.19, so 4.5% higher for Brent. Gold prices, though, have declined due to the renewed tensions in the West Asia. Manisha is now joining in with the latest update from the commodities market. Manisha.
Well, it started as a week where we're looking at the energy prices rising and the metal prices declining. I'll start with the crude oil prices, where we are looking at nearly 5% of gain now coming in for the Brent prices, inching very close to that $100 a barrel mark. And this is after over the weekend we've seen Israel, Lebanon, Iran, Israel, and then Israel retaliating yet again. So the geopolitical tension within the West Asia seems to have surged yet again, supporting the prices therein. Also, the expectation that this could perhaps take longer than what the street was anticipating earlier, and the fact that the Strait of Hormuz is shut for a fourth straight month and nearly 11 million barrels per day of oil production is now behind the blockade is worrying the markets, given the fact that you have seen the global inventories declining, strategies petroleum reserves depleting, and markets believing that you could be looking at much higher prices going forward in the month of June and then July as well. But that's about the crude oil prices. In metals, we've seen gold decline 5% in the previous week. Silver is down 10%. And with that, it's a 2-month lows that we are looking at both in case of gold and silver. There is a decline in metals as well. So whether it's copper, aluminum, zinc, all of that seeing a decline. And this is on the back of a stronger than expected US non-farm payroll data and a near 70% probability that US will increase rates once at least in the month of December 2026. All of that worrying metals investors.
All right, Manisha, many thanks for those details. On that note, it is time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned.
Welcome back. Amazon has turned 13 in India and has just committed an additional $35 billion to invest by 2030. CNBC TV 18's Ashmit Kumar sat down with the country manager Samir Kumar to find out what comes next. Listen.
We have enabled $20 billion of exports already, and we have promised to get to another $60 billion, so take it to $80 billion of exports in the coming 5 years. And we are going to be in 100 cities and 1,000 micro-fulfillment centers in the coming months, and I'm really excited about getting that to our customers. Our growth is 25% month over month for the past few months. So it really is still an exciting phase and still in a nascent stage. Prime is a big part of our overall growth. And if you look at what's happening in Prime, 70% of Prime customers are now coming from tier 2, tier 3 cities. So that gives us a lot of hope that we are going beyond India into Bharat and continuing to increase our speed for these customers as we build our fulfillment centers in places like Patna and Bhubaneswar and Kochi. We are starting to see those play out where customers are valuing the large assortment that they get in hours and days right now, but hopefully soon in minutes in these cities. We will do whatever it takes to be a leader in the fastest speed that's possible, and hopefully that fastest speed will give to our Prime customers as a benefit.
A powerful magnitude 7.8 earthquake has struck off the southern Philippines, triggering tsunami warnings across parts of the Philippines and neighboring Indonesia. Authorities have urged residents in coastal areas to move to higher ground, while strong aftershocks have been reported across the region. The Philippines Civil Defense Office says at least 8 people are feared dead. Eyewitness videos show buildings shaking violently as people rushed out of their homes in search of safety. The quake has caused significant damage, with an abandoned school building collapsing in Davao del Sur and another structure in General Santos City partially collapsing. Rescue and assessment operations are currently underway.
Well, the recovery that we had seen on the index at the start of the show is starting to getting sold into yet again, and we are back at that 23,200 mark as we speak. So we're back at those levels as we were at around 11:30. So we're still stuck in a range. There is no significant directional move that the index has seen just yet. We are of course heading into the business end of the trading session in the last 2 hours, and particularly the last 60 minutes where a lot of action generally transpires. Wipro has extended its losses now, is down around 7% at the lows of the day is where the stock stands. The buyback dates are yet to be announced. The buyback price is 250. The stock is at 184. What has also extended its losses is Netweb Technologies. That too is down around 7.5%. The top loser on the Nifty 500 in today's session. But of course has been a big wealth creator in the past. So some bit of profit booking continuing on Netweb. What is also not doing well is First Source. That is down 5.5% as well. Muthoot Finance has moved to the lows of the day, almost 5% lower in this stock as well. So not good going for the gold financiers, of course, with the volatility seen in the gold prices globally. 4.5% lower on Muthoot Finance as well. Aarti Industries, Anant Raj, Latent View, all of them seeing losses of anywhere between 3 to 4%. Not to forget Urban Company, that too is trading with losses of around 4%, hovering around its IPO price of 103 rupees a share. Take a leave on this edition of Business Lunch from Arundhati and me. Thank you so much for watching. Midcap Radar on the other side.
Hello, good afternoon. Welcome to Mid-Cap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. Today, joining me on the show is Mangnam Malu. Mangnam, good afternoon. Well, we did see some recovery from the lows of the day. Nifty is above the 23,200 mark, courtesy Bank Nifty, which is down around 0.4%, but it is outperforming the benchmarks as we speak. Whether that continues or not is the big question, because the geopolitical concerns, they are on the front foot yet again.
They are on the front foot yet again, and the kind of stocks that are doing well today tells you that maybe there is some flight to safety which is currently underway. You have the pharmaceutical stocks, the FMCG staples, and a lot of these sugar stocks doing extremely well in today's trading session, maybe on hopes of the ethanol trade playing out once again, given the sort of rise that we've seen in crude prices. But a lot of the top stories that we're tracking this afternoon right up for you. It is stocks that slide on global market weakness following a sharp sell-off that we saw and resumption of hostilities in the Gulf. Healthcare stocks managed some gains. Metals, autos and industrials are the big drags today.
Shares of EMS surge nearly 15% as the company emerges as the L1 bidder for a 103 crore rupee Jal Nigam project in Uttar Pradesh.
HG Infra receives a provisional completion certificate for a near 5,000 crore rupee project in Uttar Pradesh. Stock surges 5%.
Okay, all right. These are the top headlines that we are tracking. The pharma index continues to be one of the gainers in an otherwise weak market. But recovery is something that we are tracking very closely. 23,100 continues to be an important support on the Nifty as we speak. The pharma index has come off from the highs, but a lot of individual stocks which continue to be on our radar. So that is something we'll track through the course of the show.
We will track through the course of the show. Names like Thangamal Jewelry doing extremely well. A lot of these jewelry companies are doing well. All of last week, Titan was one of the bigger gainers. Kalyan Jewellers was the other one. And now we're seeing this gain come back on the lower rung of all these jewelry stocks as well. Currently, some profit taking for Titan is what we've seen. Just be mindful of the flash at the bottom of your screen, which is Brent prices. They are now about $97 per barrel. This morning, it was slightly, ahead of $96 per barrel. In the matter of today's trading session so far, it's increased by about 1.5%. Started with 3%, now closer to about 5%, and has a bearing on the rupee as well, which has moved towards 95.65. Remember, it had strengthened past 95 on Friday's trading session, now nearly given up all those gains that we saw on Friday itself. But let's get to mid-cap movers in our special segment. Ria joins in with all the stocks that are moving around. Ria.
Well, yes, let's take a look at all of the stocks moving around in today's trading session. Starting off with the gainers first, we have CCL Products seeing a strong move and backed by strong volumes as well. Nearly 6 times the 30-day average volumes traded in today's trading session. Kaplan Point also seeing a strong move today. The stock is up around 35% just in the last 2.5 months. Meesho today bucks up in trade after seeing a decline of nearly 23% in the last 1 month. Aster DM Healthcare also seeing a strong move of around 3% in today's trading session, as well as Syngene, which is also trading on the back of strong volumes, nearly 8 times the 30-day average volumes traded today. But this stock, remember, is down nearly 31% on a year-to-date basis. Moving on to some of the stocks that have hit their all-time highs as well as their 52-week highs, even in a weak trading session as today. There's Aster DM Healthcare, Acme Solar, as well as Kim's, all performing well in today's session. And on the flip side, looking at some of the losers, then Netweb Technologies is taking a big hit in today's trading session, although this stock is up over 2 times just in the last 1 year. Tata Teleservices also taking a hit, and it continues its decline. It is down around 40% for the year, even after recovering around 40% from its April lows. And IFCI also taking a hit of around 5.5% today. But this stock has rallied around 60% in the last 6 months. First Source also in the losers list today. The stock is down over 30% just in the last 1 year as well. And also RHI Magnesita down around 5.5% today.
Okay, all right. Thank you so much for joining us with that list, Ria. So some of our mid-cap movers in trade. Other than that, you do have a lot of these products. CCL Products, for instance, is up around 7.5%. We'll be having a conversation with the management in just a bit. We do have DE Development as well, which is up 5%. Cartrade Tech is the other one, which is on our radar. But it's a good time to get a technical check on the markets. Richard Jain from Motilal Oswal Financial Services is joining us for just that. Richard, what are the charts suggesting? Is a definite recovery underway? Do you think that could happen today? What's the next important level on the Nifty?
Yeah, hi, very good afternoon. Well, we've already seen a time-wise as well as a price-wise correction from that high of 24,600 and 61.8% retracement of the entire previous up move from where we marked the bottom of 22,200 is placed around 23,000. So I think 23,000 remains an important support for the Nifty. And till that is intact, we might see some consolidation itself rather than any big price-wise downmoves from current levels. So although the risk-reward issue is favorable around 23,000, but still needs that confirmation in terms of reversal. So we are advising our clients to take more of a stock-specific approach over here. 23,000 is a support, 23,500 is a resistance. Let this range breakout come for any directional move on the index.
Right. And individual stocks, how should one play that? Because the index is consolidating. A lot of the stocks which are declining, and then there are a few which are rising with great volumes. How do you play that? Is it long short? Is it short short? Is it long long?
So considering that Nifty is more towards the support, so we are looking for long opportunities at current levels, but specifically only those stocks which are showing a relative outperformance to the market in the recent fall. So Federal Bank is one stock which, if you compare the returns of Federal Bank and to the Bank Nifty or other private banking names, and it has shown a good relative strength over there. So Federal Bank, we are advising to go long at current levels also, keeping a stop loss below 295. We expect potential targets around 326, 327 in the near term. Apart from this, amongst the broader markets, Azad Engineering is one stock that we like. Again, similar concept that when markets are falling, the stock is not going down. And that too, whatever minor corrections that we are witnessing, they are not backed by any high volumes. Whereas recently we have seen that the price of moves were supported by very good volumes. So Azad also can be bought at current levels with stop loss below 2080 for potential up move towards 2400 in the short term.
Okay, take that point, Richard. Thank you so much for joining in. So those are some technical bets in the broader markets. We'll slip into a short break. When we come back, we'll connect with Praveen Jaipuria, who is the CEO of CCL Products, to discuss the FY27 outlook and the business update as well.
Welcome back. In an otherwise wobbly market, one stock which is actually doing very well is CCL Products. It's up about 7% in today's trading session, opened in the red but saw some buyers, and at the same time this month it's done extremely well. In this market is just 5% away from its 52-week high. So we're obviously beginning to ask which is what's brewing with CCL Products. We have the management with us, Praveen Jaipuriar, who's the CEO CCL Products, joining in now. Praveen, good afternoon. We'll try to repatch that connection with him, but just to recap the move on the stock, it's up 7% in today's trading session. This month it's up in double digits, and in fact this year itself it's seen an over 22-23% sort of gain coming in. Fourth quarter results not particularly bad, 46% on the revenue, margins coming in at around 16%. The company says EBITDA per ton is a better metric to measure that. But what we'll do is we'll take a short break, come back on the other side, have the management join in to decode what's actually brewing with CCL Products. Stay with us.
Welcome back. You're still tuned into Midcap Radar on CNBC TV 18. It's time to bring you some more conversations on the sidelines of the ICICI Securities Investor Conference. My colleague Nigel D'Souza caught up with Hitachi Energy's MD and Venu and started off by asking him about the company's data center opportunity. Listen into a slice of that conversation.
Data center is one of the big vector or big growth segment going to play massively in India in that. So as you know, a lot of demand drivers, localization of the data, and also the AI and also cloud, all these things are enabling that we need more data centers to come in that. And today, if you take over the data center, India is having a less than 2 gigawatt of data center.
Right.
The projections, depending upon what you take, anywhere between 13 gigawatt to 15 gigawatt of data centers required by 2030 itself. We're not talking very long, we are talking about next 4-5 years in that.
Right.
And these data centers require a reliable power. When you're talking about the reliability, means it's a 99.99% availability required in that. So they need a very robust, reliable power round the clock in that. And that's what is the opportunity where Hitachi Energy is looking forward to us. And we, right now, we provide the grid connections. The grid connection means the data center will be powered through our technology, and also inside the data center we provide the transformers, etc. It's roughly in the range of 10 to 15% of the data center capex is our addressable market in that.
If I put a rough number, sir, at the lower end, it could be that the total capex that is lined up for data centers just till 2030, on the lower side, it could be around $30 billion. So my question to you is, if you all are eligible for around 15%, mathematically, it could be around a $4.5 billion opportunity for a company like Hitachi.
Over a period of time.
Over a period of time. Would that be a fair estimate?
10 to 15% of the addressable market is a fair estimate in that. But in addition to that, what we also recently announced, we announced an additional portfolio that is a grid-to-rack portfolio. That will give you a further expanded addressable market over a period of time.
Okay, so what you're trying to tell us is this data center opportunity could actually be even larger than the HVDC opportunity that you spoke about, say, 3 to around 4 years ago, right?
Yes, when we talked about, HVDC was not visible. Today, HVDC is more visible, and it's available for the next couple of years. And I believe that, to manage the complexity arising of this large-scale integration of the renewable, country like India needs at least minimum 2 to 3 HVDC projects per year in that. That's what I said, and you can see the product, you can see the pipeline of that. But it's not fair to compare the HVDC and the data centers. Data center is, for example, it's a standardized, it's a repeatable, and it's a scalable in that.
Yes.
So if it is successful, because what data center hyperscaler they look at it the infrastructure, lower cost of the power, and reliable power. And if we are able to provide as a country, and I'm sure the scale is much higher in that.
So looks like I'm being conservative this time around with that estimate of around 10 to 15% of a $30 billion opportunity. 3 to around $4.5 billion looks conservative as of this juncture.
No, that's a whole market we are talking about. It's not that everything we win it.
Yeah.
Of course, our endeavor is to ensure that we win as much maximum as possible in that.
Okay, all right. Let's take a couple of those aspects forward then. India's competitiveness in this entire data center opportunity. I think there are two factors that we look at. First is cost. One is cost competitiveness, and the other factor is technology know-how.
Right.
Do you think India is well placed?
Absolutely. On the cost standpoint, yes. So we are able to offer very attractive price point on the green energy. Okay, that's definitely there. With our government's pushes to 500, 600 gigawatt to 900 gigawatt by 2035, that's structurally visible in that. What's also important for the data center is the reliable power. One is that cost, for sure, that's important, but that's not only sufficient. In addition to the cost, what is extremely or equally important is the reliable power. How do we ensure that 99.99% available power round the clock is available to them? And that's where the technologies will play a major role, like HVDC, like STATCOMs, and many other things where Hitachi Energy has pioneered in those technologies, and that's what is going to be.
So India is relatively better placed in this data center opportunity.
Absolutely.
Okay, all right. We've got that out of the base. I want to ask you, there was another notification that came in from the center with regard to equipments, 60% sourcing or something on those lines.
Right.
Could you help us out with what kind of impact it has on a business like yours?
No, as I said, Hitachi Energy has been, investing in India and localizing the many of our technology, very, very critical technologies. For example, HVDC in 2022, we started the manufacturing in that. So as far as Hitachi Energy is concerned, we are far ahead of those minimum requirements set by the government in that.
Right.
We are much, much higher than that. We continue to even more localize many of our products and solutions in that.
So that won't be a big impact to you then?
It will be a positive impact for us, because we are doing more locally added and locally produced things in.
All right, that is the management of Hitachi Energy. Meanwhile, don't lose sight of the market. The Nifty is now down firmly below the 23,200 mark. Part of the reason could be increased spike in oil prices, and alongside that, further weakness in the rupee as well. So up moves towards that 23,220 thereabouts have been sold into. The Nifty down about 50 points from the highs. What is taking it lower is the Nifty Bank, which at the start of the show was down by about 0.4%, has now corrected to about 0.2%, and that's largely on account of the macro weakness, which shows in the banks first. But InterGlobe Aviation is the stock on our spotlight, under our spotlight, because of the company's targets that they've given for 2030. They, in fact, want to position themselves as a key global aviation player by 2030. The stock currently lower, understandably, on account of increased oil prices.
Well, Indigo is positioning itself as a key global aviation player by 2030, and in its India 2030 vision, it has targeted 300 billion ASK capacity and 200 million passengers. Now, that said, the FY27 capacity is expected to grow in the single digits itself, with it accelerating to mid-teens by FY28 till FY30. Now, it aims for 3,000 daily departures with a fleet of over 550 aircrafts by 2030, with mid to long-haul international flights set to rise to 10 to 15% of the total capacity from the current 4%, while domestic share is set to decline to 85 to 90% of the capacity from the current 96%. Now, that said, the premium push is also what Indigo is aiming for. Now, the business class seats are set to expand to over 4,300 by FY27 end from the current 2,800 plus, with the stretch product rollout to reach 105 aircrafts from the current 53 only.
Okay, all right. That is about InterGlobe Aviation. And while we are talking about mid-caps on the broader markets, don't lose sight of what's happening with the benchmark index. Nifty IT is the one which is pushing the Nifty lower. There is a sharp fall from the highs of the day with the mid-caps, which is now down 500 points. Nifty IT is the one which is leading to that fall. We do have Wipro, there's TCS, these two stocks under pressure. In terms of the top losers or the stocks of the day's low, there's Tata Consumer, HDFC Bank, SBI Life, Jio Financials. So a lot of stocks which are under a lot of pressure and pushing the Nifty lower as well. But on the flip side, there are stocks which are buzzing on the upside with big volumes. NRB Bearings, on the back of that block deal, is seeing a gain of around 15%. EMS Limited is the other one which is higher by 14% in a weak market like that. But we do have a conversation lined up on the show.
We do have a conversation lined up on the show, and as promised, finally, after I think it was a long brew, the management of CCL Products joins in. Praveen, thank you so much for joining in. And, you know, I believe there were some technical glitches which have gotten fixed right now. You can hear us, right?
Yeah, I can hear you.
Perfect. You know, if you look at your fourth quarter numbers, I was looking at your revenue growth. A large part of that obviously was, you know, on account of the higher prices of coffee. And the better way to look at your EBITDA is EBITDA per kg as against margins, because, you know, the top line has a function of the commodities as well. So I just have a two-part question right now. How has volume growth been in the first quarter so far? You had targeted about 18 to 20% for the full year. And consumer sentiment around current coffee prices and geopolitical uncertainty, how have they panned out?
So two things as you have asked, Mangalam. The first part is about the volume growth. So we are actually, you know, last year we did get a volume growth of 18 to 20%, and last quarter was a little higher, closer to 20% or so. The balance of the rest of it was value-driven growth. So that was the kind of volume growth we got last year and last quarter. And on the demand and the supply side, the demand seems to be good. There hasn't been any let up on that. And the supply side, the things have eased up a lot as far as the coffee prices are concerned. You know, there has been a drop of almost 20% or so from the last year's level. And the indications are good coming from the Brazil crop. That should lead to further softening is my personal guess here.
Okay, so you're expecting further softening in prices, and that's new considering the geopolitical worries that we are seeing. Most of the commodity prices are going higher. What's your take? By the end of the year, how much lower could that be? What would that mean for your margins per ton? And also trying to understand what is the debt reduction plan this year, because you have seen a considerable debt reduction already.
So yeah, first and foremost, I don't think so any softening leads to any better margins, because we work on a cost plus model, which means that if we were to finalize the contract today, we do back-to-back buying. So therefore, like Mangalam was mentioning a while ago, that we try to keep our EBITDA per kilo intact. So therefore, an increase in coffee prices upwards or a decrease downwards does not lead to our margin changing. And the good part about the lowering of prices is that it gives a lot of confidence to the client side, because they are much more surer of the prices when it is at a lower level. and they go for long-term contracts. So that makes things a bit easier. Yes, the geopolitical situation has kind of, given a little bit of impact on the logistics side. But thankfully, since the supplies come from Brazil and a lot of it comes from Southeast Asia, it's a little insulated as of now. And even, as far as the end customers or the clients are concerned, a large part of our customer and the client bases are in, North America, Europe, CIS countries, and Asian as in Southeast Asian countries. So, so a lot of them, from both from a supply and from the end customer point of view, are still, insulated from the current geopolitical situation that has emerged in the Middle East largely. So that way we are looking at, not looking at much of bad news coming from these sectors.
Okay, no bad news coming in from these sectors means good news for your shareholders, and that's what we've seen in your stock price as well. Praveen, just a final question before we let you go. Two things that could impact your margins going forward. One could obviously be the higher share of revenue coming in from freeze-dried, and the second one would be higher share of revenue coming in from lower unit packs, lower small packs in the domestic business. That number increased from 15% to 20%. What's your target out here? And on the freeze-dried business, how much can that increase in your overall sales mix, given your current capacity utilization?
So, I have not seen much of an increase in terms of, EBITDA per kilo is concerned, because let's say even last year, the proportions for freeze-dried has already increased. So there was much higher proportion of freeze-dried last year. And considering the capacity that we have put and the constraints that will come in, because the freeze-dried capacity seems to be more, fuller. So therefore, I don't see a proportion change in the product, or let's say the product mix driving more of EBITDA per kilo. Yes, small packs will keep on driving the EBITDA per kilo. And there could be a little margin erosions in terms of maybe a logistics cost, or let's say if spray dried proportion goes up in the coming months. So what we are guiding the market is that we will keep the volume growth at 15, and we'll try and maintain the EBITDA growth also in the region of 15, not taking it up to 20 or 25 on the back of a volume growth. If the volume growth goes up, yes, it will definitely go up to those levels.
Okay, right.
But we are keeping the guidance at 15% or round about that.
Take that point, Praveen. Would have had a longer conversation, but we'll keep that for some other day. Thank you so much for joining in today with your thoughts on the business and the outlook going forward. The stock is doing well in a weak market like this. With that, we'll take a leave on this edition of Midcap Radar. Stay tuned, your stocks when we return.
Hello, good afternoon. You've tuned into your stocks coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, good afternoon. And we started Monday with Monday blues, Monday reds, whatever. We are at least in those colors of not being too bright, not being too happy. And the market as of now, 23,170, 180, around that level is what the Nifty is trading at. Tried making a recovery somewhere at around 12 to 1. But then we again saw that fall coming in. So we'll watch out for where the market is going to be headed, right? As of now, down 0.8%. Broader end of the market not doing anything well as well, especially the small cap side that's seeing a sharper cut in the trading session. So you have that broader end of the market which is under pressure. That's why the advance decline ratio also, Arundhati, is in favor of obviously declines versus advances in today's trading session.
Yes, absolutely. And the West Asia war, escalation in the West Asia war instead of a de-escalation, higher oil prices, all of that weighing on the markets. And if you take a look at the sectors, we've got that healthcare pack, which is the only pack that's sort of bucking the trend. We've got Apollo Hospitals, Max Healthcare. Those stocks are gaining in trade. And on the downside, we've got the metal pack, which is the top losing index today. But that's how the markets are set up. Let's start with the show and answer all of our viewer queries. And to do just that, joining us today is Gaurang Shah, Senior Vice President at Jio Financial Services, and Shivangi Sarda, Analyst Derivatives Wealth Management at Motilal Oswal Financial Services, to answer all of your stock queries. Now, the first, thank you so much, Gaurang and Shivangi, for joining us on the show. The first query coming in is from KS Rao, who is on the line from Andhra Pradesh. He invests in LIC. Please go ahead with your query, sir. So we don't seem to have the caller with us at this point in time. So KS Rao has a query on LIC. He is making a loss on the stock and he holds 100 shares of LIC at 800 rupees. He says he is a long-term investor and can hold the stock for another 2 years. So Gaurang, let me come to you first. What do you make of the stock? Is it a good bet?
Hi, Arundhati. Thank you so much for having me on your show. Good afternoon to all your viewers, to Shivangi and to Vinny as well, and to you as well. Small disclosure before we go any further, that all recommendations that I'll be sharing with you on your show, they are part of our fundamental research team recommendation from a long-term point of view. Our company, Jio or myself, we do not have any kind of personal investments, no financial interest, no conflict of interest, but we share similar investment ideas with our clients. They might have their investment interests. So actually, Arundhati, if you go to see, there is not a loss. If I'm not mistaken, about a week or 2 weeks back, there was a bonus 1:1 for LIC. So this gentleman, since he got in at 800, I'm sure he would have got that bonus shares as well. And then if you adjust the price with the bonus shares, then you would see a better picture. Having said that, from a long-term point of view, in the life insurance sector, other than LIC, we are positive on SBI Life, HDFC Life, and ICICI Prudential Life. And our sense is that ensuring the uninsured is going to be a big theme going forward, as the approach towards taking term insurance, especially for the millennials, have changed for better. So we expect the new premium run rate to go through, thereby improving the top line and bottom line. Stay invested for long term.
Stay invested for long. That's a word there on the fundamentals. Shivangi, good afternoon. What's your view coming in for LIC? Obviously, YTD, the performance has been muted. Last 1 year also, nothing exciting. So on the charts and technicals, for the long-term story, are we expecting some bit of a bounce back now?
Hi, good afternoon, Vinny, Arundhati, and Sameer. So we've seen that overall this stock has kind of witnessed a kind of lackluster move from the last 3 years, and even despite the attempts of recovery, the stock hasn't been able to sustain at the level. So clearly, momentum is missing in this one, and volumes have dropped. From the last 5 to 6 trading sessions as well. So immediate basis, we're not kind of seeing any kind of respite here. And even on the long term, this might be a little staggered one because it is still below its key exponential moving averages on the monthly frame. So not much of an upside here, maybe a little capped upside on the cards for this one. And immediate basis, I think it would be important to watch out for a support of 385 levels.
Okay, we'll keep an eye out on those levels over there. Shivangi, thanks for that. Let's move on then to the next query. We have Saurabh Manyam, who's writing to us from Andhra Pradesh. He is holding some shares of Tata Elxsi. They've not exactly mentioned at what price they have, but they bought it they bought it over a period of 10 years. So surely they are a long-term investor. They've been holding it for a while and adding it for a while as well. But now, is it time to continue to hold to Tata Elxsi or maybe switch to other IT stocks, they're saying, like TCS? Gaurang, your view?
So Vinny, hi, good afternoon to you as well, Vinny. So taking into consideration last 10 years of accumulation of Tata Elxsi, I am assuming that the average cost of investment for Tata Elxsi for this investor should be at a much lower level. Since he's not mentioned the average price, I'm assuming this. Having said that, and as a disclosure, we do have positive coverage on Tata Elxsi. Really, look, there was a problem last year and possibly the year before on the earnings front for Tata Elxsi. Before that, it was one of the outperforming stocks in its category and sector in terms of return on investment. But now things have started to change. The earning visibility has come back. The management has given a strong verbatim going forward into the future for the business, etc., etc. So if you're a long-term investor, why do you want to come out of a stock which you have invested at a very decent level, at a lower level, and now that the turnaround is there, might as well stay invested and reap the benefits of it. So I would give a hold from a long-term point of view.
Okay, hold from a long-term point of view is the view coming in there for Tata Elxsi. But Shivangi, Gaurang, we have to take a quick break, but we'll answer all more stock queries on the other side. Stay tuned.
Welcome back. We are at the ICICI Securities Conference and we've got a very, very special guest with us, Mr. H.M. Bangur, one of the pioneers of the cement industry and the owner of Shree Cement. Well, Mr. Bangur, it's been a while. Always a pleasure having you on the show. Well, how are things looking on ground in terms of demand? And could you tell us, you all went through a bit of a change over the last few years between pricing, value versus volume. For the next few years, what is it? Is it going to be volume over value or is it value over volume?
Now, India is changing and changing fast. Whatever is cheap will not be sold. So volume will come only with higher prices.
Okay.
You are selling confidence and confidence doesn't come selling cheap. So anything which is sold at a higher rate is perceived to have better value.
Okay.
India is now having affordability. Cheaper price is no more the virtue. So price and will be changed to chase volume.
Okay, all right. Now, in terms of pricing, the point that you're making, the last few years pricing has been quite dismal. And you have normally told me, Nigel, look at the prices, they're not moving at the pace that I'm quizzing you about. You expect now prices to improve? If you could give us a rough number, because the last few years it's been in low single digits, if at all. From here on, how do you see price increases moving, particularly when that new entrant, that's the Adani Group that came in a few years ago, now they're going slow on their aggression and they're turning their sights on profitability. So how do you see pricing move?
All the good things, whatever you say, the price increase in cement industry is at the CAGR era of 3% for last 5 years, 10 years, 20 years, whatever time period you take.
Yeah.
The industry is surviving because of higher efficiency. Prices, I don't think, will be increasing at much higher rate. Only thing is this year, because of the war, cost increase is very high.
Yes.
So the prices may increase higher, but profitability will not increase much. Their prices will only cover the cost increase.
Okay.
So price increase and profitability, higher profitability doesn't go together.
Okay, so let's focus on that then. You have a dominant share in North India, which has been a very lucrative market. Now we have other players that are saying, we want to come in and have a piece of the pie. So Mr. Bangur, your supremacy there is going to be challenged. Do you think directionally then the EBITDA per ton starts declining from here on, or have you done enough on the cost side to protect the EBITDA per ton that we have seen over the last few years?
North India is having a market of about 120 million ton per year. If we take 7 to 8% growth, about 10 million ton additionally is required every year. And with 70% capacity, it will become about 13 to 14 million ton. Everyone you are talking about is adding some capacity, that is a must. But 14 million ton capacity if added will only increase the pie, not eat away others' portion. So our market share will only increase. It will not decrease even by coming so many people. Moreover, when new players come, their cost of production is higher. They will like to push up the prices. Wherever the new players doesn't come, the profit rise is not there. Whether it is tea industry, jute industry, sugar industry. So for profits to increase, more competition is necessary.
So you believe that your profitability will be maintained?
Increased.
Will be increased from here on?
Right.
Interesting. And your volume as well has been lagging the street over the last few years. But now you believe you will outgrow what the industry is going to grow. I think industry is expecting 5 to 7% very, very roughly in terms of a cement demand growth. Do you think you can do, say, 1.3, 1.5 times of what the industry does?
No, 1.3, 1.5 is too high.
10% growth for this year?
1.1 times the industry growth. Now you see the last quarter. Last quarter compared to this, our volume growths are much better.
Okay.
Even in the first quarter, April, May, June, we expect volume growth to be better than the last year and better than the industry average. Only because of last year we increased the prices, our base effect is lower.
Okay.
So much better volume growth will be there.
Okay, all right. So you're saying volume growth will be better as well. Now that pricing that you're talking about, there was this conscious decision that you want to go ahead and you want to narrow the pricing gap with, say, the leader, that's UltraTech.
Right.
Is that realignment done?
Yes, realignment is partially done. The price difference has come down. Initially, some volume loss was there. That's why I was saying the base effect.
Okay.
Now the volume has come back. So we have got the prices, we have got the volume.
Okay. All right. So now you're set for better times ahead. Profitability improves, volume growth as well outpaces.
Right.
Your journey to 80 million tons. Where is the focus area? Normally it used to be North India. Now you have some exposure East as well as South. The next leg of growth comes from where?
It will come from North, West, Kutch and other places. It will also come from East and Northeast also.
Okay.
So it will be a mix of all the places.
Okay. So it won't be, but all of this will be organic, or is there some inorganic? Because you're missing in action for the last many years.
No, there will not be any inorganic growth. Our volumes and plans are well set, and we will be talking only the organic growth.
Okay. One question that the street has is, what about Mr. Bangur, the analyst? Because you have been missing in action in terms of inorganic growth. But I recall a couple of smaller companies like Orient Cement, when it was available at much less than replacement cost, you went in there and personally you bought a 1% stake. And the street got very, very excited. But ultimately, it was just a pure investment. If I tell you today, Mr. Bangur, which is that company that you're looking at from a personal investment perspective, what would your approach be for the cement companies?
Cement companies, I have enough exposure in cement for myself.
Right.
I will not like to invest in any cement company. That was a very cheap and we thought it worth. But now I am not seeing this type of opportunity. And for 10% or normal growth, I will not like to go to cement.
Okay, so you don't believe there is any stock that you would like to invest from the cement space like you have done in the past.
Right.
The other question is, normally people say when you have cash in the books, it's very good. But for your company, sir, it's been a little bit of a negative from a shareholder perspective. I'll tell you why. Because you're sitting on close to around $1 billion odd. But the FD rate as well would have been better than, some of this. Some question about capital allocation, basically. That's the point that I'm getting at. Why to have so much cash in the books if you're not going to go ahead and buy an asset, and keeping this money in bonds or FDs or other safe investments? Street wants you to use this money. Some of the return ratios as well are getting diluted.
Perfectly right. We also realize it. This year, our dividend distribution is much higher. From next year onwards, we find that having some cash is okay. But not much more cash. So cash will be maintained. With the increase in volume, cash percentage will only come down.
Will you do a buyback?
No, buyback is not the thing. The higher dividend payment is because our capital is as it is very small.
Right.
So no buyback.
Okay, so you're giving us some clarity on that. The other big happening on the political arena in the last few months has been a change of regime in West Bengal. That's been a state that's actually not grown as much as India as well in terms of a GDP growth. Do you see this as a bit of a booster shot for West Bengal? Or, do you also see that for the industry, cement industry, it could be some kind of a push?
For West Bengal, everybody's mood is very positive. A lot of things have been done. Industries, the Chief Minister actively wants industrialists to stay there, outside industries to come and invest. Only thing is, we also want to invest in Bengal. When I said in East, we have a ready grinding unit. We are all waiting for the new industrial policy in Bengal. Once the industrial policy comes, we are clear about what can be expected. Okay. Right now, it is only the expectations. So it has to become on ground.
So hopefully gets into reality. Final question, sir. In the past, we have heard about you giving those CAT exams, which had kept the mind very, very sharp. Of late, I hear you're not giving those exams. How is the mind being kept sharp then?
CAT examination is a thing of past. Right now, my grandson is in class 12. And the course has changed much more than what it was about 50 years, 40 years back. To study with him is a big pleasure, big pastime, challenging the new physics courses, the computer courses, chemistry courses. And what I find that what I could not learn in my IIT also, that type of questions he is solving. So sitting with him and doing and challenging him is the big pastime.
A bit of a change from the CAT exam to helping the grandchild with his 12th standard, a PCM, so to call it.
Helping is one word which is good to hear, but it is basically learning from him.
Well, always a pleasure having you on the show, Mr. Bangur. Thanks a lot for giving your insights into the cement demand, the country's growth on the whole, and also how are you keeping the mind sharp. Well, interesting conversation as always. Well, we'll wrap up on this interview, but you stay with us. The team of Closing Bell will join you on the other side. Don't go anywhere.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
All of those Asian indices, look at the Taiwanese index, that's down 5% as we speak. The Iran's Revolutionary Guards called the attack against Israel a warning.
After a long time, we saw a pretty sharp cut. The Nasdaq was down 4%. It wiped out 2 weeks worth of gains.
They've conceded the fact that they will not have nuclear weapons.
Nobody guessed that this number could be as good as this. And some of the services numbers that really stand out.
A lone gainer, that is Tech Mahindra, everything else is down. Wipro, Hindalco, Bajaj Finance, Shriram Finance, Automotive Passenger Vehicle, Asian Paints and Eternal, etc., etc.
Because what will happen mathematically, certain companies will benefit from the inflation. The upstream E&P companies will do well. On the back of this, some of the refining stocks should do well as well.
You can't get $50 billion if all you're saying to the NRI is that, okay, I will give you 6.25% instead of 4% that you'll get for this term from just your regular offshore bank wherever you are.
You have to break vicious cycle. There's a cost for the vicious cycle which is very small, which Reserve Bank can afford to break. So that's where it is. So once the vicious cycle is broken, will FPI money definitely look more positively in debt? Yes.
Iran launching multiple rounds of missiles towards Israel. And there have been statements from US President suggesting that Israel should be avoiding retaliatory action against Iran. But that's exactly what Israel has done.
From a 300-point gap down, we are now around about 150 points lower. So the index trying to hold on to some important levels.
Today, about 0.7% lower. So you can see that a large part of the Friday gains have been sold into.
There is no significant directional move that the index has seen just yet. We are, of course, heading into the business end of the trading session in the last 2 hours.
Okay, well, that is a day so far, and markets are treading water. 200 points lower, 23,150. Which basically, by the way, means that we are somewhere near, as of now, near last week's lowest point. So last week's low was 23,151, which, by the way, is also an important gap area. So we broke the 21,150 level, 23,150 level in the morning, but there has been a bit of a rebound intraday, and we are exactly at those support levels. As we speak. So that gap that I'm talking about is the high on the 7th of April. The high was 23,153, and between the 7th and the 8th of April, the market jumped quite massively. We filled that gap, but we've not broken 23,150 in a meaningful way. So, we live in hope, and hopefully things will look a little better. Oil prices will come up on your screen, and they're not looking all that good. So oil, I think, is moved up quite a bit from the time that we started in the morning. We are up a full, not a full, but almost a full 5%. So 98 on Brent crude oil prices as Israel and Iran seem to be exchanging fire. And this is something which we walked into this morning, and that is continued over the last few hours as well. So those are the variables. They're not very different compared to the last many trading sessions. Well, we've been getting you coverage out of the ICICI Investor Conference 2026, and Nigel is joining me from location. Nigel, good afternoon.
Well, good afternoon, Prashant. You were here earlier. I've come in as the afternoon substitute, I think so. So we're managing between studio as well as the conference. But interesting day of trade. We saw a bit of a fight back. That's got sold into, though. If you compare what India has done today in comparison to what the other Asian markets, you'll say, well, not too bad. Let's get in Mitesh Thakur, who joins us on the show. Mitesh, what do you make of today's trading action? The bulls would like to believe we're off the day's low. However, we're still holding at around the 23,150 odd mark. The selling is definitely re-emerging on a bit of a bounce, and you have been fairly cautious. Would you be gutsy enough to go in now, or do you believe this market wants to correct even more?
I think,
Good afternoon. One, I think, I did say that 23,150 is a minor support because the gap was there, but the gap, got filled on the 3rd of June. And today we kind of retested it, went below it as well. So now that gap level is not good anymore. There's this 23,000 which has got some option option level support because put writing has happened over there. And then 22,700. So I'm still not sure that we're done with the declining part. Also, a lot of stocks are still breaking down. So I have, in fact, 2 sell calls right now. Wipro is one stock which is broken down below its earlier swing lows of 190 to about 187. There were multiple lows being made in that area, and Wipro has broken that. So sell here with a stop at about 188, 188.5. Look for a target of around 175 to begin with. And also a sell on Motilal Oswal Financial Services Limited. That's also giving a break below its 10, 20, 30-day averages. So maybe it could decline a bit more. Sell with a stop at 850 or just above it, and a target of 790 at the moment.
Sorry, Mitesh, just a quick word on the Nifty, where I was mentioning this 23,150 kind of zone. What's the call? We break it and we head it down. What's the call?
See, Prashant, one, I think, it's still a pivot. The gap has got filled, but it's not an important pivot as it was earlier. So right now we're just hanging out there. I'm still not sure. I'm waiting for it. But if I was to comment, I think there's a slightly higher probability of us either going towards 23,000 or maybe in the worst case scenario 22,700, then bouncing back. In case there's a bounce back, I think we'll get some kind of signal on the hourly charts, which is yet elusive. And therefore, I think, for the timing, we'll assume that whatever trend was in force will remain in force. So I think for the timing, mild negative bias on the markets with chances of breaking down slightly higher than chances of a reverse.
Absolutely. Thank you very much, Mitesh, for that. We'll speak again in a bit on specific stocks, etc. Well, the rupee is making a bit of a move, and we'll get to rupee in a bit. But let's talk about the underlying issue first, which is oil, right? And oil prices, as I told you, are up 5%. So there is kinetic action once again between Iran and Israel. Trump, of course, wants to negotiate some sort of peace, but it looks hard to come by. No doubt. I mean, I think US wants the war to end, but as I think it's becoming increasingly clear, they've perhaps underestimated Iran's resolve and, of course, tolerance for pain as well. This is the report that our colleague Dan Murphy sent us earlier with regards to the latest between Iran and Israel.
First, this new escalation certainly putting that fragile April ceasefire to the ultimate test now. Israel and Iran have struck each other directly for the first time since that truce took hold, leaving the regional peace agreement basically hanging by a thread. Of course, markets reacting to the uncertainty. We're seeing oil prices spiking here at one stage over 5%, with Brent crude surging over 95 USD as investors brace for potential disruption. Of course, the Israeli Air Force has hit military targets deep inside central and western Iran, specifically targeting air defense systems and weapon sites, they say. We're also following reports that say explosions were heard across multiple Iranian cities. And this was direct payback in a way. On Sunday, we saw Iran firing at least 10 ballistic missiles into northern Israel in response to a deadly Israeli airstrike inside Beirut, targeting Hezbollah locations. Israel saying it was able to intercept all of those incoming targets and there were no injuries on the ground. Crucially, though, neither side has officially declared the ceasefire dead, but as I mentioned, the truce has kind of never been more vulnerable at this point. The real battle, though, seems to be unfolding behind closed doors between Washington and Tel Aviv. And Steve alluded to this earlier, but Axios reports that President Trump personally ordered Prime Minister Benjamin Netanyahu to stand down and to give diplomacy more time. One US official says Trump told Netanyahu, "We are close to doing something good in terms of a deal with Tehran." Israel went ahead and struck anyway, and the president's frustration is seemingly spilling into the open as well. President Trump also speaking with the Financial Times in the last 24 hours, saying, "I call all the shots. He doesn't call the shots." President Trump also insisting that Israel's prime minister won't have any choice but to accept whatever final agreement Washington secures. So behind the scenes as well, US officials speaking to Axios are seemingly trying to contain the damage, not just the fallout in what appears to be a growing fracture between the United States and Israel, but also intentionally describing these Israeli strikes as relatively limited in scope, perhaps hoping to prevent a formal declaration that the truce is over and to maybe even buy the president more of a narrow window to try and salvage these negotiations. Iran had previously threatened to target US military bases if Israel retaliated, and its top negotiator also warned that American assets in the Gulf will once again become legitimate targets. It's a threat really underscored by that weekend clash between US and Iranian naval forces near the heavily blockaded Strait of Hormuz. So the Gulf certainly on a higher alert this morning, how Iran could potentially retaliate, whether or not US bases or even civilian and energy infrastructure could once again be in the crosshairs remains to be seen at this point. But just to underscore it, the truce looks incredibly fragile right now, and asset markets are reacting as a result.
Okay, well, oil's up sharply as we are highlighting, and that's a report from Dan in terms of what's been happening. Well, I think it's having an impact on the rupee as well, and the rupee is now sharply lower as compared to the dollar. It appreciated about 0.9% on Friday. RBI has, of course, announced a slew of measures, lots of numbers floating around in terms of how many dollars it can attract over the next 3 to 6 months. Lata is here with the latest from the forex markets. Lata, take it away.
Yes, the rupee is down about 0.7% compared to the 0.9% that it rose on Friday after the set of announcements from the Reserve Bank laying out the red carpet to capital flows. The sell-off today in the rupee, or rather the dollar purchase, is kind of risk-off globally. The dollar itself, dollar index has risen. More importantly, of course, for us, crude prices are up about 5 to 6% compared to what it was on Friday. Both those hurting us badly. Together, there's also a risk-off globally on equities, and that's also enveloping us. FPIs sold nearly 8,766 crores, I think, worth of stock on Friday. That kind of gets delivered now, and they're buying the dollars to remit it back, and that also is casting some bit of pressure. At least the early morning pressure came from there. But if it's any consolation, India is one of the better performing currencies. IDR, the Indonesian rupiah, has fallen more than us. Ringgit has fallen a lot, more than the Indian rupee. And Bharat is also very weak today. And the important point to note is those currencies didn't run up on Friday. So for them, it is continuous losses. To that extent, over a 2-day period, we may look like relative outperformers. The market is also having its eyes cocked on the FCNR deposit scheme that Reserve Bank announced. The expectation is about 50 to 60 billion will roll in. But all that depends on the details of the plan. These numbers, about 50 to 60 billion or even more, there are people going up to even 75 and 80, including the ECBs, the external commercial borrowings that PSU companies are allowed to borrow. The point is it will depend on the detail. The devil is in the detail. What CNBC TV 18 learns is that those circulars will come later today, by end of day today. Normally, Reserve Bank announces the policy and by evening the circulars are out. The fact that a weekend went without the circulars coming in has created a bit of a flutter on what the details will be. But now that we learn it will mostly come by end of day today. Perhaps that will kind of encourage rupee bulls tomorrow if the circular and its details are out and they are as per market expectation.
All right. Well, Lata, thanks very much. And we'll keep an eye out on that one as it comes out and come back to you for more. A slew of opinion, right, that we've been getting you on this measure in terms of the quantum of money that we could expect coming in. Here's a slice of what various experts have told us over the last many hours today.
When you see economy size, bank size, you can easily get 40, 50 billion. Now, it depends exactly. But it won't be outside, it won't be less than this range. I am thinking, because I spoke to 2-3 private bankers here, and they said you could get 75 billion also. But the only thing is that I believe now, after talking to these two guys, that India may have to stop it after 1 or 2 months, because this time you can do it till September. Maybe they have in mind, RBI has in mind how many billion they want. And they should create that impression so that these banks run around faster.
See, in debt, there are two factors. One is currency, second is taxation. Both have gone very positive. And so that's why I think the chances in debt are very, very high that Bloomberg can consider much more positively. And that's why I think on the debt side, clearly, I would say that the mood is very, very optimistic.
I think going forward, the interest rate on FCNR will likely to increase, and we are going to mop up good volume under that. We are expecting that country as a whole, I think it should be in the range around 35 to 40 billion USD.
Many of the irritants which were there for foreigners has now gone away, which means it's a matter of time, hopefully, before we get inclusion into the Bloomberg Aggregate Index. That alone should bring in passive flows of $25–30 billion to start with.
Well, let's welcome Deepan Mehta onto the show. Then, Deepan, you heard what PNB in particular had to say. They quantified that for them it could be close to around $2.5 billion in terms of an opportunity of raising some capital. What's your take? There is the double whammy that's come in the positive side, both for, a double trigger, so to call it. On the ECB front, there's an option out there on the FCNR deposits as well. And the RBI is willing to take some part of that hit with regard to the hedging cost, which gives them an additional funding option. What's your observation and which stocks would you play on this?
Good afternoon and thank you for having me on your show. A bit difficult to call, because I'm not an expert on the debt market. And if you go by the fact that $40–50 billion will come to the banking system, then certainly it will alleviate the liquidity pressure and provide more capital, more resources for these banks to lend. But then why is the bank Nifty down? So, I would just say that, in my opinion, any money coming into India like this is going to be viewed positively, and sentimentally, I think the sentiment for the rupee and the stock market should go up. But look, today's developments about what's happening in the Iran war are certainly negative, and I think we've taken like one step back. So this is like 2 steps forward, 1 step back, as I look at it. And let's hope that this kind of stops at this point of time, because clearly I think investors, at least the bulls, their conviction and their patience seems to be running out.
Absolutely. Deepan, we just want some, self-help is good and we'll do what we can. Like RBI has done some self-help, but we need outside help as well, right? We need a confluence of factors, oil cooling off and all this madness with fighting coming to an end, but no end in sight, Deepan.
Yeah, that's right, but only all I can say, Prashant, is the ray of hope or one silver lining is the mid-cap index. The NSE 100 mid-cap index is round about at its all-time high, or just touches all-time high.
Absolutely.
And that's, I think, investors' portfolios are doing well. The mid-cap mutual funds are doing well. And I think retail investors' interest and faith in the market remains strong. So that's just a silver lining over here. And I can only hope that, this particular problem in the Iran and Middle East gets solved. Then we have, I think, a clear runway for improved fundamentals.
Yeah, that is true. Broader markets have been running up, and Nimesh put out that piece on Editors Roundtable on Friday on what's happening. So many big winners actually since the 1st of April. So there is no dearth of those. And when you look at that list, you say, well, oh boy, there's a full bull market on, right? And here you are complaining and lamenting about. So it's a very bipolar market, right? I mean, both the complaining is right, but the winners are also right.
See, I think, Prashant, I spoke to a few people and they are just targeting stocks where there is no FI investment. Okay. So that's the big issue, because there is no end point as to when the FIs will sell. So all the Nifty stocks, the HDFCs, the Reliances, the ICICI banks, TCS, all of them are going out of the portfolio or not being considered for fresh investment, and money is being deployed into high growth mid-cap stocks where even the FIs want to look at increasing their holding because that's where the returns are coming. So it's a very piquant situation that because of the wave of FI selling continuing, I think there's a lot of money being diverted to small mid-cap stocks.
Got it. All right, Deepan, there was some news flow that's coming in there which could be a bit of a positive for HAL. I think it should come up for you on the screen. It's with regard to the LCA, aircrafts. Your view on this particular counter, HAL, it's reacting positively currently. It's come up drastically from the recent top. But how would you approach the stock? There is some positive news flow that's flashing on the screen.
I think first a disclosure that we have an investment in HAL and very positive on that company. It is.
Yeah, Dipan, I'll just read out the news flow that the Defense Ministry sources are saying they should have around 18 to 24 LCA Mark 1A aircraft ready by the end of this year. So that's the positive news flow. That's why the stock that was in the red, it was down, I think, 1%. Now it's up close to 100%. Please go ahead. You made that disclosure.
I think it's very positive because so far, if you see in the defense, the PSU defense, one of the kind of disappointment that investors have is on the execution front. I mean, it's all right to have great order book position, but when you look at the quarterly number, the year-on-year numbers, they tend to disappoint a bit, and there's a lot of lumpiness in their earnings, which is something which kind of impacts investor sentiment. But this is great news and would mean that billing would take place in this financial year itself, and you could see a nice bump up in the profitability top line, bottom line for HL. In any case, I think over the last 2-3 years or so, valuations now also have normalized and more or less in line with what the earnings growth is expected. And look, there's fantastic visibility when it comes to earnings because of the large scale order book position, which they are actually sitting on, and the kind of potential new orders which can come through. And these companies haven't even scratched the export market.
Yeah. I'm just looking at a few of these big winners from the last few days, right? Look at Rubicon Research. Went up like a rocket, 970 to about almost 1400 in 3-4 days. It's back at about 1174. So it's cooled off. Tejas Networks, right? A massive move from about, actually moved up middle of May, was about 450 and went up to about 630. Now at about 550 odd rupees or so. So there is actually a fair bit going on stocks like this. Z is holding on. Z has been another one of those moves, right? From 80 to about 120, almost 120 in about 4 sessions flat, 4-5 sessions flat. And it's come off a little bit, but still in the green, about 1/3% higher right now. Deepan, any thoughts on Z? I mean, there's a notice for fundraise, but I don't know if you cover it or if you looked at it.
Well, I think, Prashant has just dropped off the radar because consistently they've been kind of, promising and trying to say that we'll be out of the woods and growth will come back. But look at the numbers which came in the last quarter. And I think that while the deal with FIFA is positive, but again, it'll be lumpy, I mean, you'll have one good quarter at best when the ad revenues will go up. But the underlying problem, which remains intense competition and high cost of content, and overall, I think investors also moving away from mainstream media into a lot of other options which they have. So that also is affecting Z. So I'm not so sure that one should look at Z as a great long-term investment story. I think such spikes, such trading opportunities will keep on coming and going. But I wouldn't want to be invested for a long period of time, like 3 to 5 years in Z, and expect that it'll be a secular growth story.
Absolutely. Look at some of the losers, right? And this is the AI, the AI rub-off stocks here. NetWeb down 8% is the biggest loser. MTAR Tech is down about 5.5%. That tie up with Bloom Energy, which means they're exposed to, again, power for data centers in the US. Hitachi is down 4%. GE Vernova is down about 5%. You look at something like a Sterlite Tech, which is down about 5%. Keynes, if you want OSAT, but I'm not sure. Keynes is down, just down 2.75% or so. But these are, what the list I read out are the largest volume-led losers as far as the overall NSE goes. 190 points on the Nifty, 23,150 is where we are right now. It's down. And today, of course, broader markets are also lower. It's almost 3:1 now in terms of the number of stocks which are down to the number of stocks which are higher. So 3:1 declines to advance ratio on the overall NSE basis. Well, Deepan, thank you very much for joining us today. Good speaking with you as always. Here's some sound bites from ICICI Pru Mutual Fund's S. Narain on India's macro situation, leveraged position in the markets, the relentless FI selling, and of course, outlook and potential for outperformance. So the country's largest equity mutual fund manager, listen in.
Level of margin trading funding facility which has been taken from brokers, even those have started to go up. So, it requires, that's the worry, that continuously leverage of the HNIs and retail keeps going up. And that's a scope for worry. Mutual fund side, even if SIP flows come down slightly, I don't think it's a problem. But we are more worried about the leverage in the derivative markets than about mutual fund flows. Because I think the mutual fund investor is at least a long-term investor who's they are not leveraged. But the derivative investor who's leveraged, and why should the MTF facility amounts keep going up today? It's, I think, at the highest ever at this point of time. That is more worrying for us. Any stock where FII holdings have been very high, that stock has been punished. So if you look at the amount of selling which has happened in the mega caps, which the FIIs liked as on September 24, and see their FII holding as of today, that has been a big role. So our view is that if you have to look at something contrarian today, it would be all the stocks where FIIs have sold for the last 20 months relentlessly. And I think if you take a 3-year view there, that's why private banks come as one of the best sectors to invest for the next 3 years. Simply because in the last 20 months, I think FIIs wake up every day in the morning and sell private banks. Because they used to have 40% of their portfolio in private banks. So for them, when they wanted to sell India, they had no choice but to sell private bank. One day they'll sell A bank, second day they'll sell B bank, third day they'll sell C bank. So we'll think that the problem is in A bank, but the problem was not in A bank. The problem was A, B, C, D bank were the 4 biggest stocks in their portfolio. In a framework-based of view, it looks like India will be an outperformer. The question is, what is the absolute return? That part we don't have clear answers because of war, because of El Nino, because of valuations can go down everywhere in the world. So I think outperformer over a long period of time from here looks more logical. With what absolute return, I do not know.
Welcome back. 200 points lower, 23,170 is where we find ourselves at 3:1 declines to advances ratio. Now, the Tata Group has had a forgettable start to 2026. The group's combined market cap has shed 3.6 lakh crore rupees since January 1. The stock and the stock doing most of the damage, of course, is TCS, the crown jewel of the group, which has lost nearly 4 lakh crore in value this year alone. Of course, it's not just TCS. I mean, it's a broad-based sell-off in IT, but TCS happens to be, as I said, the most valuable company within the group. It's, of course, also trading at its lowest level since August of 2020. That's what a 30% fall in 6 months looks like. We break down the winners, the laggards, and what's driving the trouble at the top as far as TCS is concerned. Hormuz is standing by. Hormuz, take it away.
You know, so much has happened with the Tata Group over the last 12 to 18 months, but this year in particular has been a forgettable one for a lot of the group companies, to be frank, and more importantly, but the headline here is not about the group erosion itself, is the fact that TCS's market cap erosion in the first 6 months of 2026 is higher than the entire group put together. Now take a look at this. At the start of the year, Tata Group's overall market cap was at 27.7 lakh crore rupees. Today it stands at 24 lakh crore. For TCS, it started the year at 11.5 lakh crore rupees, the most valued IT company in the country. It remains the same today as well, but the market cap now is sub 8 lakh crore rupees. So that's an almost 4 lakh crore rupees wiped out in just the first 6 months. And there you can see that's where the difference comes up. 3.6 lakh crore wiped out for the Tata Group this year, but more than that is 3.8 lakh crore wiped out for TCS. Despite this, TCS still remains the biggest company within the Tata Group with a market cap at 7.8 lakh crore. But there has been changes as well. The sell-off in Trent has relegated it to the 4th spot, but the outperformance in Titan and the outperformance in Tata Steel have taken them to number 2 and number 3 respectively, and Tata Motors passenger vehicles, after this recent resurgence that the stock has seen, has made its way into the top 5. Now we mentioned TCS, so the fact that they lost nearly 4 lakh crore rupees in market cap, but there are other underperformers as well. If Tata Motors PV has done well, Tata Motors CV hasn't quite. It has lost almost 20,000 crore in market cap. Trent has lost over 4,000 crore. Tata Consumer has lost nearly 8,000 crore, and Tata Elxsi 2 has lost nearly 6,000 crore rupees in market cap this year. What has offset these losses? The offsetting has come from Titan and Tata Steel, as we mentioned earlier. Almost 30,000 crore added for Tata Steel, almost 14,000 crore added for Titan, for almost 9,000 crore for Tata Power and Tata Technologies too. A surprise package with a market cap of 26,000 crore rupees at the start of the year. The stock nearly tested its IPO price, but is now seeing some bit of rebound from lower levels and has added well over or nearly 5,500 crore rupees in market cap so far. But speaking of TCS, it's been a very forgettable start to the year, and not just for TCS, of course, but for the entire broader IT sector in general. But TCS currently is trading at the lowest level since June of 2020. The first 6 months of the year, including June, it has declined in 5 of them. And of course, the stock, the last time the stock was down more than 30% in a calendar year was all the way back in 2008 when the stock was down 55%. So the story, of course, is that yes, there has been a market cap erosion in the Tata Group, but it is TCS that has taken the limelight. Almost 4 lakh crore rupees wiped out in just the first 6 months of the year.
All right, thanks very much for that, Hormuz. Well, that is the Tata Group story, at least this year. Let's see if there is a turn here at some point. Vaibhav Sanghvi is with us, CEO, Ask Hedge Solutions. Vaibhav, good to have you with us here. Thanks for joining in. You know, there's a pullback afoot once again. It's the same drivers, oil, a bit of rupee, and just generally, unanswerable questions about where oil is going to go and how this is all going to pan out. So, a bit of a setback to broader markets, etc. as well, despite the broader otherwise outperformance. Just how are you looking at the situation, Vaibhav?
A tough one, as you rightly mentioned, Prashant. I think the amount of geopolitical events which are kind of affecting, especially on the supply chain, along with a few issues which we've been facing, as a country, I think partly kind of addressed by the measures taken, last weekend. So I think we have some time yet to go before we completely stabilize, from a market standpoint. Till then, I think the volatility will continue. Look out for any resolution on Middle East, and subsequently we can take a constructive call from a overall risk-on environment.
Vaibhav, what would you be inclined to do as of now? This war has prolonged for around 100 days odd. We have some optimism, some measures being taken both by the central government, the RBI as well. What would you be inclined to do right now? Buy or sell?
No, of course, Nigel, I think that's a silver lining for sure. But we'll continue to with our neutralish positions, what we have from an overall portfolio standpoint. And the reason being very clear that we don't know what's going to happen from the Middle East perspective, how the supply chains will continue to get disrupted, at least in the shorter to medium term. While as I continue to mention, the measures which have been taken over the weekend has been fairly constructive. And to be very honest, I think a lot more of those measures are needed also going forward. I think once those are taken, we, on a relative basis, would come out pretty strong.
Vaibhav, in terms of some of these, sharp movers that we have in our hands, I don't know if you have any specific calls. There's NetWeb, the power names, this is the strongest part of the market. Hitachi, GE, Vernova, I mean the grid and grid infrastructure companies, if I can put it that way. MTAR Tech, Sterlite is selling off, HFCL. I mean, this is the closest you can find, at least in the listed universe, to what is happening globally, which is that AI boom. And of course, the reversal that we've seen on Friday in the US and this morning in Asia as well. Any thoughts on any of these names?
No, I mean, not on a specific name, but I think I've been consistently mentioning for some time now that the overall data center opportunity, AI opportunity, in whatever way we can play, I think that in our view is looking exciting, not only on the immediate short-term perspective, but at least from a longer-term perspective is where we can say that. Now, what has happened over the weekend, or probably the kind of turbulence which we have seen, I think it is also to do with a lot of big money raise, which are likely to happen from a global standpoint. And time and again, people will keep casting doubts in terms of the valuations and the overall opportunity which is available. But one thing is pretty sure that we are on the way or path to further AI rather than less of AI going forward from here onward. So any play, ancillary, non-ancillary, core, whatever we may say, I think that is a space will continue to perform, going forward as well.
Vaibhav, what do you make of this broader market outperformance? Some are thumping the table and saying, wow, just look at that. There's been money that's been made. Do you think actually it's a little bit dangerous because the street is reading a little bit too much into it and ignoring some of the risk? Or do you believe some of these stocks actually rightfully, there are stories, there are themes that are playing out and earnings will gradually come? So it would be justified to see this kind of an outperformance because you have stocks that are moved up drastically in this sort of environment.
Yeah, two things again, Nigel, to that. One is a fundamental reason and two is the technical one. When we talk about the fundamental reason, I think what we have seen from a quarterly earnings standpoint, at the same time, the commentary which has been coming from the companies or from a broader perspective, I think has been, kind of very soothing, encouraging, and should the things on a macro kind of get stabilized, then these are the ones which will give you pretty decent momentum from a business perspective. Second, and more importantly from a technical side, is that I think these are lesser owned by FPIs. What we have seen is from an overall broader market standpoint, wherever the higher ownership of FPIs have been, irrespective of how the company has been doing, there have been relative underperformance from the overall market standpoint as well. So I think it's because of both of these two reasons is what we are seeing, what is happening. So pointing case, or probably I would say in conclusion, yes, they do have good opportunity on back of earnings increase, but I would suggest that once FPI is setting weights, then large caps are the one to look forward to.
Vaibhav, we'll leave it there. Thank you very much for joining us. Good speaking with you and appreciate your time here on CNBC TV 18. Thank you. Vaibhav Sanghvi, CEO, Ask Hedge Solutions. Well, I think, we'll just take a quick break here. Our segment D-Street Chatter will come up. Nimesh is going to get us that insight from dealing rooms. And of course, a list of stocks that he's got on his mind as well. I think Nimesh also joining us in a bit from the ICICI conference here in Mumbai. Stay tuned, coming up.
Welcome back. You're tuned in to Closing Bell. You're on CNBC TV 18. By the way, keep an eye out on the bottom of your screen. Mr. Trump has put out some information. Mr. Donald Trump says Israel and Iran must immediately stop shooting. So, he's trying to stitch a bit of a deal, and hopefully both of them listen. But we know overnight, at least Israel, as they said, they had a mind of their own, and Iran was doubting whether or not United States' intent was to actually strike a peace deal. So, for the time being, that's the big statement that's coming in there. Hopefully, de-escalation is on its way, because overnight the action was a little bit worrying. That said, Nimesh is with me today. We are at the conference. Nimesh, tell us, what are you picking up in terms of DC chatter?
Well, Nigel, of course, the markets are down largely on the back of global risk-off. That's something which was anticipated as well. But at least we are outperforming the Asian peers. The kind of fall we saw in the other Asian markets, that's not the case today. And a bit of selective buying as well. While the flows are mixed, I understand there's a bit of buying in the financial names, even in today's market, especially the large cap private banks, is where I believe there are some bit of bids from larger institutions. So that's the point. But technically now we are slipping below the crucial support of 23,300. If on a closing basis we close below that, maybe it will open up further selling pressure. So that's something to watch out for. And the fact that the retail investors are so long on the futures market, you might see further pressure in the broader market, especially the F&O names in the days to come. So that's something to watch out for. But broadly, I guess we are relatively outperforming in a very bad scenario in the global markets.
Well, that's right. We didn't perform that well on the upside, so not too bad. When all the other markets fall, we don't fall as much. What about individual stocks, Nimesh? What do you pick up?
A lot of action in the broader markets. While the screen may not look that, but a lot of individual names are buzzing in trade. So the first name is NRB Bearing. That's been buzzing in trade after a very large block. Nearly 5% equity got changed hands. I believe the promoter entity was a seller, and there were multiple buyers in the block deal. So disclosures will be quite interesting in NRB Bearing today. The second name is SBI. Within the PSU banks, this is one stock which is well bid today by larger institution. In fact, a leading long-only FI seems to have turned a new buyer in SBI at current levels after the recent performance. So that's the second name. The third name is Welspun Corp. This is also interesting. While the stock is down today, but almost at 52-week highs, has actually outperformed big time. Even here, I believe one of the domestic mutual fund has done active buyer, and also there is a buzz of a large order win as well for Welspun Corp very soon. And the last is Raymond Lifestyle. Again, the stock is down in markets today, largely in the line with the markets. But I believe there are buy flows from larger HNIs in Raymond Lifestyle. And also in Raymond Lifestyle, there is a buzz of a potential buyback coming very soon. So that's the trigger as far as Raymond Lifestyle is concerned.
All right, we'll have to keep an eye out on that one. Thanks, Nimesh, for that. Well, the markets, we're still down close to 230 points, but that comments that are coming up for you on the screen, that's important with regard to what Mr. Trump says. And I think by the time we wake up tomorrow and we are bracing for a market opening, I think we'll have far more comments as well that will be coming from the other parties. But Prashant, how do you read this?
Nigel, President Trump is built different, right? It's not even 6 o'clock in the morning in Washington, D.C. He's up tweeting. or whatever, truth socialing. It's not 6. And the man is away, typing away, right? So, but obviously, he likes to.
I think we have plenty of more action from him.
Yeah, we will hear more, most definitely. Because, in the morning he said, right, well, I hold all the cards and Netanyahu does not hold all the cards. But we obviously know it's not true. And Israel has done what it wants to do. He likes to talk, he likes to type, and he likes to be out there in the public eye. So this is one more comment. Beyond that, not very much, really, right? Let's just look at oil prices, if they've moved at all. I don't think they have. But I think they were up 5% when we started closing bell, and they're still there. Not very, I think they've come off a little bit, maybe a little bit. So 4 1/3% higher. They were up almost 4.9. So I think they cooled off a little bit. I'm not sure if this is right after the Truth Social post which came through. And that's a crazy bit. Markets react on both ways, right? I mean, when there's escalation, markets react. When there is attempts at de-escalation, markets react. But 100 days of this conflict now, and prices are remarkably steady now. I mean, around the $100 a barrel, but they're not. I mean, those doomsdays of 140, 150, at least not materializing yet. Well, let's just talk about oil prices, but from an India perspective. And this is, our petroleum minister, Hardeep Singh Puri, telling CNN News 18 that India has begun diversifying supply sources while maintaining the domestic fuel availability remains secure.
Three things are happening here. One, on the extreme, is the possibility that this might not remain it's very remote, nobody's talking about it, may remain a conflict not confined to that theater, that you could have problems elsewhere, maybe some other theater starts off. That would be worrying. The second is that Strait of Hormuz remains closed, but meanwhile our diversified supplies have also started. You are the third largest refiner in the world, if I'm not mistaken. You're the fourth largest exporter in the world. In the midst of all this crisis, you have no dry out taking place in any part of the country, and you're still exporting.
Okay, well, that's India's Petroleum Minister Hardeep Singh Puri. Well, let's talk about trades now, here and now. Mitesh, what's in your mind and how are you looking at the trade so far for the last 45 minutes?
So I think very clearly the recovery is not happening and we are slightly below 21,150. So as I said, I think till we get a sign of a reversal, we can assume that the trend continues on the negative side. So I have two STBT calls. Bajaj Holding is a STBT which is stopped at about 9,900 for targets of 9,800 to about 9,790. And Jio Finance, I think that's also showing a mild negative setup. So STBT there as well with a stop at about 230.5 for targets of 225.
Got it. Okay, all right, Mitesh, thanks for that. Well, let's get in our fundamental expert then. We have Amrish Palika who joins us on the show. Hi, Amrish, good afternoon. And good to see you. And as always, well, markets have got a little bit jittery. And at this point of time, you normally get stocks that you like at the price that you like. I believe you have your eyes set on auto ancillary CEAT. We had the management, by the way, a couple of days ago, and they were talking about that acquisition that they did, that's scaling up and getting a bigger chunk in terms of market share as well, higher exposure to the international markets as well. What do you like about it?
See, first of all, it's among the top 3 tire manufacturers in India, having 61,000 touch points and around 50 OEM relationships, diversified product mix, right from commercial vehicle tires to PVs and UVs, two-wheeler as well as three-wheeler, as well as off-highway. Like you rightly said, they recently completed an acquisition of Camso brand of off-highway construction equipment, bias tires and tracks business from Michelin. And this was acquired for about $225 million with manufacturing facilities in Sri Lanka. But this also gives them an addressable market of about $850 million. And right now, because of the commodity headwinds, because of the ongoing US-Iran war, and generally what happens is they pass on this, but they normally pass on with a lag of a quarter. So normally they take a hit for a quarter or so. So because of which the stock has corrected extremely well. And I think this is an opportunity as the replacement market is expected to really pick up. Because the last 4 to 6 quarters, we've not seen a major growth in replacement markets. But going ahead, I clearly see that because there's a cumulative of about 40 crore vehicles on Indian roads. And 2.5 crores are getting added every year. And typically your tires are changed at least about 3 to 4 years unless your mileage is too high. So I see that picking up. So expecting a revenue CAGR of about 13% over the next 3 years, EPS of about 240 for FY28. And with this, my target price is 4080.
If you're driving in Bombay, Amrish, I think it's more than that, right? Tire changes?
Yeah. looking at the condition of the roads.
Yeah, no, I hope it gets better. But boy, some of those really... it's quite something. So CEAT is your sort of call today. Amrish, what is this? How many stocks in your list now in terms of what you're advising? How many buys do you have now out there?
I have about 35 to 40 buys. But then I generally tell people that whatever I give as a buy does not mean that you just go ahead and buy that blindly. Because typically I don't suggest more than about 20, maximum 25 stocks in a portfolio. So one needs to see as to what fits into, like the way things are. I have a retail shelf space. You need to buy what you think is right for you.
Yeah, and every time you join us, mostly you do have a name on your mind, right? But as you said, it's not necessary everything goes up immediately, so there's lead lag. Sometimes markets correct, stocks correct. Where do you see absolute upside within this 30 stock universe? Out of stocks that you have recommendations on?
I see an absolute upside if you're talking of the next 12 months, because I don't give short-term calls.
Yeah.
Calls are typically 9 months to 12 months or maybe higher than that. So I see a decent upside happening in the specialty chemical side, where again, I've recently been bullish for the last 2 years or so, but they're not moved. But now looking at the sort of earnings which we've seen for Q4 and even the earlier one, Q3, I think over the next couple of quarters, we should see a decent upside.
And what's the name there that you like?
I like Deepak Nitrite. I like Aarti, although the earnings weren't too great last quarter. I like Archean Chemicals. So these are the ones which I had recommended in the past.
Got it. I think I'm being told that oil prices have come off a little bit. I was talking about how from being up almost 5% when we started, not quite 5, I think about 4.9 or so, the prices have come off a little bit. They have on your screen now. And we should actually highlight that at the bottom of the screen, oil prices dip. And I think this is the only trigger, of course, is the Trump Truth Social post, 96.78 on Brent prices right now. Well, let's just play out some opinion from Samir Arora of Helios. We had him on in the morning, and this is his view on everything which is happening market-wise.
The demand is very big. It's just that what should be the price for that? That you are when you are buying it now, you're believing that the price will keep going up because the volume is what it is, and that actually if the price of these memory chips and other chips fall a little bit, either because it's gone up too fast or because of some more efficient chips, or because against Nvidia now you have Amazon making Trainium and what is it called, something Inferentia, or TPUs from Google. So all that will reduce the prices a little bit and maybe make the AI investments more useful. Because right now, all these guys who are hyperscalers who are investing, some part of it is getting wasted in the sense that they are just paying a higher price for whatever was otherwise at X price, and they are paying 40% more. But the hyperscalers investments don't seem to be ending. So after seeing Korea's fall and Broadcom falling 8% on the day before and Korea falling 5%, I said enough of me. And I'm not going to buy it back, although I think they will not fall much more. But I've had enough of the semiconductor going up some 60-70% in 2 months. It's a bit too much. Top of mind till say a month ago. Now it's gone up a bit much after the results for these power equipment related stuff. We also have defense. We're talking about new marginal things. We are not really adding to the private banks. I was a bit frustrated seeing, have you heard of this company Revolut? It is basically an online doing 1/3 the things of a bank valued at $125 billion. I don't know why. In India, we could not have done. So we are buying broadly the same kind of things, which are the cash app, the quick commerce, defense. We are not buying new power equipment because it's gone up a lot. All we are doing is not buying old. And I think that is another thing, that you can't keep thinking that your life will totally change just because P of a company has gone down. The competition, people's expectations, in terms of service, in terms of things. So the new is good actually, but we don't have so much of the new. We have maybe 15-18% of new, but excitement is only in new things. Rest is okay, you are just defending.
Welcome back. Markets going home virtually at the low point of the day. But very quickly, let me put this question across to Amrish. Amrish, we had the management of Stovecraft earlier today, and they are talking about a resurgence in terms of demand, both for induction cookers as well as other appliances. All these stocks, Hawkins, TTK, Stovecraft have corrected big time. You're interested or no?
Yeah, I mean, clearly there would be a demand increasing for induction cooking. I mean, the way there is shortage of LPG as well as the way the prices of LPG is going up, there would be a shift, no doubt. And at the same time, the bigger issue is in tier 3, tier 4. I think that's where the demand will be coming from.
I think there's a minute to go for market closing. Amrish, you mentioned specialty chemicals. Any other pockets like that where there's a large gap between where you think things will be 12 months out and where we are now?
I mean, there's one more stock which I recommended a while back, Himadri Specialty Chemicals at I think levels of about 450 or so. And even in a market like this, I mean, the stock has given close to about a 50% return. Again, because they are looking at those futuristic sort of products which will go as a supply chain for the EV batteries, and that's I think what is working out well for them. And even looking at the Q4 earnings and the same trajectory continues, I think we should see levels of about 760, 780 for the stock quite soon.
Okay, well, thanks very much, Amrish, for that. We'll leave it there. Appreciate your time. 23,100. So, we've closed below the 23,150 odd level, which, by the way, is the high on the 7th of April. But, we had that gap area. It's been filled, and we've now closed, of course, under it, which perhaps opens up more downside. So, let's see. 265 points lower is where we've ended. If you want to look at Bank Nifty, of course, did a little better as compared to the Nifty, but not by much, 0.9 lower. Mid-cap and small-cap indices, the mid-cap index down more, 1.6. The small-cap index down about that much. Actually, the small-cap index down 2% plus. Autos, real estate, and metals are the three top losing sectoral indices where we saw pressure coming through. So 3% actually on the real estate index. So there is no respite at all for Nifty Realty. Metals, of course, has been the stronger part of the market. There were profits to be had, and profits were taken as far as the metals space is concerned. As far as large caps go, there was Wipro, Jio Finance, Eternal, Hindalco, Shriram Finance, which were the top Nifty losers coming through today. As far as the broader market is concerned, it's the bunch of names which we've mentioned again and again. It's the NetWeb, MTAR, Hitachi, GE Vernova, Tejas Networks, Sterlite Tech, which of course came in for a bout of selling pressure. 3:1 declines to advances is what you had going on. So pretty poor start to this fresh new week coming through. Well, it's of course all eyes to the US session. This entire large cap tech sell-off, perhaps. Let's hope there is some stability, and of course let's hope the missiles stop flying between Iran and Israel. The Trump Truth Social post coming in as well. We'll see if that has any impact in the next few hours or so. It's a wrap on this edition of Closing Bell. Thank you very much for staying with us. More coming up on the other side.
Markets see broad-based selling dragging benchmark indices to the lowest in nearly 2 months. The Sensex and Nifty both fall around 1% each, while the rupee erases most of Friday's gains to end above the mark of 95 to a dollar.
Indigo unveils an ambitious 2030 roadmap, targets 200 million passengers and 300 billion available seat kilometers as it positions itself as a global aviation player. The airline expects capacity growth to pick pace starting next fiscal and strengthen its premium offerings.
Infrastructure stocks see strong buying interest. EMS jumps nearly 15% after emerging as the lowest bidder for a 100 crore rupee Uttar Pradesh Jal Nigam project, while HG Infra received a provisional completion certificate for its near 5,000 crore rupee project in the state as well.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points together for the next trading day. I'm Sonal Bhutra. With me is my colleague Hormiz Fatakia. Hormiz, a fresh new day with fresh new updates coming on the West Asia crisis. The Nifty fell below the 23,100 mark in trade today, recovered from that around 50 points, but most of the day did see a big red on the screen. All the sectoral indices were in the red, barring Nifty CPSE. We did see some gains for pharma, for consumption as well, but that was sold into. The mid-caps also underperformed the benchmark indices, with that index down 1.4%. And realty was the top loser, followed by metals index. So no relief really. The mid-cap index did try to recover in the last couple of minutes. So did realty, but no real recovery that has come by, and the geopolitical tensions that continue to dominate the market sentiment.
You know, it's not been a promising start to the week for sure. And the fact that we were looking to hold on to last week's low of 23,151, that has not happened in today's session. 23,070 was the low of today. Of course, we managed to close above that, yes, but only by just. So we've just about managed to defend that 23,100 mark. A lot of developments not going in our favor. The rise in oil prices, some depreciation in the currency after last week's strength, and a lot of other technical factors as well. Once we broke below that 23,300 support, it was only going to go one way down, as the next important support comes in at 23,000. So that is the important level that we have managed to defend. But here's what we have in store for you on the show today. We start with the top movers and shakers with Sudarshan. We get you the key takeaways from Indigo's 2030 vision, along with the news-led stocks that were in action like EMS and HG Infra. And of course, we get you the big corporate voices for the day. And to our first segment then, Sudarshan is now joining in with, from the big wall with the top stocks that made headlines in today's session. Sudarshan.
The equity market remains weak, but in commodities, we have seen a big up move in the crude, and that's the reason this has weighed on all the crude derivative names. Indigo was one amongst top Nifty losers, closed with a cut of almost 3%. Similar move we have seen in OMC name, IOC, HPCL and BPCL. All the three names were down somewhere in the range of 2 to 3%, while ONGC, it closed in the red, but for major part of the session, it was trading in the green. If you talk about the Nifty, the biggest drags, IT remains weak. Wipro was down almost more than 8%. TCS again has fallen more than 2%. Reliance remains one of the biggest drags, closed in the red for 9th straight day. Today also has fallen more than 2%. L&T and ICICI Bank also were the major drags, closed with a cut of 1 to 2%. Now the fall in the gold and silver has weighed on certain stocks. Muthoot Finance was amongst top mid-cap losers, closed with a cut of almost 6%. Similar move was seen in Manappuram Finance, the peer name. Kalyan too has seen a big down move, closed with a cut of almost 5%, and Titan too closed with a cut of 2%. But some of the mid-cap names and some of the stocks have moved higher, even in a weak session. Fortis Health, Alchem Lab, InfoEdge, all these names have seen a up move in the range of 1 to 2%. Even BSE and MCX, after a big down move on Friday, today closed in the green, 1% higher each.
Okay, so there were some green shoots in the market, even though they were not big surges that we saw in some of these stocks. Thank you so much, Sudarshan, for joining us with that list. Let's get to the first stock that we are tracking. Indigo is aiming for a bigger global footprint by 2030, with plans for 3,000 daily departures, over 550 aircraft and 200 million passengers annually. Let's go across to Divyani, who is joining us with more details on what the company is planning going ahead.
Well, Indigo is positioning itself as a key global aviation player by 2030, and in its India 2030 vision, it has targeted 300 billion ASK capacity and 200 million passengers. Now, that said, the FY27 capacity is expected to grow in the single digits itself, with it accelerating to mid-teens by FY28 till FY30. Now, it aims for 3,000 daily departures with a fleet of over 550 aircrafts by 2030, with mid to long-haul international flights set to rise to 10 to 15% of the total capacity from the current 4%, while domestic share is set to decline to 85 to 90% of the capacity from the current 96%. Now, that said, the premium push is also what Indigo is aiming for. Now, the business class seats are set to expand to over 4,300 by FY27 end from the current 2,800 plus, with the stretch product rollout to reach 105 aircrafts from the current 53 only.
Devyani, thank you for that update there. And to take this discussion forward, we are now being joined by Amrish Baliga, who's an independent market expert, and Jay Thakkar from ICICI Securities. Gentlemen, good afternoon. Thank you for joining in. Well, Jay, until a better part of last week, we were talking of levels of 23,800, 24,000, and now we are down to even 23,000 being under threat. With the short-term structure being the way it is, what are the next levels that you are watching out on the Nifty now going forward?
A very good afternoon to you, Hormaz and Sonal. I would say that 23,000 on an immediate basis is the support for this week. In fact, tomorrow we have this weekly expiry for the Nifty, Hormaz, and the highest open interest on the put side is at 23,000 levels. Hence, that strike becomes a very, very critical support. And if it breaks then, 22,000. 800 to 750 would thereafter be the next target. I don't see Nifty falling below 22,750 in any which case because of a couple of reasons. One is that, the FI index shorts have been now again at the extremes of around, say, 2.75 lakh contracts. If at all those have got it added today, it might have even shot up to 2.8 lakh contracts. In the previous fall wherein Nifty had gone to those levels of 22,250. We had seen FII index shorts had gone to 2.9 lakh contracts, and from there we had seen a sharp recovery of almost 2,000 plus points. So we're already there, and interestingly, this time around, Hormaz, the VIX is still trading below the levels of 20. I mean, it's still at around 17 today. So that point of time, it was 28, 29, and this time around, it is 17, 18 right now. So that is one significant thing which I have seen in market. In fact, that point of time, the crude oil prices were also at around $110, $115. I'm talking about the Brent crude. And right now, we are saying it's still trading below 100 levels. So I think the probability of 22,750, 800 holding out in this current pullback is quite high. So now from here on, Hormaz, I think that the risk reward on the sell side would be lesser relatively. Hence, if market dips towards 23,000 or below, that should be a great buying opportunity from a trading perspective.
Okay, so that's on the market technicals. Let's get an Amrish Baliga as well. Amrish, we spoke about InterGlobe Aviation. Fundamentally, they have been trying to make things better, expansion plans in place, and barring the forex and the crude prices impact, we did see Q4 wasn't as bad for the company. But going forward, do you think crude prices will keep the growth under check for this particular name? And also the fact that they've been cutting flights to some destinations, and that would impact their general volume. So what do you make of that?
See, I mean, first of all, the way the crude prices have gone up, you can't have the fares going up in the similar sort of a percentage. I mean, that's the only way they can keep their margins intact. But then in case the fares are raised in the same manner, there is no way they'll get the traffic which they've been getting in the past. So, I mean, from that point of view, it's quite negative as of now. So unless the crude price is correct, I don't see, Indigo getting back to those margin levels which you have seen in the last 3 to 4 years.
Right, so that's Indigo for you, ending almost 3% lower in today's trading session. But some of the others that bucked the trend, in fact, in today's trade were both infrastructure names, EMS and HG Infra. Both of them did very well on the back of development projects in Uttar Pradesh. Vinny is now joining in with more details on that. Vinny.
Hi, thanks for that. Yes, so HG Infra as well as EMS Limited, both of the stocks were buzzing in focus today. So for HG Infra, what was the reason? The company announced that it had received a provisional completion certificate for the contract which they had of around 4,900 crores approximately for the Ganga Express project in Uttar Pradesh. This project was mainly EPC project. EPC is engineering, procurement, construction, as well as involved some associated as well as civil work. So this was a completion that they received for this project, and that is why the stock was buzzing in trade. Now, other than that, we're seeing EMS Limited, that was also in focus today. They were declared as an L1 bidder for a project which was in UP Jal Nigam Varanasi. It's a turnkey sewer network project. House connections are also involved in this project as well. And obviously, this is a contract value of around 103 crores. Execution period is 24 months. Do not forget, the order book for the company stood at around 1,800 crores at the end of March 2026. Now, in the con call also, they had given certain highlights and order book guidances as well, where they said that they've received an order of 209 crore already, and this was during the period after their Q4 numbers, right? So somewhere in May, they'd spoken about a 209 crore order from UP Jal Nigam. Then there was this order, today's order of around 103 crores. Plus, the company had highlighted that they were already in talks with some other tenders in UP as well, right? So seems like there could be some more tenders that we could see coming in on the UP front. Apart from that, 2,500 crores to 3,000 crore tenders is also as a pipeline that they have. So that is also very interesting in terms for FY27 outlook, and they've spoken about 1,500 crores in terms of order book or securing excess orders of that much in FY27, and that is why today we have finally seen the stocks see a run up as well. Last 1 year it was underperforming, was down 44% as well, and mainly the order win is the reason for the up move.
Okay, all right, Vinny, thank you so much for joining us with those details. Some of these stocks are bucking the trend in an otherwise weak market. Amrish, let me come to you. Anything that you like from these two names, EMS, a big surge, or anything from the infrastructure space in general?
No, in fact, EMS has been one of my picks for a while. Although, I mean, the last quarter earnings were not that great, because of which we had seen a correction in the stock. But the sort of order flows which are there for this, and the sort of focus which is there in water infra, I think should stand in good stead for EMS even going ahead. So, I mean, in fact, I see, at least a target price which is about close to about 35% higher than where we are right now.
There is EMS and HG Infra. Jay, on the charts, anything within the infrastructure space that you find interesting, not just EMS or HG Infra in particular, but anything that comes on your radar?
No, as of now, I would not be focusing on that particular space. Almost the reason being is that there is not much clarity out there. However, the sectors which I would say, apart from this, looks positive would be healthcare, and within that, Max Healthcare really looks good at these levels. So I would be ignoring the infra or the realty pack as of now, unless we see a clear reversal happening on the index. But then I would say that pharma is relatively looking better from the current levels.
Okay, pharma is looking relatively better. Max Healthcare was up 3% in trade today. But let's move on and get some more market opinion. Earlier today, we caught up with Helios Capital Samir Arora and Punjab National Bank's Managing Director to get their take on the RBI's latest measures to boost foreign inflows. Let's listen in.
When you see economy size, bank size, you can easily get 40-50 billion. Now, it depends exactly. But it won't be outside, it won't be less than this range. I am thinking, because I spoke to 2-3 private bankers here, and they said you could get 75 billion also. But the only thing is that I believe now, after talking to these two guys, that India may have to stop it after 1 or 2 months, because this time you can do it till September. Maybe they have in mind, RBI has in mind how many billion they want. And they should create that impression so that these banks run around faster. The only bet you are taking is that India does not impose capital controls 3 years later when you have to get your money back. That bet every NRI will take very easily. No, I don't expect anything on equities. I have been saying that it is wrong and you are losing many billions. But I don't think anybody is doing that. But it's okay for now. This is quite meaningful in itself. And this whole world works on delta. It does not work in absolute that way. So this news is quite positive, and this can keep us going. And then we see, unless there's another issue in life that happens later.
I think going forward, the interest rate on FCNR will likely to increase, and we are going to mop up good volume under that. We are expecting that country as a whole, I think it should be in the range around 35 to 40 billion USD. And for our bank, we are calculated and somewhere we are expecting that around 2.5 to 3 billion USD we are going to mobilize during this period. Right? It is somewhere around 3% difference is there now. Because right now we are offering the FCNR deposit between 3 to 5 years band is somewhere around 3 to 3.5%, whereas the deposit domestic rate is around 6.5 to 6.6%. So we need to wait for the RBI guidelines to come, RBI circular to come.
Those are some expert opinions coming in on the measures announced by the Reserve Bank of India and the government last week. Amrish, based on all of this, does financials still become an attractive theme considering the amount of inflows that are lined up potentially? And if not, especially considering the fact that there may be still second order effects felt due to the war and so on and so forth. So if so, within the financials, where would you place your bets? Private sector banks, PSUs, NBFCs?
In fact, I've been decently positive on the private sector banks for the last, 2 quarters, because we have seen a good move in the PSU space. From there, we have seen a correction. But the private sector banks had underperformed in the last 18 to 24 months. And if you look at the earnings, we are seeing that uptick as far as the private sector banks are concerned. And I do see credit growth happening, not in the next 2 quarters, but post that. And I think that should be positive for the private sector banks. So my pick out there would be HDFC, ICICI, as well as Axis.
Point, Ambrish and Jay, thank you so much for joining us today to talk about your individual stock insights, fundamentally and technically as well. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get to the top corporate voices on the other side. Welcome back. You're still tuned into Markets Forward. Let's get you some corporate voices of the day. Shriram says industry volume growth will now be supported by higher cement prices, with price hikes averaging around 3% over the past several years. The company has guided for volume growth this year to be better than last year and also expects to outperform the broader industry. The management of IRCTC told CNBC TV 18 that it is guiding for an EBITDA margin of 30% and remains confident of sustaining growth despite near-term challenges. The company plans to reduce catering from the current mix of 45% and focus on online travel agency, tourism and IT non-convenience businesses. Moving on, Hitachi Energy said that the data center opportunity is emerging as one of the most significant growth drivers for the power and infrastructure sector. Speaking to CNBC TV 18, the management said India is well positioned on the cost front, making it an attractive destination for data center investments. Well, Tata Group has had a forgettable start to 2026. The group's combined market cap has shed 3.6 lakh crore rupees since January. Hormuz is by the big wall to break down the winners, the laggards, and what's driving the bleed at the top. Hormuz.
A lot has transpired at the Tata Group over the last 12 to 18 months. But if you take a look at the story here is the fact that TCS has lost market cap that is higher than the entire erosion seen in the Tata Group in the first 6 months of the year. Now, look at this. At the start of the year, Tata Group's market cap was at around about 27.5 lakh crore rupees. That currently stands at 24 lakh crore. And for TCS, the largest IT services company in the country, it began the year with a market cap of 11.5 lakh crore. That number now stands at sub 8 lakh crore rupees, and that's where the difference emerges. The Tata Group has lost 3.6 lakh crore in market cap so far, and compare that to TCS, it has lost 3.8 lakh crore rupees. Now, despite this, TCS still remains the largest Tata Group company by market cap, but there has been some churn at the top as well. The sell-off in Trent has relegated it to the 4th spot, and Trent has been replaced by the outperformance seen in Tata Steel and in Titan, and Tata Motors passenger vehicles as well, after the recent resurgence that the stock has seen, has made it to the list of the top 5 names as well. Take a look at the top 5 stocks that have lost market cap this year, barring TCS. You look at Tata Motors PV, which has done well, but Tata Motors CV has not done very well, losing almost 20,000 crore in market cap. Tata Consumer has lost nearly 8,000 crore. Tata Elxsi has lost 6,000, and Trent too, as we mentioned, the stock which has already halved from its peak, has lost over 4,000 crore rupees in market cap this year. And lastly, of course, you look at the gainers as well. At the outperformance in Tata Steel and Titan, as we spoke about, Tata Steel has added nearly 30,000 crore in market cap, Titan nearly 14,000 crore. So the stocks that have done well include Tata Power and Tata Technologies as well, a stock that almost tested its IPO price and is now seeing buying interest emerge at lower levels. But to TCS in particular, the stock, of course, not just TCS, the entire IT sector has seen a very brutal sell-off at the start of the year. But for TCS, it is now at the lowest level since June of 2020. In fact, in the first 6 months of the year, the stock has declined in 5 of them, and it's down around 30% so far this year. The last time the stock fell over 30% in the calendar year was all the way back in 2008. So that's the story of the Tata Group so far. The group has lost market cap, yes, but the bigger story is that the entire group market cap erosion is lesser than what TCS has lost this year so far.
Okay, that's a big data point. Thank you so much for bringing all those details for us, Hormuz. With that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Good evening. Thanks for joining us on India Business Business 360. I'm Shriram. The top stories we're tracking for you this evening. President Trump urges Iran and Israel to immediately stop shooting. This after Israel struck Iranian military targets and a petrochemical plant overnight. Tehran accuses Washington of bearing direct responsibility for repeated ceasefire violations. Oil prices jumped nearly 4% amidst fears of a wider regional conflict. The Sensex and the Nifty hit their lowest levels in 2 months after a broad-based sell-off on Dalal Street. Metal stocks take a beating. IT stocks decline for the 4th straight session. The rupee weakens by more than 70 paise against the dollar, but bond yields soften as money markets expect RBI's recent measures to draw $35 to $50 billion in foreign funds this year. Tax relief for foreign investors can also help India's inclusion into the global bond indices. After Flipkart, PhonePe and Boat, Cure Foods delays its IPO plans amidst choppy markets. Sources say roadshows failed to get institutional backing for the company's desired valuation of 4,000 crores. The cloud kitchen platform will revisit plans for the 800 crore rupee public issue next year. Noel Tata-led Tata Trust Board meets in Mumbai. A review of the group's loss-making businesses on the agenda. The Tata Group has seen nearly 13% of its market value wiped out this year. Leading the decline is TCS, the conglomerate's crown jewel, which has lost close to 4 lakh crore rupees in market cap this year. The profits of airlines worldwide set to halve this year, warns the International Air Transport Association, but demand remains robust with a record 5 billion passengers taking to the skies this year. Rising fuel costs and geopolitical tensions dent bottom lines. The government is likely to tighten rules for bus registration soon. Sources say the changes are driven by passenger safety concerns, especially in sleeper coaches. Large automakers likely to benefit as smaller builders could face higher compliance and certification requirements. The Delhi High Court seeks a response from CBSE on the evaluation of Class 12 results, agrees to hear a petition filed by Congress Party Students' Union. CBSE says more than 1.6 lakh candidates have sought re-evaluation of 3.8 lakh answer sheets. The Trinamool Congress is staring at both TMC Supremo Mamata Banerjee and Bengal's Chief Minister Suvendu Adhikari are currently in Delhi. At least 19 people dead, many injured after a powerful earthquake struck Philippines. Tsunami warnings issued after the 7.8 magnitude quake flattened several buildings. The top story this evening, Israel and Iran have attacked each other for the first time since agreeing to a ceasefire, sparking fears of a full-blown war once again. Here are the latest developments. President Trump has called on both Israel and Iran to stop shooting immediately. The US president made the remark in a social media post after Israel and Iran were locked in retaliatory attacks. It all began after Israel attacked Lebanon's capital, Beirut, over the weekend. Israeli military said Iran launched a second wave of missiles across its territory. Both sides are targeting energy infrastructure. Tehran claims to have targeted a petrochemical facility in northern Israeli city of Haifa. According to Iranian state media, Israel has carried out 2 Israeli strikes on Iran's Karun petrochemical plant. However, no casualties have been reported so far. Tensions also beginning to spread across the Red Sea. Yemeni's militant group of Houthis has confirmed it fired missiles towards Israel's port city of Jaffa. The Houthis also declared an absolute ban on maritime navigation off Israel in the Red Sea and threatened to attack all Israel-linked ships. The Israeli attack on Iran came hours after President Trump said that he, not Netanyahu, calls the shots on the peace process. In an interview with the Financial Times, Trump also said Iran's strikes on Israel have not changed his desire to conclude negotiations between Tehran and Washington. Separately, in an interview to Fox News, the US president also said he was not happy about Israel's brazen attack on Beirut, but maintained that Iran's latest strike will not help negotiations. Amidst all of this, the US-Iran peace talks remain at a stalemate. Iran's foreign ministry spokesperson has said US bears direct responsibility for repeated ceasefire violations, adding that Israel's military actions cannot be separate from US policies. Shipping traffic in the Strait remains constrained. Brent crude prices surging nearly 4%. India has called for immediate de-escalation of tensions and expressed regret over renewed attacks in West Asia. Here's Iran's foreign ministry spokesperson on the latest attacks.
The United States bears clear responsibility as a party to the April 8th ceasefire understanding. Whatever happens in the region, whether the U.S. itself violates the ceasefire Iranian commercial vessels and incursions against the southern regions of the country, or whether such violations are carried out by the Zionist regime in Lebanon or through its coordination with the US in our region. The direct responsibility of the United States is unequivocal.
Well, a broad-based fall on Dalal Street has seen the markets close lower for the second straight session. The Nifty and the Sensex hitting 2-month lows, falling 1% each. The Nifty ending below the 23,150 mark, dragged lower by Reliance and ICICI Bank. Broader markets fall in line with the blue chips. Healthcare stocks bucking the trend. Prashant is here with the details. Prashant, markets down starting Monday on a weak footing.
Well, oil continues to be the big story, and oil prices moved up at 1.5% and to about 98 before cooling it a little bit as we ended the session by about 3:30 or so. The Nifty, though, saw little by way of recovery. It did see attempts at a recovery, but then, I think we ended pretty much near the lower end of the range today, intraday range, so pretty much close to the day's lowest level, which is not a great sign. A dollar rupee again reflected this. So the rupee gave back more than three quarters of the 0.9% gain against the dollar that we saw on Friday after the RBI's measures. Lots of opinion coming in about how much inflow India can get, dollar inflow India can get, and the numbers range from between $40 to $70 billion. We will see, and it'll be important to watch. The Nifty Bank was down, but down far less compared to the broader indices. Mid-cap and small-cap indices were down a lot more. You look at sectorally, where was the pressure? Real estate was one, metals were lower, and the auto index was down as well. Now, the large cuts in Wipro, Jio Finance, Eternal, Hindalco, and Shriram Finance, these are the biggest losers as far as the Nifty 50 stocks are concerned. And then you go wider, right? By the way, market breadth was 3:1 in favor of decline. So 3 down for every 1 stock higher. The AI pack, grid infrastructure, power, that pack, NetWeb, MTAR Tech, Hitachi, GE Vernova, Tejas Networks, Sterlite Tech, these are all stocks which actually pulled back on pretty heavy volumes.
All right, Prashant, many thanks. Meanwhile, President Trump, in a post on Truth Social just a while back, said, and I quote, both sides, Israel and Iran, are looking to do an immediate ceasefire. Final negotiations on peace are proceeding, subject to the ignorance or stupidity getting in the way. The blockade will remain in place and in full force and effect until a final deal is reached. Things should move quickly. So this is the latest coming in from President Trump. Let's head to the money markets now. The rupee erased most of its gains from Friday, ending the day at 95.70 against the dollar. An escalation in the West Asia war and higher oil prices weighing on sentiment today. The currency closing at 95.70. Now, the market is hopeful that the government's move to waive taxes on foreign investment and sovereign bonds could trigger $40 to $50 billion in fresh capital inflows. And that's not all. Bankers also believe the RBI's decision to ease rules for NRI deposits could attract an additional $40 billion into the country.
When you see economy size, bank size, you can easily get 40, 50 billion. Now, it depends exactly. But it won't be outside, it won't be less than this range. I am thinking, because I spoke to 2-3 private bankers here, and they said you could get 75 billion also. But the only thing is that I believe now, after talking to these two guys, that India may have to stop it after 1 or 2 months, because this time you can do it till September. Maybe they have in mind, RBI has in mind how many billion they want. And they should create that impression so that these banks run around faster.
See, in debt, there are 2 factors. One is currency, second is taxation. Both have gone very positive. And so that's why I think the chances in debt are very, very high that Bloomberg can consider much more positively. And that's why I think on the debt side, clearly, I would say that the mood is very, very optimistic.
I think going forward, the interest rate on FCNR will likely to increase, and we are going to mop up good volume under that. We are expecting that country as a whole, I think it should be in the range around 35 to 40 billion USD.
Many of the irritants which were there for foreigners has now gone away, which means it's a matter of time, hopefully, before we get inclusion into the Bloomberg aggregate index. That alone should bring in passive flows of $25-30 billion to start with.
Well, let's put all of that into perspective. The money market expects the RBI's recent measures could draw $35 to $50 billion in foreign funds this year. Ritu joins us now to decode the multi-pronged strategy to boost foreign inflows into India. Ritu.
Well, yes, the RBI and government's multi-pronged bazooka to attract foreign inflows into India can prove to be pretty substantial and help bring in up to $40 to $50 billion, according to various street estimates. Starting with SBI Research, which believes that the FCNRB deposits alone can attract more than the $34 billion that came in during the 2013 scheme. They also point out that foreign investors have barely used the fully accessible route or the FAR route, with utilization at just 6.8%, while more than 4 lakh crores of investment capacity remains available. Now, RBI has, of course, also expanded the pool of bonds that are available to foreign investors under the FAR route, and they've also removed the restrictions on short-term bond investments. Of course, that comes with the government taxation move as well, and Deutsche Bank believes that these can eventually help India gain inclusion in more global bond indices. They estimate that without the 5th of June measures, India could have faced a $43 billion balance of payment deficit. But with these moves from RBI and the government of India, we could attract an additional $40 to $50 billion of foreign capital, which will be enough to potentially bridge the expected balance of payment gap for FY27. Macquarie also arrives at a similar estimate of $40 to $50 billion of potential inflows. They say RBI decision to absorb the hedging cost can also allow banks to offer these FCNRB deposit rates closer to the domestic deposit rates, and that will make them far more attractive to overseas Indians. Jefferies also compares the move to the successful 2013 scheme, though it notes that the lower India-US yield differential can limit inflows this time around. The bottom line, analysts believe the combined RBI government package can attract tens of billions of dollars into India. It will support the rupee and it will lower the borrowing cost and strengthen India's case for inclusion in more global bond markets.
All right, Ritu, many thanks for joining us. The government has hiked domestic LPG cylinder prices by 29 rupees, marking the second increase in 3 months. The price of a 14.2 kg LPG cylinder in Delhi now rises to 942 rupees from 913 rupees with immediate effect. In a statement, the government has said Indian households still pay amongst the world's lowest cooking gas prices. Remember, the government had increased domestic LPG prices by 60 rupees in March when tensions in West Asia had choked global oil supply. And staying with that, Oil Minister Hardeep Puri says India has started looking at diverse sources of oil supply since the Strait of Hormuz is shut. Speaking to CNN News 18, he clarified that there is sufficient oil in the country. Also said that India is still exporting oil and continues to be the third largest refiner in the world.
Two, three things are happening here. One, on the extreme is the possibility that this might not remain it's very remote, nobody's talking about it, may remain a conflict not confined to that theater, that, you could have problems elsewhere, maybe some other theater starts off. That would be worrying. The second is that Strait of Hormuz remains closed, but meanwhile our diversified supplies have also started. You are the third largest refiner in the world, if I'm not mistaken. You're the fourth largest exporter in the world. In the midst of all this crisis, you have no dry out taking place in any part of the country, and you're still exporting.
Well, that is the oil minister on the current situation. Now, cloud kitchen operator Cure Foods has put its planned initial public offering on hold. This even after it secured regulatory approval from the market regulator. Sources say the company pushed its IPO plans due to tensions in West Asia and volatile market conditions. Aishwarya joins us now with more details. Aishwarya, Cure Foods has joined the long list of deferred IPOs this year. Take us through the other companies who have also faced a similar situation by delaying their IPOs.
CNBC TV 18 has learned that Ankit Nagori-led Cure Foods has hit pause on its public market debut and is now exploring a fresh pre-IPO funding round. The company had received SEBI approval in October 2025 for an 800 crore IPO. Sources say Cure Foods wants to assess how the situation in West Asia evolves before taking a call on listing timelines. Cure Foods now joins a growing list of startups choosing to wait rather than list into uncertainty. PhonePe was the first to publicly pause its IPO plans, citing geopolitical tensions and volatile markets. CEO Sameer Nigam said that the company remains committed to a listing in India Now, once conditions stabilize. The fintech had been targeting a valuation of $15 billion, but bankers reportedly pushed that down to $9 to $10 billion as global markets turned. For parent company Walmart, this is the second India IPO to be delayed. After PhonePe, Walmart had asked Flipkart to focus on hitting EBITDA break-even by end of FY27 instead of going for a listing right now, putting also a planned $2 to $2.5 billion pre-IPO round on hold. And as cnbc TV18 had earlier reported, wearable brand Boat also deferred its IPO for the second time despite receiving SEBI approval for a 2,000 crore issue. Now, the pattern is clear: volatile markets, geopolitical uncertainty, and a valuation gap that most founders would rather wait out than accept. Now, access to private capital means that they can. But the pipeline isn't dead. Oyo Parent, Prism, Zepto, and Shiprocket are all actively moving towards listing. Now, the startup IPO wave hasn't totally disappeared. It's just become a lot more selective about timing.
All right, Ishwara, many thanks for joining us. Noel Tata-led Tata Trust's board meets in Mumbai. A review of the group's loss-making businesses, including Area and its digital ventures, have been part of the agenda at the Tata Sons board meeting, likely to be discussed here as well. The Tata Group has seen nearly 13% of its market value wiped out this year. Leading the decline is TCS, the conglomerate's crown jewel, which has lost close to 4 lakh crore rupees in market cap. Hormuz joins us now with more. Hormuz, decode Tata's market cap erosion for us.
So much has happened with the Tata Group over the last 12 to 18 months, but this year in particular has been a forgettable one for a lot of the group companies, to be frank. And more importantly, but the headline here is not about the group erosion itself, is the fact that TCS's market cap erosion in the first 6 months of 2026 is higher than the entire group put together. Now take a look at this. At the start of the year, Tata Group's overall market cap was at 27.7 lakh crore rupees. Today it stands at 24 lakh crore. For TCS, it started the year at 11.5 lakh crore rupees, the most valued IT company in the country. It remains the same today as well, but the market cap now is sub 8 lakh crore rupees. So that's an almost 4 lakh crore rupees wiped out in just the first 6 months. And there you can see that's where the difference comes up. 3.6 lakh crore wiped out for the Tata Group this year, but more than that is 3.8 lakh crore wiped out for TCS. Despite this, TCS still remains the biggest company within the Tata Group with a market cap at 7.8 lakh crore. But there has been changes as well. The sell-off in Trent has relegated it to the 4th spot, but the outperformance in Titan and the outperformance in Tata Steel have taken them to number 2 and number 3 respectively. And Tata Motors passenger vehicles, after this recent resurgence that the stock has seen, has made its way into the top 5. Now, we mentioned TCS, so the fact that they lost nearly 4 lakh crore rupees in market cap, but there are other underperformers as well. If Tata Motors PV has done well, Tata Motors CV hasn't quite. It has lost almost 20,000 crore in market cap. Trent has lost over 4,000 crore. Tata Consumer has lost nearly 8,000 crore, and Tata Elxsi 2 has lost nearly 6,000 crore rupees in market cap this year. What has offset these losses? The offsetting has come from Titan and Tata Steel, as we mentioned earlier. Almost 30,000 crore added for Tata Steel, almost 14,000 crore added for Titan, for almost 9,000 crore for Tata Power and Tata Technologies too. A surprise package with a market cap of 26,000 crore rupees at the start of the year. The stock nearly tested its IPO price, but is now seeing some bit of rebound from lower levels and has added well over or nearly 5,500 crore rupees in market cap so far. But speaking of TCS, it's been a very forgettable start to the year, and not just for TCS, of course, but for the entire broader IT sector in general. But TCS currently is trading at the lowest level since June of 2020. The first 6 months of the year, including June, it has declined in 5 of them. And of course, the stock, the last time the stock was down more than 30% in a calendar year was all the way back in 2008 when the stock was down 55%. So the story, of course, is that yes, there has been a market cap erosion in the Tata Group, but it is TCS that has taken the limelight. Almost 4 lakh crore rupees wiped out in just the first 6 months of the year.
All right, Harus, many thanks for joining us. Up next, the profits of airlines worldwide are set to halve this year, warns the International Air Transport Association. That and more when we return. Prime Minister Modi has completed 12 years in office. In a post on social media, the Prime Minister highlighted many welfare measures undertaken by the government. This is the longest-serving Prime Minister after Pandit Nehru now. That is the milestone that's been marked by Prime Minister Modi. Ashmit Kumar joins us now with the details. Ashmit, many milestones clock us through the last 12 years.
Well, it's been an impressive list of achievements, especially as far as some of the announcements that were shared today by the top brass of the party. They were meeting with journalists, and some of the key issues that they've highlighted, some of the key achievements that they've highlighted. For one, they point out the Jan Dhan accounts. They point out that there are as many as over 58 crore accounts, that there was always this issue of leakages that take place between disbursements by the centre and the money that finally landed in the hands of the beneficiary. That has been avoided. Over 3 lakh crore rupees, they claim, have been transferred via these Jan Dhan accounts, again leading to great savings as far as the exchequer is concerned. UPI, another aspect which they point out, is a standout feature as far as their achievements are concerned. The data clarifies that as far as December 2016 is concerned, there were only 2 million transactions for about 708 crore rupees. In April of 2026, that's the latest data available, that numbers have gone up. Number of transactions over 22 billion. The amounts in transacted through these through UPI in a single month was over 29 lakh crore rupees. Same for GST rollout, which again we saw the rollout in 2016. Importantly, the government is quick to point out that the average run rate that they're looking at in terms of collections is over 2 lakh crore rupees every month. Those are from GST collections. Startups, again, is something that's close to the heart of the current leadership. They pointed out as a part of today's presentation as well, the number of startups have gone on and increased from somewhere in the neighborhood of 350 to 400. That was back in 2014. That has gone up all the way to over 2.35 lakh startups, which give as many as 24 to 25 lakh jobs. Forex reserves is again something that was highlighted by the government, saying that the forex reserves that we currently have is pegged at about 67 lakh crore rupees. That gives an import cover of about 11 months and protects the country from any imported inflation, helps target inflation as well. And that is something that's critical. Electronics manufacturing has been the poster child of the Make in India story. The numbers have been staggering with respect to electronics production. Used to be around 2 lakh crore rupees, now has gone up to over 12 lakh crore rupees. That's accounting for the exports as well that have been seen. And all of these, of course, are not even mentioning the leaders that we met today were careful to point out that it does not even take into account the expansion of the road network, the railway network, the Prime Minister Aviation Yojana, the insurance program, and all of this, they say, will help improve ease of living over the last 12 years that we've seen from the government.
Ashwat, many thanks for joining us. Now, 3 Air India narrow-bodied aircraft parked at the Delhi International Airport were damaged after ground support equipment crashed into them. The airport authority said that the step ladder belonging to Air India and Indigo broke loose after strong winds and heavy rain. The airport operator said all 3 aircraft were taken out of operation after the collision. And staying with aviation, budget carrier Indigo has unveiled its vision for 2030 with the aim to become a key global player. The airline targets annual capacity of 300 billion available seat kilometers and plans to serve 200 million passengers by the end of the decade. It's also targeting more than 3,000 daily departures and a fleet of over 550 aircraft in 4 years. And more aviation, the profits of airlines worldwide set to halve this year, warns the International Air Transport Association. But demand remains robust with a record 5 billion passengers taking to the skies this year. Rising fuel costs and geopolitical tensions have, however, dented bottom lines. Madiha reports from Rio de Janeiro, the venue of IATA's annual general meeting.
Airline CEOs from every continent, all in one place. This is the 82nd IATA annual general meeting in Rio de Janeiro in Brazil, a boardroom of aviation executives. And the news from here is not good. IATA says global airline profits are set to halve this year, from $45 billion in 2025 to just $23 billion in 2026. Airlines will fly more passengers than ever before, a record 5.1 billion, and still make less money. There are 2 reasons: the West Asia war, which grounded Gulf carriers, shut airspace, and forced airlines to reroute flights at enormous cost. And second is jet fuel, which is up 70% to $152 a barrel. Airlines will spend $350 billion on fuel alone this year. Willie Walsh, the head of IATA, who will also soon take over as Indigo CEO, said there are plenty of passengers, but the problem is that costs are rising faster than revenue.
So once again, we meet in challenging and unpredictable times. No sooner did we put COVID behind us than we faced aerospace supply chain failures, war in Ukraine, geopolitical tensions, and tectonic shifts in trade policies. And when war broke out in the Middle East in March, oil prices jumped and jet fuel prices skyrocketed.
Despite everything, the war, the fuel shock, the uncertainty, airlines are still buying aircraft. In fact, they are buying more urgently than before because newer aircraft burn less fuel, and right now that matters more than ever. The problem is supply. IATA says the global aircraft backlog now stands at 18,100 jets, more than half the world's entire active fleet.
We're very grateful to have this order backlog, but I'm very pleased to let you know that in May of this year, we have delivered 60% more aircraft than the previous year. And when we look at the deliveries year to date, till May of 2026, the number is that we are 8% higher in deliveries than the previous year.
Well, that is all the aviation action. It is a difficult year for aviation worldwide. But with that, it is time for us to wrap up this edition of Business 360. The news will continue right after this short break. Stay tuned. We're back in a minute.
Samir Arora is joining us now. He's, of course, needs no introduction with Helios. Samir, great to have you with us here on the program. Thank you very much for joining us. You know, I don't know if you can pull Samir's tweet up. He said, if I have correctly understood the FCNRB scheme, India will get maybe $40 to $50 billion by September through the scheme. Samir, is that a updated assessment, or
that was my instant reaction within maybe half an hour. It could be higher. Now it depends on if the RBI does not. You know, how did I get this random 50 billion? Is because more or less the features are similar to what AI was hoping for and saying on your channel, but because I had seen that same numbers in 13, sorry. I mean, not numbers, the same features. And therefore, if at that time we could get $30 billion or so, now the market is much bigger, the banks are much bigger, economy is much bigger, NRIs are much bigger. So you can easily get it. And the economics is very easy, that an investor who leverages, an NRI who leverages, can make around 15% per annum, and that is a decent number. The only thing is, the fine print, I don't know whether RBI says to banks, don't give leverage to the NRIs to do it, or it just sort of keeps mum. If you keep mum, yeah, you can get 50 billion, no issues. I think just simply because we have seen live 30 billion like 13 years ago, so why should it be any less now?
Yeah, I think 2013 we got about $26 billion.
26 billion. So I'll change. When you see economy size, bank size, you know, you can easily get 40, 50 billion. Now it depends exactly, but it won't be outside. It won't be less than this range. I am thinking, because I spoke to 2-3 private bankers here, and they said you could get 75 billion also. But the only thing is that I believe now, after talking to these two guys, that India may have to stop it after 1 or 2 months, because this time you can do it till September. Maybe they have in mind, RBI has in mind how many billion they want. And they should create that impression so that these banks run around faster.
You're saying that they may need to actually close it.
No, I'm not saying they need to.
Then
I'm not saying they need to.
But they may.
But
they may
assuming
want to.
that there is a budget in mind. Yeah, assuming there's a budget in mind. Because it is very attractive to get 15-16% in dollar. The only bet you are taking is that India does not impose capital controls 3 years later when you have to get your money back. That bet every NRI will take very easily.
Yeah, 100%. Just a couple of more questions. You said that unless they say something about maximum leverage they can take, if they say stay mum, then it is all good. Why did you? Is there a reason you brought that point up?
So what happens
is there something you're looking to? Yeah.
So what happens is normally you're going to get on your deposit around 6%, because right now the FCNR rates are some 3.5%. And that is because the bank which takes that money in dollars has to hedge, and maybe their cost is say 2.5-3%. So once that hedging cost is taken by RBI, basically the Indian bank can offer the same rate as what they offer for INR funds, which is say, let's say 6.5% or whatever it is. So you can try and be stingy there and give 6.25%. But you know, you can't get $50 billion if all you're saying to the NRI is that, okay, I will give you 6.25% instead of 4% that you'll get for this term from just your regular offshore bank wherever you are. So the way this works is that the offshore foreign bank or an Indian bank tying up with a foreign partner, foreign bank, will say that I will lend you money around 5%. That is the current rate at which an NRI, high net worth NRI, can borrow money from the bank. So you put a $1 million, and bank will give you $9 million, and you have a 10 million deposit, FCNR deposit. But if they say that you can't lever, then what happens? The NRI has to first put up $10 million. And then maybe 3 days later, you can get 9 million back, because then you're not taking a loan to put a deposit. You are taking a loan against your deposit, and that is a different thing. So it constrains the capacity of the NRIs to, take leverage and put in, and they should not bother. It's an offshore leverage. It has been done every time. Just keep mum. You can get as many billions as you want, maybe double of this also if you want.
Yeah. Samir, how much are you putting in?
I will put in if they let me lever, of course. I don't have to take out of India. I have global and all I can take out of. No, this is good. All for motherland, India.
No, got it. Now, on the fixed income side, a lot has happened, right? So this has happened. On the equity side, do you think, and you and I have spoken about this in the past, and you alluded to, you think for now this whatever firefighting had to happen, I'm calling it firefighting, is done,
been saying,
or
but not
this
expecting.
is a series of steps and something on equities as well?
No, I don't expect anything on equities. I have been saying that it is wrong and you are losing many billions. But I don't think anybody is doing that. But it's okay for now. This is quite meaningful in itself. And this whole world works on delta. It does not work in absolute that way. So this news is quite positive and this can keep us going. And then we see, unless there's another issue in life that happens later. But the thing with equity, if you remove equity taxation, the issue is not that this one is literally the next day you will get the money because there's a time bound and it's an easy thing to quantify. But if you reduce taxes on equity, it does not mean that tomorrow you'll get flows, but it means that over time you will get, according to me, 20-30% more flows than you would get otherwise. But you won't know what is the base because these things will all work in future. I can't even imagine anybody arguing against it from a numbers point of view because it is just simple. You are making 10%, now you're making 8. 8 is less than 10. And 8 makes you relatively unattractive on if you put all the other countries, then obviously you have to lose money, but nobody knows how much. But I can give you one example, although I don't expect it now. If you look at the world ETF, MSCI World ETFs, these ETFs are quite big. Their benchmark as India, and they don't put money in India. You can see it for any ETF, any world ETF which should have India in it, does not have because they don't know how to handle the taxes. Now, if somebody has an ETF which has 20% India, obviously they have to buy it. They can't avoid it if it's some Asian emerging market or some 5-country ETF. What's an India ETF? So you can see that there is leakage, but I'm not expecting, and right now it doesn't matter for me to be bullish. I was bullish even before this, and now I am happy that some very meaningful steps have been taken which can stem the currency weakness. And then, small correction in the rest of the world puts us back in sort of plus minus similar keel.
Samir, it's almost consensus now that this, memory North Asia trade needs to cool off for foreigners to look at India in a meaningful way. Do you believe that? And you invest, you've invested in markets around the world for a long time. Friday, NASDAQ sold off, the SOX index sold off 10%, but frenzied rise into it. This morning, Korea was down sharply. I think it's down only 4-5% now. How do you read it? It's like a normal, regular, healthy reset or a warning shot?
I think the small reset because the demand will not go away. The demand is very big. It's just that what should be the price for that? That, you are, when you are buying it now, you're believing that the price will keep going up because the volume is what it is. And that actually, if the price of these memory chips and other chips fall a little bit, either because it's gone up too fast or because of some more efficient chips or because against NVIDIA, now you have Amazon making Trainium and what is it called? Something Inferentia or TPUs from Google. So all that will reduce the prices a little bit and maybe make the AI investments more useful. Because right now, all these guys who are hyperscalers who are investing, some part of it is getting wasted in the sense that they are just paying a higher price for whatever was otherwise at X price and they are paying 40% more. But the hyperscalers investments don't seem to be ending. This weekend, I saw a presentation which you can see on Google, on YouTube, on Google, because when they're doing their equity raise, saying that in 2027, the capex by them will be nearly double, I think, if I remember saying, of what it is this year, which is 180 billion. But it'll be more than 180 billion next year. So you will still need all these memory chips and all. By the way, I have sold my semiconductor ETF on Friday, fortunately, before US opened, because all ETFs of offshore guys are London listed, mostly we buy. So after seeing Korea's fall and Broadcom falling 8% on the day before and Korea falling 5%, I said enough of me. And I'm not going to buy it back, although I think they will not fall much more. But I've had enough of this semiconductor going up some 60, 70% in 2 months. It's a bit too much.
A great conversation, Samir, as always. Really appreciate your time and thanks for being such a sport. Well, let me welcome in our two top people from ICICI Securities, the people who put this conference together. Prasanna Balchandar is head of investment banking and institutional equities, and Manoj Menon is head of research at ICICI Securities. Gentlemen, great to have both of you here. Thank you very much for joining us. So just a quick word, Prasanna, on the conference itself. What are the aim? What do you expect to come out of it? Lots of corporates, lots of investor interest. Although, generally speaking, investor interest in India has been a little low, but they're showing up here.
So, Prashant, first of all, thanks very much for coming over to our location and having us at the show. So, when we started the planning for the conference, Prashant, world was much safer. Yeah. The war was not on, and traveling was easier. Yeah. And we started this theme. And then, all the troubles which have, started for the last 2-3 months, and we've started kind of getting a little nervous on the attendance. But happy to say that the response has been phenomenal. It's a kind of, I think, a testament to the fact that India as a long-term, medium-term growth location and economy is very much there. And we are got a phenomenal amount of interest from corporates and investors seeking one-on-one meetings, more than group meetings, which actually means that they are actively pursuing some kind of investment opportunities rather than just monitoring their investment. So that's one part. The other part is the fact that more than 125, 130 companies are in this conference, and that is a kind of a full house for us. That's how much we invited, and we got full confirmation. More than 800 investors are attending from 300 funds, and a very strong DII community, of course, but very good representation from foreign investors as well. And interestingly, foreign investors have come in from multiple geographies, almost all the geographies. So that is also another thing. And most of the guys who are actually present here, on paper, do not have a positive view on the country, but are still here to explore new ideas, new themes, talk to companies, find out which companies are the ones which have moat and which will be
And I'm going to ask you guys about which are those areas where there is, maximum meeting requests, right? I think that'll give us a sense. But Prasanna, let's start with the macro-ish question, right? Which is the big one, RBI and what they've done. And hopefully that turns the mood around in a more durable way. Because markets have not done terribly or anything. It's just that the sentiment has been pretty poor because of, I guess, the rupee, and there's a fair bit of self-loathing, if I can put it like that. But so simple question. What are the quantum of dollars which all these measures put together, the FCNR, ECB, and all the other stuff, will help us get in the next 3 to 4 months?
So first of all, we're not an expert in this topic, but I think since we have continuous discussions with various people, whether it's bank treasuries or investors, we have a very informed view of what we think is going to happen. So I think what RBI did on Friday is a bazooka of sorts. Whatever we had suggested, whatever the market wanted, I think they have literally given everything. And if you look at the 3 or 4 measures that they have done, I think getting into removing taxation on government bonds is one, but probably the least effective at this point of time. It will turn out to be a very good one much later when things get better. But the other two, which is FCNRB and ECB, I think are, with the subsidy being taken over substantially by RBI, is very, very powerful. Just to give you kind of a number, if a bank is looking like borrowing at 5.5%, it's in dollars, but its domestic borrowing rate is close to 7.75 or 7.5. With RBI giving full subsidy on the hedging cost, your dollar borrowing cost for the bank also becomes your rupee borrowing cost. So that means that the bank can actually go much higher than 5.5 as well to announce deposit rates.
So on FCNR in 2013, about $26 billion came in, right?
Yeah, that's right.
What do you think? This just an estimate.
So I think I'm an optimist. So I do think that this time around RBI very well knows the cost of these measures, and they will be following up with banks and PSUs to figure out how they are pricing their deposits and borrowing. If the pricing is quite attractive for investors, I would say $50 to $60 billion can come over these 2-3 schemes.
Across the board, 50 to
$60 billion is possible from ECB borrowing as well as from the FCNR.
And that is pretty consequential, right? The current account deficit is projected to be about $75-80 billion, right? Yeah. So this is a chunky.
Yeah, so that's why I said it was a bazooka of sorts, because what is happening in the market is that, like you mentioned, that the market has not been going anywhere. I think the view on the currency was kind of driving the view on the equities. Normally it is the other way around. Equity move drives the currency market, but over the last 2-3 months it is the other way around. So I think clearly the BOP hole, the current account deficit, and the fact that we were not getting capital flows enough on a net basis meant that the view on the rupee was never positive over the last 2-3 months, and that was preventing foreigners from actually entering the market, and to that extent prevented the market from rallying.
Hopefully now with the RBI having acted, the actual underlying situation with regards to the war, etc. also, although this morning there is no sign of it. I mean, there are again missiles flying, oil's jumped to about $96, $97 So we'll just have to wait 100 days of this now.
Yeah, absolutely. Today, I think, is the 100 or 101st day. But I think from a short-term perspective, we will still, bow down to what's happening globally, oil prices and all that. But if you see over the last almost 2-3 weeks, between 23,000 to 24,000, a lot of bad news is getting absorbed. So that clearly means that more and more bad news getting absorbed. When things get resolved, hopefully we'll start. And with the RBI measures, meaning the rupee is not a headwind anymore. Hopefully, we'll see better days ahead.
Manoj, give us a sense of what is top of mind for you. We were just chatting before we hit air that there's a fair bit of difference between how US investors perceive India and, I mean, investors in other parts of the world. And just what's going to be top of mind for you here?
Yeah. So just, 3-4 things, because just last 4 months, I happened to market in all geographies, right? Starting with Asia, US, Europe, and also UK. Now, I found a distinct pattern over here, right? I mean, so the investors in Asia, in fact, we rolled out and, it was sold out in a day, right? So we've never seen that actually, right? All long onlys, etc. I think the investors in Asia was largely conveying a message that, look, quote unquote, I've made money in, Taiwan, Korea. I've not really looked at India. I'm an underweight. It's not sort of a stance, but I know that in the next few months, few quarters, I need to relook at India. So help me bring up to speed. Absolutely high levels of interest.
Let me be ready with a list.
Oh, absolutely. Absolutely, right. And within that, I found a very clear pattern. It was a fairly pro-cyclical sort of investment thought process, right? For example, like let's say, we talk about consumer staples, etc. There's hardly any interest, right? I mean, so don't even mention the names, right? Kind of that sort of stuff. It is extremely positive on the cyclical side of it, whether it is metals, power, defense, and all cyclical aspects, large banks, etc. Remember, this was before the war broke out, before the view that inflation is inching up, which essentially helped the bank system, etc. Right? So this was before that. As you move away from Asia, I generally found the interest to be, let's say, tad lower, right? And one of the yardsticks which I have when I walk into these meetings is, if someone like, let's say, spend 10-20 minutes on, let's say, general India or cricket or kind of, not necessarily you're not using your 1 hour, is essentially tells you that the level of interest is low.
Correct.
Right? I mean, yeah, so the only point which I'll highlight here is, again, is that the number of investors sitting in Singapore who are actually the decision makers, along with the other geographies, is a very clear indication about the optimism, the way I would put it.
What is the number one? I mean, the rupee has been stable. So it's what's head, what's tail. But rupee apparently has been driving sentiment. But earnings is the other thing, right? What are you projecting, actually, earnings growth? Because earnings growth in these other two markets, Taiwan, Korea, has been... I mean, it's tough to imagine that it didn't last. I mean, Samsung, $30 billion profit will go to $250 billion. And it's just crazy, right? But those are also, I mean, memory, for example, is a cyclical kind of, it's a commodity at the end of the day, but it's real shortage. But it can't last forever. So do we have to wait for those things to cool off for money to come here? What's your sense?
I think somewhat, I think that's a reality, right? I mean, so, look, there are two types of investors, right, in any market, particularly when you talk about, relative investors. Very few of them tend to be early in any cycle, right? Which means, most of the investors, by definition, end up chasing, right? So that same thing happened in this case as well, right? So which essentially would mean that, for let's say, things to cool off first, then you'll probably see some reallocation. I really don't think it's going to happen before that. But that said, that scenario is also not necessarily great because, a lot of the portfolios may have losses, which means there has to be a stabilization phase, right?
And we get most of our funds through the emerging market route, right?
That's
we don't get not very much India dedicated flow. It's largely EM funds.
No. Historically, we used to get a lot of India dedicated. It's just that the last few years, it's kind of, I would say, got evaporated for a variety of global reasons. I just want, Prashant, one perspective on the FI bit, right? Kind of versus consensus. I was looking at one statistic. There is this narrative that FIs are selling India, which has kind of affected the rupee, etc., etc. But if you actually look at a hard statistic, the number of stocks in which FIs own more than 1%, right? That's actually gone up from 900 to about 1300 in the last 6 years, right? Of course, the headline numbers would say that the FI holding in India is down from 20 to 15, but the fact of the matter is it is again broad-based. So it will be inappropriate to say that they're exiting India. Probably they're exiting positions which they own, but at the same time, you're adding a lot of, I would say,
that was actually an investor pointed out this report. I think you guys published a report.
Yeah, we published a report on it.
And I had a long chat around it, based off this report, how when we say India weight has gone down, but it's basically from large caps to the mid cap.
So the way to look at it is India is being seen as a bottom-up micro story right now, and anybody who's looking at a macro top-down approach is actually selling because they're looking at the overall macros, current account deficit going up, inflation going up, interest rates likely to go up, and so on and so forth. So we are possibly seeing a little bit of selling from some of these large cap ones and getting replaced with small cap and other stocks.
Prasanna, the other bit, of course, is the retail flows, right? FIs can keep selling, but if the retail bid is super strong, I mean, market just stays where it is. I mean, small drawdowns, do you think that'll continue?
So I think if you look at it over the last maybe 7-8 years, Prashant, 14 lakh crores to 82 lakh crores of AUM, 27 crores of folios, out of which 21 crores more or less are equity or equity based. And I think somewhere we also made it much easier and tax efficient for equities rather than fixed income. Maybe we earned a little bit on the other side, but whatever it is, that's what it is. So I think this is going to continue. And if you see last 2 years, there have been tremendous amount of drawdowns, and there have not been returns which have been made by incremental SIP investors, but still SIPs are continuing. And today SIP AUMs are as much as 20% of the overall equity AUM managed. So I think this is not a cyclical kind of a flow. It is a structural flow, and it is a realization that Indians are underinvested in equities. Early 2000s, if you remember, there was a lot of talk and discussion as to how will risk appetite be, formed off from the FPIs to domestic if domestic is not investing. It's exactly the mirror image of that which is happening right now. So I don't think this is going to, change very quickly. And also, if you look at the measures which are taken, which are likely to be positive, plus the fact that it does look like Trump is not, eager to go for a war this time around in trying to, catch hold of straws. So if things were to get better, I'm reasonably confident that, inflows will still, continue.
Let me put you on the spot, Prasanna. Tomorrow, if the war stops, Strait of Hormuz opens, how much will we go up by?
No, so I think there will be a short-term reaction positively. But I think
but do you feel there's this huge kind of, it's like, it's like a dam which is waiting to, not like that, right? It's not as if you're going to suddenly go to...
No, that's right. So what I mean to say is that I think things will stabilize and marginally go up, or maybe go up a little bit. But also be aware that there are a lot of investors on the FPI side who are possibly waiting to sell as well. And IPO pipelines are there. All of us have, issues which are still not hitting the market because the market is still not as good as what it could be. So these two supply will definitely come into, kind of assuage the rise.
As soon as markets start to look better, supply will hit.
Supply will hit. So I think that should be taken into account.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, US President Donald Trump has claimed that Israel and Iran are looking to do an immediate ceasefire. In a social media post, he said, and I quote, "Final negotiations on peace are proceeding, subject to ignorance or stupidity getting in the way. The blockade will remain in place and in full force and effect until a final deal is reached. Things should move quickly." End of quote. Now, Trump's post came just an hour after he urged both sides to immediately stop shooting. But here's what has transpired over the last 24 hours. Iran and Israel have exchanged strikes for the first time since the April ceasefire. Iran fired missiles at northern Israel late Sunday night after Israel said that it had struck Hezbollah targets in Beirut's southern suburbs. Tehran accused Washington of bearing direct responsibility for repeated ceasefire violations. Foreign Ministry spokesperson Ismail Baghai said that Israel's military actions cannot be separated from US policies. In the early hours of Monday, Israel attacked Iranian military sites and a petrochemical plant. Iranian state media reported that explosions were heard in Tehran, Isfahan and Tabriz. Now, amidst the escalation, Iran suspended flights to 3 major airports, including Tehran's international airport, until further notice. Now, while Iraq and Syria, meanwhile, have announced temporary airspace closures. Multiple explosions were also heard over Jerusalem this morning as the Israeli military claimed that Iran had launched a second wave of missiles across its territory. Now, media reports cited the Israeli army as saying that it is preparing for at least several days of fighting with Iran or a prolonged campaign. Well, now to take this discussion ahead, we are now joined by former diplomat Ashok Sajjanhar as well as senior journalist Wail Awad. Gentlemen, thank you for joining us on this show. Mr. Awad, let me come to you first. Again, we've gone past the 100-day mark of this conflict. It's been more than 100 days since this conflict began. I remember when this was beginning, Donald Trump saying that, look, it's only going to be a 4 to 6 week contest. It won't be anything longer. It'll be a short blitzkrieg is what he had promised his constituents back home in Washington. That's clearly not happened. Now the very same man, Donald Trump, says that, look, both sides want to sign up for peace. The question I want to begin by asking is that is the statement coming from the President of the United States. The question is, are the stakeholders on the ground listening?
Thank you for having me, and greeting to you and Ambassador Ashok. Actually speaking, it has been always been the case that the United States and Iran wanted to end this war, and both sides wanted to be the winner. So therefore, there have been the negotiation off and on, and that they have been trying to reach a sort of an agreement and with compromising position from each side. But yet they are sticking to their position. Having said that, I would say that the elephant in the room was always Netanyahu, who was refusing this war should be stopped without achieving the Israelis' objective of this war. And that was one of the main objectives, is to continue its conquering the lands of Lebanon and attacking on West Bank and Gaza Strip, which he has been violating the ceasefire ever since they've signed with Gaza and even with Lebanon. So therefore, Iran have made it very clear to the United States, ending of all cessations of activities should be, including Lebanon and Yemen and all the fronts. So he refused, and they were trying to separate the two issues and make only Iran and the United States and Israel as a separate issue. So I believe now with the American president, he wanted to find a solution, even with his popularity falling down, even with the midterm election is approaching. And he knows that this is the time where the crucial meeting taking place between the two sides, that he wanted to reach some sort of an agreement. Almost a compromise has been approached. So therefore, he may be putting pressure on both sides. And Iran, at the other hand, now have already announced ending of cessation against Israel if Israel does not attack Beirut again.
Ambassador Sajjanhar, let me take that comment across to you. Mr. Wail Awad, they're referring to Netanyahu as the elephant in the room. Donald Trump has been heard in the last few days to say that I'm the one calling the shots. America calls the shots. Netanyahu will not have a choice. Is that so on the ground, at least from your reading of the situation?
Well, number one, thank you very much for having me, and my compliments to you and to my friend Wail Awad and to your listeners. You see, as far as Israel is concerned, its objectives have been quite clear. The objectives of the United States might not be so very clear because they have been moving from one end to the other. First, President Trump had said it was regime change, then it was nuclear capability, then it was the nuclear stocks of 440 kilograms. So things have been changing there. But Israel has always wanted that this war should continue. But we have seen that over the last several weeks, the negotiations that have been going on, Israel has not been part of those negotiations.
Ambassador, my apologies for interjecting. We just have you on a very difficult line. Let me request our production team to connect you again on a better line, but till we get him back. Mr. Awad, again, the same question. We've heard Donald Trump insist that what he says actually holds sway in West Asia, especially with respect to Prime Minister Benjamin Netanyahu. You've identified him as the irritant. What I want to ask you is, how much sway does Washington have over what Israel deciding what to do?
Well, absolutely, Ashmit. You remember when last week President Trump had a talk with with Netanyahu, there was a heated argument between the two leaders, and he was reprimanding Netanyahu that he wanted to end this war, and he's reaching to a deal with the Iranian, while Netanyahu was defiant his deal, and he doesn't wanted to reach to sort of a deal and trying to separate the Lebanese front. So therefore, this was an issue of one of the main issues for the Israelis, that they wanted to make sure that the Americans stay in this war with them, because they are occupying till Zahrani River of Lebanon. That means 40 kilometers inside Lebanon territories they wanted to conquer, and they are already doing it. They have also reached an agreement with the Lebanese government on this front. So therefore, prolonging of the war actually in Lebanon, and even igniting the war on Iran, it is one of the main reasons for his personal survival and political survival of Netanyahu, because he is facing lots of problems inside his country. Even President Trump, you remember also, he was trying to asking the Israeli president to have an amnesty against Netanyahu. Therefore, I think as long as the war prolonged, he will stay in power.
Sure. Mr. Awad, while I have you again, another issue, we're just getting unconfirmed reports that Iran is saying that there will not be any hostilities going further, at least that they're done with the second wave of attack. And now, whether or not that's true, of course, in the next few hours, we'll begin to get a better picture. What I want to ask is that, given what we've seen in the last 24 hours, the extent of strikes exchanged between the two sides, the worst since the ceasefire was announced between Israel and Iran, what I want to ask is that, is this only the two sides testing how much muscle flexing they can get away with as a part of the ceasefire? Or is this well and truly the first steps towards a much greater escalation leading to a full frontal assault between the two sides?
Well, both your questions are the answers, actually speaking. To be honest, that Israel wanted to make sure that a regional power like Iran should be disintegrated and broken down, so Israel can remain the dominant force in the region, and the next they can take either on Turkey or on Egypt. Therefore, Turkey is on the next for the Israelis, we all know, and they are openly saying it in Israel. And the second part, Iran also knows that this war was imposed on it by Israel and the United States, and they wanted to end it on their own term, which is impossible at this stage. But they're having already the bargaining chips, which is the Strait of Hormuz. They're holding the American there. The international global trade and oil is also at stake because of the partial blockage of the Strait of Hormuz. And the American took the counter step to counter Iran step. So therefore, I believe the ambiguity of the American strategic objective of this operation clearly indicate that first, the decapitation of the head, the regime change, the nuclear issue, then the Strait of Hormuz. It's a clear indication, as I said, it's not an American war. So Israel understands that Iran, to stay in power, has to remove Iran from the hurdle of the dominance in this region.
Right. Let me also get Ambassador Sajjan Har in on this conversation. Ambassador, it was difficult to connect with you. We finally have you on a clear phone line. The question I want to ask is that, speaking of these negotiation chips that Iran has stacked up, Strait of Hormuz being the biggest of them, now we're beginning to get reports that Bab al-Mandab is also facing some form of closure. Iran expressing confidence that they'll be able to secure that strait as well. How much of pressure will that pile on to Washington in looking for a solution and looking for a solution quickly for this crisis?
No, I think as far as the pressure on Washington is concerned, there would be other elements of that pressure and not necessarily only of this. I think Mr. Trump will be guided more by what affects him personally and the United States, basically, in terms of the inflation in the U.S., in terms of the increase of gas prices, in terms of its sinking popularity, rather than all these things about Strait of Hormuz. Of course, it's a pressure point. Bab el-Mandab will be. But I think Iran should also recognize that when it tries to do all these things, then it is also pitching itself against the whole world, because the whole world is suffering. It is not only the United States that is suffering, it is also the Gulf states that are suffering hugely. And what is going to be the impact of this? Do you think Iran is going to escape the impact of all this? What the world has experienced, what the world has faced during this period when it has kept the Strait of Hormuz closed, and when it is now threatening to put Bab el-Mandeb also under strictures. So I think Iran should also look inwards and look in terms of its future policy and the future impact that its actions are going to have. The world might not be speaking out in very loud voices, in very strong terms, but the impact of the closure of the Strait of Hormuz, which has been done by Iran, we can, of course, speak about who has done the original mistake, who has done this. But right now, the world is suffering because of actions that Iran has taken on the Strait of Hormuz and that it is threatening to take on the Bab el-Mandeb. So I think Mr. Trump might not be impacted all that much by the closure of Bab el-Mandeb, but the whole world is really going to pay the price for that also.
Right, so a difficult situation for all stakeholders, especially those involved. I'd like to thank Ambassador Sajjan Har as well as Dr. Wael Awad for joining us, being a part of this discussion. We hope to come back to you again to get a sense of how the situation in West Asia is developing. And on that note, let's slip into a very short break. We'll continue come back with more news and updates for you on the other side. Welcome back to News Center. Now, while quick commerce rivals are grabbing headlines with aggressive expansion plans, Amazon is making strong moves of its own. Amazon India head Samir Kumar has told me that the company is placing big bets on now offering, backed by a surge in Prime membership. What's even more significant is that much of this growth is being driven by their Tier 2 and Tier 3 cities. Now, before we look at what is in the next decade for Amazon India, I began by asking Samir Kumar about the company's 13-year journey in this country. Here's the conversation.
We are really happy with where we started our journey and where we are at today. And we continue to focus on, as you talked about, all the things that you talked about in terms of providing the best value to our customers, where it comes to offering the largest assortment, getting them the best prices, and then for our sellers, making sure we make it easy for them to sell, not only in India, but around the world. For India, we have just done lowering our fees, so we're up to 1,000 rupees. We don't charge any selling fee for our sellers, and we have seen great adoption of an increase in our assortment that we carry on Amazon in India. And with the help of AI and other tools, we are enabling the next generation of sellers and making them possible to sell around the globe. So as we said, we have enabled $20 billion of exports already, and we have promised to get to another 60 billion, so take it to $80 billion of exports in the coming 5 years. So all of those are really, really important for us. And for the past year, I have really enjoyed working with our Amazon Now team, which has really worked very hard and fast to build the fastest speed for the widest selection. And we are going to be in 100 cities and 1,000 micro-fulfillment centers in the coming months. And I'm really excited about getting that to our customers, and along with the widest selection that will be available for the quickest delivery.
How much of a challenge will it be? Because analysts say that now the cost of acquiring customers will be significantly higher for a newer player in the market. You'll have to burn capital. What does this journey in quick commerce look like for you?
As we said, like e-commerce, which is quick commerce, is a subset of e-commerce in our opinion, and it's just a speed game. We are still in very early innings, and that's why we said it's still day one for us in that journey, and especially in India, where the penetration is still in single digit or low double digit. So we remain excited about what is coming in the future. And as far as we know, that we have started this journey on January of last year. And since then we have expanded, and as we said, we're going to get to 100 cities. Just in the last month or so, we have gotten our service launched in Amritsar, Kochi, Vizag, Mangalore. And everywhere that we have gone, we have seen really good response from our customers. Our Prime customers are shopping 3 times more using our service, Amazon Now service, in those cities that we have launched. Our growth is 25% month over month for the past few months. So it really is still an exciting phase and still in the nascent stage of. So I believe that there is still a lot of room to grow. And as long as we are building India's fastest delivery, most reliable, with the widest assortment that's possible, we believe we have a chance to win, and I believe we'll win in this game in the coming years.
Any figures you'd like to share in terms of funds that you may have earmarked for this quick commerce deep dive?
I think we'll continue to build our service, which is the right service for our customers. So whatever it takes to do the right thing for our customers, we'll go do that. And yes, as you know, that as we set up these micro-fulfillment centers, as we build these services, as we scale our services, there'll be investment required. But our goal is to make sure first we build the right service for our customers. If the customers are happy, we believe in the long run, this business will make money for us. And for the first stores that we launched in Q1 of 2025, quarter one of 2025, we are seeing really good progress in terms of the scale that we have been able to achieve and how they are performing on various markers that we had set for them. So I remain excited about where we are at. And I'm not going to go into specific numbers. We will do whatever it takes to be a leader in the fastest speed that's possible. And hopefully that fastest speed will give to our prime customers as a benefit.
We're given to understand from your team that the Prime membership is likely to double by the end of this year. What will that look like?
I think like where we were at number 23 with Prime membership, we have doubled from there. So we have already doubled the number. So it continues to grow in a very healthy fashion for us. And we just hit another milestone. Just last week, we celebrated that. I can't disclose the numbers, but Prime membership continues to be a big differentiator for us. Prime shoppers, they shop with us more often. They engage with us a lot more often. And they are some of our best user of our services and some of our best critics as well. So Prime is a big part of our overall growth. And if you look at what's happening in Prime, 70% of Prime customers are now coming from tier 2, tier 3 cities. So that gives us a lot of hope that we are going beyond India into Bharat.
Tell us, the next decade, will the focus be more towards ensuring that Amazon India is a self-sustaining, profitable entity, or will the focus continue to be towards growth? Where will the bias lie?
I think it's not an either or for us. Both are important. So we'll continue to grow the business and make sure that we continue to be the largest selection and offer the best value to our customers. At the same time, we'll continue to figure out as we scale our business, how do we make it sustainable? But that's our long-term goal, and that we continue to march down that path, and really happy with the progress that we are making on both fronts.
Any indication, Mr. Kumar, you can share with us in terms of by when we'll see Amazon India become again a self-sustaining, profitable entity?
I cannot give you timeline, but you can definitely look at some of the reports that are published out there. But we continue to build a business which is right for our customers, and it provides them value. And as we do that, as we scale this business, we will build the sustainability will come in this business as well.
A forward-looking question to you, Mr. Kumar. Robotics and AI, what does Amazon India of a future look like to you, to their customers, to the sellers?
I think as I'll talk about this in a way that AI for India will make things better. AI for Bharat will make things possible. So that's the way I look at it. The example that I have is a seller in Gujarat who is selling toys online. Before, they had to figure out how to get a UPC EAN code, how to create listing. With our seller assistant, they can create that listing with taking a picture from their phone. And we have already used AI to be able to do that for her. Next step of that is she can sell on Amazon India, but how can I take that listing and allow her to sell around the globe? And the localization agent that we have will help her to get her listing listed in Amazon in France and Amazon in Germany, localized in their local language. And some of the AI agent and tools that we are building will help them to ship their products to our warehouses around the world and get their money in their bank account. So it allows a small seller, it makes it possible for her to get her product introduced to customers around the world and make money. And that's what I believe the AI in Bharat will make it possible. Similarly, for customers, it will be around how do I make sure that customers can shop in their own languages and get the right agents to give them advice on what to buy and also surface the right product for them in tier 2, tier 3 cities. So for Bharat, it makes it possible for these customers to come online and shop online. So I'm really excited about what future holds for AI.
Excited. Speaking of plans about the future and being excited, any conversations about listing of Amazon India? Is that even on the cards? Something that we can expect perhaps, if not in the immediate future, maybe in the mid to long term?
These are all speculation. I cannot talk about future or any speculation.
Well, with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
This is a very interesting dialogue, a dialogue between practice and policy. The long vision is the topic that we've been asked to discuss. This is kind of an overnight preparation, but my guests are conducting this dialogue on a daily basis, on an hourly basis, between practice and policy. So we should be in for some very interesting conversations. Anant, I'm going to start with you. We don't have details about the ECBs that PSUs have been allowed to raise. But from what we have, and from the fact that you were a key player when the 2013 FCNR deposits were announced, I want you to explain what may be the depositors' interest. People are talking about 50 billion. Is that an underestimation or an overestimation?
You're absolutely right. We don't have the details of the swap that the governor announced on Friday. So a lot depends on the fine print that finally comes out. But assume that what was followed in 2013 is also followed now in a sense. The subsidy that has been announced by the RBI is quite substantial. Effectively, what RBI is saying is that it is willing to sell 5-year forward dollars against the rupee at the current spot rate. So if, for argument's sake, dollar rupee today at spot is 95 rupees, RBI is saying, I will also sell you dollars 5 years from today at 95 rupees. Now, the actual market for dollar rupee in the free market, and there is a cross-currency swap market which quotes these things, is between 110 rupees and 115 rupees over the last few days. It's been volatile after the announcement, right? So essentially, RBI is saying, I'll give you a 15 rupee discount for every dollar, or maybe 15 to 20 rupee discount on every dollar. That is an amazing amount of money, roughly equal to 3% per annum running. So it's a huge subsidy, and the back of this subsidy, precisely the kind of leverage trade which happened in 2013 can follow, assuming that the RBI allows for leverage. So effectively what can happen is, banks can offer FCNRB deposits, offer to take deposits at a very high interest rate, let's say 5.5%, because they can swap this 5.5% in dollars into 5.5% in rupees effectively for the principal. We don't know about the interest. And obviously that 5.5% in rupees can be deployed into government securities risk-free at roughly at 7% or so. So you get a clean spread there. At 5.5%, when the NRI sees that number, she can in turn borrow against this deposit at something like 4.5% or so. So imagine the NRI would be in a position to borrow in dollars overseas against the collateral of this deposit at a rate lower than this deposit is worth. Which means on a leveraged basis, and if the same leverage that was followed in 2013 is followed here, 9 times leverage if it is allowed, effectively the NRI can get double-digit dollar return, maybe 14 to 15% return on their core principal. And the risk you're taking is India cross-border risk, which you and I know is close to zero. When has India ever defaulted on a cross-border obligation? So this is an extremely attractive scheme, both for NRIs, if it is followed the same way it was done in 2013, and for the banks raising these funds as well, which means it can be very, very successful. People are saying $40, $50 billion. It can easily reach that amount if this process is followed. It might even come to a stage where RBI says, I've got enough, now please stop, before the 4 months are over. So it can be extremely successful.
Naren, to your view, now, in terms of how FPIs might react, we got the feeling that even when FPIs were willing to put their toes in, there was this fear that they bring in and the next day the value goes down because of the currency. The currency was becoming self-fulfilling. If that is out of the way, which it looks like in the next few hours, perhaps by end of day we will know. Do you think that the FPI attitude to India, both in debt and equity, is going to be much different?
I think FPI and debt certainly immediately. And one thing what we have to keep in mind is, and this is learning over the last 20, 30 years, you have to break vicious cycles. So when UTI was in trouble in 90s, they created SUTI and UTI. And no one would have believed SUTI would have created so much money. In 2008, for example, when Ben Bernanke bought warrants in all the banks and said, I'm backstopping all the banks, they made huge money on those warrants. In 2019-20, when, the government supported Yes Bank and made the other banks invest, a lot of people criticized how can the banks make money. Every bank is sitting on huge profit out of that investment. So what we have learned is when you have vicious cycles, and because today we don't have current account deficit, we have a huge gold reserve, both with the people and the Reserve Bank of India, and still people question dollar rupee. You have to break vicious cycle. There's a cost for the vicious cycle which is very small, which Reserve Bank can afford to break. So that's where it is. So once the vicious cycle is broken, will FPI money definitely look more positively in debt? Yes. Equity is today, there's so many questions, AI, no AI, I mean, what's happening in the world? It will come, but it's not something where one RBI policy changes equity money. And that is what is very evident at this point of time. But is this a positive development? It breaks the vicious cycle of rupee? Certainly. From that point of view, it certainly does.
Yeah, I mean, we are going to discuss both FPI attitude and our growth and earnings cycle in just a minute. Let's just finish the policy to practice dialogue on the most newsy bits, and I'll come to the larger growth issue. Anant, on the FPI, tax debt, both withholding and capital gains, in your learning and in your understanding, how good is this from an FPI point of view?
So Lata, I think of the announcements made on Friday, this is probably the most consequential one in terms of medium-term policy. And I have to commend the government for biting the bullet and saying that at least for government bond investments, there will be no tax liability on foreign investors. Now, I know this is a tricky topic and lots of people have strong views on this, but the reality boils down to this. Globally, every country or most countries follow the OECD norm of saying that foreign investors will be taxed in their country of residence. So it's a residence-based taxation as opposed to paying tax where you're operating, as opposed to a source-based taxation. A few years back, we effectively moved to a source-based taxation where we said foreigners have to pay capital gains tax here. Of course, we also said that we will put in place double tax avoidance treaties, etc., so that the liability on foreigners does not go up across what they have to pay in their home country and what they have to pay here. However, in practice, that double tax avoidance did not work always.
Oh, really?
Yeah. In the sense, if you are a sovereign wealth fund, or if you're a person based in Singapore, or if you're an endowment for a university in the US, which is exempt from paying capital gains taxes, if you have withholding taxes in India, what do you set it off against? There is no set off. Secondly, if you're an investor coming via a fund and investing in India, then what you get when you exit is a provision for withholding tax which your fund deducts. That provision for withholding tax cannot be set off against the liability you have in your home country. Finally, and all of you are market participants, you'll understand this. In India, we calculate capital gains on a rupee basis. Now, a foreign investor might actually have a loss in a dollar basis or a euro basis, particularly at a time when rupee has been depreciating. But yet, you have to pay a withholding tax, which is computed in rupee terms. What do you set that off against? And finally, think of the process implications for people coming into the country. For every sale of security, you required a tax certificate telling you exactly what the tax liability is. You had to make sure the tax liability is made good. Only then you could remit the funds out. Can you imagine the nightmare? Now, I have to commend the government for doing the analysis and at least for government bonds removing this particular requirement. By the way, at least my back of the envelope implications. Foreigners typically hold about 3 lakh crores of government bonds. Assume a 7% interest. So every year, they're earning about 21,000 crore rupees. If you take 15% withholds, etc., that's about 3,150 crores of annual withholding tax held by the government. In the overall scheme of things, in the fiscal balance that we have, it's a rounding off error.
The other newsy bit that came on Friday was the GDP number. So let's discuss growth. And I have a whole set of questions on the next chapter of reforms that we have to talk about now. Now that, in a crisis, we always reform. So let's talk about that in a bit. But I'm very keen to understand this valuations and earnings growth argument now. My first question to you, Naren, is more macroeconomic. See, it was a surprise to all of us the way the GDP number came. The poll I got was 7.3% for fourth quarter, and even the highest number was not above 7.6, the range of expectations. There was no 7.8 anywhere in the analysts' expectations. That's exactly what we have delivered in the fourth quarter. Now, if you look at that, and you look at the RBI forecast, or all economists' forecast for the current year, 6.6. I mean, does it look like, we are that much slower, that the growth has to fall by almost 1.5 percentage points, 130 basis points? Or do you think that the strength of the performance in the fourth quarter and the subsequent auto sales in April, PMI in April, power consumption in April, just all the indicators are in such deep green, do you think that we are not going to have that bad, at least a first half?
Think of last year, they cut GST rate sharply, they cut income tax rate sharply. So when you have done all that, in fact, RBI did a lot to increase liquidity in the economy. All that helped the economy so much that we actually had a very good year in 2025-26. And in March, people decided, let's stock up after seeing the war. That also helped March. Because who would want to take risks on supply chain in a situation of a war? So that's why it was good. But look at what RBI has to do. They don't know how strong El Nino will be, how long the war will go. So it is better to be slightly cautious and forecast at this point of time.
Today, Japan's GDP numbers came in. Expectation was 1.4. They produced 1.8. Highest, fastest growth in 4 quarters. We are talking large economies. Okay, we're getting these numbers from US, we're getting stronger numbers from China than before. They are also in the throes of a capex cycle. Japan, China, US, and Korea, Taiwan. Is there a global, higher than expected growth? And we are also benefiting from it.
I'll defer to Naren and this very knowledgeable audience here on the actual earnings and all that. But as a macro person, when I look at the overall performance of the listed space, I know that the benchmark indices don't seem to be doing too well in terms of earnings, right? The Nifty 50 or the Sensex 30. But if I look at the BSE or NSE 500, or if I look at the entire listed space, it's looking good. I mean, the performance has been 15% annual year-on-year growth, and which is more than 1.5 times the nominal GDP growth. It's looking pretty good compared to an FY25. I'll give you another data point, which I'm not sure why people aren't speaking about this more often. Look at the employment numbers. If you don't trust government numbers, look at CMI employment numbers. They're showing very robust growth over the last year and a half.
See, this momentum in auto is continuing. Momentum is many of the discretionary, like one of the gold jewelry companies, leading companies, had an analyst meet. They gave such a fantastic target for the next 5 years. So there are a lot of discretionary entities which are giving good growth. Most of the IT services companies show low growth. So we have a situation where underlying trends are fine.
Let me come to the specific sectors. And my sector where I am the beat reporter, banking. There has been this spectacular run of public sector banks vis-a-vis private sector banks. I hope your owners don't mind that. But at the moment, do you think that has run its course and attention comes back to private sector banks? Or do you think that, public sector banks probably lack digitalization? That's what they tell me when I speak to the public sector bank chairman, that, 5 years ago, besides the fact that they were laden with more AQR than the private sector banks, they were also not as digitized. But now they're almost on even, level according to them. So they see this narrowing of valuations between PSU and public sector banks likely to continue or even improve. Your take, which sector would you bet on?
Any stock where FI holdings have been very high, that stock has been punished. So if you look at the amount of selling which has happened in the mega caps, which the FIs liked as on September 24, and see their FI holding as of today, that has been a big role. So our view is that if you have to look at something contrarian today, it would be all the stocks where FIs have sold for the last 20 months, relentlessly. And I think if you take a 3-year view there, that's why private banks come as one of the best sectors to invest for the next 3 years. Simply because in the last 20 months, I think FIs wake up every day in the morning and sell private banks. Because they used to have 40% of their portfolio in private banks. So for them, when they wanted to sell India, they had no choice but to sell private bank. One day they'll sell A bank, second day they'll sell B bank, third day they'll sell C bank. So we'll think that the problem is in A bank, but the problem was not in A bank. The problem was A, B, C, D bank were the 4 biggest stocks in their portfolio.
Anand, you have this wide group of FPIs you speak with, you used to speak even more regularly, and you still speak to in your other responsibilities. What is the sense you're getting about AI as a whole? Is this danger that India would be the negative end of AI, job losses? Is that the narrative you're hearing? Or is the narrative that jobs have just moved from IT to GCCs and we are confusing the AI issue? How do we see the overall story with all of us is, even if the Gulf War ends today, from tomorrow we have to worry about AI. Is that any better now? Is there an understanding that India need not be in the negative end?
So I think, Lata, there are positives to be seen. First is the moves in the market and the positioning in the market. Let's take dollar rupee. Dollar rupee has obviously moved sharply from 84 a year ago to 95, or wherever it is today. In real effective exchange rate terms, it's gone from 107 to 90, below 91 now. Okay, so it's corrected a lot. Now, alongside that, as I mentioned, the amount of fear and greed trades which have been put, which are people buying dollars because they're worried about what's going to happen to the rupee, I've counted $120 billion of such buying over the last 2 years. $200 billion is what RBI has sold. Out of that, $120 billion has been picked up by people hedging or taking speculative positions against the rupee. To me, that's great news for India. Because if everybody is positioned on one side, people are prepared for bad news, people aren't necessarily prepared for good news. Similarly, on equities, we've seen relentless selling coming through. Our weightage now in MSCI EM is now below 12%. Even there, it looks like many FPIs are actually underweight India, which means people again are not prepared for any good news on India. That's a great place for us to be in. Finally, on growth, as I mentioned, people are very knowledgeable here, they'll know better than me. But I can't see a problem on growth. Earnings looks fine to me. As I said, employment looks fine to me. If anything, the adoption story on AI in India, whether it's the software services companies, the GCCs, or normal corporates, is fantastic. You know, that Stanford report beginning of the year, which shows adoption in India is 3 times the global norm. The number of research papers on AI coming out from India is now rivaling China. The number of research citations, the number of GitHub contributions coming from India is rivaling the world. We are still low on patents, but everywhere else, I think our adoption rates are very, very high. Yes, we missed the bus on foundational models, but it does look like when it comes to the application stage, including with the software services majors, we actually have a story developing. These are consultants, software service majors are consultants who will be required whenever somebody decides to move towards agentic AI. So I think the negativity around India is frankly the positive. The fact that there is so much of negativity and people aren't prepared or ready for the fact that we have very, very bright people trying to prepare for the future.
Naren, 2 important stock market questions without which my viewers will be very, very upset with me. One, this correction that you're seeing, Kospi and Samsung and SK Hynix and TSMC and now Broadcom, all those chip stocks in the US. Should we look at it as a good correction? Because if you look at the economy, it's red hot as we're looking at all the US economy indicators and Korean Far East economy indicators. So is this a healthy reset in a secular bull market for the moment?
Yeah, it is a healthy correction. You can't have some 9 successive weeks. I think US S&P went up. It went up, I think, 22% from the bottom, something like that. It has to be a healthy correction. But even after this correction, I don't think on market cap terms it is cheap.
Okay. Well, the other question which I must ask you is, what are your favorite sectors at this point in time? We know that you are the contrarian and have always made money on contraries.
So oil and gas clearly, because no one wants to look at it.
Yes.
Banking clearly. These are two clearly at this point of time. I mean, the two sectors where maximum work we are doing and we are already having a position and we are struggling is FMCG and IT. But those two, each have their challenges because both are seeing such low growth. So the growth has to come back in these sectors. That's what I would say.
Thank you very much, Naren and Anant. Many positive takeaways. The markets itself are in correction territory, but as our experts see it, this boring markets are the time that long-term investors should get in. The earnings story seems to be turning if we look at the third and the fourth quarters. And of course, while there is the challenge of oil taking away a lot from our GVA, it's still something that we are hoping will not be the story of the full year. And the tax corrections that the government has brought about, the deposit SOPs that RBI has thrown, looks like the correction should end sometime soon. Thank you very much.
Good evening. Thanks for joining us on India Business Business 360. I'm Shriram. The top stories we're tracking for you this evening. President Trump urges Iran and Israel to immediately stop shooting. This after Israel struck Iranian military targets and a petrochemical plant overnight. Tehran accuses Washington of bearing direct responsibility for repeated ceasefire violations. Oil prices jumped nearly 4% amidst fears of a wider regional conflict. The Sensex and the Nifty hit their lowest levels in 2 months after a broad-based sell-off on Dalal Street. Metal stocks take a beating. IT stocks decline for the 4th straight session. The rupee weakens by more than 70 paise against the dollar, but bond yields soften as money markets expect RBI's recent measures to draw $35 to $50 billion in foreign funds this year. Tax relief for foreign investors can also help India's inclusion into the global bond indices. After Flipkart, PhonePe and Boat, Cure Foods delays its IPO plans amidst choppy markets. Sources say roadshows failed to get institutional backing for the company's desired valuation of 4,000 crores. The cloud kitchen platform will revisit plans for the 800 crore rupee public issue next year. Noel Tata-led Tata Trust Board meets in Mumbai. A review of the group's loss-making businesses on the agenda. The Tata Group has seen nearly 13% of its market value wiped out this year. Leading the decline is TCS, the conglomerate's crown jewel, which has lost close to 4 lakh crore rupees in market cap this year. The profits of airlines worldwide set to halve this year, warns the International Air Transport Association, but demand remains robust with a record 5 billion passengers taking to the skies this year. Rising fuel costs and geopolitical tensions dent bottom lines. The government is likely to tighten rules for bus registration soon. Sources say the changes are driven by passenger safety concerns, especially in sleeper coaches. Large automakers likely to benefit as smaller builders could face higher compliance and certification requirements. The Delhi High Court seeks a response from CBSE on the evaluation of Class 12 results, agrees to hear a petition filed by Congress Party Students' Union. CBSE says more than 1.6 lakh candidates have sought re-evaluation of 3.8 lakh answer sheets. 19 people dead, many injured after a powerful earthquake struck Philippines. Tsunami warnings issued after the 7.8 magnitude quake flattened several buildings. The top story this evening, Israel and Iran have attacked each other for the first time since agreeing to a ceasefire, sparking fears of a full-blown war once again. Here are the latest developments. President Trump has called on both Israel and Iran to stop shooting immediately. The US president made the remark in a social media post after Israel and Iran were locked in retaliatory attacks. It all began after Israel attacked Lebanon's capital, Beirut, over the weekend. Israeli military said Iran launched a second wave of missiles across its territory. Both sides are targeting energy infrastructure. Tehran claims to have targeted a petrochemical facility in northern Israeli city of Haifa. According to Iranian state media, Israel has carried out 2 Israeli strikes on Iran's Crude petrochemical plant. However, no casualties have been reported so far. Tensions also beginning to spread across the Red Sea. Yemeni's militant group of Houthis has confirmed it fired missiles towards Israel's port city of Jaffa. The Houthis also declared an absolute ban on maritime navigation off Israel in the Red Sea and threatened to attack all Israel-linked ships. The Israeli attack on Iran came hours after President Trump said that he, not Netanyahu, calls the shots on the peace process. In an interview with the Financial Times, Trump also said Iran's strikes on Israel have not changed his desire to conclude negotiations between Tehran and Washington. Separately, in an interview to Fox News, the US president also said he was not happy about Israel's brazen attack on Beirut, but maintained that Iran's latest strike will not help negotiations. Amidst all of this, the US-Iran peace talks remain at a stalemate. Iran's foreign ministry spokesperson has said US bears direct responsibility for repeated ceasefire violations, adding that Israel's military actions cannot be separate from US policies. Shipping traffic in the Strait remains constrained. Brent crude prices surging nearly 4%. India has called for immediate de-escalation of tensions and expressed regret over renewed attacks in West Asia. Here's Iran's foreign ministry spokesperson on the latest attacks.
The United States bears clear responsibility as a party to the April 8th ceasefire understanding. Whatever happens in the region, whether the U.S. itself violates the ceasefire Iranian commercial vessels and incursions against the southern regions of the country, or whether such violations are carried out by the Zionist regime in Lebanon or through its coordination with the U.S. in our region, the direct responsibility of the United States is unequivocal.
Well, a broad-based fall on Dalal Street has seen the markets close lower for the second straight session. The Nifty and the Sensex hitting two-month lows, falling 1% each. The Nifty ending below the 23,150 mark, dragged lower by Reliance and ICICI Bank. Broader markets fall in line with the blue chips. Healthcare stocks bucking the trend. Prashant is here with the details. Prashant, markets down starting Monday on a weak footing.
Well, oil continues to be the big story, and oil prices moved up at 1.5% and to about 98 before cooling it a little bit as we ended the session by about 3:30 or so. The Nifty, though, saw little by way of recovery. It did see attempts at a recovery, but then, I think we ended pretty much near the lower end of the range today, intraday range, so pretty much close to the day's lowest level, which is not a great sign. A dollar rupee again reflected this. So the rupee gave back more than three quarters of the 0.9% gain against the dollar that we saw on Friday after the RBI's measures. Lots of opinion coming in about how much inflow India can get, dollar inflow India can get, and the numbers range from between $40 to $70 billion. We will see, and it'll be important to watch. The Nifty Bank was down, but down far less compared to the broader indices. Mid-cap and small-cap indices were down a lot more. You look at sectorally, where was the pressure? Real estate was one, metals were lower, and the auto index was down as well. Now, the large cuts in Wipro, Jio Finance, Eternal, Hindalco, and Shriram Finance, these are the biggest losers as far as the Nifty 50 stocks are concerned. And then you go wider, right? By the way, market breadth was 3:1 in favor of decline. So 3 down for every 1 stock higher. The AI pack, grid infrastructure, power, that pack, NetWeb, MTAR Tech, Hitachi, GE Vernova, Tejas Networks, Sterlite Tech, these are all stocks which actually pulled back on pretty heavy volumes.
All right, Prashant, many thanks. Meanwhile, President Trump, in a post on Truth Social just a while back, said, and I quote, both sides, Israel and Iran, are looking to do an immediate ceasefire. Final negotiations on peace are proceeding, subject to the ignorance or stupidity getting in the way. The blockade will remain in place and in full force and effect until a final deal is reached. Things should move quickly. So this is the latest coming in from President Trump. Let's head to the money markets now. The rupee erased most of its gains from Friday, ending the day at 95.70 against the dollar. An escalation in the West Asia war and higher oil prices weighing on sentiment today. The currency closing at 95.70. Now, the market is hopeful that the government's move to waive taxes on foreign investment and sovereign bonds could trigger $40 to $50 billion in fresh capital inflows. And that's not all. Bankers also believe the RBI's decision to ease rules for NRI deposits could attract an additional $40 billion into the country.
When you see economy size, bank size, you can easily get 40, 50 billion. Now, it depends exactly. But it won't be outside, it won't be less than this range. I am thinking, because I spoke to 2-3 private bankers here, and they said you could get 75 billion also. But the only thing is that I believe now, after talking to these two guys, that India may have to stop it after 1 or 2 months, because this time you can do it till September. Maybe they have in mind, RBI has in mind how many billion they want. And they should create that impression so that these banks run around faster.
See, in debt, there are 2 factors. One is currency, second is taxation. Both have gone very positive. And so that's why I think the chances in debt are very, very high that Bloomberg can consider much more positively. And that's why I think on the debt side, clearly, I would say that the mood is very, very optimistic.
I think going forward, the interest rate on FCNR will likely to increase, and we are going to mop up good volume under that. We are expecting that country as a whole, I think it should be in the range around 35 to 40 billion USD.
Many of the irritants which were there for foreigners has now gone away, which means it's a matter of time, hopefully, before we get inclusion into the Bloomberg aggregate index. That alone should bring in passive flows of $25-30 billion to start with.
The government has hiked domestic LPG cylinder prices by 29 rupees, marking the second increase in 3 months. The price of a 14.2 kg LPG cylinder in Delhi now rises to 942 rupees from 913 rupees with immediate effect. In a statement, the government has said Indian households still pay amongst the world's lowest cooking gas prices. Remember, the government had increased domestic LPG prices by 60 rupees in March when tensions in West Asia had choked global oil supply. And staying with that, Oil Minister Hardeep Puri says India has started looking at diverse sources of oil supply since the Strait of Hormuz is shut. Speaking to CNN News 18, he clarified that there is sufficient oil in the country. He also said that India is still exporting oil and continues to be the third largest refiner in the world.
Three things are happening here. One, on the extreme is the possibility that this might not remain it's very remote, nobody's talking about it, may remain a conflict not confined to that theater, that you could have problems elsewhere, maybe some other theater starts off. That would be worrying. The second is that Strait of Hormuz remains closed, but meanwhile our diversified supplies have also started. You are the third largest refiner in the world, if I am not mistaken. You're the fourth largest exporter in the world. In the midst of all this crisis, you have no dry out taking place in any part of the country, and you're still exporting.
Well, that is the oil minister on the current situation. Now, cloud kitchen operator Cure Foods has put its planned initial public offering on hold. This even after it secured regulatory approval from the market regulator. Sources say the company pushed its IPO plans due to tensions in West Asia and volatile market conditions. Aishwarya joins us now with more details. Aishwarya, Cure Foods has joined the long list of deferred IPOs this year. Take us through the other companies who have also faced a similar situation by delaying their IPOs.
CNBC TV 18 has learned that Ankit Nagori-led Cure Foods has hit pause on its public market debut and is now exploring a fresh pre-IPO funding round. The company had received SEBI approval in October 2025 for an 800 crore IPO. Sources say Cure Foods wants to assess how the situation in West Asia evolves before taking a call on listing timelines. Cure Foods now joins a growing list of startups choosing to wait rather than list into uncertainty. PhonePe was the first to publicly pause its IPO plans, citing geopolitical tensions and volatile markets. CEO Sameer Nigam said that the company remains committed to a listing in India now once conditions stabilize. The fintech had been targeting a valuation of $15 billion, but bankers reportedly pushed that down to $9 to $10 billion as global markets turned. For parent company Walmart, this is the second India IPO to be delayed. After PhonePe, Walmart had asked Flipkart to focus on hitting EBITDA break-even by end of FY27 instead of going for a listing right now, putting also a planned $2 to $2.5 billion pre-IPO round on hold. And as CNBC TV 18 had earlier reported, wearable brand Boat also deferred its IPO for the second time despite receiving SEBI approval for a 2,000 crore issue. Now, the pattern is clear: volatile markets, geopolitical uncertainty, and a valuation gap that most founders would rather wait out than accept. Now, access to private capital means that they can. But the pipeline isn't dead. Oyo Parent, Prism, Zepto, and Shiprocket are all actively moving towards listing. Now, the startup IPO wave hasn't totally disappeared. It's just become a lot more selective about timing.
All right, Aishwarya, many thanks for joining us. Noel Tata-led Tata Trust's board meets in Mumbai. A review of the group's loss-making businesses, including Area and its digital ventures, have been part of the agenda at the Tata Sons board meeting, likely to be discussed here as well. The Tata Group has seen nearly 13% of its market value wiped out this year. Leading the decline is TCS, the conglomerate's crown jewel, which has lost close to 4 lakh crore rupees in market cap. Hormuz joins us now with more. Hormuz, decode Tata's market cap erosion for us.
So much has happened with the Tata Group over the last 12 to 18 months, but this year in particular has been a forgettable one for a lot of the group companies, to be frank. And more importantly, but the headline here is not about the group erosion itself, is the fact that TCS's market cap erosion in the first 6 months of 2026 is higher than the entire group put together. Now take a look at this. At the start of the year, Tata Group's overall market cap was at 27.7 lakh crore rupees. Today it stands at 24. The year at 11.5 2.5 lakh crore rupees, the most valued IT company in the country. It remains the same today as well, but the market cap now is sub 8 lakh crore rupees. So that's an almost 4 lakh crore rupees wiped out in just the first 6 months. And there you can see that's where the difference comes up. 3.6 lakh crore wiped out for the Tata Group this year, but more than that is 3.8 lakh crore wiped out for TCS. Despite this, TCS still remains the biggest company within the Tata Group with the market cap at 7.8 lakh crore. But there has been changes as well. The sell-off in Trent has relegated it to the 4th spot, but the outperformance in Titan and the outperformance in Tata Steel have taken them to number 2 and number 3 respectively. And Tata Motors passenger vehicles, after this recent resurgence that the stock has seen, has made its way into the top 5. Now, we mentioned TCS, so the fact that they lost nearly 4 lakh crore rupees in market cap, but there are other underperformers as well. If Tata Motors PV has done well, Tata Motors CV hasn't quite. It has lost almost 20,000 crore in market cap. Trent has lost over 4,000 crore. Tata Consumer has lost nearly 8,000 crore, and Tata Elxsi 2 has lost nearly 6,000 crore rupees in market cap this year. What has offset these losses? The offsetting has come from Titan and Tata Steel, as we mentioned earlier. Almost 30,000 crore added for Tata Steel, almost 14,000 crore added for Titan, for almost 9,000 crore for Tata Power and Tata Technologies too. A surprise package with a market cap of 26,000 crore rupees at the start of the year. The stock nearly tested its IPO price, but is now seeing some bit of rebound from lower levels and has added well over or nearly 5,500 crore rupees in market cap so far. But speaking of TCS, it's been a very forgettable start to the year, and not just for TCS, of course, but for the entire broader IT sector in general. But TCS currently is trading at the lowest level since June of 2020. The first 6 months of the year, including June, it has declined in 5 of them. And of course, the stock, the last time the stock was down more than 30% in a calendar year was all the way back in 2008 when the stock was down 55%. So the story, of course, is that yes, there has been a market cap erosion in the Tata Group, but it is TCS that has taken the limelight. Almost 4 lakh crore rupees wiped out in just the first 6 months of the year.
All right, Harus, many thanks for joining us. Up next, the profits of airlines worldwide are set to halve this year, warns the International Air Transport Association. That and more when we return. Prime Minister Modi has completed 12 years in office. In a post on social media, the Prime Minister highlighted many welfare measures undertaken by the government. This is after Pandit Nehru now. That is the milestone that's been marked by Prime Minister Modi. Ashmit Kumar joins us now with the details. Ashmit, many milestones clock us through the last 12 years.
Well, it's been an impressive list of achievements, especially as far as some of the announcements that were shared today by the top brass of the party. They were meeting with journalists, and some of the key issues that they've highlighted, some of the key achievements that they've highlighted. For one, they point out the Jan Dhan accounts. They point out that there are as many as over 58 crore accounts, that there was always this issue of leakages that take place between disbursements by the centre and the money that finally landed in the hands of the beneficiary. That has been avoided. Over 3 lakh crore rupees, they claim, have been transferred via these Jan Dhan accounts, again leading to great savings as far as the exchequer is concerned. UPI, another aspect which they point out, is a standout feature as far as their achievements are concerned. The data clarifies that as far as December 2016 is concerned, there were only 2 million transactions for about 708 crore rupees. In April of 2026, that's the latest data available, that numbers have gone up. Number of transactions over 22 billion. The amounts in transacted through these through UPI in a single month was over 29 lakh crore rupees. Same for GST rollout, which again we saw the rollout in 2016. Importantly, the government is quick to point out that the average run rate that they're looking at in terms of collections is over 2 lakh crore rupees every month. Those are from GST collections. Startups, again, is something that's close to the heart of the current leadership. They pointed out as a part of today's presentation as well, the number of startups have gone on and increased from somewhere in the neighborhood of 350 to 400. That was back in 2014. That has gone up all the way to over 2.35 lakh startups, which give as many as 24 to 25 lakh jobs. Forex reserves is again something that was highlighted by the government, saying that the forex reserves that we currently have is pegged at about 67 lakh crore rupees. That gives an import cover of about 11 months and protects the country from any imported inflation, helps target inflation as well. And that is something that's critical. Electronics manufacturing has been the poster child of the Make in India story. The numbers have been staggering with respect to electronics production. Used to be around 2 lakh crore rupees, now has gone up to over 12 lakh crore rupees. That's accounting for the exports as well that have been seen. And all of these, of course, are not even mentioning the leaders that we met today were careful to point out that it does not even take into account the expansion of the road network, the railway network, the Prime Minister Aviation Yojana, the insurance program, and all of this, they say, will help improve ease of living over the last 12 years that we've seen from the government.
Ashmit, many thanks for joining us. Now, 3 Air India narrow-bodied aircraft parked at the Delhi International Airport were damaged after ground support equipment crashed into them. The airport authority said that the step ladder belonging to Air India and Indigo broke loose after strong wind and heavy rain. The airport operator said all 3 aircraft were taken out of operation after the collision. And staying with aviation, budget carrier Indigo has unveiled its vision for 2030 with the aim to become a key global player. The airline targets annual capacity of 300 billion available seat kilometres and plans to serve 200 million passengers by the end of the decade. It's also targeting more than 3,000 daily departures and a fleet of over 550 aircraft in 4 years. And more aviation, the profits of airlines worldwide set to halve this year, warns the International Air Transport Association. But demand remains robust with a record 5 billion passengers taking to the skies this year. Rising fuel costs and geopolitical tensions have, however, dented bottom lines. Madiha reports from Rio de Janeiro, the venue of IATA's annual general meeting.
Airline CEOs from every continent, all in one place. This is the 82nd IATA annual general meeting in Rio de Janeiro in Brazil, a boardroom of aviation executives. And the news from here is not good. IATA says global airline profits are set to halve this year, from $45 billion in 2025 to just $23 billion in 2026. Airlines will fly more passengers than ever before, a record 5.1 billion, and still make less money. There are 2 reasons: the West Asia war, which grounded Gulf carriers, shut airspace, and forced airlines to reroute flights at enormous cost. And second is jet fuel, which is up 70% to $152 a barrel. Airlines will spend $350 billion on fuel alone this year. Willie Walsh, the head of IATA, who will also soon take over as Indigo CEO, said there are plenty of passengers, but the problem is that costs are rising faster than revenue.
So once again, we meet in challenging and unpredictable times. No sooner did we put COVID behind us than we faced aerospace supply chain failures, war in Ukraine, geopolitical tensions, and tectonic shifts in trade policies. And when war broke out in the Middle East in March, oil prices jumped and jet fuel prices skyrocketed.
Despite everything, the war, the fuel shock, the uncertainty, airlines are still buying aircraft. In fact, they are buying more urgently than before, because newer aircraft burn less fuel, and right now that matters more than ever. The problem is supply. IATA says the global aircraft backlog now stands at 18,100 jets, more than half the world's entire active fleet.
We're very grateful to have this order backlog, but I'm very pleased to let you know that in May of this year, we have delivered 60% more aircraft than the previous year. And when we look at the deliveries year to date till May of 2026, the number is that we are 8% higher in deliveries than the previous year.
Well, that is all the aviation action. It is a difficult year for aviation worldwide. But with that, it is time for us to wrap up this edition of Business 360. The news will continue right after this short break. Stay tuned. We're back in a minute.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always is Shruti Mishra and Ritu Singh. These are the top headlines from the startup world. After Flipkart, PhonePe and boat Cure Foods delays IPO plans amid choppy markets, sources tell CNBC TV 18 that the company is now exploring a fresh pre-IPO funding round. The company had received SEBI approval in October 2025 for an 800 crore rupee IPO. Sources say Cure Foods wants to assess how the situation in West Asia evolves before taking a call on listing timelines.
Infosys CFO Jayesh Sangrajka joins Cars24 board as independent director. Cars24 co-founder and CFO Ruchit Agarwal announced the appointment in a blog post, describing the move as significant for the used car platform as it scales operations and eyes a public market listing.
Kiran Mazumdar-Shaw's Immunil Therapeutics raises 100 crore rupees from Singularity AMC, Rain Matter and others. The firm will use the funds to scale its GMP manufacturing capacity, advance its next-generation deep tech cell and gene therapy pipeline.
Space startup Apex has seen its valuation surge to $2.3 billion. This comes after a new funding round where the company raised over $200 million. The investment will fuel Apex's expansion in satellite manufacturing.
The UK competition regulator has launched a probe into eBay's $1.2 billion purchase of Gen Z-focused fashion resale platform Depop from Etsy. The deal was announced earlier this year and is expected to help Etsy double down on its core handmade and vintage goods marketplace in pursuit of a turnaround.
Well, those were the headlines we've been tracking for you this evening. The top story today: cloud kitchen operator Cure Foods has put its planned initial public offering on hold. This even after it secured regulatory approval from SEBI. Sources have said that the company pushed its IPO plans due to tensions in West Asia and volatile market conditions. Aishwarya Anand joins us now with more. Aishwarya, Cure Foods has joined the long list of deferred IPOs this year. Take us through the other companies who've delayed their IPOs as well.
CNBC TV 18 has learned that Ankit Nagori-led Cure Foods has hit pause on its public market debut and is now exploring a fresh pre-IPO funding round. The company had received SEBI approval in October 2025 for an 800 crore IPO. Sources say Cure Foods wants to assess how the situation in West Asia evolves before taking a call on listing timelines. Cure Foods now joins a growing list of startups choosing to wait rather than list into uncertainty. PhonePe was the first to publicly pause its IPO plans, citing geopolitical tensions and volatile markets. CEO Samir Nigam said that the company remains committed to a listing in India now once conditions stabilize. The fintech had been targeting a valuation of $15 billion, but bankers reportedly pushed that down to $9 to $10 billion as global markets turned. For parent company Walmart, this is the second India IPO to be delayed. After PhonePe, Walmart had asked Flipkart to focus on hitting EBITDA break-even by end of FY27 instead of going for a listing right now, putting also a planned $2 to $2.5 billion pre-IPO round on hold. And as CNBC TV 18 had earlier reported, wearable brand Boat also deferred its IPO for the second time despite receiving SEBI approval for a 2,000 crore issue. Now, the pattern is clear: volatile markets, geopolitical uncertainty, and a valuation gap that most funders would rather wait out than accept. Now, access to private capital means that they can. But the pipeline isn't dead. Oyo parent, Prism, Zepto and Shiprocket are all actively moving towards listing. Now, the startup IPO wave hasn't totally disappeared. It's just become a lot more selective about timing.
All right, Aishwarya, many thanks for taking us through those details. Now, India's startup funding landscape is evolving, with more companies looking beyond equity to fund their growth. But accessing debt capital can still be a long and complex process, often taking months for businesses to secure financing. Looking to solve this challenge is Recca Club, an AI-powered debt financing platform that uses data-driven underwriting to connect businesses with the right lenders faster. Now, the company has received backing from Japan-based Enrison India Capital as part of its $50 million Series A round. So how is AI changing the way credit is underwritten, and what does the next phase of growth look like for debt financing in India? Joining us now is Eklavya Gupta, the co-founder of Recca Club. Eklavya, thank you so much for joining us on the channel today. You know, debt financing for startups always has remained under-penetrated in India, despite the funding slowdown, right? So what gap did you sort of identify in the market, and why is now the right time to continue building this debt-first platform?
No, absolutely. So debt market in India is huge, but it suffers from a lot of inefficiencies because it takes a lot of time still, right? Like credit is not easily available to SME mid-market corporates in India. It takes, almost 2 to 3 months to actually get the financing that you want. So that is what we are solving for, leveraging the AI-powered platform, enabling credit on the right form and structure to the SME and the mid-market corporates of India is what Recur is solving for today. Right? Like I think we work with around various NBFCs and banks to get that and cut short time by almost 50%, right? For those SMEs and mid-market providers. It aggregates data across various data sources that, shortens the decision-making time without compromising on any credit quality, right? Like, so we do internal checks, external scorecard checks, right? Like everything that a bank NBFC would want to do is enabled through AI, and it, fastens the entire process very smoothly.
Absolutely. And your AI credit analyst, which is the AICA, right, claims to reduce loan approval timelines from months to as little as 5 days. What is the AI actually doing differently from sort of traditional underwriting models?
Oh, I think, AI has totally changed the way you are underwriting mid-market companies. There's a lot of unstructured data, right? Like every company stores data in their own formats, in their own, local drives, etc. Every CA would have their own way of creating financial statements. So what AI does, it triangulates beautifully, all those unstructured files into structured data, makes sense, collaborates between those provisional financials, GST, bank statements that a traditional underwriting would not have been able to do, right? Traditionally, people had digital journeys, LOSs, etc., which, are totally changed now. Any form of unstructured data to make sense out of it, and deduce a logic out of it to underwrite and give great credit assessment from a financial, legal, compliance, and market study is now possible.
Yeah, and you've closed this another round of this $50 million Series A, right? So where will this capital be deployed? Can you tell us how much you've raised now? Where will the capital be deployed? What are the partnerships you're looking at? Acquisition, new product development?
So it's basically extension of the ongoing $50 million round that we did. We are glad to get Envision India onboarded, right? Like they open a lot of Japanese borders for us eventually at scale. Currently, this capital will be used for twofold purposes. One is to bolster our ICA product, which is the AI-driven credit analyst that we're talking about, right? Like everything to be done by relationship managers and credit analysts can now be done through AI, at least 80% of it. So majority capital will go there. And second would be to expand our domestic presence in tier 2 markets to enable the SME credit from a distribution point of view. These were the two major key end uses of this capital today.
Sure. And if you could sort of share your current revenue run rate, assets facilitated, and the number of businesses you've financed so far, how have these metrics sort of grown over the last 12 months? And what are the targets that you have for the months to come?
So we have sanctioned to close to around 1,200 odd, customers lines at Recur. Annually, we do close to around 3,000 odd crores of, sanctioned limits to these customers today. Plan is to, grow this at least 3x in the next 12 to 18 months. That is what we are going after. With AI, people feel that you can grow faster, but, that is what we are trying to gain towards. But as we sit now, we believe 3x is possible from here.
Sure. And, banks, NBFCs, and a growing number of fintech lenders are all targeting the same SME and startup segment, right? What sort of gives Recur Club that sustainable competitive advantage, and how defensible is your AI underwriting model?
So the AI depends a lot on data that you gather, right? Like at Recur, we have been doing this for more than 4.5 years now, right? Like, so we have evaluated close to 10,000 some similar companies, and we have data sets, primary, secondary, of these 10,000 companies that enables us to underwrite better as compared to a generic AI model, right? Because it's all about the right data sets, context that a company has. Also, our deep-rooted network in startups as well as SMEs over the last 4.5 years gives us that headway, to win, and our models to throw better outputs as compared to any other generic AI output. That is a right to win today. and closely working with lenders, right? Like I think we work with close to 100 lenders on the platform already, who are using this and giving it more and more feedback to make it more stronger.
All right. Eklavya, it was a pleasure having you on the show, and we wish you all the best on this journey going forward.
Thank you.
All right, so let's move on next to what's brewing. We've got Ritu in conversation with the founder of TrueFan AI.
Well, artificial intelligence is transforming everything, and one of the fastest growing segments is AI-generated videos, where companies are replacing expensive shoots and production cycles with personalized videos created in just seconds. Joining us today is Nimish Goyal, the co-founder and CEO of TrueFan AI, which has just raised $10 million in a Series A round that was led by Baring PE India and Z3 Partners. Now, the company claims to have scaled from 5 million to more than 20 million videos in just a year, and it works with more than 100 enterprise customers, including HDFC Bank, Bajaj Finance, Zomato, and others, and has built AI avatars for more than 150 celebrities, including Shah Rukh Khan and even Kareena Kapoor. Nimish, welcome to Startup Street. Thanks very much for joining us here. You know, AI is attracting a lot of capital right now. But give us an elevator pitch to begin with. What got you the backing from investors at this stage, and how will you deploy the money?
Yes, I mean, AI indeed is sort of the topic of this season. But for us, I think we don't put that in sort of our conversations as the key thing. I think we are a very customer first company. One of the key things that we do is we have redefined the ways of how video is being created with AI. So we are a large-scale enterprise-grade platform for AI video creation. We work with top 100 enterprises in India, including the likes of Bajaj Finance, HDFC, Axis Bank, Max Life, Make My Trip. We work with big houses like Reliance, Tata, Adani, etc. So generally speaking, that's been one of the big areas of why investors have shown the interest that we are sort of powering AI videos for large enterprises. This capital raise is obviously for two big reasons for us. One is we are doubling down on our India strategy. We have about 100 customers. We want to get that to 500 customers in India and then also expand globally. So we are expanding in adjacent markets like Southeast Asia and Middle East, where we already have a few clients, as well as going to the Western market like US. So that's sort of one area which is doubling down on distribution. And number two is building product. So, we're building real-time video agent where videos will become faster to deploy at scale, and they'll be real-time conversational as well.
Nimish, so simply put, if I'm a marketer that is watching this, why will I ever pay for another expensive celebrity shoot again?
Yeah, so I think this is not if or, this or that. It's actually complementary to a production skill. So a marketer today typically ends up paying X dollars for a celebrity shoot or for any shoot, right? But what they get out of that is maybe 2 or 3 pieces of content, because that's the limitation of a production scale, right? But with AI now, with same amount of capital, you can actually create 1,000x more content. So this is actually a big complement to marketer strategy. We work with over 150 brands, and 150 celebrities in India, where what celebrities have started to do is coin AI rights. They give their rights to the brand can shoot once and then create 1,000 pieces of content, which earlier was limited to only probably 2 or 3 pieces of content.
Okay, you're also going up against companies in Silicon Valley that have raised far more money than you have. So when a US client evaluates TrueFan AI against, say, a HeyGen or something else, why would you win that conversation?
It's a very interesting question. My answer to that is great expectations create great capabilities and not the other way around. Ritu, we started when there was no AI. We built our own foundation model. It is comparable to any global foundation model, including HeyGen and Synthesia. We know their founders very well. We speak to them. Our quality is insane. And our scalability and cost is actually 20 times cheaper than the global counterparts, right? So for us, we take it as a challenge, and it is a challenge. No, I'm admitting that. We believe that with that challenge, our GTM motion will evolve, our quality of product and technology will evolve. And, it's a big market, which everyone can serve. I don't think there's a name tag for any company on a big market.
Nimish, I have to end by asking you, every time people hear AI-generated video, the first thing, at least I think of, is deep fakes. How have you, how are you looking to tackle this? Have you ever had a celebrity brand or an investor telling you they're actually worried about what this technology could do? Could it be a part of a problem rather than the solution?
Absolutely. Look, when social media was launched 20 years back, this was the same thing. And when taxis were launched, Uber, customer safety was the same thing. There's no difference with that with AI. AI for the longest time has had negative connotation. But I think the way we work is we work on a dual layer of approval system. One is consent. So any celebrity that we work with, and we work with pretty much all the big names of Bollywood, cricket, etc. We take what you call an upfront consent, and consent is to create a video, not to distribute. It's just to create. And then the second approval layer is to rights on sort of distribution. So once the content is created, you then take permission again to distribute. So we've had no incidents in the past where we work with celebrities and any kind of data is being misused or done that. In fact, we force our clients to obtain their rights in advance. We have definitely refused business with some clients who for casual sake would come in and say, let's do the material and do the rights later. So we are a proponent of kind of educating, by the way, both celebrity world and client world to say rights comes first. Once rights are there, then there is approval. So until both the guardrails are in place, we would not release any video from our system.
All right, Nimish, we'll leave it at that. Thanks very much for joining us here on Startup Street.
Thank you. Thanks, Ritu. Thanks for the time.
Well, on that note, it's time for us to head into a short break. But coming up, Make My Not believes that the future of matchmaking will be built on trust, transparency, and verification. We put the founder on the hot seat to find out more. Stay tuned. Welcome back to Startup Street. We verify drivers before booking a cab. We verify sellers before shopping online. Banks verify borrowers before giving loans. So here's the question. Should we also verify a potential life partner before saying I do? One startup believes the future of matchmaking could be built on exactly that: trust, transparency and verification. Backed by over 50 years of matchmaking experience across 3 generations, Make My Not is looking to modernize an age-old industry with AI-led compatibility tools, premarital counseling, and even background verification services. Joining me now is Maulik Goyal, the founder and CEO of Make My Not. Maulik, welcome to Startup Street. India already has a crowded market of dating apps and matrimony platforms. What gap did you see that others weren't solving, and how do your AI-led compatibility and family approval scores actually work? Can technology meaningfully improve matchmaking outcomes, or is it simply helping people make more informed choices?
Hi everyone. Hi, I'm the founder of Make My Not, and I am the India's youngest matchmaker. I came from a family that has been in this matchmaking industry for the past 50 years, across 3 generations. It's exactly like to feel me that why should I have gone for this is what I have seen when I have entered in this industry. Most matchmaking platforms were only just profile setting. The focus was just on 4 parameters, which is salary, caste, looks, and location itself. But what I believe is marriage doesn't fail because someone lives in the wrong city. Marriage fails when expectations, values, communication don't align. So that is the reason why we come up with this idea. Make My Not is a matchmaking platform, and we have the first matchmaking platform which has introduced premarital counseling. Now, what does that mean is we are majorly focused on emotional readiness, compatibility, counseling, and verification.
Oh, Maulik, that brings me to my question. Make My Not claims to be among the first platforms to introduce structured pre-marriage counseling, a fairly unconventional offering. So what prompted that decision? And are you seeing younger couples becoming more open to discussing compatibility, expectations and conflict before marriage?
Yeah, honestly, Shruti, I would say when I have spoken to people across my age, I realized that matchmaking conversation, when it was used to, it was just only for 4 questions. How much do you earn? Where do you live? Do you drink and do you smoke? But somehow I feel that they expect us to make the biggest decision of our life based on that. So there was something fundamentally wrong with this approach. We at the Make My Not believes in, we are living in the century. Still, we are matching the profile based on salary, caste, looks, but where compatibility. That is the major reason. That is the reason why we come up with this idea that we have a counsellor who's having experience of 16 years in this industry. So she understands about the person's personality before, giving the partner to them. We understand their preferences. We understand about their compatibility. We understand about their, what type of partner are they looking out for. And that call would be very discreet. No family members, not even us. Only the matchmaker and the person, so that they can be very much comfortable there. And as your question said, yes, young couples are very much interested for this. And we have 2 types of premarital counseling, which is individual and couple as well. So both are aligning with the exact approach.
Sure. Maulik, let's now talk about your recent partnership with Identify to launch a premarital verification service. Generated significant attention. Traditionally, families have relied on references, relatives, and informal networks to verify prospective partners. Why did you feel there was a need to institutionalize this process? And are trust concerns becoming more pronounced in the digital era?
I would like to, give it to you by an example. So a family known to our relatives did everything traditionally. They have been around, they have asked their relatives, they have made their inquiries. Everything seemed perfect. But now comes the bigger part. When they dig deeper, they find out that the guy was having a significant depth of himself, which they later find out with us with very much important. The question is not whether verification is necessary. The question is why families are still relying on informal queries in an era where every other major decision is verified professionally. We verify drivers before booking a cab. Companies verify employees before hiring them. But why in the matchmaking club, in the marriage field, everyone says...
Absolutely, Maulik. The idea of conducting background, financial and identity checks before marriage may sound practical to some and intrusive to others. So how have users reacted so far, and where do you draw the line between due diligence and privacy?
I would be very honest with you. The response have even surprised us. We have not received a single query. Families are not asking why should we verify. They are asking why mothers are earlier. So that makes a difference what we are creating.
Maulik, let's talk business. What is the core revenue model today? Is it premium memberships, counseling, verification services, wedding-related offerings, or a combination of these? And what kind of traction and scale are you seeing? What are your current revenue numbers, and what is the road to profitability looking like?
Matchmaking cannot remain in the same for the next 50 years. I would be very honest to that. Every industry revolves. But the major point platform, my one-stop solution. And what we are including is our revenue model includes our commitment fees, professional counseling, premarital verification, which make us revenue grows.
Okay. One final question before I let you go.
Sorry.
Beyond matchmaking, you're also building a broader ecosystem around weddings and related services. Maulik, do you ultimately see Make My Not becoming a full stack relationship and wedding platform? And looking ahead, what does the future of matchmaking in India look like? Will biodata still dominate, or will AI, behavioral insights and verification fundamentally reshape how people and life partners?
I would say biodatas won't disappear, but they will become the starting point and not the ending point. The future is a complete relationship ecosystem, I believe. Counseling, verification, and we are creating one solution. We are doing from premarital counseling to making a people doing the wedding services and travel as well, which would create a huge revenue system in that model. Goes from 5,000 crores market to 15 lakh crores market.
Okay.
That is what we are building.
Well, on that note, Maulik, it's time for me to wrap up our conversation. Many thanks for joining us on Startup Street, and wish you the very best with all your growth plans. And with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
The Reserve Bank and its MPC will be announcing its policy when there is much to worry about the fall of the rupee and possible rise in inflation. However, growth looks resilient. As always, the CNBC TV 18 Citizens Monetary Policy Committee is here with me to discuss what the RBI may and should do in its June 5th policy. Let me welcome Chairman of our committee, Pranab Sen, and members Sajid Chinoy, Samiran Chakraborty, Shaumika Ghosh, and Sonal Verma. Sonal and gentlemen, thank you very much indeed for your time. Sajid, may I start with you? Well, inflation is the mandate of the Reserve Bank, and chances are it is going to be pushed up. If you go by their MPR announced in April, they said if there is an average of $95 crude for the current year, then the current year inflation gets bumped up to 5%. For a 5% inflation, a 5-quarter repo looks less. Is there a fair chance, therefore, for a rate hike?
Lata, I don't believe so, because I think what's important is this is a flexible inflation targeting, and we're looking at supply shocks here. If this is a demand shock and you expect inflation to be upwards of 5% for the foreseeable future, there's a compelling case for the central bank to act. But when you've got a supply shock, and possibly two supply shocks here, right? Two adverse supply shocks, an energy shock that we're living through and a potential El Nino shock, both of these could be adverse and could push up headline inflation. But, raising rates is not going to bring crude prices down. It's not going to make El Nino into La Nina. What the central bank needs to look at is, A, how sustained will the supply shock be? And more importantly, is it spilling over into a more generalized, entrenched inflation? And the best way to assess that is to look at how core inflation evolves, right? So I think what the central bank is going to look carefully is, if A, do these shocks pan out for months to come? B, do they translate into core inflation? C, do they unanchor inflation expectations? And then there is a case for central banks to act. Remember, back in 2015, we had a pretty severe El Nino. But for a variety of reasons, we had strong buffer stocks, initial conditions were favorable. That did not translate into the kind of broad-based inflation we had feared. And I think similarly, starting points here allow the central bank to be patient. Buffer stocks are high, reservoir levels are normal. And more importantly, we come into the shock with very benign inflation. Core inflation has been running, correctly measured. If you take out precious metals, take out petrol and diesel, is running at 2.2%. That suggests that producers in this environment don't have much pricing power. So even though input prices will surge, it remains to be seen if this gets translated to a broader output price inflation. Therefore, I think the RBI will and should be patient.
Okay, fair enough. Sonal, now let me ask the other question that the markets are asking. Indonesia has raised rates because of the attack on the currency. It's been similarly impacted like India. So is Philippines. They raised rates in April. Whether or not the flexible targeting allows it, theoretically, practically there is a market expectation. Shouldn't the RBI oblige with a rate hike for the sake of the exchange rate as well?
Yeah, Lata, I think, MPC needs to conduct policy based on what is effective. In Indonesia's case, FX stability is part of the BIS mandate, but, the surprise 50 basis point hike actually did not help stabilize the IDR. And in Philippines, inflation is running above 7%. So compared to the upper bound of 4%. So the inflation picture in Philippines is very different to India. So we need to look at our own scenario. I think using the interest rate to defend the currency is inadvised for actually a number of reasons. First, we've spent more than a decade trying to anchor expectations in terms of the inflation targeting regime and what the monetary policy framework is about. The moment we start targeting FX to manage using rates, I think that essentially undoes a lot of the hard work that has been done to anchor expectations. Second, interest rate hikes to defend the currency are not effective, as seen in the case of Indonesia and also as seen in India's case back in 2013. And third, we need to do a cost-benefit analysis. The cost of doing a very aggressive rate hike in order to curb demand vis-a-vis, the benefit, we will end up in a situation where the growth damage is so substantial that we'll start worrying about the fiscal side and other consequences of weaker growth rather than on the balance of payment situation. And, as we've discussed in the past, India does get a lot more of growth capital. And finally, I think we have, a number of non-monetary measures on the current account, on the capital account, on the macroprudential toolkit that can be used to manage the currency. So I think, the market argument of using the interest rate to defend the currency, I think both from the currency side as well as from the inflation side, it is not essential and not needed in my view.
Okay, I'm going to bounce the same thing to Samiran as well, because there is a lot of voices in the market which believe that the optics are that the Reserve Bank may be falling behind the curve. Both on inflation, but even on interest rates, the defense is being asked for by some quarters. Samiran.
Yeah, thanks, Lata. I guess Sajid and Sonal have very eloquently argued in favor of the view that why RBI can delay any rate hikes at this point of time. And it's also our view that that's probably likely in the June policy that RBI defers it. But it's interesting that there could be another way to play this also. First, we have to understand that the December rate cut actually did not have any intended effect on the transmission. So in our view, probably another 25, 50 basis point hike from here is simply normalization because we probably cut too much in the cutting cycle at that point of time. So it just creates a little bit buffer for RBI to work with. The second issue is that we all are forecasting that inflation in the latter part of the year is definitely going to go up. By how much, we probably don't know for sure. But that increasing trend of inflation, again, it's possible that the MPC decides to create a buffer now so that they don't have to scramble too much at the latter part of the year when there's a sudden spike in inflation, partly simply because of base effects. And the last point, which you also mentioned, which is about this whole perception about falling behind the curve. And there is a risk that if the markets feel that the RBI is falling behind the curve, then the exit route or the valve that the markets will try to play it through is likely the currency. And that's where the fear is that if RBI is seen not to be doing anything, then is that going to be some sort of an additional risk that the market will try to price in on the currency front? So we remain with the baseline view that probably not a hike in June, more likely in August, because RBI wants to give some guidance generally to the markets. But having said that, there is a we will not be surprised, at least, if the hike is advanced to June itself.
Okay, so the governor has, elbow room on both sides. Soumyakanti, actually the bigger thing that the market is waiting for is what's the package for the rupee? If not rates, what? What do you think? They just have to sound, the optics have to be pro-rupee. What will they announce?
Yeah, thank you, Lata. I think there are a couple of options on the RBI before the table. And in my sense, I think given the rapid and the unprecedented depreciation in the value of the rupee, which is, I think, has somehow been significantly higher compared to any other currencies, I think possibly and addressing the issue becomes more important at this point of time. There are various options. I think the first options, all the other members have already debated, an interest rate hike. I am of the view that a policy rate hike may not be appropriate for this currency, the currency, because of the simple reason is that the more you try to hike the currency, the more the market will believe that the rupee could actually, it is being done to protect the rupee. And better way is basically to work on regulatory to other measures. For example, measures which attempt to address the market microstructure, which raises the short-term rates and lowers the long-term rates, like Operation Twist, or even widening the corridor for a limited period, which was done in 2013. So that could be one of the options. Regarding the second option on the balance of payment, I think there are a couple of options, but the options are on an FCNRB window, like which we did in 2013, or even raising bonds at this point of time, would be a little defeatist because the cost of such mobilization could be in double digits. And I don't think at this point of time, for example, even if they give the options of an FCNRB deposit mobilization, the end use of that funds with an 10% upwards, I think nobody is going to willing to borrow. So it's an avalanche of liquidity in the system.
Okay.
Apart from this, there could be issues like capital controls. There could be also controls on the repatriation of funds from the NRI deposits. There could be some simplification of the tax structure on the portfolio outflows. And there could be also some measures which tries to addresses the LRS.
I take your point, Soumya, but much of this falls in the remit of the government. Not all of them fall like taxes or capital controls. Dr. Sen, as Sabinan also said, they first like to guide and then hike. What should the RBI's message be? Because this policy, more than any, is going to be a matter of optics. How should they sound?
Well, the point is that we are in a situation where the government or the RBI should make no effort at all into downplaying the seriousness of what we are facing. And the RBI needs to talk about it. I mean, it's not that people are insensitive, but the conditions that we are facing are really quite serious because, everybody's talked about the supply side shock, which is absolutely true, but there's a demand shock that's going on as well simultaneously. And so that puts us on a really serious tightrope walk at the moment. And this is something that the RBI has to make very clear, saying that things are in the process of development. We will watch and take appropriate action when the time is right.
Okay.
But a full description of the situation that we are facing upfront and clearly is what the RBI should be doing. And I agree with everybody else that this is a time to actually give them not necessarily a guidance, but at least give them the likely scenario that the RBI is visualizing.
Fair point.
Guidance may come, but it's not absolutely necessary. But people need to know where RBI stands, how RBI is analyzing the situation, and what its take is on the likely future.
Fair point. No pussyfooting on the difficult issues
No
is what you're saying.
at all.
Absolutely, point taken. Actually, I want more of your views on what is in the what are the options available for RBI, and more on whether of the dangers of falling behind. Considering that growth is resilient, why not now? I want to ponder those questions more, but we have to take the first vote. So, gentlemen and Sonal, be ready. First question: what will RBI do on June 5th? I've more or less guessed, but Sonal, you go first.
On hold.
On hold on repo rate. Okay. Samiran, what will they do to the repo rate?
Hold.
Soumya?
Hold.
Sajid?
Hold.
Okay. Chairman, your role is easy. Would you agree?
Hold.
Yes, you sounded that way. Okay, it's a universal hold or unanimous hold. Let's see if the next question throws up a difference. Sonal, how many rate hikes do you think in this year, FY27?
None, and can't say right now.
Okay, can't say. Samiran?
We're penciled in 50 basis points.
Okay, 2 hikes. Soumya?
Can't say at this point.
Okay, playing it safe. Sajid?
As of now, none. I think
None.
uncertainty, but as of now, none.
Okay, this is a divided house. Dr. Sen, what would you say?
It's difficult to say, but at least one will have to come sooner or later.
Okay, that's a divided house on how many rate hikes in FY27. But I want to dig deeper into how many steps are available, options are available to shore up the rupee. Those questions coming up after the break. Well, welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC TV 18. I've been speaking with Chairman of our committee, Dr. Pranab Sen, and members Sonal Verma, Sajid Chinoy, Shaumika Ghosh, and Sajid Chinoy. Gentlemen and Sonal, thanks for your patience. Okay, now a little more on the issues we already discussed. What we didn't discuss was liquidity. Shaumya, there are times when the collateral, the CBLO market or the tripartite repo has gone even below 5%. Right now, call is a little above 5.25 at 5.3. But this looks like hardly in sync with a country that is running towards 5% inflation. What are you expecting on the liquidity front?
Liquidity front, I think the Reserve Bank would like to try to play it safe. I think recently they have just done a buy-sell swap. So it has to maintain a delicate balance of ensuring that the long-term rates doesn't go significantly higher, which is already at 7%. And given the borrowing program which the government and the states are running, I think to bring it below 7% will be a tad difficult. So from that perspective, I think the liquidity management has to be modulated a little bit at this point of time. So may not be aggressive OMO purchases which the central bank has done in the last year or so, injecting around 10 billion into the system, but some amount of modulation of the liquidity. But the point which I emphasized in the beginning, that the central bank needs to do some micro management measures. It needs to attend the market microstructure in terms of controlling the rates. For this, ensuring liquidity that is a little bit at the shorter end of the market should be a little squeezed, and at the long end of the market it should be more flexible, so that the overall term structure of the interest rate remains benign and not significantly increases at the cost, and which could actually hurt the cost of growth and borrowing at future.
No, to be fair, they don't usually speak too much about liquidity in the policy these days. They do say that it's delinked with their policy itself. But Samiran, you had a big report on the steps that Reserve Bank can take. Soumya narrated some of them. Much of them fell on the government's lap. What do you think of RBI can do? This is going to be the much-watched space.
So there are two broad approaches. The one approach is that we are likely to have a BOP gap this year. We are expecting it to be as large as $50 billion. So the RBI can consider a large bazooka step to fill up that hole in the BOP. That's one approach.
How?
I'll come to it. But the second approach is to say that it's too early to go big and bold, because that can create some sense of panic in the system, also that we are getting into some sort of a crisis mode. So we go the other way in saying that in comparison of last 2 years BOP deficit of only $34 billion, the extent of rupee depreciation has been just too much. So some adjustments in administrative measures can affect the hedging / speculative behavior in the market, and to that extent can also have some control on the currency. So this has to be in two parts. RBI has to decide which one they want to sequence earlier. If we go by the first one, in our view, the best method is right now to allow the banks and financial institutions to issue dollar bonds abroad and swap them through a concessional facility and convert into INR. That kind of kills two birds with one stone. You address the USD INR problem as well as you address the credit spread problem. And on the side of trying to tweak with administrative measures to change hedging perception, one of the things could be you can have an asymmetric measure to increase the hedging cost for importers / FPIs. And second is that you could have some measures through which you can fast track the exporter hedging, which currently is very deferred. So these are the two broad approaches. The sequencing of it is a very difficult policy dilemma for RBI, because the first one is a more permanent solution. The second one is a more band-aid solution. But the first one creates sense of panic, whereas the second one, you can do it in a very quiet way.
Okay, fair enough. It's just that ECBs, even if all the banks were to raise, it doesn't, for me, it doesn't add up to 40-50 billion. But I could be wrong. It could still be an incremental positive step. Sajid, I want to pick your brains on this. What are the FPIs saying? Are they okay? They don't see comparing India with Philippines and Indonesia and seeing us as behind the curve. And more importantly, you ask a trader, they do tell you that when interest rates near-term, one-day money or money market rates are higher, the rupee premium goes up. It is attractive to stay in rupees rather than in dollars. To say that interest rate is completely unrelated is not something many treasury guys buy.
There are two different questions, both good questions. So let's take them. I think the situation in Indonesia and Philippines is very different. Philippines saw a huge spike both in headline inflation and core inflation, because there was a much larger increase in retail prices in that country, and B, it's a larger weight in the CPI. So the central bank, given what their mandate was, had to respond. Right?
Okay.
That's a very different situation from where India is, where you've seen a less pass-through, core inflation is lower, and even forecasting out, the RBI's inflation forecast is below the upper end of that band. So it's a very different situation.
Okay.
In the case of Indonesia, as Sonal mentioned, it's one where the mandate is, currency stability. India's mandate is not currency stability. Now, interest rates do matter for currencies. There's no doubt about that. But the question is that if you were to meaningfully want to change currency expectations, 25 basis points will not do it.
Okay.
You will need to move 100, 150 basis points. And I think this is where one has to understand that the situation is very different from 2013. In past episodes, whenever the rupee's been under pressure, it's been typically the current account widens sharply, and then capital flows are not enough to finance that. Yeah. And so you rely on some rupee depreciation. If that doesn't work, then you do expenditure compression. You tighten fiscal policy, you tighten monetary policy. This BOP situation is very different. The current account deficit over the last year, 25 calendar year, has been 0.5% of GDP.
Yeah.
Core inflation is running at 3%, and we're still awaiting a capex cycle.
Yeah.
So even though headline growth may be healthy, we have to be very clear here that this is very different from 2013. Expenditure compression, fiscal and monetary tightening need to be a last resort. We should start with the rupee being the shock absorber, A. B, if that leads to expectations getting unanchored, I agree with Shaumaran, you require a circuit breaker in terms of capital flows to prevent this hedging behavior. And expenditure compression, I think, should be a last resort given these circumstances.
I'm sorry I'm rushing you because you're running out of time. Sonal, you have to keep it brief. How should the stance change, if it should?
Yeah, Lata, I think the stance should stay neutral. The challenge with changing the stance towards tightening is it gives a clear signal for markets that we are going to more likely than not hike rates in August. And given the uncertainty on whether this is morphing into a demand shock, uncertainty on how the deal and oil price plays out, I think better to keep the stance at neutral. But guide that policy is going to be agile, data dependent, and will ensure that inflation stays anchored to 4% over the medium term, and clearly specify the parameters that MPC will be watching to decide what will trigger a rate action.
Okay. Well, Dr. Sen, again, you'll have to keep it brief, sir. But, growth numbers so far are very good. Auto sales are really decent, if one is looking at it as a measure of demand. And also, there is a likelihood of inflation also because of the El Nino situation. So really, why are you guys resisting a rate hike, ahead of the curve rate hike?
Well, the main reason I think we are resisting it, and all of us are resisting it,
yes,
is the fact that if you give a rate hike today, you are giving the impression that all is well in terms of our growth trajectory.
Okay.
And that is in fact not true. If you look at what has been happening to investments, it's been a fairly sad story for a fairly extended period of time. We are living off past capital.
Okay.
And nobody should be under any illusion that we are on a high growth trajectory for the foreseeable future. We are not.
Okay.
At some point, the question is going to arise. And by the way, the government's done a lot to revive investment. None of that has had much impact. We are going to have to start focusing on domestic demand, on domestic investment, on capacity creation. And this is not the time to upset that particular apple cart.
Got that.
So I would be very, very cautious because we are not in as sweet a situation as people believe we are.
Fair enough. I was under the impression that growth is more resilient. I take your cautionary words. I'm trying to squeeze in a last vote because it's nagging me and many in the market. Should the Reserve Bank use rates, interest rates, to control inflation? By which I mean policy rates to control exchange rate. Sonal?
No.
No, not use. Samiran?
No.
Okay. Shaumyo?
Not the policy rate.
Okay. Yeah, I got that. You wanted other rates. Sajid?
No.
I'm not surprised. You are the one of the authors of the flexible inflation targeting. Dr. Sen, would you?
No.
Okay. So clearly, I see my small voice within me is a minority. Do not use interest rates to control the exchange rate. That's the word from the Citizens Monetary Policy Committee. Thank you very much, gentlemen and Sonal, for a very, very erudite and enlightening conversation. That's it on this discussion of the Citizens MPC. The Reserve Bank and its MPC will be announcing its policy when there is much to worry about the fall of the rupee and possible rise in inflation. However, growth looks resilient. As always, the CNBC TV 18 Citizens Monetary Policy Committee is here with me to discuss what the RBI may and should do in its June 5th policy. Let me welcome Chairman of our committee, Pranab Sen, and members Sajid Chinoy, Samiran Chakraborty, Shaumika Ghosh, and Sonal Verma. Sonal and gentlemen, thank you very much indeed for your time. Sajid, may I start with you? Well, inflation is the mandate of the Reserve Bank, and chances are it is going to be pushed up. If you go by their MPR announced in April, they said if there is an average of $95 crude for the current year, then the current year inflation gets bumped up to 5%. For a 5% inflation, a 5-quarter repo looks less. Is there a fair chance, therefore, for a rate hike?
Lata, I don't believe so, because I think what's important is this is a flexible inflation targeting, and we're looking at supply shocks here. If this is a demand shock and you expect inflation to be upwards of 5% for the foreseeable future, there's a compelling case for the central bank to act. But when you've got a supply shock, and possibly two supply shocks here, right? Two adverse supply shocks, an energy shock that we're living through and a potential El Nino shock. Both of these could be adverse and could push up headline inflation. But, you know, raising rates is not going to bring crude prices down. It's not going to make El Nino into La Nina. What the central bank needs to look at is, A, how sustained will the supply shock be? And more importantly, is it spilling over into a more generalized, entrenched inflation? And the best way to assess that is to look at how core inflation evolves, right? So I think what the central bank is going to look carefully is, if A, do these shocks pan out for months to come? B, do they translate into core inflation? C, do they unanchor inflation expectations? And then there is a case for central banks to act. Remember, back in 2015, we had a pretty severe El Nino. But for a variety of reasons, we had strong buffer stocks, initial conditions were favorable. That did not translate into the kind of broad-based inflation we had feared. And I think similarly, starting points here allow the central bank to be patient. Buffer stocks are high, reservoir levels are normal. And more importantly, we come into the shock with very benign inflation. Core inflation has been running, correctly measured. If you take out precious metals, take out petrol and diesel, is running at 2.2%. That suggests that producers in this environment don't have much pricing power. So even though input prices will surge, it remains to be seen if this gets translated to a broader output price inflation. Therefore, I think the RBI will and should be patient.
Okay, fair enough. Sonal, now let me ask the other question that the markets are asking. Indonesia has raised rates because of the attack on the currency. It's been similarly impacted like India. So is Philippines. They raised rates in April. Whether or not the flexible targeting allows it, theoretically, practically there is a market expectation. Shouldn't the RBI oblige with a rate hike for the sake of the exchange rate as well?
Yeah, Lata, I think, MPC needs to conduct policy based on what is effective.